Namaste, Namaskara, Vanakkam. If you think income tax is so vast, how will I revise my whole income tax in just a limited time which I have available on my hand for the coming attempt? I want to revise income tax multiple times in a short period of time. How to do that? Then guys, this marathon video is going to be a game changer in your income tax preparation. In just a very limited time, I have covered every chapter. I have not even left a single topic, guys. Every topic is covered in this marathon video, and this marathon video is equally applicable for both CA Inter and CMA Inter students. This income tax marathon, if you are a CA Inter student, it is equally applicable for May 26, September 26 and Jan 2027 attempt. And if you are a CMA Inter student, you can refer for June 26 and December 26 examinations. Guys, mind you, this marathon video I am doing it in two parts, part 1 and part 2. Part 1 itself, if you properly cover, guys, 40 marks laddu in your pocket out of 50 marks. Part 1 itself will give you 40 marks, guys. Trust me, if you do this marathon properly with a lot of patience, 3 times you do it, guys, properly. 2 to 3 times if you do it properly, income tax headache will just go off like this. In the latest attempt results, lot of students have cleared through the income tax content which I provided in the last attempt, guys. So in part 1, I will be providing basic concepts: residential status, house property, PGBP, capital gain, TDS, TCS, set off and carry forward of losses, salary, written off income. All these are covered in part 1, and the rest of topics, IFOS, clubbing, advance tax, deductions are covered from part 2. So do it very, very diligently. With the proper patience and hard work you have to put in, guys. Just by doing marathon, you cannot expect that you will clear your examination. But if you are looking for one Brahmastra through which you want to cover income tax multiple times in short period of time, in that case, this is going to be helpful. But if you do not have conceptual clarity, you have to go for either regular course or a practice batch, guys. This marathon video is just to revise the concepts. Here, if you are a fresh student, this video is not applicable to you. The book which I have used in this marathon video is actually Thailava notes which I have used. Thailava question bank is also available. If you want, you can download that also. And Thailava handwritten notes also I have used at multiple places. If you want to download Thailava notes, Thailava question bank, you can just go to my website www.taxthailava.com. Here on this website, you will find under books if you go, or under free resources if you go, you will find the free PDF, or if you go under books, this hard copy book you can place order and it will be delivered at your doorstep. Now coming to the Thailava handwritten notes. Guys, these are the handwritten notes which I used in my regular course recently which I recorded. If you want a beautiful summary of with a lot of examples of the whole income tax syllabus, this Thailava handwritten notes, you can actually buy it from the website itself. So you can refer www.taxthailava.com for that. And if you want a combo income tax and GST, or you want accounts, law, like that group 1 full all subjects you want, or you want group 2 also like this, you want combos, in that case you can definitely visit www.caclassroom.com, owned by Mr. Karthik Manikonda sir. So we have officially collaborated. If you want to purchase group 1, group 2 or income tax GST combo like that, you have multiple options like Amit Mahajan sir is there, then Lijil Lakshman sir is there, like this many options are there. You can definitely create a combo and purchase from them. That's all, guys. Enjoy the marathon. All the very best. And I am damn sure from the work which I have put in, guys, you just watch the marathon, you will get the confidence. So you go, enjoy the marathon, and all the very best for your examination. This is not just the content which is coming for your examination. Lot of amazing content is awaiting and it is there in the pipeline. You will be seeing all that content in very soon before your examination. All the very best. Namaste, Namaskara, Vanakkam. Enjoy the marathon. Guys, basic concepts is one of the most important chapters in your income tax preparation. The reason is very simple. In every attempt, you will find in your question paper a total income computation question. And tax liability also a lot of times asked. If you do not have knowledge of basic concepts like what are the tax rates which you need to apply, in which cases surcharge will be applicable, in which cases marginal relief will come, or rebate, and a lot of times agriculture income is also separately a question is asked. All these topics we will be discussing in this basic concepts chapter. So it is going to be very important chapter, and amazingly we will cover each and every point. Minute details also we will be covering in this topic, guys. First of all, you need to understand money is very essential for anyone, for you also, for me also. Without money we cannot live. Exactly the same way, Indian government also requires a lot of money to run this country, because Indian government provides, clean roads, big highways, police service, army is protecting us at the border. For all these people, Indian government has to pay salary, no, for the government employees. Now where from the government will get money? They will get essentially from three kinds of sources. The first source is business. You know what, Indian government also does business. Indian Railways, it is owned by Indian government. If you go in train, you have to buy a ticket. That ticket amount, whatever you paid at the counter, will go to Indian government. And the government will utilize that amount for the betterment of the society only. So the first source of income for government is business. The second source is borrowing money. If money is required, a lot of money is required, in that case, Indian government also borrows money from big banks like World Bank. It may borrow money. That is the second source of money for the government. And the third source is taxes, guys. The people who are living in the country, they are only utilizing all these services, no, road service, army service, police service. Then they should also contribute for whatever services they are utilizing in this country. And that's why the government says, from the people of country, we will collect taxes. Tax is nothing but your contribution to the Indian government for the services which you are utilizing. That's all. So generally, government collects two kinds of taxes from the public in India: direct taxes, indirect taxes. First, under direct tax, what happens, sir? Let's say, for example, I am doing this coaching business. I will earn some income. On this income, I will directly pay to the government. Little bit of my income I have to pay tax. I have to compute my tax liability and I have to pay to the government. That is directly the income earning person. Who have earned the income? I am only earning the income. So I will only directly pay the tax to the government. That is called direct tax. So best example for direct tax is income tax. So on my income, whatever business income I'll be earning, on that I have to pay tax to the government. That is called direct tax. Indirect tax. The next one is indirect tax. Indirect tax, what happens? Let's say, for example, you went to one restaurant with your girlfriend to have dinner. So you had dinner. When you will get the invoice, when you will check, you thought 100 rupees is the dinner cost, but actually it is not 100. You see 105 is given in the invoice. You will ask that waiter, hey waiter, why you charged 105? The waiter will tell, sir, 100 rupees is the idli cost, 5 rupees is the tax, sir, which we are collecting from you. So you are the customer. You will pay tax to that hotel fellow. That hotel fellow will collect tax from the public and then deposit with the government. Tax is paid by you only, but it is indirectly paid. You are not directly paying to the government. First, you are paying the GST to the hotel fellow. That hotel will go and deposit the amount with the government. So indirectly, you are paying tax to the government. That is called indirect tax. And the best example for indirect tax is GST, which is goods and service tax. Now you will get a doubt, sir. Who shall pay tax, sir? The government says, the Income Tax Act says, every person should pay tax in this country. Every person, whoever has earned income during the year, has to pay tax on an annual basis. Everyone will pay tax. Now you will get doubt, sir. When you say every person, what do you mean by person, sir? Person, do you mean only persons like you and me, sir? No, guys. So person has been defined under section 2, clause 31, guys. And person includes individual. Individual means whom? This individual, natural person like you and me. We are individuals. And HUF, Hindu Undivided Family. You must have learned in my regular class. I taught you beautifully about HUF. In short, it is called Hindu Undivided Family or HUF. So a family, a Hindu family can actually create one entity, and if they run some business, whatever income they earn, they have to pay tax. So that is a separate entity, HUF it is called. So the family members, the lineal ascendants, descendants, everything has been discussed detail, in the regular class. So that HUF entity is also a person who is required to pay tax to the government. The third kind of a person is a company, guys. You know very well what is a company: private limited company, public company, foreign company, Indian company, domestic company. All these companies also required to pay tax in this country. Then the firm. Firm means what? Partnership firm or a limited liability partnership firm, LLP. All these also required to pay tax. Association of persons or body of individuals. You know what is the difference between a body of individual and association of person? Body of individual means a group of individuals who create a business or creates an entity for a particular purpose. That is called body of individuals. Only individuals can create. Let's say, for example, me and my three friends, we created one entity, BOI, for a particular purpose. That is called body of individuals. Let's say, for example, we thought, okay, we will invest in particular business, or we will do one construction project. Once the construction is over, we will sell all the flats. Whatever profit will come, we will share equally. That is called body of individual. For a particular purpose we are creating. Once the construction of all the flats will happen, once all the flats are sold, the entity will come to an end, because the entity was created just for this project only. That is called body of individuals. But association of person is also similar concept, but just that in association of person, not only individuals, apart from individuals, let's say for example, me and one HUF and one partnership firm or one company, we all get to one create one entity. That is called association of persons. So when we say persons, it can include individual, HUF, AOP, BY, AJP, company, everything. But in body of individuals, only individuals will create an entity. Got it? Next. Then you have local authorities, like you have gram panchayats, municipal committee, everything. And artificial judicial person means any kind of, apart from these persons, any other person will form under AJP. So these are the persons who are required to pay tax to the government. Now you'll get a doubt. Okay, sir, how to compute the tax liability, sir? How will I know, sir, how much tax I have to pay? How to compute my total income and all? That, if you want to understand, you have to have knowledge of components of income tax law. Guys, in syllabus, what you read is not just Income Tax Act. You are actually reading or studying income tax law. When we say law, law has multiple things in it. Number one is Income Tax Act 1961. You know how to find Income Tax Act 1961? Just you have to go on Google. If you go to Google, guys, if you go to Google, just give me a minute. If you go to Google and if you just type www. incometaxindia.gov.in, this kind of home page will open. Just give me a second. I'll show you how to find out the income tax website. This is the income tax website, guys. In income tax website, if you see here, home, about, this and all is there, no, about taxpayers charter, tax laws and rules. If you click on tax laws and rules, the first one you will find Income Tax Act. So if you want to read the bare act, which is written by the Indian government, which is actually the source of the ICA study material, everything, this is the source. You will find here Income Tax Act 1961. For your examination, Income Tax Act 1961 only applicable. Forget about Income Tax Act 2025, that is applicable from May 2027 examinations. Okay, so Income Tax Act 1961, if you click, you will find here many sections. See here, section 1, section 2, section 3, section 4, like the sections are available. Likewise, if I just click on section 2, for example, if I click on section 2, you will find here under section 2, you will find again 1A. Again under 1A, again you will see A, B, like that. So guys, very simple, very simple. The first one which you have to knowledge of Income Tax Act 1961, you must have in order to understand how to compute your tax liability. The first component of income tax law which you have to have knowledge is Income Tax Act 1961. In Income Tax Act, if you open, you will find a lot of sections, subsections, clauses, subclauses, and you will find provisos and explanations as well. Now, what is a proviso, sir? Any condition attached to a particular section. Let's say, for example, additional depreciation. It is not available under the default tax regime. Only under optional tax regime it is available. So they will provided that they'll in a section they will mention provided that if a person is paying tax under optional tax regime, only then additional depreciation is available. So it is a condition which is kept for a particular benefit to be enjoyed by a taxpayer, that is called proviso. And the explanation, lot of times particular term has to be defined, otherwise there will be lot of contradiction. I may think a person can be any person, I may think person is only individual, but Income Tax Act specifically says person means this and this. So if explanation is provided, means nothing but a meaning of a certain term is provided. So guys, in Income Tax Act you will find a lot of sections, subsections, clauses, subclauses, and provisos and explanations. Likewise, you have to have knowledge of income tax rules also. You know, a lot of times in section 32, especially depreciation section. Section 32 says you can claim depreciation. That's all it says. And it says at the rates as may be prescribed. So in section 32, if you open, you will not find the depreciation rates there. Depreciation rates are separately provided as an appendix, as an annexure under Rule 5. So Rule 5 will tell, okay, these are the depreciation rates at which you need to calculate the depreciation. Are you getting it? So income tax rules are a kind of a stepney, or in addition to, or as a support of the Income Tax Act laws, whatever sections are there, for that to support the Income Tax Act, income tax rules are framed. There will be lot of rules in the income tax rules. You should have knowledge of those income tax rules also in order to compute the right tax liability. The third thing which you have to knowledge is Annual Finance Act, or it is simply called as budget. Every year, Finance Minister, you see here, Union Budget 2025. For your examination, Finance Act 2025 is applicable. Now, what is happening in Finance Act, you know? Every year, the Nirmala Sitharamanji, the current Finance Minister of India, comes into the Parliament and present budget. And in budget, in the finance bill, she will present in the Parliament and she will make amendments to the original Income Tax Act 1961 as per the requirements. So for your examination, guys, remember Finance Act 2025 is applicable, and the previous year for your examination is previous year 25-26, and the assessment year which is going to be 26-27. So in this finance bill or in the Annual Finance Act, there will be generally 4 parts, and each part has different kind of information. So just remember like this for examination purpose. In the Annual Finance Act, generally the Finance Minister make amendments to the original Income Tax Act 1961 as per the requirements. Then comes the notifications. So whatever amendments are announced in Parliament, lot of times the effective date of such amendments is taken at a later date, or during the year. If the Income Tax Act has to be amended, then the amendments would be done by way of notification. So Income Tax Department will release, CBDT will release a particular notification, and through a notification, income tax provision can be made. And there are something called as circulars. Circular is generally issued by CBDT to clarify regarding the scope and meaning of certain provisions of Act. Mind you, circulars are bound on the department, but it is not binding on the assessees, guys. So generally circulars are internal circulation, internal notification for the income tax officers. So if CBDT wants to circulate something, wants to inform something to the income tax officers, in that case a circular is issued. The circular is not binding on the assessees, guys. And the last one is legal decisions. Whenever a conflict happens between a taxpayer and the income tax department, it is called as an assessment or a litigation. That litigation is if it is gone to any court, or let's say for example tribunal, then the judgment will come. That is called legal decision of courts or tribunals. That also you need to have knowledge. So very simple guys, if you want to understand how to compute my tax liability, sir, where is it given, sir, which is the source which I have to rely on, in that case you have to rely on the components of income tax law. There are basically 5 kinds of components of income tax law, which you six components of income tax law you have to have knowledge. Now you will get it out, sir, when shall I pay tax, sir? When I have to pay tax, sir? First of all, in order to pay tax, you should first earn your income. So the year in which you will earn income will be called as previous year. Let's say for example, I started my business from 1st of July 2025. Let's say for example, I started my business on 1st July 2025. Now, you must have knowledge of financial year. It starts from 1st April but ends on 31st of March. Correct? Every year it ends like that. But for me, I cannot say my year will start from 1st of April, because on 1st of April, my business itself was not existing. My business itself, I started from 1st of July 2025. So my previous year in which I will earn income will become 31st of March 2026. So this is the year in which I am earning income. This will be called as my previous year 25-26. So my previous year 25-26 started from 1st July till 31st of March 2026. It ended. Sir, what if I am an existing business, sir? In that case, your previous year will start from 1st April 2025 and will end on 31st of March 2026 in case of existing businesses. So whatever incomes you earned during this period from 1st April till 31st of March, you will have to consider that income for the purpose of computation of your tax liability. Sir, when will I pay tax, sir? You will pay tax generally. Let's say, for example, the due date is 31st of July 2026. So what is happening here? First, for the full year, you are earning income. So in this year, you will not pay any kind of taxes. Generally, I am saying exceptions are advanced tax, TDS and all. That is a separate concept. But generally, I am saying for this year, you will first earn income. Once the year will end on 31st of March, you have time from 1st of April till 31st of July 2026. You have time. So from 1st of April 2026 till 31st of July 2026, you have time to compute your tax liability and pay to the income tax department. So April, May, June, July, 4 months time is given by the government after your previous year ended to compute your tax liability and pay the tax to the government. So very simple terms if I have to say. So guys, very simple. Now you see here, whatever income you earned in this previous year, you are paying the tax in the very next year. That is why it is called previous year is the year in which you are earning income, and assessment year is the year in which you are paying tax. Now, technically, if you see this 1st April to 31st of July 26 will fall in which year? 26-27. That will be called as assessment year. So for previous year 25-26, the immediate next year will be called as assessment year in which you pay tax to the government. So previous year 25-26, assessment year 26-27. I hope that is clear. So previous year is the year in which you earn income. Assessment year is the year in which you pay tax. Now, there are two technical terms which you need to understand. Assessee. Assessee means the taxpayer is technically called as assessee under the income tax laws. And assessment is nothing but the assessment means calculation of your tax liability or your taxable income. Next. You know what? There are some special cases in which the government says, we will not wait till the assessment year for you to pay tax. We will collect the tax in the previous year itself in which you earn income. Some special cases. So exception, certain cases when income of previous year will be assessed in the previous year itself. Generally, you will pay tax. First, you will earn income in the previous year, and in the next year, you will pay tax. That is called assessment year. But there are some special cases in which you will earn income in previous year and you will pay tax also in the previous year itself. What are those special cases? Shipping business of a non-resident. Who is a non-resident? Foreign fellow. You can think like that. Let's say, for example, from Sri Lanka, one big ship is coming with full load of goods. Let's say, for example, I imported goods from Sri Lanka. Now, one Sri Lankan ship is there, which is owned by one Sri Lankan person. That ship is getting my goods. It will come to India. It will unload my goods here. What it is doing for free? No. I have to pay charges for the shipping. No. So once I will pay charges, shipping charges to this Sri Lankan ship, it has earned income from India only. No. The Sri Lankan ship fellow earned income from India. No. Shipping charges. So he has to pay tax in the India. The income tax department says that wait. You don't go back to Sri Lanka now only. First you pay tax here for the shipping charges what you earned from India. Then only you leave for Sri Lanka. So in case of shipping business of non-resident, the ship before leaving India has to pay tax on the shipping income which that has earned from India. Person leaving India permanently. Let's say for example, I was born and brought up here in India only. I became chartered accountant. I am getting an amazing offer in Dubai to work in a one big Dubai firm in finance department. Now I got visa, everything. I am permanently leaving India. Then the income tax department says in this year, before leaving India, whatever incomes you earned in India, on that you pay tax and then only you go. Because once you go, we do not know where you are. We can't come and catch you because you earned income in India no during this year. First pay tax and then leave Dubai. AOP or BOI or AJP formed for a particular event or purpose. Just now I told you, body of individuals or association of persons, they may actually create an entity for a particular purpose. Once the purpose is met, the entity will come to an end. Say for example, me and my three friends, we created one body of individual, and the purpose is what we will purchase one land, we will construct 20 flats on that, and we will sell it off. That's all. The purpose of this entity which we created is only this. Let's say for example, the entity name is ABC Enterprise. That's all. We created this only for this project purpose. Once all the flats are sold, whatever profit will come, will equally share. Like that, we have decided. And we will close that entity once the project has come to an end. That is called body of individuals. In that case, the government says if the assessing officer feels that once the BOI has ended its project, in that year only we will collect the taxes. We will not collect the tax in the next year. Say for example, in this year, in the December month itself, December 2025 itself, the project has come to an end, all the flats are sold, everything is done. Now the purpose of BOI is done. There is no more BOI entity. So the government, the income tax department may collect a tax from you in this previous year 25-26 itself. The next one is person likely to transfer property to avoid tax. A lot of times people do a lot of tax planning to avoid tax. And if the assessing officer feels that in order to avoid payment of tax liability, this person is transferring the property, in that case, in the year in which such transfer will happen, the income tax department will collect tax from the taxpayer. Discontinued business. A lot of times you will stop your business, you will close down your business, you will discontinue your business. In that case, government, if the assessing officer is nothing but the tax officer, income tax officer, if the income tax officer feels that we have to collect tax from this person, let's say for example, in this year, in the December 2025, you are shutting down your business, for example. But from 1st April 2025 till 31st of December 2025, you must have earned some income now from the business. So once you shut down the business, immediately the officer may come and collect tax from you. So that may happen if it is a discontinued business. So in these cases, guys, these are the special cases in which you will not pay tax in the assessment year. You will be paying the taxes in the previous year in which you earned income itself. Generally, you are required to pay tax in the assessment year, but these are the special cases. Now you will get a doubt, sir. What are the rates of taxes, sir? How will I calculate my tax liability? How would I know at what rate I have to pay tax? Is the tax rate equal for everyone in the country, yes, sir? No. See, understand one thing. If you are an individual or HUF or AOP or BOI or AJP, I repeat, only in case of individual, HUF, AOP, BOI, AJP. Don't include company, firm, LLP and all here. Only in these kind of people, persons, only in case of these person, individual, HUF, AOP, BOI, AJP, government says what, see, by default, we will give you one tax rates. You are actually required to pay tax or calculate your tax liability using these tax rates only. That is called a default tax regime. By default means the government is saying by default you are required to pay tax under this tax slab rates. But if you wish, option is up to you. If you wish, you can opt out of the default tax regime. Let's say, for example, you want to go to movie. Generally, from many years, your family goes to one particular theater only nearby your home. So, by default, your family routine is you go to that theater only. So, that is by default you have to go. So, if you ask your parents, I am going to movie, so your parents will think, okay, by default they will go to this theater only. But your friends are insisting, acha, we will go to some other theater. Then you are opting out of that theater. Are you getting it? So by default, you are required to go in this theater. But if you don't want to go in this theater, you have to take permission of your father. Father, this theater I am not going. My friends are asking me, we will go to big mall. In that big theater is there, PVR. In that we will go. So you have to take permission. You have to opt out of this theater. Exactly same way, government is saying to all the taxpayers, individual, HUF, AOP, BOI, AJP, that by default you are required to pay tax under default tax regime. But if you wish, you can opt out of default tax regime and can pay tax under the optional tax regime, because the name itself says optional. That is optional, boss. By default, you are required to pay tax under default tax regime. Are you getting it? So first we will see what is that default tax regime under which the government is asking you to pay tax. So mind you, this default tax regime, the tax slab rate is given under section 115 DAC of the Income Tax Act. So if you open Income Tax Act 1961 and if you see 115 BAC section, you will find these tax rates are given. Default tax regime is also called as alternate tax regime. Mind you, in examination, lot of times the question may not say find out the tax liability under default tax regime. The question may use a different language, alternate tax regime. In that case, you have to understand, okay, alternate tax regime means default tax regime. And here the tax rates are given. Very simple, you need not mug up in examination. For every increase of 4 lakh rupees, you will see the tax rates will increase by 5%. Very simple. 0 to 4 lakhs, 0. 4 to 8. Difference you see here, 4 lakhs only everywhere. 4 lakhs only difference. So until 30%, you keep on increasing. For every increase of 4 lakhs, you will see 5% increase in tax rate will happen. Mind you, these tax rates you will apply only on the normal income, not on special income. Now, what is a special income? Special income is an income which are taxed at a special tax rates. Let's say, for example, short-term capital gain, 111A. Remember capital gain chapter? 112, long-term capital gain. On that equity share, equity-oriented mutual fund, units of business trust. Are you getting it? So, those are special incomes. So, 111A short-term capital gain, 112 long-term capital gain, 112A long-term capital gain, 115BB winning income, lottery income, special incomes. So, on the special incomes, we never apply these slab rates because we apply special rates which are given in these sections. So in 111A, separate rate is given 20%. 112A, separate rate is given 12.5%. And all these sections, 30% tax rate is given there. So in these sections, specifically one tax rate is given. So on special incomes, never apply the slab rates. This will apply only on all incomes other than the special income. We call it as normal incomes. And special incomes will be taxable at special rates given in those particular sections. This is a default tax regime. Mind you, this is applicable only in case of individual HUF, AOP, BY, AJP. This default tax regime, optional tax regime, not applicable for companies and all. That is a separate thing. This 115 BSE will not apply in case of company, firm, LLP and all. So, okay, sir, default tax regime, we understood. These are the tax rates, sir. What about optional tax regime, sir? If I have to opt out of default tax regime, what are the tax rates, sir? Optional tax regime. Person has opted out of default tax regime, like this language they will use in examination. Be very, very careful. This language you have to read and go for examination. Because a lot of time in examination, they will directly they will not tell compute the tax under optional tax regime. The question may say a person has opted out of default tax regime, then you have to understand, okay, they are asking me to compute the tax under optional tax regime. Person has exercised the option of shifting out of default tax regime. Optional tax regime is also called as regular tax regime, or they will also tell in examination a lot of times compute tax as per the normal tax rates. Normal tax rates means you will apply the optional tax regime, mind you. But here is a twist. In this case, there are three kinds of slab rates given under optional tax regime. Mind you, under default tax regime, we had only one slab rate. But under optional tax regime, we have three kinds of scenarios. Scenario 1. If you are individual HUF, AOP, BY, AJP, whether you are a resident or non-resident does not matter. Generally. And if you are shifting out of default tax regime, then your slab rate will be this 0 to 2.50, 2.5 to 5%, 5 to 10, 20%, and about 10 lakhs, 30%. But mind you, if you are only individual and you are a senior citizen and that too you are a resident individual, in that case, you cannot apply this slab rate. You will apply this slab rate where the higher basic exemption limit you will enjoy. See here, the basic exemption limit, in short, it is called BEL, equals to 2,50,000 rupees. Whereas here, the basic exemption limit is 3 lakh rupees. Means, if you are not a senior citizen, let's say for example me, my age is what? 30, for example. Am I a senior citizen? No. Then I will compute my tax liability using this slab rate. So for me, up to 2,50,000 of income, no tax. But look at senior citizen, up to 3 lakhs of income, the senior citizen is not required to pay any tax. So is it a higher basic exemption limit or not? Yes. So this is kind of a benefit given by the Indian government to the senior citizens. So generally, a benefit is given to senior citizens only. No, if you go in bus, The senior citizen will come like that. Hey, sit. Stand. I want to sit here. I am a senior citizen. You should give preference to me. Like that. Government is giving preference to senior citizens. That if you are a senior citizen, in that case, you're not required to pay tax up to 3 lakhs of income. But if I am not a senior citizen, young person, in that case, you are not required to pay tax only up to 2,50,000 only. But mind you, this senior citizen should be resident. If you're a non-resident senior citizen earning any income in India, then this slab rate you will not apply. You will apply this slab rate only. I hope that is clear. Say for example, you are a non-resident. Age is 65 years. In that case, you will not apply the slab rate because you cannot say, sir, my age is 65. Boss, your age is 65, but you are a non-resident individual. So we will not apply this slab rate. We will apply this slab rate only. And for super senior citizen, who is a resident individual in India and who is a super senior citizen, sir, age of 80 years or more, in that case, much more higher basic exemption limit of 5 lakhs is given. Basic exemption limit of a super senior citizen is 5 lakh rupees. So the government is saying very simple. Mind you, if you pay tax under default tax regime, you are a resident, you are a non-resident, you are a senior citizen, you are a non-senior citizen, does not matter. In all cases, the tax slab rates are same here. But mind you, only under the optional tax regime, depending on whether you are a resident, whether you are a senior citizen, whether you are a not senior citizen, depending on that, it will be decided what will be your basic exemption limit and what will be your tax slab rate. Mind you, again the same thing here also, the slab rates we will apply only on normal income because special incomes like 112, 1128, 111A and all will be taxed at special tax rates only. One more thing, one small point I would like to highlight here. Generally, let's say for example, 1st April is your birthday. When do we celebrate birthday? On 1st April only. We think that we have turned 60, we have turned 58, we have turned 32, like that we celebrate on 1st of April. But the government says, government is giving you one benefit. If your birthday falls on 1st of April and your birthday means on 1st of April, you are turning either 60 or 80, it will be deemed or imagined that on 31st of March itself you turned 60, means in one previous year itself you can enjoy the benefit of higher basic exemption limit. So if your 60th or 80th birthday falls on 1st of April, technically you will apply the higher basic exemption limit in previous year 26-27. But the government says, okay, even if you turned on 1st of April 2026, I will treat that you have actually turned 60 or 80 years on 31st of March itself. Means in previous year 25-26 itself, we will think that, we will imagine, I'll give you that benefit that you turned 60 or 80 on 31st of March itself. So from previous year 25-26 itself, you start taking the higher basic exemption limit. Now you will get one doubt, sir, how do we decide? How the taxpayer will decide, sir, whether he has to pay tax under the default tax regime by default or he has to shift out of default tax regime? How we will decide, sir? That decision will happen based on the computation of tax liability under both the tax regimes. Are you getting it? By default, I am required to pay tax under default tax regime. But if I wish, I will opt out of default tax regime and pay tax under optional tax regime. But I have to decide. How will I decide? You will compute the tax liability under the default tax regime. You will calculate the tax liability under the optional tax regime. Of course, under whichever option the tax liability is the least, that I will treat it as my optional that I will treat it as my tax regime which I want to pay tax. Mind you, very, very important point. One important point I would like to highlight here. Under optional tax regime, generally the tax rates are higher for lower income itself. See here, for income of just 5 lakhs to 10 lakhs, you will see tax rate of 20% is coming, for example. I repeat, for income of 5 lakhs to 10 lakhs, 20% tax rate is coming. But if you come here, 5 lakhs to 10 lakhs, if you see here, 5 lakhs to 10 lakhs means the income will fall here. The tax rate is lower. See, I repeat, if you are having income of 5 to 10 lakhs, let's say for example, your income is 8 lakhs, for example. If your income is 8 lakhs, under optional tax regime, you are required to pay tax at 20%. But if your same income under 8 lakhs, you will pay tax at 5% only. Then you will get a doubt, sir. If here tax rate is less and here if tax rate is higher, everyone will pay tax under default tax regime only, no sir. Why would they go and opt out of default tax regime and they pay tax under 20%? Why they will pay tax, sir? Because under optional tax regime, you will enjoy lot of benefits of exemptions, deductions like that. But under default tax regime, tax rates are less, but you will not enjoy benefit of deductions, exemptions, many provisions you will not be able to enjoy. So under default tax regime, that's why I have written here, you see concessional tax rates. Concessional means low tax rates. So under default tax regime, the tax rates are less, but you are not able to enjoy the benefits of exemption deductions. Under optional tax regime, tax rates are higher, but they are giving you the benefit of deductions and exemptions. No, are you getting it? So based on that, you will decide based on your calculation of ultimate tax liability under both optional tax regime and default tax regime. You will have to decide which is more beneficial for you. Sir, what are those benefits which I will not be enjoying if I pay tax under default tax regime, sir? Yes? Yeah. So, conditions to be satisfied while computing total income, following deductions exemption would not be allowed under default tax regime, mind you. See here, exemptions or deductions not allowable under default tax regime. But the same deductions allowable under optional tax regime. Deduction or exemption is a benefit. So, if you want to pay tax under low tax rates, forget about exemption deductions. If you want to pay tax under higher tax rates, then you will also enjoy the benefit of exemptions and deductions. The number one benefit is under income from house property, if you remember. If you have a self-occupied property, under optional tax regime, you get interest deduction up to 2 lakh rupees, if you remember. But that enjoy of that deduction of interest deduction you will not get under default tax regime. So interest on loan for a self-occupied property is not allowed under default tax regime. So in this table, whatever I will discuss is those exemptions and deductions which are not allowable under default tax regime. The next one is income from a house property loss cannot be set off with any other head of income and no carry forward of loss also. So under default tax regime, if you are paying tax and if you have loss from house property, you cannot set off with other head of income, and whatever loss is pending in your hand, you cannot even carry forward to the next year. And under salary head of income, you cannot claim the deductions under entertainment allowance deduction, profession tax deduction, leave travel concession exemption you cannot claim, house rent allowance exemption, you remember that 4 things we compared, that you cannot claim, and special allowances exemption also you cannot claim. But in special allowances, 4 kind of allowances you will be eligible to claim even under default tax regime. That is transport allowance for deaf, dumb people, transfer allowance or travel allowance, daily allowance and conveyance allowance. These 4 allowances you will be able to enjoy under default tax regime. But apart from this, whatever allowances I have mentioned here or deductions, you will not enjoy under default tax regime. And under income from other sources, If you remember, allowance to MLA MP is exempt under optional tax regime, but it will not be exempt under default tax regime. And remember, in clubbing chapter, I taught you one concept. Whenever a minor's income is clubbed in a parent's hands, parent can enjoy exemption up to 1500 rupees, I told you. But mind you, that is available only under optional tax regime. Under default tax regime, you cannot enjoy that benefit. And under PGBP, we discussed SEZ, deduction under section 10AA. Then 32(1)(a) additional depreciation. Then contribution to scientific research, institutions. You will get section 35. Remember that. And section 35 AD, if you do capital expenditure on particular things in particular businesses, in that you will get deduction under section 35 AD. All these four things you have to forget. You will not get under default tax regime. Only under optional tax regime you will enjoy those things. What are the four things under PGBP? Number one, 10AA SEZ deduction you will not get. 32(1)(a) additional depreciation you will not get. 35 contribution to outside institutions and approved colleges, universities, you will not get that deduction benefit. And 35 AD specified business deduction also you will not get. And mind you, chapter 6A deductions, once you compute all your gross total income, at the end you take the chapter 6A deductions. Those chapter 6A deductions you cannot claim if you pay tax under default tax regime. But mind you, you have totally deductions from 80C till 80U, 80C, 80C, CDC, CC, 80D, 80E, 80EA, like this. Many sections are there. Out of these sections, government income tax department says only 3 deductions I will give if you pay tax under default tax regime. But if you pay tax under optional tax regime, all deductions I'll give you. But under default tax regime, only 80CCD2, 80CCH2, 80JJAA only we will give you as deduction. Apart from that, all deductions you forget. You will not get under default tax regime. So very simple. If you pay tax under default tax regime, these benefits you will not enjoy. Next, adjustment of loss. Just now I told you guys, whatever here things are not allowed. In respect of these, if you have any losses, those losses also will not be carried forward and set off. Now you will get a doubt, sir. This year, let's say for example, I am paying tax under default tax regime, sir. Next year, I want to pay tax under optional tax regime, sir. And next year, I want to pay tax under default tax regime. Like this, can I switch from one regime to other regime every year, sir? My wish, sir. That will depend on what kind of income you have. Let's say, for example, if you do not have any business income, I repeat, if you do not have business income, there are 5 heads of income. If in this year, in this previous year, apart from PGBP income, you may have any income. You may have salary income. You may have income from house property. You may have capital gains. You may have other sources. But you should not have business income. In that case, you can switch between both the tax regimes any number of times, no restrictions. So let's say, for example, I do not have any business income. In that case, this year I may pay tax under default tax regime. Next year I may pay tax under optional tax regime. The next year I may switch to DTR. Then again OTR. My wish. But if I have business income, by default I am required to pay tax under default tax regime only. I repeat, if I have PGBP head of income in this year, I am by default required to pay tax under the default tax regime only. But the income tax department says you can, I'll write here, see here, I'll write here, first you are required to pay tax under default tax regime only if you have PGBP income. But you can shift out of default tax regime and can pay tax under optional tax regime. Say for example, this year I want to opt out of default tax regime and pay tax under optional tax regime, for example. You can do so. If you have a business income, you can do so, no problem. But mind you, once you go to optional tax regime, only one time you can come back to default tax regime. Let's say for example, this is year 1, this is year 2, this is year 3. First year, I am paying tax under default tax regime. I have a business income. Now, year 2, I want to pay tax under optional tax regime. Is it possible, sir? Yes, possible. Possible, no problem. Now, year 3, I want to pay tax under default tax regime, sir. Yes, it is also possible. But mind you, year 4, 5, 6, 4, 5, 6, 7. In all these future years, you can never pay tax under optional tax regime. You will always be required to pay tax under default tax regime only. Means very simple. If you do not have business income, I can change any year, any tax regime, I can pay tax. But if I have business income, by default, I am required to pay tax under default tax regime only. But one chance the government will give you to switch out of default tax regime. Only one chance. So let's say for example, so you switched from default tax regime to optional tax regime in the next year. Okay, no problem. You continue paying tax under optional tax regime. But you want to come back to default tax regime, you can come back. But you will be only one time you will be able to come back. Then in lifelong, you will not be able to enjoy optional tax regime. I'll take one more example here. Let's say for example, year 2 you pay tax under optional tax regime. Year 3 also you pay tax under optional tax regime. Year 4 also you pay tax under optional tax regime. So here I'll write optional tax regime. But in year 5 you want to come out of optional tax regime and pay tax under default tax regime. You can come out. But mind you, in all these future years, you will never enjoy optional tax regime. So once you opt out, either continue optional tax regime only. But you can come back. Only one time you can come back. Then again not. Are you getting it? Yes. Next. AMT liability also not attracted under default tax regime. You know, alternate minimum tax which I taught you, under optional tax regime, under default tax regime, AMT is not applicable. Guys, I have given some Thailava tips at multiple places. In the PDF you will find it. Go and check them out. You can directly read it. I have given some practical tips I have given you, which you have to self-study, you have to do. So, whatever I have discussed so far is only from the standpoint of individual HUF, AOP, BY, AJP. Now we will look at the tax rates of firm, LLP, company, cooperative society and local authority. Mind you, for firm, LLP, local authority, the tax rate is 30%. Domestic company, if the turnover in the previous year 23-24, if it is up to 400 crores, then the tax rate is 25%. And if the turnover in previous year 23-24 of the domestic company, if it is more than 400 crores, the tax rates will be 30% for the company. And for foreign company, the tax rate is 35%. And for cooperative society, up to 10,000 of income, 10%. And this is a slab rate given up to 10,000 to 20,000, 20%. Above 20,000, it is going to be 30%. Now, I am going to teach you something called as surcharge. Guys, remember one point. Your total tax liability will have three components. One is called basic tax, the other is called surcharge, and the other is called as health and education cess. You will add all these three and you will tell that this is your total tax liability. So first you will calculate basic tax using the slab rates which I taught you. Then on that basic tax you will have to add surcharge, and on the sum of both basic tax plus surcharge you will calculate health and education cess. But mind you one point, surcharge is not applicable in all cases. Surcharge is applicable only in case of special cases. Who will call sir? Let's say for example, you go to one 5-star hotel. Full suit to boot, nicely you will go. One person will be standing at the door and he will open the door. Sir, good morning sir, welcome sir, he will welcome. Let's say for example, the same person, he will go in one beggar attire. Full old dress with bad smell, he will go. That person at the door, the watchman will throw you out because you have not earned income, more income. So surcharge, sir means person who has earned more than 50 lakhs of income will be called as sir, come sir, like that. Rich person tax it is. So poor person will be only paying basic tax plus cess. But from rich person, if rich person means he has a lot of money, so government thinks, okay, from rich people we will collect more taxes, and that's why additional surcharge is also levied on rich people who are having income of more than 50 lakhs in a year. So total tax liability is nothing but your basic tax plus surcharge plus cess. Mind you, you always calculate cess on sum of basic tax plus surcharge. On both you will add and you will calculate the cess. Sir, if there is no surcharge, sir, then very simple. Basic tax plus 0, on that you will calculate cess. Are you getting it? That is called surcharge. Mind you, surcharge is only applicable in case of rich people only. And one more thing, keep in mind, in basic tax there will be two kinds of basic tax. Basic tax on normal income, basic tax on special income. Just now I told you there are two kinds of incomes. Normal income, special income. Special income means what? 112, 112A, 111A, 115BB. These are special incomes. On that, whatever tax you will calculate, that is called basic tax on special income. Means the long-term capital gain into 12.5%. That is basic long-term capital gain tax. And normal income means the slab rate whenever you apply, whatever tax will come, that is called tax on normal income. Both put together will be called as basic tax. Now, keep in mind one thing. So, very simple, surcharge is additional tax payable over and above the income tax. It is levied as a percentage of basic tax. Rate of surcharge on special income, dividend income, capital gain, 111A shall not exceed 15% under both regimes. This I will teach you now. Don't worry. Sir, what are the surcharge rates, sir? Under optional tax regime, under default tax regime, again here also different surcharge rates are given. Actually same surcharge rates under both tax regimes. The only difference is the highest surcharge rate under default tax regime is 25%. But the highest surcharge rate under optional tax regime is 37%. That is the only difference. But the whole table remains the same. So if you have a total income up to 50 lakh rupees, you are a poor person, no surcharge for you. Because you are not rich. Why should we collect additional tax from you? If you are a rich person earning more than 50 lakh rupees, then surcharge will be collected apart from your basic tax. On basic tax, you will calculate the surcharge. Are you getting it? Yes. So surcharge rate is given 10%, 15%, 25%, 37%. Mind you, one point keep in mind. If your total income, when I say total income, mix of both normal income and special income. If your total income is up to 2 crore rupees, then apply the same surcharge rate on the total income. But if your total income exceeds 2 crore rupees, then you have to remember two dialogues. I have taught beautifully in my regular batch. Beautifully I taught in regular batch with lot of examples. Surcharge on special income will be flat 15%. Surcharge on normal income will be minimum 15% you have to apply. So, if your total income has a special income also, and if the total income is up to 2 crore rupees, you apply the surcharge rate normally. Whatever rate will come up to 2 crore means up to here, there is no problem. Up to here, there is no problem. But if the total income exceeds 2 crore rupees, in that case, if your total income also has special income, then you have to remember two dialogues. Surcharge on special income will take flat 15%, and surcharge on normal income, we will have to check the limit separately for the normal income. Minimum 15% we have to apply. Let's take one example and let's look at this default tax regime table. So under default tax regime, we will try to understand this table. Let's say, for example, if your total income, guys, this columns you understand. This is the total normal income. This amount is in lakhs, guys. This amount is in lakhs. Okay. This is normal income table. This is special income. This is total income. What will be special income, normal income? This is the total. Plus equals to. And surcharge on special income, surcharge on normal income, it is given here. Surcharge on special income, surcharge on normal income. What rate we need to apply? Okay. Now, total income, if it is 40 lakh rupees, the total income is 40 lakhs. Is it exceeding 50 lakhs? No, poor person. So no surcharge. If the total income is 65 lakhs, is it exceeding 50 lakhs? Yes, but it is not exceeding 2 crore rupees. So generally, whatever is the surcharge rate, 10% we will apply both on special income and normal income. 10% will come. Then 100 lakhs means 1 crore. 50 lakhs up to 1 crore, the same surcharge rate will be 10%, 10%. And 1 crore 85 lakhs, is it less than 2 crores, more than 2 crores, less than 2 crores? Less than 2 crores means up to 2 crore rupees, same surcharge rate for both normal income and special income. So on 1 crore 30 lakhs and 55 lakhs, both we will apply same 15% of surcharge. But the twist will come under this scenario. Twist will come from these scenarios. Because in these scenarios, you see, everywhere the income is more than 2 crore rupees. But here, the income was up to 2 crores only. So if the income is up to 2 crores, you see, same surcharge rate will come, whether it is a normal income or special income. But if the total income exceeds 2 crore rupees, there may be possibility of different surcharge rate on normal income, special income. Possibility I am saying. So if the income is, total income is more than 2 crore rupees, I told you flat 15. Flat means what? You need not check how much is the income, special income. See here, I told surcharge on special income flat 15%. Your special income may be only 100 rupees. Does not matter. Flat 15% you apply on the special income tax. And on the normal income, you will check the separate limit. You will check separately. And minimum. What is minimum? Minimum means at least give 15%. But the flat means what? Don't see anything, just give 15%. So, very simple. If the income exceeded 2 crore rupees, on the special income, whatever special tax will come, on that you will apply flat 15%. This is a flat. This is flat 15%. Everywhere you will have to give flat 15%. Now here you see the normal income is only 45 lakh rupees. Normal income is 45 lakh rupees. Now I told you to check limit separately. 45 lakhs will fall here. But here the surcharge rate is given as nil. But can I give nil there? No. Because I told minimum 15%. So you will apply 15% minimum you will apply there. Got it? Next. 3 crore 10 lakhs. Flat 15%. You need new. If your total income is more than 2 crores and you have special income, flat 15% you give. You don't even check this. Directly go and give. Flat 15%. Everywhere you will see only flat 15%. Are you getting it? You cannot say, sir, here 2 crore 50 lakhs. No, sir, special income. Special income is 2 crore 15 lakh. No, sir. 25% I should give. No. Because flat means what? Same. 15% you will give everywhere. So here 15% will come. And you see here 60 lakhs. 60 lakhs will fall under actually this category. Sorry, this category. 10% should come. But minimum when I say 15%, how can you give 10%? So you will give here also 15% only. Then 2 crore 77 lakhs, flat 15% on special income. Then you will check normal income separately, 1 crore 67 lakhs, that will fall under 15% category. You will give 15%. Then 4 crores 250 on that, flat 15%. But here 150 is there. 150 means what? 150 means it will fall under this category, 15%. Straight away give 15%. Now 5 crore 50 lakh rupees. On this 2 crore 50 lakhs, flat 50% on special income. But mind you, this is 3 crores. If the normal income is 3 crores, which is more than 2 crores, means 25% shall come. 25% shall come. 25%, is it more than 15% or not? Yes. Here I told minimum. Minimum means at least 15. If I am giving 25, minimum criteria is met or not. That's why you will see here, we will give 25% on normal income. And 7 crore 92 lakhs. On special income of 192, flat 15%. But on 6 crores of normal income, 25% I'll give. That's why 25% will come. I hope that is clear. This is the concept of surcharge. On basic tax liability, you will add surcharge. Then, and once you add, first you will take basic tax. To that you will add surcharge. You will take total. On this total you will apply health and education cess at the rate of 4%. On this you will apply. And mind you, this surcharge you always apply on basic tax. Never apply on total income. Surcharge you will always apply on basic tax only. Got it? Next. Surcharge for companies, cooperative societies. For domestic company and cooperative society, this is the surcharge. For foreign company, these are the surcharge. This also up to 1 crore, nothing. Up to 1 crore to 10 crores, 7%, 2%. More than 10 crores, 12% and 5%. But for firm, LLP, local authority, LLP, up to 1 crore nil, above 1 crore 12%. And health and education, just now I told you, 4% you will apply on basic income tax plus surcharge. Next, there is a concept called as marginal relief. Guys, we will understand this with the example. Let's say, for example, your income is 50 lakh rupees. Before cess, we have to find out this marginal relief. If your income is 50 lakh rupees, up to 50 lakh rupees, will you get surcharge? No. So your basic tax you will calculate under optional tax regime. If you apply the slab rate, you will get 13,12,500 on 50 lakhs of your income. Okay, 13,12,500. You will add surcharge? No, because your income did not exceed 50 lakhs. No. So in this scenario, you will get total tax liability before health and education cess. You will get 13,12,500. I'll take one more scenario where the total income is 51 lakh, for example. Then your basic tax liability will become 13,42,500. And in this case, since the income exceeded 50 lakh rupees, we have to add health and education. We have to add surcharge. The surcharge rate is 10%. So I will apply on this 10%. If I apply, I'll get 134,250, and my total tax liability before health and education cess will become 14,76,750. Now, what is the twist? Your total income is increasing only by 1 lakh rupees. But look at your tax liability, it increased by 1,64,250 rupees. Guys, imagine logically. If for an increase of income of 1 lakh, if the government is expecting you to pay tax of more 1,64,250, is it injustice or not? Your income increased only by 1 lakh here in this scenario. From 50 lakhs, 51 lakh happened. But look at the tax liability. The tax liability increased from 13,12,500 to 14,76,750, which is the difference of 1,64,250. So for increase of 1 lakh of income, you cannot ask increase in tax of 1,64,250, and that's why you will get a marginal relief of 1,64,250 minus 1 lakh, which will be 64,250, will be called as marginal relief. Got it? So marginal relief is nothing but unreasonable increase in tax due to marginal increase in income. Income increased only by 1 lakh, because of which your tax jumped by 1,64,250. So the government says, I'll give you marginal relief, don't worry. Yes, now you will get a doubt. A lot of students keep asking me, sir, this marginal relief, how much increase of income till there I have to check, sir? I'll tell you, if it is 50 lakh criteria, in that case, up to 51,95,896, you can check marginal relief, you will get. Beyond that, you will not get. And if it is a 1 crore category, to this amount, 2 crore category and 5 crore category, up to this amount, you will get the marginal relief. Beyond that, you will not see marginal relief. Got it? Next. So that was marginal relief, guys. Next concept is rebate. Guys, for small taxpayers, government is giving additional benefit called as rebate. Mind you, rebate is available only for resident individual. You can remember like this for examination purpose. Rebate, R means resident. In the place of E, rebate, you write like this, no, rebate. Re means what? R-I, rebate. Resident individual, only resident individual can enjoy this benefit of rebate concept. What is rebate? Under default tax regime, under optional tax regime, the rebate limits are different. Rebate is nothing but, guys, up to a particular limit of income, if you have income, you are not required to pay tax, provided you satisfy the conditions. Are you getting it? So, under default tax regime, eligibility for rebate. Mind you, only for resident individual you are eligible. If you are resident individual only, you are eligible. If you are a non-resident individual, you are not eligible. With a total income of 12 lakh rupees. So if you are paying tax under default tax regime, and if your total income is up to 12 lakh rupees, in that case, you will compare two things. First, you will take 60,000 rupees and you will compute your tax liability before health and education cess. Mind you, before cess you will do this rebate concept. Guys, whether be it marginal relief, be it rebate, be it marginal relief on rebate, everything you do before health and education cess only you will do it. So this rebate, before adding your health and education cess, whatever your tax liability will come on your income, total income, that you have to compute 100% of your tax payable. These two you will compare, whichever is lower will be there, that will be treated as rebate. So your income, total income should be up to 12 lakhs only. If your income, total income is 12 lakh 1 rupee also, you are not eligible for this rebate benefit, mind you. Up to 12 lakhs if you paying tax under default tax regime. But if you pay tax under optional tax regime, and if you are a resident individual, in that case, if your total income is up to 5 lakh rupees, you will compare two things. First, you will take 12,500, then you will compute your tax liability before adding health and education cess. Whatever will come 100% of tax payable, whichever is lower here also, that will become a rebate. Yes, are you getting it? So rebate concept is very simple. If you are paying tax under default tax regime, if your total income is up to 12 lakh rupees, you will compare these two things. Whichever is lower will come, that you will take it as rebate. Under optional tax regime, if your total income is up to 5 lakhs only, you will enjoy this benefit of rebate. But mind you, there is a concept called as marginal relief on rebate, which is only available under default tax regime. It is not available under optional tax regime. Sir, what is this, sir? I'll teach one example. Marginal relief on rebate only under default tax regime, this is applicable. Guys, let's say for example, scenario 1, your total income is 12 lakhs for example. If your total income is 12 lakhs, what you will do? First, using the slab rate of default tax regime, you will calculate basic tax before a health and education cess, that will come to 60,000 rupees. On 12 lakhs, you calculate. and since your total income is up to 12 lakhs, you will enjoy the benefit of rebate. Correct? So 60,000, what you will do here? 60,000 or 60,000, whichever is lower is what? 60,000. So 60,000, you will remove rebate, then your tax liability actually will become sunyam, zero it will become. I'll take one more scenario. Scenario 2, I will increase the income by 15,000 rupees from 12 lakhs. So that will become 12 lakh 15,000. And if I calculate using the slab rate of default tax regime, the basic tax I'll get 62,250. But can I reduce rebate here? No, because my total income exceeded 12 lakh rupees. I cannot enjoy the benefit of rebate here. So my total tax liability before health and education cess will become 62,250 rupees. Now, what is happening, Increase of income is only 15,000. But increase of tax is 62,250 rupees. The tax has increased. Just think logically. If your income increases by 15,000 only, but the government is asking you tax increase of 62,250 rupees, isn't it unfair? So the government told, okay, I'll give you marginal relief on rebate, but under default tax regime only. How will I calculate that? Very simple. 62,250 minus 15,000, 47,250 is the relief. So you pay tax only 15,000 rupees. The government is saying this is the relief. This much relief you will get. So from 62,250 of your tax liability, you remove 15,000. So you remove 47,250. Only you pay tax of 15,000 to the government. That is called marginal relief on rebate. Sir, up till what limit I have to calculate? Till 1275.85 you calculate, you will get marginal relief on rebate. Now, one very, very important point which I want to discuss. The rebate concept, rebate, you will get against all incomes, but except 112A income under optional tax regime. So I repeat, if you pay tax under optional tax regime, if you pay tax under optional tax regime, in that case, rebate you can enjoy against all incomes, but except 112A income. Long-term capital gain 112A, you cannot calculate. So whatever 112A income will come, on that whatever tax will come, that tax is not eligible for rebate calculation. You have to pay it. But if you pay tax under default tax regime, this is the amendment, guys. Very, very important for your examination. Under optional tax regime, against 112A income, you are not getting the rebate benefit. But under default tax regime, the law says against any special income, you will not get the rebate benefit. You will get rebate only against that income which you calculate tax using the slab rate. Means rebate you will get under default tax regime only against normal incomes, not special incomes. This point you remember very well. But under optional tax regime, you will get rebate benefit both for normal income and special income also. But only one special income is not eligible, which is 112A income. But apart from the 111A, 112, 115BB, all incomes are eligible for rebate. But under default tax regime, none of the special incomes, not even 111A, 112 winnings, nothing is eligible. Only on normal income, whatever normal tax you will calculate, only that normal tax is eligible for rebate benefit. Now, one very, very important point I want to say. In case of surcharge, You have to remember one very, very important point for examination. When I told here special income, special income, special income, special income, special income will include four kinds of incomes here. Dividend income, triple 1A income, double 1-2 income, double 1-2A income. But you know what? Actually, dividend is not a special income. Only triple 1A, double 1-2, double 1-2A are special income. But dividend is not a special income actually, generally. Because dividend is taxed at the slab rates only. Dividend do not have any special tax rate. Still, only for surcharge purpose, dividend income is treated as special income. Only for surcharge purpose, mind. Very, very important point. Okay, next. Now we will come to agriculture income. Guys, agriculture income is generally exempt. No need to pay tax on agriculture income. But sir, what is agriculture income? There are four kinds of incomes which are given under Income Tax Act, which will be treated as agriculture income, guys. Number one, rent or revenue derived from let out of Indian agriculture land. Let's say, for example, you have one agriculture land which you have given on rent to someone for cultivation purpose. So you are not a farmer. Let's say, for example, I am a chartered accountant. I am owning one agriculture land. I gave it on rent to some one farmer. He will do agriculture on that. He will pay rent to me. That is called rental income. Whatever I will get, nothing required to be paid tax. Fully exempt. Income from sale of agriculture produce. Let's say, for example, I am a farmer. I have one agriculture land. And I have done agriculture activity on that, and I produced some agriculture produce out of it, and I want to sell it. I can sell it. Whatever profit I will get will be exempt. But mind you, see here I have given C below. C below. What is it? C below? C below here. C below here. Wait a second. C below here. Yeah. So I repeat. I have agriculture land. I am only doing agriculture activity on that. In that case, I will produce some agriculture produce that has to be taxed. So, agriculture produce will be exempt. If I sell the agriculture produce in raw form in the market, then the total income will be called as agriculture income only. Let's say, for example, I have one agriculture land. I have grown tomatoes. Now, tomatoes, exactly same tomatoes. Once it is grown, I sold directly in the raw form. Raw tomatoes I sold in the market. Now, keep in mind one thing, very, very important. What is agriculture income? You know, not the sale price of tomatoes. Sale price of tomatoes minus expenditure which I spent in order to grow these tomatoes. Let's say, for example, my sale price is totally 10 lakh rupees. So all the tomatoes I sold in the market for 10 lakh rupees. Less expenses. What kind of expenses? I might have hired some labor for the agriculture purpose. I might have purchased some pesticides, or I might have purchased tomato seeds. All this is my expenditure. I might have taken a tractor on rent, the rental expenditure. So whatever expenses I incurred, I will reduce. Let's say, for example, it is 6 lakh rupees. So the net will be called as income. This will be called as agriculture income, and no tax on that. Fully exempt, because tomatoes as it is I sold in the market. I did not do anything to the tomato, mind you. So Rule 7 says income from sale of agriculture produce, sale of tomatoes. If I sold in raw form, totally agriculture income 4 lakh rupees is agriculture income. You cannot say 10 lakhs is agriculture income. No, 4 lakhs is agriculture income, which is fully exempt, no tax. But I did not sell directly into the market. Or wait a second. I did not sell directly into the market. This one, what I did, I grown tomatoes. Out of the tomatoes, let's say for example 100 kgs I grown and 20 kgs I sold directly into the market, but 80 kgs I am converting the tomato into ketchup for example. Now, this 20 kgs which I am directly selling into the market in the raw form, then whatever income will come out of the 20 kg, totally agriculture income, correct or not? But this 80 kg of tomatoes, I did not sell directly into the market. I converted the tomato into ketchup, and the ketchup I sold into the market. Then what will happen, this 80 kgs will get two kinds of incomes: agriculture income and PGBP business income. Agriculture income means what? First, what will happen? You have a land. You purchased some seeds, pesticides, and you sprinkle on the land. Tomato will come out. Cute tomatoes will come. That tomatoes, until the tomato has come out, that will be called as agriculture activity only. Yes or no? Now, once the tomato came out, you started converting this into ketchup. That will be called as business activity. So from the day you started growing the tomato till the tomatoes are out, that will be treated as agriculture activity. So out of that agriculture activity, you have to compute income. But you will tell, sir, how will I calculate income, sir? Because I am not selling tomatoes, no, sir, directly into the market. I am selling ketchup, no, sir. So how will I take sale value here, sir, for agriculture income purpose? You will take the fair market value of the tomatoes as on the date it was ready. So you will take the fair market value of agriculture produce and you will reduce the cost of growing the tomato. You will get agriculture income that is fully exempt. But from the day tomato came out, the whatever process you did until you sold the ketchup into the market, that will be treated as PGBP income, business income. Then how will you calculate PGBP income? Simple. Whatever price you sold ketchup into the market, that you will take it as sale value. Let's take 15 lakh rupees you sold the ketchup, for example. Now think logically. In that ketchup, you used tomatoes, no? Which tomatoes you used? You used this 80 kgs tomatoes, no? In this to convert the ketchup. So what will be your cost in that? Less cost of tomatoes used. That will be your cost now for the ketchup. That we will take the fair market value which we have taken here. Are you getting it? So we will reduce the fair market value of the tomatoes which are used for converting into ketchup. And for converting the tomato into ketchup, you would have spent some expenditure. Say for example, you got some chemicals, you took some machinery on rent, like that. So that will be called as conversion cost. You will reduce conversion cost. That also, if you reduce, the net income will be called as business income. Got it? So very simple. Agriculture income, how will you calculate? FMV of the tomatoes minus cost of agriculture produce. Agriculture income, this is exempt. But PGBP income, sale of final product. Final product means what? Ketchup. Less fair market value of tomatoes which you use, less process cost. Process cost means cost which you incurred to convert the tomatoes into ketchup. That will give you PGBP income of this thing. This is taxable, guys, mind you. This is taxable. This is not taxable. This is not taxable. Got it? Next. Now keep in mind one thing. This we talked about from the sale of agriculture produce standpoint. This I am telling in case of any kind of agriculture produce. You produced wheat, rice, tomatoes, anything, sugarcane, anything, agriculture produce. But there are some special criteria like tea, coffee, rubber, where the government says you need not calculate like this separately. If you guys think logically, how do you get tea powder? First, tea leaf will come out of the land. That will be dried. Then it will be grounded, everything, some process, big process will be there. If you go to Ooty, Assam, Manali and all, you will see big tea factory will be there. In that machine, first tea leaves will be laid. From that tea powder will come out. Correct? So in this case, or in case of coffee also, you cannot directly have coffee leaf, no. First the coffee leaf will be converted into powder, coffee bean will be converted into powder. And in case of rubber also, the eraser which you use with for your pencil, do you think directly that eraser will be hanging on the tree, you will pick it? No, that rubber will be in some other form. So in that case, guys, in case of tea, straight away the income tax department is saying that if you sell tea powder outside, if you are only growing, mind you guys, you should only grow and sell the tea. In that case, 60% treated as agriculture income and 40% treated as business income. In case of coffee, if it is only grown and cured, means the coffee seeds if you are selling, 75% agriculture income, 25% business income. And if it is grown, cured, roasted, grounded, in that case, 60% agriculture income, 40% business income. But in case of rubber, 65% agriculture income, 35% is business income. Mind you, sir, on what we will apply the 60-40? Not on the sale price. You will apply on the net income. Net income means what? Sale price minus cost of growing. The net income you will apply. So always split only on net income, means sale price minus farming expenses. Now, this is the second type of income which is exempt. Rent from letting out of farmhouse in rural area. So let's say, for example, you have a one farmhouse in a rural area which you are giving on rent for storehouse or residential dwelling purpose of persons who are working in agriculture land. Say, for example, in a one rural area, you have one farmhouse and one nearby agriculture land. One farmer asked you, sir, give me your farmhouse for rent. I want to store agriculture produce. My wheat I want to store here. Then whatever rent you will get, that is totally exempt agriculture income. Income from sapling or seedlings grown in nursery. You know, no nursery, no, on big highways, small cute small plants will be there. They will grow and they will sell. So that is called as nursery. And from the nursery, if you sell and if you get any income, that is also totally agriculture income only. Now we will get to the one more concept, partial integration in case of agriculture income. I'll take one scenario in order to explain you this. Let's say, for example, you are paying tax under optional tax regime. There are two kinds of persons, person A, person B. Person A has agriculture income of 5 lakhs and has a business income of 6 lakhs. Person B has rental income of 5 lakhs, business income of 6 lakhs. Now guys, they both have total income same, 5 plus 6, 11, 5 plus 6, 11. But you know what? Here he has agriculture income. But this person do not have agriculture income here. Now, this person has agriculture income. This will be totally exempt. No tax on that. So, he will calculate tax only on the 6 lakh rupees. So, if he will calculate tax only on 6 lakh rupees, he will pay tax on this 6 lakh rupees at what rate? You know what rate he will pay tax? 6 lakhs means he will pay tax 0 to 2.5, 0, 2.52, 5 lakhs, he'll pay at the rate of 5%. On 5, more than 5 lakhs, 1%, more than 5 lakhs, he'll pay tax at the rate of 20% only. But, so how much it will come? Let's say, for example, here you will get 12,500 if I am not wrong. And here you will get 1 lakh into 20%. That will be 20,000. So that will come 32,500 only. In this case, person. I'll write it here. Just give me a second. Oh. Wait a second. Yeah. So for this person, 32,500 tax will come. But look at this person, 11 lakhs income is there. But there is no agriculture income, no. So how much he will pay tax? 0.2.5, 0, 2.5 to 5, 12,500, 5 to 10, 1 lakh. And on another 1 lakh, he'll pay at the rate of 30%, that is 30,000. So he will pay 1 lakh 42,500. Look at the difference. Look at the difference. Both have same total income 11 lakhs. But person B is required to pay tax of 1,40,500, but person A is only paying tax of 32,500. So this person will cry like anything. Sir, my income is also 11 lakh. This person income is also 11 lakh, but he is paying tax of only 32,500. I am paying tax of 1,42,500. Sir, this is injustice. So that's why government told, okay, why this person is not paying tax, why this person is paying less tax? Because he has agriculture income. No, we will do one thing. I will tell one concept called as partial integration in case of agriculture income. So if this person has agriculture income, in that case he cannot compute his tax liability like this. He will have to do something called as partial integration. But this partial integration concept is applicable only in case you satisfy these conditions. All the conditions should be satisfied. Condition number 1, he should be individual HUF AOP BOI AJP, and he should have an agriculture income of more than 5,000, and he should have a non-agriculture income of more than basic exemption limit. Only then this partial integration will happen. Very simple, guys. 5 steps are there. Step number 1, you will take non-agriculture income plus net agriculture income. What is non-agriculture income? Other than agriculture income, whatever you have, you take that. Then to that you add integration. Means what? Partial integration means you are adding to the non-agriculture income the net agriculture income. So you add both, and that you will find out tax before cess. Then step 2, basic exemption limit you will take, and the net agriculture income also you will add before cess. On that you will calculate tax before cess. Step 3, whatever you got step 1 minus step 2 you do, you will get basic tax liability. You know what is happening here? If you do step 1 minus step 2, what will happen? Net agriculture income will get deleted. Ultimately what is happening? Non-agriculture income minus basic exemption limit only happening. Are you getting it? Yes. Then you will add surcharge and you will check if rebate is there, and you will add 4% of health and education cess. So if you follow these steps, in case of this person, the injustice will not be so much. It will be little bit only. Got it? So if you satisfy these conditions, then you have to calculate tax using the partial integration you will do, and you will calculate tax like this for this person. Guys, mind you, you have to read these Thailava tips. Amazing Thailava tips I have provided. Okay. Now the last concept, undisclosed source of income. No one wants to pay tax. Everyone wants to hide their income, and no one is happy to pay tax. So lot of people don't disclose their income, and they are scared of income tax officers. Guys, there are some special sections, section 68 to 69D. There are some special cases in which the tax will be laid on those people who want to hide their income. Raid will happen, income tax raid. If income tax raid happens, the income tax officer will come and check which is your undisclosed incomes. On that, the income tax officer will collect tax from you. Yes. Now, first one is cash credits. Let's say, for example, income tax officer came to your home, and when he checked your books of accounts, there are many entries in your books of accounts. You have written 10 lakhs I have given to this person, 20 lakhs I have given to this person. Like this, you have a lot of credits in your books of accounts. Or let's say, for example, in your bank statements, lot of credits are there, and you are not able to give any explanation. You are not able to explain where from the money has come. Or you are saying that I have borrowed money, sir, I have taken on loan. Then they will check with the lender also where from he got the money. If there is no explanation, or you gave explanation, but that is not satisfactory to the assessing officer, then whatever credits are there in the books will be treated as undisclosed income, and you have to pay tax on that. Unexplained investments. Say, for example, you recently purchased one land, but you did not disclose in your books of accounts. Then the officer will find out that the land is purchased, but it is not disclosed not recorded in the books of accounts. Then the officer will ask you where from you got the money. If you offer any explanation which is not satisfactory, or you could not give any answer, then whatever land value is there, whatever purchase value of the land is there, that will be treated as your income. Unexplained money. Let's say, for example, when raid happened in your home, they found lot of money, bullion, jewelry, or any other valuable assets like big cars, costly watches like this. Then if you do not offer explanation, when the officer looks at your income tax return, you filed return of only 10 lakhs, but you have jewelry worth of 1 crore. The government will ask you where from you got 90 lakh rupees extra. If you do not give explanation, or the explanation which you gave is not satisfactory, in that case, that will be treated as unexplained money which is not recorded in books of accounts, and it will be treated as income, and on that 90 lakhs of excess amount, they will treat it as income and they will ask you to pay tax. Amount of investments not included, not fully disclosed, means, let's say for example, you purchased one building for 2 crore rupees actually, but you are disclosing in your books of accounts only for 20 lakhs you purchased like that. 1 crore 80 lakhs is your black money. In that case, that is not fully disclosed, that also you are required to pay tax on. Unexplained expenditure. Let's say for example, you celebrated your friend's birthday in big 5-star hotel. You spent 20 lakh rupees, but you never file your return of income only. Then the officer will catch you and will tell where from you got 20 lakh rupees unexplained expenditure. You are saying, sir, I got money, I found money on the road, sir, so I spent on my friend, sir. You cannot give such explanation. If it is unsatisfactory explanation, that 20 lakhs will be treated as your income and you have to pay tax on that 20 lakhs. Amount borrowed on or repaid on hundi. Hundi is kind of a very old kind of a transaction, chits you can say. In that case also, in your account, if you borrowed money other than through account paychecks and you repaid through other than banking channels, in that case, whatever money borrowed other than through banking channels, that will be treated as your income and you have to pay tax on it. Sir, at what rate they will pay tax? You know what, this is a very special case. So in all these special cases, you will not pay tax under slab rates and all. You will pay tax at the rate of 60%, and they will add 25% surcharge and 4% cess also they will add on that. Now, two important points I would like to highlight. Basic exemption limit benefit is not available against the special incomes, but basic exemption limit is available against 111A, 112, 112A if it is unexhausted. I repeat, unexhausted basic exemption limit, you cannot use it against the special incomes of winnings, but you can use the unexhausted basic exemption limit against 111A, 112, 112A only in case of resident individual or HUF. This is the end of basic concepts. Last 5 attempts question papers you pick and check of CA intermediate income tax paper. Question number 2A, 100% damn sure every attempt they have asked from this particular topic, which is residential status. So 100% there is a guarantee that minimum 4 to 6 marks will be asked from this typical topic. Very small topic this is, but very, very important topic. Imagine out of your 50 marks of your income tax paper, if 6 marks comes from this particular topic, means that from the small topic, 10% of your question paper you can easily cover and you can score good marks from this topic. Very small topic, very few limited concepts, but if you remember very well, in examination it becomes very easy for you. So you would ask, sir, what is residential status, sir? A lot of people are scared of this particular subject, this particular chapter. What is residential status? Guys, residential status in simple terms, if I have to say, guys, where do you generally live? Say for example, last year I was in India only. So I lived in India. So my residential status is resident of India. If let's say for example, last year I was in America, then my residential status will become America. Where do you live? Where do you live? You have to find out. That's all. That is residential status. So residential status of a person keeps on changing year on year. Say for example, last year I was in America, this year I'm in India. So last year I'll be called as resident of USA, United States of America. This year I'll be called as resident of India. So residential status of a person, every year we have to check for the year in which we have to compute the tax liability. Now you will ask a doubt, sir, tell me one thing. Why are we even finding this residential status, sir? Why it is even important to find residential status? And the reason for this is because the income tax is generally levied based on either residence rule or source rule. Now, what is residence rule? Say for example, Indian government says that I will collect a tax from those people who live in India because these people are utilizing the resources which I am providing in this country and they are earning income. So that's why they have to pay tax to me. That is called residence rule. So any person who lives in India has to pay tax to me. This is called based on residential status. Whoever lives, let's say for example, Chris Gale, you know Chris Gale, that 6 feet fellow, West Indies person. That person, let's say for example, last year he lived in India only. Being in India, actually is a West Indies person. But the last year, he was in India only and he earned some income in India. He went to one advertisement, ooh la la la, eh, oh, like that he did. And he got advertisement amount. That is an income for him. That income he has gotten from India only. So that income will be taxed in the hands of that Chris Gale because he is a resident of India. While he was residing in India, he was utilizing all the resources. Now, when he is in India, he is using the Indian roads, he is using the Indian army, he is using the Indian police, he is using the Indian water, Indian electricity, everything, all the resources he is using. No. So that is why he will be taxed based on residence rule. Same way, there is another rule under which the Indian government can tax you, which is source rule. Let's say for example, one cricketer, say for example the same Chris Gale, he is in West Indies, he is not in India this year, but he has purchased one house next to Virat Kohli's house. He purchased one house in India, Chris Gale, and he letted out that property on rent to someone. Now rental income is coming for Chris Gale, but he is in West Indies. He was not in India. He is a non-resident of India, but he has a house property in India from which he is earning a rental income. The source of the income is in India. So guys, generally keep in mind, why do we find residential status is because the income tax is generally levied based on two rules. One is called residence rule, the other is called source rule. Under residence rule, a person is taxed because he is residing in India and earning tax in India. That is called residence rule. Source rule means the source of income is in India. That is why the particular income will be taxed. So residence rule, resources of the country are used by the person, so tax that person. And source rule is income is taxed in the country where the income is earned or generated. Now, keep in mind one thing. Residential status, generally, broadly, there are actually two types. Either you are resident or non-resident. Resident means you were residing in India during the previous year. Non-resident means you were not residing in India for the majority of the part of the year in India. You were outside India for the majority part of the previous year. That is called non-resident of India. Under residential status again, if you are a resident, you have to further go and check whether you are a resident ordinary or you are a not ordinary resident. Are you getting it? Now, first we will check. You know, there are different types of persons which are given in the basic concept chapter. I told you individual, HUF, AOP, BY, AJP, LLP, company and all. But first I am going to discuss residential status of an individual. Individual means like you, like me, natural persons. In this case, first of all, there are two kinds of conditions here. One is called the basic condition, the other is called additional condition. Always keep in mind one thing. First, we will check basic conditions. There are two basic conditions given. Any one basic condition if you satisfy, good. Anyone I am saying anyone. Please guys, in this chapter you have to focus on the terms which I am using. Yes, so you have to satisfy any one basic condition. Because here see, or is given means what? 1 or 2 you have to satisfy. Once you satisfy any one of the basic condition, you become resident in India. Once you become resident in India, I just now told you, once you become resident, you have to go further and check whether you are a resident, ordinary resident, or you are not ordinary resident. So, how will you find out whether you are a resident or not? You will find out whether you are a resident or not by checking if any one of the basic condition is satisfied. Say for example, any one of the basic condition is satisfied, then the next step will be you will go and check whether additional conditions are satisfied or not. But mind you, in additional conditions, both the additional conditions has to be satisfied, because the term used here is and. And means what? 1 and 2 both has to be satisfied. If you satisfy any one basic condition, you become resident. Then further you go and check additional conditions. If you satisfied both the additional conditions, you will become resident and ordinary resident you will become. So first let's see what is the basic condition. Basic condition says very simple thing. First basic condition says that if you stayed in India for 182 days more in previous year, in the current previous year, if you are staying in the current previous year for 182 days or more, you will become resident. Previous year means what? From 1st April till 31st of March. If you stayed for 182 days or more, sir, continuous stay required, sir? No. Say for example, initially 100 days you were in India, then you went to America, then you came back, you stayed for another 50 days. So 100 plus 50, 150, again you went to America, you came back again, then you stayed here only. So total of the number of days which you stayed in a year, it need not be continuous. So total number of stays you will, total number of days of stay in India you will add up. That will be called as stay in India. If that stay in India is 182 days or more in a previous year, you will be called as resident, because you are satisfying that condition. But let's say for example, you have not stayed 182 days or more in this previous year. You have stayed less than 182 days, or you have stayed less than 182 days in the previous year. In that case, you will check second condition, because you are not satisfying the first condition. In second condition, mind you, there are two conditions in second condition. Condition number 1, 60 days or more in the current previous year, and it says 365 days or more in the last 4 previous years. So current year you will check minimum 60 days you have stayed, plus you have to check last 4 years, immediate last 4 years, all 4 years put together. It is not 365 days each year. No. All the last 4 years put together you will check 365 days have you stayed or not. If you have satisfied second basic condition, then you will become resident. So I repeat, any one of the basic condition has to be satisfied. Basic condition number 1 says that 182 days or more you should have stayed in the current previous year. If you stayed, if you satisfied, then no need to check second basic condition, because anyone if you satisfied, good enough, no. Why you would go and break your head, waste your time in second basic condition? If you do not satisfy first basic condition, then come and check the second basic condition. Current previous year, did you stay 60 days or more in India? And last 4 years you check 365 days, did you stay or not? If you satisfied second basic condition, then you will become a resident. Sir, if I satisfied first basic condition, I am not satisfying second basic condition, sir, am I resident? Yes, because any one you have to satisfy now. So once you satisfy any one of the basic condition, then go to additional conditions. You have to mandatorily go and check this. Additional conditions. Additional conditions, both has to be satisfied. First additional condition says you should have been resident for 2 previous year or more in the last 10 previous years. So you will forget about the current previous year. Look back at the 10 previous years, you will check. Last 10 previous years, you will check. out of last 10 previous year, minimum 2 previous years, if you are resident in India, you have satisfied additional condition number 1. Additional condition number 2 says that stay in India for 730 days or more in the last 7 previous years. Sorry guys, there is a lag. 1 second. Just a moment guys. Yeah. Last 7 previous years you will take and check whether have you stayed 730 days or more. All the 7 years put together. Some total you will check. So, if you satisfy both the additional conditions, you will be called as resident and ordinary resident. If you satisfy anyone here, you are not, let's say for example, you are satisfying first additional condition, not satisfying the second additional condition, you will be called as resident, not ordinary resident in India. If you satisfy both the additional conditions, you will be called as resident, ordinary resident in India. Guys, in the name itself it is there. Resident and ordinary means generally you are resident only. Resident, not ordinary means you are resident in this year. But when you look the history, past 10 years, 7 years, you are not residing in India frequently. So that is why resident in this year, but not ordinary resident. So I will repeat very slowly again guys. Very simple. Basic condition, any one you have to satisfy. Once you satisfy any one condition, go to additional conditions. Additional conditions both you have to satisfy. Don't worry, you will understand better now in this summary. Basic condition, any one satisfied, you will become resident. Any one basic condition if you satisfy, you become resident. Basic condition, not even one satisfied or both unsatisfied, means you are not satisfying any of these conditions, not even one you are satisfying, then you will become a non-resident. You will become non-resident. Additional condition. So once you satisfy any one basic condition, you will go to additional condition. Sir, I am not satisfying any of the basic conditions, sir. Can I go and check additional condition? Why you will check? Only if you become a resident, you will go and check whether you are ordinary resident, not ordinary resident. If you are not satisfying any of the basic conditions, straight away you are a non-resident. That's all. Only if you satisfy any one condition here, you will go and check additional condition. So additional condition, any one only satisfied. One only satisfied, but you have to satisfy both, no. So if you satisfy any only one, then you will become a resident, not ordinary resident. But additional conditions both if you satisfy, you will become resident and ordinary resident also, means you are a proper resident of India. See, ROR means you are fully resident in India. Non-resident means you are not a resident of India. RNOR means you are resident in India for this year. But generally, if you check last 10 years, 7 years, you are not so ordinarily residing in India. There are some important points. The term stay in India includes stay in territorial waters also. So, even territorial waters of India, you know that 20 nautical miles and all in regular batch I have taught you. Even in water, if you stay, you are considered as staying in India only. And the stay need not be continuous, guys. I told you already. Date of departure and date of arrival ought to be considered in India. Very, very important. In practically, when you will solve questions, in the question it will say, on this day he boarded flight. In that case, you have to remember that the day you boarded the flight, you are in India only. No. Are you getting it? And once you come back also, once the flight has landed, you will keep your step on the country, India's land. You are in India only. So both the day when you left and the day you arrived will be considered as in India only. And citizenship is different from residential status. Don't confuse that. I told you Chris Gale is a citizen of West Indies, but he may be resident in India because residential status will be determined based on where you are living, where you are residing. So, if Chris Gale has stayed more than 182 days in India for a particular previous year, he will be called as resident of India. He may be a citizen of West Indies, but he will be called as resident of India. Exactly the same way, Virat Kohli is a citizen of India, born and brought up here, but he may be living in London. So, let's say for example, in this year, Virat Kohli was totally in London only, UK. So, he is a citizen of India, but he will be called as resident of London, not resident of India. Got it? So, both concepts are different. Now there are some special cases which you need to remember for your examination. Special case number 1. Remember, in special cases, there are 4 people. 4 people. Special case number 1, there are 4 people. 2 people are going outside India. 2 people are coming in India. I repeat, in special case number 1, there are 4 persons. 2 persons going out of India. 2 persons coming in India. Who are these 2 persons going out of India, sir? These 2 persons are Indian citizens leaving India, means leaving India, going out of India for employment or as a member of crew of a ship. You know, a lot of times when you become chartered accountant, you will get an offer from Dubai, one accounting firm. You will go to Dubai and you will settle there. So if you are an Indian citizen means what? The person who is born and brought up in India is called Indian citizen. So Indian citizen leaving India means he is leaving India for the purpose of either employment or as a member of a cruise ship. You know, big ships will go from India with lot of goods in that, passengers in that. It will take many months to come back again. So if you are an Indian citizen leaving India either for employment purpose or as a member of a crew of a ship, you are covered under special case number 1. I told you 4 people, out of which 2 are leaving India. So these 2 people are leaving India. Now 2 people are coming in India. Who are these 2 people? These 2 people are Indian citizen or person of Indian origin visiting India having Indian taxable income up to 15 lakh rupees. Mind you, Indian citizen means the person who is born and brought up in India. Person of Indian origin means either the grandfathers or ancestors of the person was born and brought up in, born in undivided India. You know, undivided India means before, now India map is different. Earlier, before independence, Pakistan was also part of India. Bangladesh also was part of India. So at that time, any of the person was in undivided India and his grandson or son is visiting India. So Indian citizen or person of Indian origin visiting India and having Indian taxable income means this Indian citizen who is generally living outside India, non-resident Indians, NRI they are called. If someone is settled abroad already, let's say for example, I am a chartered accountant, I have settled in America. From past 15 years, I live in America only. Now I am visiting India. That person is covered here, Indian citizen or person of Indian origin visiting India having Indian taxable income of up to 15 lakh rupees. So 4 persons are covered in special case number 1. In these 4 people's case, mind you, only one basic condition will apply. Here, I taught you 2 basic conditions are there. Anyone you have to satisfy, I told you. But in this special case, this is a special case. That's why in special case, 4 persons are covered here. In this 4 persons case, only one basic condition will apply. You have to delete the second basic condition. You have to forget about the second basic condition. Only the first basic condition will apply in these 4 cases. What is the first basic condition? Stay in India for 182 days or more during the current previous year. So in these 4 cases, you will forget about the second basic condition. So if this person satisfies the first basic condition, he is the resident. If first basic condition is not satisfied, you will not check second basic condition because it is not applicable. So first basic condition satisfied, resident. First basic condition not satisfied, non-resident. And one more thing, once the first basic condition is satisfied, then you will go and check additional conditions. Both has to be satisfied. Same additional conditions will remain same. Whatever I have taught you here, same additional conditions will remain. So very simple, guys. Special case number 1, 4 persons are covered. 2 persons leaving India, 2 persons visiting India. Who are these 2 persons leaving India? Leaving India, Indian citizens leaving India for the purpose of employment or leaving as a member of crew of a ship. And 2 persons visiting India, generally they live outside India but they are visiting India, being a Indian citizen or a person of Indian origin visiting India. But mind you, their Indian taxable income should not be more than 15 lakh rupees. In this case, delete the second basic condition. Only first basic condition applicable. First basic condition satisfied, this person will become resident. Then you will go and check additional conditions. Additional conditions both satisfied, they will become resident, ordinary resident. Basic condition 1 satisfied, additional condition any one only satisfied, resident, not ordinary resident. Basic condition A not satisfied, non-resident. Basic condition satisfied, none of the additional conditions satisfied, resident, not ordinary resident. I hope that is clear. Next, special case number 2. Mind you, here in special case number 1, I told you 4 people are covered. 2 are going outside India, 2 are visiting India. But in special case number 2, only 2 persons are covered. Both are visiting India. Both are visiting India. Indian citizen or person of Indian origin visiting India during previous year, Indian taxable income more than 15 lakhs during there. Very simple, guys. Here, Indian citizen, person of Indian origin visiting India having taxable income less than 15 lakhs, I told you, up to 15 lakhs. But here, more than 15 lakhs. So, persons are same. But if the same person earns income up to 15 lakhs in India, then you will apply this special case number 1. But the same persons having Indian taxable income more than 15 lakhs, they will be covered under special case number 2. In special case number 2, what happens, basic condition 1 remains the same, but basic condition 2 also will be applicable, but in the place of 60, you have to strike off and write 120. I repeat, in special case number 2, first basic condition remains the same. But second basic condition, in the place of 60, you strike off and you have to write 120 days. And this 365 remains the same. Additional conditions also remains the same only. But there is a small twist, I'll teach you that regarding additional conditions. But keep in mind one thing. In basic conditions, first basic condition remains same. Second basic condition, in the place of 60, you will write 120. Let's see that. Special case number 2, only applicable in case of 2 persons visiting India. Indian citizen or person of Indian origin visiting India whose Indian taxable income is more than 15 lakh rupees. Basic condition 1, 182 days or more during previous year, or in the place of 60, you strike off 120 days during previous year, 365 during last 4 years. If you satisfy any one, because or is written, any one basic condition, you will become a resident. Correct or not? Correct or not? But, very, very important point I am going to discuss now. If you satisfy first basic condition, then of course you will not check second basic condition. So if you satisfy first basic condition, directly go and check additional conditions, and additional condition both satisfied, you will become resident, ordinary resident. If additional condition not even one satisfied or only one satisfied, then you will become resident, not ordinary resident. But let's say, for example, you are not satisfying the first basic condition, then what you will do? You will go and check the second basic condition. In second basic condition, keep in mind one very, very important point. Second basic condition, if you are satisfying, you need not check additional conditions. I repeat, you will check additional conditions only if you are satisfying the first basic condition. If you are not satisfying the first basic condition, but you are satisfying the second basic condition, you need not check the additional conditions. You need not check. I'll show you the points. If satisfies the first basic condition, then check additional conditions. But if you do not satisfy the first basic condition, but satisfies the second basic condition, no need to check additional conditions. Person is straight away RNOR. RNOR. Always. That is a thumb rule. Resident, not ordinary resident, that person will become. By default, you will become resident, not ordinary resident. Indian citizen or person of Indian origin. I am summarizing this in this. Visiting India means the special case 1 and 2. So, I am summarizing this category of person under special case number 1 and special case number 2. Same people we are categorizing and summarizing. So, Indian citizen or person of Indian origin, total Indian income or other than foreign income up to 15 lakhs means this is special case number 1. No need to check second basic condition. Total Indian income other than foreign income more than 15 lakhs. Second basic condition, at the place of 60, 120 will come and 365 days you will check. If this you are satisfying, you will not check additional conditions. Yes or no? If this is satisfied, straight away you will become resident, not ordinary resident. If this is not satisfied, then you will become non-resident. Now, there is one rule, rule 126. Guys, lot of times in a ship, there will be crew members who go along with the ship in the Indian waters, then they go abroad, whatever they want to do, they will do. So in case of Indian citizen being a crew member of a ship, of a foreign bound ship, the period of stay in India shall not include date of entering into continuous discharge certificate and to the date of signing off of continuous discharge certificate. So before the ship starts, they'll get one certificate called as continuous discharge certificate. In that discharge certificate, whenever you enter from that date till the date you sign off that continuous discharge certificate, you will be treated as you are outside India. This is applicable only in case of a crew member of a foreign bound ship who is an Indian citizen. Now, there is a concept which is called as a deemed resident. Lot of times in examination, this has been tested with beautiful complicated questions. This is actually simple. People think it is very complicated, but actually it is simple. I'll tell you some conditions. Remember those conditions. If these conditions is applicable in the facts of the question, then you can apply this deemed resident concept. First condition. This deemed resident concept is applicable only in case of Indian citizens only. And that Indian citizen is not satisfying any basic condition, then he will become non-resident. Means this deemed resident concept you will apply only in case of non-resident Indian citizens, number one. So two conditions we have read. Condition number one, the person should be Indian resident. Condition number two, the person should be non-resident. Condition number three, this non-residents Indian income should be more than 15 lakhs. This is condition number three. Condition number four is he is not liable to pay tax in any country due to his residence. Then he will be called as deemed resident. I repeat, guys, if you satisfy four conditions, you will become deemed resident in India. Condition number one. Deemed resident means what? Generally, you are not resident, but the Indian government will deem, will treat, will assume you as a resident person only. Condition number one, you are an Indian citizen. Condition number two, you are a non-resident in India. Condition number three, your Indian income is more than 15 lakhs. Condition number four is you are not paying tax in any other country outside India due to reason of domicile or residence. In that case, you will become deemed resident. And mind you, always the deemed resident is by default treated as resident, not ordinary resident only. You need not check how many days he is staying, additional conditions, nothing. He is always a deemed resident, is always a resident, not ordinary resident. We'll take one small example. Let's say, for example, this is the person. He is a non-resident in India. He is actually an Indian citizen. But he stays in Dubai. You know what? In Dubai, there is no tax. So, if he stays in Dubai all the time, he is a non-resident in India. But he is an Indian citizen, means he was born and brought up in India, settled in Dubai. In Dubai, there is no tax now. But this person has some Indian income like rental income. Let's say, for example, this person has one house property in India, or he has given some loan to someone for interest. So, all this income he is getting Indian income more than 15 lakhs in a year. In that case, he is satisfying all the conditions or not? Condition number one, he is a non-resident in India. Condition number two, he is an Indian citizen. Condition number three, he is not paying tax outside India also. Condition number four, his Indian income is more than 15 lakhs. If all the four conditions are meeting, guys, that person will become deemed resident of India. And a deemed resident is always a resident, not ordinary resident in India. Keep in mind one thing. Now, whatever I have taught you is regarding the residential status of an individual only. Now I will teach you how to find out the residential status in case of Hindu undivided family or HUF. You will get a doubt, sir. An individual can move around. He can go to USA, he can go to Dubai and all. So we can find out residential status may differ. But sir, how a HUF will have a different residential status, sir? That I'll tell you now. Guys, for a HUF, generally, the residential status depends upon where from the control and management of that HUF is being taken care. Where from the business of the HUF is being controlled and managed. If the control and management is in India, even partly guys, even partly, then the HUF will be treated as resident. HUF will be treated as resident. But if the control and management of HUF is totally outside India, guys, let's say for example, the HUF which is in India is being controlled or managed from America fully during the full year, then that will be called as non-resident HUF. Mind you one thing. This resident ordinary resident, resident not ordinary resident status is applicable both in case of individual and HUF also. But sir, just now we have seen how to find out residential status of HUF. Means if a HUF is controlled or managed from India, it is a resident HUF. In that case, sir, in order to check whether it is a resident ordinary resident or resident not ordinary resident, do we need to check the additional conditions or not is a question. Yes, you need to check additional condition. But the additional conditions you will check for Karta. Karta is the head of the HUF. You have to see whether Karta is satisfying the additional conditions or not. So if Karta satisfies both the additional conditions, then HUF will become resident ordinary resident HUF. But if Karta is not satisfying any of the additional conditions, then the HUF will become resident not ordinary resident. Got it? So in HUF, guys, very simple it is. First we will check residential status, resident not ordinary resident. How will we check? Where from the control and management of the HUF is being made. If the control and management is being made from India, in that case, it is a resident HUF. Once it becomes a resident, you have to further go and check whether it will be resident ordinary resident or resident not ordinary resident. How will we check? We will have to check the Karta's period of stay in India for the past 10 years, for the past 7 years. If Karta satisfies both the additional condition, then HUF will become resident ordinary resident. If Karta does not satisfy any of the additional conditions, HUF will become resident but not ordinary resident. If control and management fully outside India, then HUF will become non-resident. So guys, if I have to summarize residential status, there are actually 3 types: resident ordinary resident, resident non-ordinary resident, and non-resident. 3 types of residential status are there. But mind you, these 3 types of residential status is applicable only in case of individual and HUF only. Apart from individual HUF, whether it is a company, LLP, partnership firm, AOP, BOI, AJP, in all these persons cases, either it will be resident or non-resident. That's all. They do not have ordinary resident, not ordinary resident kind of concepts. First, we will see in case of firm, LLP, AOP, BOI, AJP, LLP, local authority. If control and management is wholly or partly in India, it is a resident. If control and management is wholly outside India, these persons will be treated as non-resident. Keep in mind this thing. Residential status of company is totally dependent on POEM. But keep in mind one thing, Indian company is always a resident in India, guys. But other companies apart from Indian company, other companies, other than Indian company, any other company, you will check place of effective management. If the place of effective management is nothing but where from the key decisions are being taken. If it is taken from India, it is resident, otherwise not. Next, taxability of income or individual and HUF. Okay, sir, we understood how to find out residential status. Who is a resident ordinary? Who is a resident not ordinary? Who is a non-resident and all we found out, sir. But what is the purpose of this, sir? Why are we even finding it, sir? Because based on your residential status, it will be decided which income will be taxed in your hands. Basically, there are 2 kinds of income, guys. Indian income, foreign income. What is an Indian income? The income which has accrued or arised in India or received in India is an Indian income. The income which is accrued or arised outside India, that is called as foreign income. So, based on your residential status, we will check whether a particular income is taxable or not. So, the government simply says what, If you are a resident and ordinary resident, means you are resident of India in this year, and ordinary also means from past many years also you are residing in India only. So you are a pure resident of India. In that case, whole world's income is taxable in your hands because you are a pure resident of India. See, resident not ordinary resident is a resident but not pure. He is a resident but not ordinary resident. But this person is a pure resident of India. Resident and ordinary resident. So for this person, you see Indian income taxable, foreign income taxable, foreign income taxable. Anything is taxable. But mind you, in case of non-resident guys, non-resident person is not resident. No, he does not stay in India generally. In that case, only Indian government can collect a tax on Indian incomes. They do not have right to collect a tax on foreign incomes because he is not a resident of India. Why will the Indian government collect a tax on him? But if the same non-resident earns any income from India, then he has to pay tax. Best example I'll take. Virat Kohli, for example, he is a resident of India. He is residing in India only. He was born and brought up in India only. He is a resident and ordinary resident, for example. Wherever he will earn income in any part of this world, he has to pay tax in India. Why? I'll tell you why. Reason I'll tell you. Resident and ordinary resident, for in a previous year, for most of the period, he is in India. And if he is in most of the period of the previous year, if he is in India, he was utilizing all the services, all the resources provided by the Indian government, and through that only he is earning income. No. So that is why resident ordinary resident is taxable on global income. But look at non-resident. Non-resident means he do not stay in India generally. He stays outside India in other country. So is the non-resident utilizing resources provided by the Indian government? No. So the Indian government do not have any right to tax him on the foreign income. But the Indian government will definitely tax this non-resident on the Indian income which he is earning in India, because source rule says what? Whatever income generated in India, on that everyone has to pay tax. Now coming to resident not ordinary resident. Here a lot of students get confused, but trust me, I'll remove the confusion now. Simple. If you are a resident and not ordinary resident, Indian income is anyway taxable. See, Indian income is taxable in all cases you check. Whether you are a resident, resident not ordinary, non-resident, anyone, Indian income is taxable. But in foreign income, mind you guys, in resident not ordinary resident case, in case of foreign income, remember this table. See, resident ordinary resident means pure resident person. Indian income fully taxable. Foreign income fully taxable. Correct? Look at the lines. Full line. Is there any breakup in the line? No. Non-resident Indian income fully taxable. But mind you, I have not drawn any line from non-resident to foreign income because it is not taxable. But resident not ordinary resident, Indian income fully taxable. So the line is full here. No breakups. But from resident not ordinary resident, if you see the line which is coming to foreign income is strike line, and the reason is here. Because in case of resident not ordinary resident, keep in mind one thing. There are 5 heads of income: salary, PGBP, house property, capital gain, IFOS. In all 5 heads of income, in case of resident not ordinary resident, only one head of income is taxable if it is a foreign income. I repeat, in case of resident not ordinary resident person, Indian income, any Indian income is fully taxable. But foreign income, only business income is taxable. Other foreign income is not taxable in case of resident not ordinary resident person. I repeat, in case of R&R, Indian income fully taxable. Foreign income, only business income or professional income is taxable. But all other foreign incomes not taxable. So you see here, this is foreign incomes. If it is a foreign salary income of a non-resident, of a resident not ordinary resident, not taxable. Taxable? No. If it is a house property, foreign house property income of a resident, not ordinary resident, not taxable. Foreign income of a capital gain, foreign income of a resident, not ordinary resident, not taxable. Foreign income of IFOS head, not taxable of resident, not ordinary resident. But PGBP, foreign PGBP income of resident, not ordinary resident is taxable, provided there is one condition. If the business or profession should be set up in India. So business should be either controlled from India or the profession shall be set up in India, only then it is taxable. If the business is not controlled from India or profession is not set up in India, then it is not taxable. Got it? So you are getting foreign income, but the control of that business should be from India. Or you are getting foreign PGBP income, but the profession should be set up in India, out of which you are getting any foreign income, that is taxable in the hands of resident, not ordinary resident. All other heads of income not taxable, foreign income not taxable, all other heads under in the hands of resident, not ordinary resident. So if mind you, if there is business controlled from India or profession set up in India, from which foreign income PGBP you are earning, being a resident, not ordinary resident, in that case deemed as Indian source income only, taxed because you are RNR. But if the PGBP income which you have in foreign, if it is not out of business controlled in India or set up in India, then it is treated as foreign income only. It is not taxed. It is not taxed. So very simple, guys. Resident, ordinary resident, global, any income is taxable. Non-resident, only Indian income is taxable. Foreign income you cannot touch. Resident, not ordinary resident, keep in mind one point. Indian income is anyway taxable because it is Indian income. Foreign income, only business income is taxable. All other foreign incomes not taxable. I hope that is clear. Next. Sir, how to decide, sir? If a income is a Indian income or foreign income, how will I know, sir? Looking at the income. Any income which is coming out of India is a foreign income. Any income which is coming in India is Indian income, sir? No, not like that. There are a lot of complications. It totally depends on two factors. First factor is where income is accrued or erased. The second factor is where income is received. Accrued means what? Where the income is generated. Received means what? Where the amount you received. Are you getting it? There are two different factors. Accrual. See, look at the term accrual or arisal means where the income is generated. How do you know where is generated? If a house property is located in India, rental income is coming out of that house. It means that income is generated in India. The source of income is called accrued or arised. Received means where you received. Let's say, for example, I am in Australia. My tenant came there and gave me rent in cash. So that will be called as income received in India. Received in Australia. Or I have a Australian bank account. In that bank account, income is credited. That will be called as income received in Australia. If I have a bank account in India, in that account, amount is credited. That will be called as income received in India. First, we will see income received. How to find out, sir? So I told you one thing. How do you decide Indian income or foreign income? Very simple. Based on two factors, you will decide. First, income accrued or arised or income received. So income received, always keep in mind thing. If you receive in cash, the place where you first received the cash will be treated as that place where you received. Let's say, for example, cash received in Dubai, then it will be called as income received in Dubai. Cash received in USA, then it will be called as income received in USA, where you received that cash. But if you received in bank account, the amount is getting credited. In that case, always remember, place where bank account is located, that place will be called as income received place. Let's say, for example, amount credited in Dubai bank account, then it will be called as income received in Dubai. If let's say, for example, you have a bank account in India, in that bank account amount is credited, then it will be called as income received in India. Income received in India. The receipt of income means the first time receipt. If the money is sent later on, it is not treated as new income. We'll take one example. Thailava is actually living in USA. He is working in Amazon USA. One company is there, Amazon. In America, he is working. That salary is actually credited in USA account. Salary credited in USA bank account. Where is the income received? Income received in USA only. Because I told you, if you receive any amount in bank account, the place where the first credit happened, that will be treated as income received in that place. So first time the salary is credited in USA. So this income, salary income will be treated as income received in USA. Once the salary is credited in USA bank account, later on that amount was remitted to family in India. Means Thailava from USA has transferred the amount to his family in India. Then the Indian government cannot torture the family members of Thailava saying that you have received income from USA, that salary income, pay tax. No. Wrong. Because you have to check first time when the income was credited in which place. It was credited in USA. So it is treated as income received in foreign only. Are you getting it? Next. Income accrued or arised. How would I decide, sir, where the income is accrued? How do I know whether income accrued in India or income accrued outside India, sir? That will depend on two things. If it is a goods, physical goods, then in that case you have to check where did you make a deal. Deal means agreement. If it is a services, you will check place where services are performed. That place will be called as income accrued or arise. That place will be called as income generating place. If you entered into agreement, sale agreement of goods in China, that place will be called as income accrued in China. But in services, you have to check where the services are performed. Let's say, for example, there is a stage show in USA. The amount might have been received in India, but that will be called as income accrued or arised in USA. Concert in India. We called Michael Jackson to India, for example. The concert is happening in India, so income accrued in India. Project in Dubai. One construction, big building construction project is happening in Dubai. Then the project services are performed there, construction is performed there. That will be called as place where the services are performed. So place of deal does not matter in this case. So in case of services, always check where the services are performed. That place will be called as income accrued or arisal place. Once we know where the accrual and arise is happened, we can easily find out whether it is an Indian income or foreign income. So accrued or arise means very simple, place where the income is generated or created or source of income. I'll take one example. Thailava. This is ICI, Institute of Chartered Accountants of India, Dubai chapter. Let's say, for example, ICI Dubai called Thailava. Sir, please come and take some tax classes in Dubai, sir. Dubai has recently came up with the taxes. So please come and teach tax here. So I went there. I conducted ICI Dubai. I conducted some classes. Now, what is the place of provision of service? Where the services are performed? It is performed in Dubai. So place of accrual of income will be called as Dubai. And I told them, you pay me in my Indian bank account. So amount credited in Indian bank account. So my place of receipt of income will become India. Now you will get a doubt, sir. Accrual of income is happening in Dubai. Amount is received in India. How do I know based on these two things whether the income which I have received is an Indian income or foreign income, sir? That too you will earn using this table. Remember this table will be immensely helpful for your examination. Income accrued or arised in, income received in Indian income or foreign income. So this column will tell what is the place of accrual or arisal of income. This column will tell where the income received. Based on these two columns, we will check, we will finalize whether income is Indian income or foreign income. So this is the conclusion table. And based on these two factors, we will decide what is the nature of income. Once we know the nature of income, we can easily say, okay, you are a resident, not ordinary. Yeah, you have Indian income, it is taxable, like that. So if the income is accrued or arised in India, income is received in foreign, anyone is happening in India, it will be treated as Indian income. If income accrued in foreign but received in India, anyone happening in India, no, it is a Indian income. Income accrued in foreign, income received also foreign, none of these two happening in India, purely foreign income, so foreign income. Income accrued or erased in India, income received in India, both happening in India, it is an Indian income. Simple thing, keep in mind, guys. Either accrual or receipt, anyone happening in India, it will be treated as Indian income. If both accrual and receipt happening outside India, it will be treated as foreign income. Once you know whether my income is an Indian income or foreign income, then it will become easy for you. You can easily say, okay, this is taxable, this is not taxable, like that. So what we have found out just now is how to find out the nature of income, whether Indian or foreign income. I hope that is clear. Next. Now we will talk about scope of total income. In scope of total income, income received, income accrued or arise, we already discussed just now. Now I will teach you income deemed to be received in India, income deemed to accrue or arise in India. See, these two are actually received or accrued, but here I am using a term deemed. Deemed means what? It is actually not received in India, or it is actually not accrued or erased in India, but the income tax department will deem, will assume, will treat that income as Indian income only. What are those cases? First, income deemed to be received in India. To be received in India. Income deemed to be received in India. What is this, sir? Means these are few incomes which might have been received outside India, but it will be ultimately treated as deemed to be received in India only all the time. Number one, employer's contribution in excess of 12% of salary to recognized provident fund or interest credited in excess of 9.5% per annum. So if an employer contribute more than 12% of salary to recognized provident fund, or in that fund interest is credited in excess of 9.5% per annum, whatever excess income you are getting, that is all the time deemed as received in India only. Number two, contribution by central government or any other employer under a pension scheme referred under section 80CCD2. So your employers are contributing for 80CCD section, if you remember, pension scheme. In that case, whatever amount an employee receives, it is always treated as received in India only. Amount transferred from URPF, unrecognized provident fund, to recognized provident fund, being the employer's contribution and interest, will always be treated as received in India only. Now what we have seen is only income deemed to be received in India. Now we will see income deemed to accrue or arise in India. What is that, sir? Income deemed to accrue or arise in India means these are some incomes which might have accrued outside India or arised outside India. The source may be outside India, but the Indian government will assume, will deem that these incomes are accrued in India, and you have to treat that as Indian income. Number one, dividend paid by Indian company outside India. If an Indian company, we will take one example. Chris Gale is there, West Indies person, invested in Reliance company shares, and the Reliance company declared dividend. The dividend whatever received by Chris Gale outside India will be taxable, will be treated as deemed to be accrued or arised in India, because ultimately Reliance company is giving the dividend. Number two, salary received by Indian citizen from Indian government for services rendered outside India. You know, lot of IFS officer, Indian foreign services officers, and embassy, in embassies, passport office, they will deploy Indian officers. So if an Indian government deploy any Indian employees outside India, who will pay the salary? Indian government will pay the salary, but the salary will be paid outside India, no? So in that case, whether the salary is paid outside India, in India, does not matter. If there is a person who is receiving salary being an Indian citizen from Indian government, always that salary will be treated as Indian income accrued only. But mind you, here only salary income is deemed as received in India, but perquisites and allowances are totally exempt. We'll take one example. IFS officer is located in London Embassy. Indian government is paying salary to this Indian Foreign Services officer who is an Indian citizen. This salary is taxable in India because this salary, though received in London, will be treated, will be deemed, will be assumed as received in India only. Next, income in the form of interest, royalty, fees for technical services received by non-resident taxable as income deemed to accrue or arise in India. What is this, sir? You know what is interest? Interest is very simple. You give loan, you will get interest. Royalty and the fees for technical services. Royalty means what? Let's say, for example, you have written a very good book. Some person wants to print that and sell it. You are giving royalty. You will get royalty for the book permission you are giving to print and sell. Publishers you are giving. Royalty you will get. Fees for technical services. You have a technique how to build a particular thing. Unique technique you know. For that you will provide fees for that. So you are providing your technique to someone. That person is giving you fees. That is called fees for technical services. Mind you, if interest or royalty or fees for technical services received by non-resident taxable as income deemed to accrue or arise in India. We will take one example. Case 1. There is one non-resident who gave loan or services to Indian government. And if Indian government, of course, you imagine if this non-resident gives loan to Indian government or services of royalty or FTS, then Indian government will pay what? Interest, royalty, FTS will be paid to non-resident. In that case, always remember, whatever income this person earned from Indian government will always be deemed to accrue or arise in India and taxable in the hands of non-resident. Next scenario I'll take. There is one non-resident, there is one resident. Non-resident means he is outside India. Resident means a person in India. Now, this non-resident gave loan to a resident. This non-resident gave loan or services of royalty or FTS to resident. Keep in mind one thing. Of course, this resident will give what? Interest, royalty, FTS will give. Interest, royal, FTS will give. Correct? This resident will pay interest, royalty, FTS. Now keep in mind one thing. If a resident gave loan to if a non-resident gave loan or FTS or royalty services to resident, and if this resident took that loan or royalty or that FTS and used that money or services in India only for generating any income, in that case, since the loan amount or services is used in India only, then whatever interest, royalty, FTS received by this non-resident will be taxable in the hands of this non-resident who is receiving it. But loan or services taken from a non-resident by a resident, but this resident person did not use the loan amount or services amount in India, but he used the money or services outside India. Let's say, for example, we'll take one example. There is one person in America. There is one person in India. Indian person took loan from American person. If this loan amount is used in India only to generate any income, then out of the loan amount, Indian income is generated. That is why whatever this Indian person will pay interest to the foreign person will be taxable in his hands, in the non-resident's hands. But I'll take one more scenario. Non-resident gave loan to a resident person, Indian person. Foreign person gave a loan to Indian person. Indian person did not use the loan in India. He took this amount, loan amount, and he invested in Dubai, for example, in foreign to generate some income. In that case, whatever interest will be paid by the Indian person to the non-resident person will not be taxed in the hands of non-resident because the amount is not utilized in India. It was utilized outside India. Now you understand. Non-resident gave loan or services to resident. Resident utilized the amounts or services in India to generate any income. Then whatever income will be given by this resident, interest income, royalty income, FTS income given by this resident to non-resident will be taxable in the hands of non-resident. But if non-resident provided any loan or services to resident, and this resident person used that loan amount or services outside India for generating any income, then whatever this resident will pay income to the non-resident, interest, royalty, FTS not taxable in the hands of non-resident because the amount was utilized outside India. Last case I'll take. Non-resident and non-resident. There is no Indian resident only. Both are non-resident. So one non-resident, there is another non-resident. So one non-resident gave loan to another non-resident. This non-resident, if he uses in India that loan amount, then of course, whatever interest will be paid by this non-resident, interest, royalty, FTS, will be taxable in the hands of non-resident. Natural it is, natural it is. But if the non-resident, after taking the loan from this non-resident, if he utilizes the amount for investing outside India, of course, it is not taxable in India. Mind you one thing, here non-resident, if he takes loan amount and if he generates only PGBP income, then only this interest will be taxable in the hands of this person. But if non-resident took a loan and invested in India, but did not generate PGBP income, let's say for example, IFOS income is generated. Let's say for example, in shares the amount is invested. In that case, this interest income will not be taxable in the hands of non-resident. No. The fourth category of income, which is deemed to be accrued or arised in India, is salary received by foreign employee for services rendered in India. So if any foreign employee is coming to India and rendering any services, then whatever salary paid by that foreign employer to the employee will be treated as Indian income only, will be treated as income accrued or arised in India only, because services are rendered here in India. Any income, capital gain or IFRS earned on Indian securities, like let's say for example, anyone in this world invest in Indian companies, whether in the form of debentures or equity shares. In that case, any income which is generated, of course, it should be taxable in the hands of that person. It will be treated as or deemed as income accrued or arised in India. Gift given by Indian resident to non-resident or RNR more than 50,000. Of course, the income is being accrued or arised from India only. Income through or from any paid or any property, asset or any other source of income in India. So anyone purchase any property, let's say house property, if it is let out, then rental income will flow. So any non-resident purchased one house property in India, then rental income is coming. That rental income will be treated as Indian income accrued or arised in India only. Profit on transfer of capital assets situated in India. So any shares, any kind of capital asset you have in India which you have transferred and you got any profit on that, that profit also treated as income accrued or arised in India. Then if you have any business connection in India, agent, branch, anything like that, and if any income is generated out of that agency or branch, in that case also it will be treated as income accrued or arised in India. Keep in mind one thing. Following shall not be treated as business connection. There are 4 to 5 points which they have given. This will not be treated as business connection. Number 1, if all the business operations are carried outside India, there is no business connection. Number 1. Number 2, if someone purchases goods from India just to export outside India, there is no business connection, there is no income. Collection of news. Let's say for example, one foreign news agency came to India to collect some news from India. They will come and they will shoot some news and they will go outside India. They will publish in outside India. In that case, any income generated, it is not treated as business connection. Shooting of cinematography films. A lot of times, from India also, film shootings will happen in foreign location. Likewise, in Indian location, if any film is being captured, in that case also there is no income accrued or arised in India. There is no business connection as such. And the display of uncut or unassorted diamonds. So a lot of time exhibitions happens, in that any uncut diamonds are displayed. In that case also we cannot call it as business connection. And that's the end of residential status. Very, very important chapter, guys, for your examination. If you think my hard work is really worth it, for a like and comment, you please like this video and comment with positivity. Guys, positivity is true. Manifestation is true. You write with positivity, I am going to clear my examination. in this attempt, so and so attempt, you will pakka clear. Because if you always think positive, positive things will happen to you. Because big successful people in life always say this manifestation is true. So write in the comment section, I am going to clear my examination, and pakka you will clear. And let me know in the comment section, how are you feeling about this videos? Yes, take care. Namaste, Namaskara, Vanakkam. Last 5 attempts CA intermediate income tax question paper you pick and check, you would find that in the compulsory question, the very first question, every attempt in the past 5 attempts, income from house property adjustment is definitely there. And you check MCQ questions also, every attempt one minimum MCQ is asked from income from house property. From this chapter you can expect at least 5 marks guys in your examination in the coming attempts also guys. So it becomes very important to revise this chapter before you go for examination. If you are new to my channel, let me tell you that I have already uploaded how to solve total income computation and PGBP master question with the 25 adjustments, set off and carry forward of losses, full summary super fast revision, and PGBP super fast revision, residential status super fast revision. Everything is already uploaded on this channel. If you are new to my channel, after you finish off this video, you can go and watch guys. So let's jump into the revision of income from house property. Sir, when we say income, what is the income we are referring to, sir? What kind of income, sir? Guys, income is nothing but here the rental income, guys. When we say income from house property, it does not mean that when you sell a house property, whatever gain you get, that will not be taxed here. In this head, you will be only taxing the rental income which you get by letting out a house property. Sir, when you say house property, what does it mean, sir? Literally only houses, sir? No guys, house property here means building and land apartment there too. Very simple guys. If there is this is the compound of the building, here building is there, this is the land which is let out for parking of car purpose. In that case, the rent which you receive from the building and also from the car parking area, both will be taxed under this head only. Sir, when you say house property, only houses are covered, sir? Only houses are covered? No. Even if you give shop on rent, even if you give go down on rent, anything, if you are giving a building on rent, that will be the income which you get, rental income will be taxed under house property, not just houses. Even if you give for shop or go down or office, any purpose you give, you are giving a building and land apartment there too. Land apartment means the land which is in conjunction with the building. If you are giving any of these two, in that case, the rental income will be taxed under income from house property. But mind you guys, one thing always keep in mind, if you let out a vacant land on rental purpose, that rental income will not be taxed under income from house property. So in examination, if the question says that the SSC has let out vacant land for rental income, in that case, don't tax that rental income under income from house property, tax it under income from other sources, guys. Yes, now keep in mind one thing, guys. There are types of house properties depending on the nature. Let out property and self-occupied property. See, in the name itself, it is there. Let out means you have given that property, house property on rent to someone. You have let out to someone for rental purpose. And self-occupied means you have not given that house property for rent. You are self-occupying. You are using it for your own purpose. Guys, keep in mind one thing. Under Income Tax Act, if you let out a property, of course, you will get rental income. That rental income is always taxable under income from house property head, guys. But in case of self-occupied property, think logically, guys. Think logically. If you have self-occupied the property for your own self, are you getting any kind of rent? No. If you are not getting any kind of income, if you're not getting any kind of rent, then where is the concept of taxing the income? There is no income at all. But wait. Government says that if you have more than 2 self-occupied properties, let's say for example you have 3 self-occupied properties, you have 3 different buildings, all 3 buildings you are using for self-occupation, then the government says wait, I will only treat maximum 2 properties as self-occupied, and beyond 2 whatever extra properties you have, that will be deemed as let out properties only. So only two self-occupied properties I will exempt. If you have more than two self-occupied properties, in that case any two self-occupied property I will exempt as a self-occupied, but the remaining self-occupied properties which you have in excess, that I will deem it as let out property. Sir, what if I use this property, the building, for my own business purpose, sir? I am not residing in that property, house property, I am using it for my business purpose. Then that will not be treated as a deemed let out property. You can just ignore it. Yes, next. Guys, mind you one thing. Charging section 22 says that annual value of house property shall be taxable under income from house property. Sir, but just now you told no, sir, rental income will be taxed under income from house property. Then what is this annual value? Guys, annual value is nothing but what you know. Let's say, for example, you are saying that rental income what I received is 1 lakh. But government, do you think will believe you blindly? No, it will also check with municipal value, fair rent, standard rent and all, and it will arrive at annual value. So there is a procedure given. There is a procedure given, a method is given to determine the annual value, guys. This method, if you follow, you will arrive at the taxable value under the head income from house property. Sir, what do we do, sir, in this? How do we find out the annual value which will be taxed under income from house property? Very simple, guys. First of all, take the municipal value. Sir, where it will be given, sir? It will be given in the question. Definitely it will be given. This information will be given in your question. First, take municipal value, compare it with the fair rent, guys. Sir, fair rent also will be given in the question. Yes, it will be given in the question. So first you will take municipal value and fair rent. This means whichever is higher. So first you will take municipal value and fair rent. Whichever is higher, you will take this value. Then you will take a standard rent. Sir, even this is given in the question. Yes, absolutely it will be given in the question. You compare with this standard rent. Whichever is lower will come. So first what you did, municipal value and fair rent, you compared only these two figures. Whichever is higher, you got one figure. Whichever is higher figure is there, that again you compare with standard rent, and the lower of these two figures you take, that will be called as expected rent. Guys, what is expected rent? You know, government is expecting at least this much rent from your house property. You may be saying I have received 1 lakh of rent, but government will not blindly trust you, because you may think to offer less income to tax. So that's why government is checking expected rent. What is the expectation of the government from your house property? Minimum rent is this much, and what is the actual rent? Means the rent which you are offering. So government will compare expected rent, expectations of the government, and actual rent what you are offering. Whichever is higher will be treated as the gross annual value, guys. From the gross annual value, municipal taxes, whatever you pay for that property which you have let out or self-occupied, whatever, that will be reduced, and the net annual value will arrive. So from gross annual value, you will reduce the municipal taxes, and net annual value you will arrive at. But the story don't end there. You are given two kind of benefits here. Deductions under section 24, standard deduction at the rate of 30%. Always calculate this 30% on the NAV value, guys. So standard deduction 30%, you will always calculate on the net annual value, and then interest deduction will also be given. Once you remove from the net annual value standard deduction and interest, you will get income from house property. But it is not as simple as it looks like. Lot of times in examination, the examiner will test you in a different languages. You need to be very careful. Now coming to the first term, which is municipal value, which I told you here, municipal value, guys. Lot of times directly the municipal value will not be given by the examiner, or the term municipal value will not be used as such in the examination question. What the ICI will do, you know, it will tweak the language. It will try to confuse you by saying value determined by municipal authorities. So directly the question will not tell municipal value 2,50,000. What the question will tell, you know, value determined by municipal authorities. In that case, it should click you. Oh, this is municipal value. He's trying to say that this is municipal value. So if you in question, if you see the language value determined by municipal authorities, it is nothing but the municipal value, guys. There is one more twist which ICI gives you to trap the students, to make the students fail. Municipal taxes paid 10%, 90,000. For example, it is given like this. Guys, municipal taxes, you always calculate on the municipal value. Now, in this question, the ICI will not directly give municipal value. What the question will do, municipal taxes, how much is paid, that value it will give. So 90,000, if 90,000 is the municipal taxes, and that to 10%, it always means that you have paid 10% of the municipal value as the municipal taxes of 90,000. So if 90,000 is representing 10%, then 100% will be what? Of course, that will be 9 lakh rupees, and municipal value will be 9 lakhs. So directly, lot of times ICI may not give you municipal value in the examination question. It will indirectly give you like this language. Be very, very careful. You can find out the municipal value just by doing this, guys, because a lot of students get confused and get stuck in that thing only. They will be checking where is the municipal value, where is the municipal value. Municipal value is hidden in this language. You need to find out the and derive the municipal value. Next, fair rent. Lot of times ICA will not directly tell you fair rent is this much. They will use the language rent of similar property in the similar locality 2,50,000, like that. When you see this kind of language, rent of similar property in a similar locality, then it means that the ICA is trying to say it is fair rent, guys. Next, standard rent. Lot of times ICA examination, they will not tell standard rent 2 lakhs. No, they will not tell like that. They will tell rent as per Rent Control Act. In that case, you need to understand rent as per Rent Control Act is nothing but your standard rent, guys. This revision is from the perspective of the tips and tricks I want to give you, guys, because lot of tricks ICA will play with you in examination. You should be very, very ready with this. Now, coming to municipal taxes or property taxes, a lot of times a word of property taxes will be used in examination. It is nothing but your municipal taxes, guys. Guys, you know that we have two kinds of properties. One is self-occupied property and let out property. Always keep in mind one thing, guys. Municipal taxes, you will not get a deduction of municipal taxes. This municipal taxes deduction you will not get for a self-occupied property, because for a self-occupied property always the NAV will be 0, guys. For a self-occupied property, you will not get municipal taxes deduction. In the examination, in the question paper, in order to fool you, in order to confuse you, ICA will deliberately give in the question paper municipal taxes paid for self-occupied property also. Be very, very careful. For self-occupied property, you cannot claim municipal taxes as deduction, guys. Municipal taxes is allowed only in the case of let out properties. And in municipal taxes, one more very, very important point, keep in mind, only if the municipal tax is actually paid, then only you will be eligible to take the deduction. Let's say, for example, in the question it says municipal tax is 10,000, out of which only 6,000 is paid, 4,000 is payable. In that case, you will take deduction of only 6,000. Don't consider 4,000 because it is not allowed. So conditions to claim deduction of municipal taxes is what, sir? It should be borne by the owner and it should be actually paid during the year. Guys, let's say, for example, in the question it says municipal taxes pertaining to earlier years is paid in this year, and this current year's municipal taxes also paid. Guys, I told you municipal taxes always give deduction based on the actual payment. So even if it pertains to earlier years, you have to claim the deduction in this year because payment has been made in this year only. Tax arrears of earlier years paid in current year also allowed as deduction. Taxes paid outside India also allowed as deduction. Sir, outside India, sir, remember your residential status topic. If you are a resident and ordinary resident, if you have a rental income from outside India also, you will pay tax on that because you are a resident and ordinary resident. Global income is taxed. Lot of times I say ask question based on this, guys. The property is situated in London, USA, like that. Rental income is received in pounds or dollars, they will tell. All that is taxable. Once it is a let out property, you are paying tax on that. You are very much eligible to claim the municipal taxes which you paid outside India on that property which you have let out outside India, guys. If municipal taxes are given as a percentage, guys, lot of times in examination This kind of language will be used. Municipal taxes paid 10%. If the question says a 10% or 15%, you would always apply that percentage on the municipal value. So in the question directly, lot of times municipal taxes amount will not be given. Municipal taxes percentage will be given. Municipal tax 5%, municipal tax 10%. No amount will be given. In that case, apply that percentage always on the municipal value only. You will apply, guys. You will apply on municipal value. And if, let's say for example, municipal value is 1 lakh and 10% is the municipal taxes paid, it says 10% of 1 lakh will be 10,000. So you will claim 10,000 of municipal taxes, guys. Yes. So if municipal taxes are given in percentage basis, then it shall be calculated on the municipal value. Next, self-occupied or unoccupied house property for which GAV is nil, deduction of municipal taxes is not allowable. So one thing I can say, municipal taxes only for let out property it is allowed, self-occupied property it is not allowed. Now comes the very important deduction, which is interest deduction. Sir, what kind of interest, sir? If you have taken loan in order to purchase the property which you have let out or self-occupied, or if you have taken loan for construction of the house property, that interest you can claim deduction. Here I told you already, interest deduction under section 24 you will be eligible to claim. But guys, you know already there are two kinds of tax regime in the Income Tax Act. One is called optional tax regime, the other is called default tax regime. First, let's discuss about the default tax regime. Guys, you know very well there are two kinds of properties. One is self-occupied, the other is let out. One thumb rule you remember, guys, one dialogue you remember. If it is a let out property, there is no limit on interest deduction. 100% of interest amount what you actually paid, you fully claim deduction, guys, under any regime, be it optional tax regime or default tax regime. Let out property, there is no limit on the interest deduction. 100% of the interest will be allowed, because you are offering rental income to tax now, then you are also eligible for 100% of the interest payments which you make. In case of self-occupied property under the default tax regime, if you are paying taxes for self-occupied property, zero interest deduction you will get. You will not get even a single rupee of interest deduction on self-occupied property if you are paying taxes under default tax regime, guys. If you are paying tax under the optional tax regime, as I already mentioned, self-occupied and let out property will be there. Let out property always give 100% of the interest amount as deduction, no limit. But when it comes to self-occupied property under optional tax regime, you will get deduction. But mind you, for self-occupied property under default tax regime, you will not get any kind of interest deduction. But for self-occupied property, only under optional tax regime, you will be getting deduction. Yes, that will depend on when you have taken the loan, guys. So under optional tax regime for self-occupied property, if you have taken loan before 1/4/1999, for any purpose you take, guys, for repairs, for construction, for renovation, anything you take loan for any purpose, if you have taken, maximum 30,000 only will be allowed as a deduction, interest deduction. Sir, what if I took loan after 1/4/1999, sir? In that case, if you have taken loan for repair of the building, repair or renovation, in that case, maximum 30,000 interest will be allowed. But if you have taken the loan for purchase or constructing the house as such, in that case, if you have to check whether you have completed the construction or purchase within 5 years or not. If you have completed within 5 years the construction, everything, then maximum 2 lakhs only allowed as deduction, interest deduction. But let's say, for example, you constructed the house for more than 5 years. In that case, maximum 30,000 only will be allowed as deduction, guys. Now, guys, this 30,000 limit or 2 lakh limit, whichever we are discussing here, it is put together two self-occupied properties. Because if you remember this dialogue I taught you here, only two self-occupied properties will be exempt. So even if you have more than two self-occupied properties, only two properties will be treated as self-occupied. The remaining will be treated as deemed let out. Now, once it is a deemed let out property, full interest deduction you will get. Guys, keep in mind this one thing, guys. If actually it is self-occupied, but it is a deemed let out property because you have more than two properties, in that case, in case of deemed let out property, full interest deduction you will be eligible to claim, guys. Next, pre-construction interest, one of the loveliest topic, one of the most dearest topic for an examiner for CA intermediate examination, guys. What is a pre-acquisition or pre-construction? Very simple. You took loan and you constructed the house for 1 year or 2 years. After the completion gets over, only you can let out or self-occupy. So pre-construction means before you constructed the house, whatever period is there for which you took the loan and paid interest, that is called as pre-construction interest. Don't worry, I will teach you with practical examples. Guys, remember one thing. Pre-construction period interest always starts from the day you took loan. Of course, the day you take the loan, once the bank sanctions you the loan, once the loan amount is credited in your bank account, your interest will start. Yes, and ends on previous year immediately ending before the date of completion of construction. Guys, we will take one example. Okay, don't worry. Thailava took a loan of 20 lakh rupees from State Bank of India on 1st April 2018. Construction was completed on 30th of November 2020. Guys, remember how many previous years are involved here? 2018-19, 2019-20, 2020-21. So in the middle of 2020-21, the construction got completed. But Income Tax Act says that I will consider pre-construction period only 2018-19 and 2019-20. Sir, what is this, sir? Construction got completed in 2021. No, sir. How can you say only till 2019-20 only? That's how the law is framed. The law says, what does it says? Now see here, dialogue. Previous year ends on, means pre-construction period ends on previous year immediately ending before the date of completion of construction. So the previous year ending just before this 30th of November 2020 is nothing but 2019-20. So 2018-19 and 2019-20 till 31st of March 2020, whatever interest you paid will be treated as pre-construction interest. Sir, but from 1st April, Sir, but from 1st April 2020 till 30th of November 2020, also construction not over, no, sir. Yes, it is not over. Still, this period interest will not be treated as pre-construction interest, because I told you here, this dialogue you need to remember. Pre-construction period starts from the date of loan you got and ends on previous year immediately ending before the date of completion of construction. Now, once you calculate the pre-construction interest, mind you guys, pre-construction interest is allowed in 5 equal installments right from the year the construction got completed. So in our example, the construction, as I told you already, construction got completed by 2019-20 previous year which ended. So in from 2020-21 onwards, you will be eligible to claim the pre-construction interest and the post-construction interest also. But mind you, pre-construction interest will be allowed in 5 equal installments. So let's take this example only. 20 lakh rupees of loan you took, 20 lakhs rupees of loan you took, guys, and the rate of interest is 9% per annum. 20 lakhs loan you took, under the rate of interest is 9% per annum. So pre-construction period will start from 1st of April, end on 31st of March. So these 2 years you will calculate the interest. That interest will be called as pre-construction interest. Pre-construction interest, 20 lakhs loan 9%, 20 lakhs loan 9% for 18, 19, 19, 20, 180, total will be 360. But always keep in mind, this total 3,60,000 rupees you will not be eligible to claim in the year 2021. Full you will not be eligible to claim. You have to split this 3,60,000 rupees in 5 equal installments. So from 2000 till 2019-20, whatever interest is there, pre-construction interest 3,60,000 rupees, you will split in 5 equal installments, means 7 lakh. One second. One second, guys. So 3,60,000 divided by 5, this 72,000 only you will be eligible to claim 72, 72, 72, 72 in 5 years, starting from the year in which the construction got over. So for interest deduction, now see here, calculate interest deduction under section 24 for previous year 23-24. Actual interest paid during the year is 1,20,000. Guys, in this year you paid 1,20,000. In previous year 23-24. But I already told you from 2020-21 2020-21 pre-construction interest you will be eligible to claim in 5 equal installments, means 2021 you will claim 72,000, 21-22 second installment, 22-23 third installment, 23-24. In this current year for which we are calculating the income tax liability, we will be eligible to claim the fourth installment of this 72,000. So pre-construction interest in previous year 23-24, when I calculate income from house property, two kinds of interest deduction I will take. One, pre-construction interest. Number two, the current year interest which I paid. So pre-construction interest I will take 72,000, and 1,20,000 which I paid during this year, that also I will take, guys. So 72,000 interest deduction for 23-24 will be current year interest which I paid 1,20,000, add pre-construction interest which is 72,000, total 1,92,000 of interest deduction I will be eligible to claim. So if I have to summarize, guys, very important concept, lot of times asked in examination. Pre-construction interest starts from the day you took the loan and ends immediately the previous financial year in which the construction got over. Look at this example and go for examination, you will understand this. And once the pre-construction interest you calculate, it will be allowed in 5 equal installments from the year in which the completion got over. Okay, next. So if I have to summarize whatever I have taught regarding the municipal taxes standard deduction and interest on loan, this is the self-occupied property. For both the self-occupied properties put together, municipal taxes for self-occupied property is not allowed. Standard deduction is not available. Interest on loan under optional tax regime it is allowable. Maximum 2 lakh rupees. When I say maximum 2 lakhs, depending on the 30,000 or 2 lakhs category, everything, but maximum is 2 lakhs under optional tax regime. But for self-occupied property under default tax regime, you will not get any kind of interest deduction. For let out property, full municipal taxes allowed, provided you made actually payment. Standard deduction 30% will be given on the NAV, and under optional tax regime also you get full interest deduction, and under default tax regime also you get full interest deduction, guys. Next, very important point, municipal taxes are allowed only if actual payment is done. Interest deduction is allowed on accrual basis even if payment is not done, guys. Very important point this is. For municipal taxes I told you, only if you actually make the payment you will get deduction. But for interest on loan, even if you did not pay, means interest is payable, still you will get the deduction, guys. Very important. In examination they may confuse you. Now there are some special cases in case of income from house property, very important. First is concept of vacancy. Guys, what is vacancy? Let's say for example, I have given on rent a house property. For 8 months the tenant was there. Now in a year there are totally 12 months, correct? In a year there are totally 12 months. Out of 12 months, for 8 months some tenant was occupying the property on a let out basis. Then the tenant, after the end of 8 months, the tenant vacated the property. So for 4 months, no one came, no tenant came in that property. I was intending or I was finding out a tenant, but I was not able to find any tenant. The property was vacant. Mind you, the tenant, after the tenant left out the property, I did not go and self-occupy that. That the property was idle and I was looking for a tenant. That is called the concept of vacancy, guys. Very, very important. Lot of times asked in examination. Let's say, for example, Ganesh has a let out a property. Municipal value of the property is 250. Fair rent is 2 lakhs. Standard rent is this. And rent per month is 20,000 per month, guys. Now, closely have a look. These three items are annual values, means these are for 12 months, correct? These are for 12 months, but rent 20,000 per month is given. This is per month rent. Now, tenant vacated the property on Jan 2025, 31st of Jan, means for 10 months the property was let out, 2 months the property was vacant, out of total 12 months, correct. Next, expected rent will be what? Of course, guys, expected rent means what? First you will compare municipal value and fair rent, whichever is higher is 2,50,000. This value we will compare with standard rent of 2,10,000, whichever is lower you will take, which is 2,10,000. So here expected rent is 2,10,000. But guys, tell me one thing. Expected rent which we just now calculated 2,10,000 is for 12 months. Correct? It is for 12 months because per annum value is given. But actual rent you will be calculating only till Jan, which will be for 10 months. 10 months of 20,000 will be what? 2 lakh rupees. Correct? Now guys, recall this concept of GAV. Recall this concept of GAV. What do we do here for GAV? We compare expected rent with actual rent. Guys, tell me, if you are taking expected rent of 12 months and the actual rent of 10 months, is it fair enough? How can you compare 12-month figure with the 10-month figure? Not possible. Correct? Now focus on this. Once again. Yes. So here, when we took this 2,10,000 as expected rent, this is pertaining to 12 months, no annual value. But actual rent you are calculating only till Jan, which is 10 months. So expected rent is for 12 months. This value 12 months. Actual rent is 10 months. If I compare, that is not a fair comparison. That's why you see here, actual rent is 10 months. Only till Jan you will calculate, because February and March the property was vacant. Correct? There is no actual rent, but expected rent you are taking for annual value. So if I compare expected rent which is pertaining to 12 months and actual rent which is pertaining only for 10 months, this is not a fair comparison, guys. And that is why GAV, in case of vacancy, there is a special method by which you actually calculate the GAV. So in case of only vacancy, you will apply this concept, guys. Don't apply in other special scenarios. Only in case of vacancy, you will be applying this. Sir, how to find out the GAV in case of vacancy, sir? Very simple. Expected rent, we know it is pertaining to 12 months, correct? Actual rent, just now we saw it is for 10 months because till Jan the property was given. Then for the vacant period for 2 months, you add this vacancy rent here. Once you add this vacancy rent, this 10 plus 2 will become 12 months. Then you compare with the ER of 12 months. Now the fair comparison will happen. Correct? Fair comparison will happen. So that is why vacancy rent is added here. So ER always we will not only compare with AR. In case of vacancy, we will add VR also, which is vacancy rent. Now, if your ER is less than AR, think logically, guys. Generally, for GAV, we take what? ER or AR, whichever is higher, we need to take. Now, in this case, if ER is less than AR plus VR, obviously this AR only will become GAV. Sir, why can't we take total as GAV, sir? You cannot take because only actual rent you received. No, that only will go for gross annual value. But if your ER means your expected rent is more than the AR plus VR, then your GAV will become that expected rent. We will take some examples. Example number 1. Actual monthly rent is 20,000. Monthly. Expected rent is 1,92,000. Of course, this will be 12 months, right? expected rent is of 12 months. Now vacancy 3 months means this 9 months you will take into 20,000, that will be 1,80,000, correct? Yes. So just now I told you, never compare directly 1,92,000 with 1,80,000 of actual rent. Don't directly compare. First, what you will take, expected rent 1,92,000, which is of 12 months. Then 1,80,000 is what, actual rent pertaining to 9 months, and this 60,000 is what, 20,000 into 3, which is 3 months. Now 9 plus 3 will become 12 months. If we compare 12 with 12, it is fair enough. So you see here 1,92,000 is compared with 180 plus 60, which is 240. Now you see ER and AR plus VR, whichever is higher. Higher is this, but I just now told you 240 directly you will not take GAV. You will take 1,80,000, which is actual rent, as your GAV, guys. Next, example number 2. Monthly rent 3,000 per month. Expected rent is 1,95,000, which is 12 months. Vacancy is 2 months. So this 10 months and vacancy of 2 months. 10 months means what? 3,000 into 10 will be 30,000. 2 months means 3,000 into 2 will be 36,000. Total 36,000. You compare with 1,95,000. 195 and 36, whichever is higher, is what? Expected rent. So your GAV will become this expected rent. Next, example number 3. Expected rent 3 lakhs. Monthly rent is 25,000 per month. Vacancy is 3 months. So of course 25,000 you will multiply for 9 months. This 25,000 into 3 you will take VR. So 23 into 5 will become 75,000. 25,000 into 9 will become 2,25,000. The total will become 3 lakhs, 3 lakhs. Sir, no, both are equal, sir. Always take GAV of actual rent only, because you will take expected rent only when expected rent will be higher than actual rent plus vacancy rent. Now, so there are some thumb rules you need to remember. Only in case of vacancy you apply this concept. Don't apply in other cases. Sir, which other case? Let's say, for example, property is let out for part of the year. Property is self-occupied for part of the year. Don't apply this concept. Be very, very careful. This applies only in the case of vacancy. Sir, what is the difference between vacancy and self-occupied, sir? Let's say, for example, in the first scenario I told you, for 10 months, for 8 months, the tenant was there in the property. After that, the tenant vacated the property. But you did not self-occupy it. You were looking for a tenant, you did not find it. That is a case of a vacancy. But let's say, for example, second scenario I'll tell you. For 8 months, the tenant was there in your property. You vacated the tenant and you then self-occupied the property for part of the year. So part of the year vacant, part of the year let out, and part of the year you self-occupied. That is not a case in which you will apply this 12 months and all. Don't apply this. Only in case of vacancy you will apply this. So only in case of vacancy we need to compare 12 months of expected rent with the 12 months of actual rent plus vacancy rent. Always choose whichever is higher. If ER is higher than AR plus VR, in that case GAV will become ER. If ER is less than AR plus VR, GAV will become AR. EAV, if it is equal, then GAV will become AR. Then, concept of part year let out property and part year self-occupied property. Now guys, one thumb rule you remember. Even if you let out a property for a single day during the year, it becomes a let out property, guys. You cannot say, sir, for part of the year it is self-occupied. No, I'll treat it as self-occupied property. No, you have let out for even a single day in a year, that property will become let out property. Thumb rule is, even if a single day property is let out, it is treated as let out property only. Correct. Next, sir, let out property, when you say here let out for whole the year, yes, you have to treat it as if you have let out for the whole year. But mind you, when you will take the actual rent, you will take only for the year, for the period for which you have actually got the rent from the tenant. Okay. Next, compare full year expected rent with actual rent of actual let out property period only. No notional rent here. Means, let's say, for example, for 8 months you let out the property, for 4 months you self-occupied the property. In this case, you will compare 12 months of expected rent with 8 months of actual rent. You will not take add 4 months and all. No, you will not do that. So 12 months of expected rent you will compare with 8 months of actual rent. You will not take additional 4 months here, because this is not a case of vacancy. This is a case of part year let out, part year self-occupied, guys. Municipal taxes, everything you will get full deduction because it is already a let out property. So you will get full interest deduction, full municipal taxes. Don't split it, guys, because I told you, even if a single day property is let out, it is a let out property, and once it is a let out property, full municipal taxes you will get, full interest deduction also you will get under both the tax regimes. Next example I'll take. Raja owns a house property in Chennai. Municipal value 5 lakhs, fair rent, standard rent. If I have to take the GAV, if I have to take the expected rent, this is full year's value, correct? This is of 12 months value, guys. So if I have to take the expected rent, 5 and 420, whichever is higher is 5 lakhs. Then 5 lakhs and 480, I have to compare, whichever is lower is 4,80,000 will become. So my standard rent will become my expected rent. Guys, this is a 12 months period. Correct. Next, property was let out till December only. Guys, only for 9 months the property was let out at 50,000 per month. So 50,000 into 9 will become 4 lakh, 5 nines are 45. That will be 4 lakh 50,000 of 4 lakh 50,000 of actual rent pertaining to 9 months, guys. Now in this case, let's see what is this. Thereafter, tenant vacated the property and Raja used the property for self-occupation. In examination, a lot of students get confused by looking at this vacated. They'll think this is also vacant case. Let me add 3 months. Gone. Sunyam you will get in your mark sheet. So once you see vacated, that does not mean it is a vacant property, because read the story full. Raja used the property for self-occupation, guys. So this is not a case of vacancy, guys. So you will not compare 12 with 12. You will compare 12 months of expected rent with 9 months of actual rent, guys. So you see here, expected rent is 4,80,000, which we compared here, which we got it here, and actual rent will be 9 months only we will take, and GAV will be 4,80,000. I hope that is clear. Next, partial house property let out and partially self-occupied. What is this? Let's say, for example, there is a building. There are 3 floors, floor 1, floor 2, floor 3. Out of these 3 floors, 1/3 means the first floor you have self-occupied property, and the next 2 floors you have let out property. So 2 floors you let out to someone, and 1 floor you have used it. So 1/3 will be self-occupied and 2/3 will be let out property. In that case, guys, remember always rule: split everything including taxes, interest based on proportion of the area. Means just now I told you, if you have a 3 floors, 1/3 is self-occupied property, 2/3 is let out property. You have to split municipal value, fair rent, standard rent, interest, municipal taxes, everything you will split. So if the property itself is split into let out and self-occupied property, you also go and split. Let's see one example. Prem owns a house in Madras. 2/3 portion is self-occupied, 1/3 is let out. Guys, here 1/3 is let out, guys. 1 floor is let out, 2 floors are self-occupied. Now, municipal value per annum. Guys, always this municipal value and all will be given for full building, no? So when a government gives you municipal value, they'll give for the full building the municipal value, correct? Fair rent, standard rent, everything. This is pertaining to full building. But keep in mind one thing. Rent, is it for full building? No, this is only for let out portion only, because you have given rent only 2 floors, or sorry, let out only 1/3. Means this rent is 1/3, guys, but this is full value of the building. Municipal taxes you paid for full building, no? Interest also you pay for full building, no? So these are all full values, but this is only 1/3 value, guys, because this is actual rent which you given for the let out portion of 1/3. So what you will do is self-occupied property, let out property. See, self-occupied property is 2/3, let-out property is 1/3. Of course, for self-occupied property, we know very well that the NAV itself becomes 0. So here you see municipal value, everything you have to take 0, 0, 0, standard deduction 0, but interest when it comes to interest is total 1,20,000 guys. If the total interest is 1,20,000, I told you to split. So out of 1,20,000, 1/3 let out property, 2/3 self-occupied property. Correct? Now, so 2/3 is self-occupied property. So out of 1,20,000, 2/3 under optional tax regime only this is allowed, guys. So I have written optional tax regime. If this is a default tax regime, you will get 0 here. Yes. So 1,20,000 into 2/3 will be 80,000. So loss from house property will be 80,000 for the self-occupied portion of 2/3. Whereas in let out property, guys, 1/3 portion, you see here 3 lakhs, 270, 330, everything 3 lakhs into 1/3, 270 into 1/3, 330 into 1/3, everything is splitted for the let out portion, guys, because only to the extent of let out portion you can compare, right? Because here you have taken 1/3 means everything has to be 1/3. So expected rent you will get 1 lakh. House or municipal value 1 lakh, fair rent 90, whichever is higher is 1 lakh. 1 lakh you compare with 1,10,000, whichever is lower will become standard rent, will become expected rent of 1 lakh. Now, mind you, always actual rent you will take full, no, because you have let out this 8,000 already pertains to, once again, this already pertains to 1/3 portion which is let out, because actual rent you will take full, guys. 8,000 into 12 months will become 96, whichever is higher will become your GAV. Again, guys, keep in mind municipal taxes also 1/3. Under standard deduction anyway 30% you will get full, and 1,20,000 interest also you will split. Very simple. If I have to say, if the property is split into self-occupied and let out, the property is partly let out property, partly self-occupied property, always split, because the building itself is split into partially let out property and partially it is self-occupied property, guys. So then you will get income from house property. Next, the lot of times jointly and co-owned property means in a property there are two owners. In that case, very simple step I'll tell you. First, don't even look at joint ownership. Simply step 1, compute income from house property normally as if property is not jointly owned. Compute like that. First, generally compute and finally divide the income from house property among the owners in their ownership ratio, guys. Okay, next, unrealized rent. See, a lot of times in the question they will be given rent, tenant did not pay the rent. In that case, in actual rent, you can reduce that unrealized rent provided rule 4 conditions are there. If you remember that conditions, if they are satisfied, then only from the actual rent you remove that unrealized rent. Let's say, for example, actually you let out for 12 months. Out of that, unrealized rent means the tenant is not paying a rent for 4 months. You can remove this 4 months of rent and only offer 8 months of rent for income from house property provided rule 4 is satisfied. If rule 4 is satisfied, reduce from the actual rent. Now, this unrealized rent, if it is recovered in future, in that case, recovery of unrealized rent is there. Very simple. Take that whatever recovery happened, from that you claim standard deduction at the rate of 30% and net 70%. Net 70% you offer it to tax. This is all, guys. Within just 45 minutes, we have covered 5 marks, 10% of your income tax paper, 50 marks at your CA intermediate level is covered, guys. Yes, so revise like this. I'll be coming up with a lot of amazing stuff like this on this channel. 100% English language, only Tax Thailava channel for only tax purpose at CA, CMA, inter or final level, guys. Yes, if you're new to my channel, please do subscribe. Please give a like for my hard work, guys, and do let me know in the comment section how have you found out this revision video. And you know what, believe in manifestation and put in the comment section, I am going to clear damn coming attempt. I will become CA in future. So manifestation is real, guys. put it in the comment section, and your achievement will definitely come to you guys. Please share this video with your friends. Also do like this video and let me know in the comment section what are your thoughts about the way I taught you this concept. I have uploaded already total income, set of carry forward of losses, residential status, and a lot of things. And a lot of other stuff is also going to come for your examination. Okay, so this is all from this video, guys. PGBP is one of the most important topics in CA inter income tax paper. Every attempt in the very first question, total income computation question of 15 marks, majority of the adjustments are asked from this PGBP topic only. So it becomes very important to learn this chapter very conceptually and carefully, guys. I will take you through all the concepts of PGBP chapter step by step in a beautiful manner with lot of examples also included in this discussion. So be tuned in this discussion till the end. Don't miss even a single topic in this. So guys, you need to understand what is PGBP actually. PGBP is nothing but we are trying to find out the profit of a business. How do you generally find out a profit of a business? Very simple. You will take sales minus all the expenses, or income minus expenses, we can say. So from income, you will reduce all your expenses, and the net profit is called the ultimate profit, which is of a business. Correct? So on the credit side of your profit and loss account, you will have all your incomes, and on the debit side of your profit and loss accounts, generally you have all the expenses which you claim against the income. And what is the balancing figure is called as the profit from business. That's all. It is as simple as that. So in this chapter, we will be discussing all those incomes which are taxable under the PGBP head, and all those expenses which we can claim under the PGBP head. Once we take income and reduce from that all the expenditures, we will arrive at the business profit, which is taxable under the PGBP head. Now, in this chapter, we will be dealing with multiple sections. See guys, always remember section 28 and section 41 only discuss about the income portion. So I told you there are two things, income and expenditure. Income is dealt with under section 28 and 41. But right from section 30 till section 40A, it will be discussing about the expenditures. But section 30 to 37 discusses about the deductions which we can claim against the income, and section 40 and 40A will discuss about the disallowances. Means these are the expenses which we cannot claim against the income. But in section 29, the method of computation of PGBP is given. What is method? Very simple method. It is just a P&L kind of a format. 29 says that on the credit side, you have to consider section 28 and 41 incomes, and on the debit side, of course, you will claim the expenses under section 30 to 37. I will be taking you through all the sections which are relevant for PGBP concept. First, we will take the section 28, which is income section. So here in section 28, there are list of things which are given has to be considered as income under the PGBP head. Income chargeable under PGBP. What are those? First one, it says any profit or gain from business or profession has to be considered as income, business income. Any profit you get from a business or a profession is taxable as the PGBP income, guys. It may be from, vocation. What is a vocation? Kind of actors or temporary business. You may be doing a permanent business or you may be doing temporary business, does not matter. You're doing business, that's all. Or you're carrying on some profession, and whatever income you have earned, that is taxable under the PGBP head. Any interest, salary, bonus, commission, remuneration received by a partner from partnership firm is also taxable under PGBP head. Now you will be thinking, sir, interest should be taxable under IFOS, salary should come under salaries head, and this commission, remuneration should again go under salary head. No sir, why are we taxing it under PGBP head? Because mind you guys, partner is owner of a partnership firm. Part owner of a partnership firm. He is not an employee, and that is why the salary, interest, whatever received by a partner from the partnership firm in which he is a partner will be taxable under the PGBP head only. Further, we will be discussing about section 40B. At that time, you will be understanding what is this to the extent allowed under section 40B. Don't worry, at the end I'll be teaching you 40B also. The third item is business of letting out of commercial properties. Now, generally, we have learnt under income from house property that if you let out any house property, in that case, rental income would be taxed under income from a house property head. But mind you, that was a residential house property. If you are into business of letting out, your business itself is letting out of commercial properties, then that rental income what the business will earn will be treated as business income. Next one is non-compete fees. What is a non-compete fees? The best example is Ambani brothers. See, when Dhirubhai Ambani, the father of Anil Ambani and Mukesh Ambani, died or expired, there were lot of businesses, and those businesses were divided into two parts and given to Mukesh Ambani and Anil Ambani. When they got separated, they had an agreement, non-compete agreement, that, say for example, Reliance Communications, telecommunications was with Anil Ambani. So Anil Ambani told Mukesh Ambani that he should not get into telecom industry for another 10 years. But in order to do that, Mukesh Ambani will collect some non-compete fees from Anil Ambani. So that is called non-compete fees. That is also taxable under PGBP. Then some received for not sharing know-how, patent, copyright. You know, during COVID, there was a company called as Bharat Biotech who invented the COVID vaccine. Now, COVID vaccine was exported throughout the world. Every country we exported from India. But China was an evil country at that point of time. No one was liking China because China is the place where from the COVID actually started. So, Modi may ask the Bharat Biotech company not to share the COVID vaccine formula with China. But Bharat Biotech will tell, sir, if we do not want to share, then you have to compensate us for that. And that is what is called some received for not sharing the know-how, patent, copyright. So Modi government paying money to Bharat Biotech for not sharing COVID vaccine formula with China. So Bharat Biotech, whatever money it will receive from Modi government, that will be taxable under PGBP head, because that is some received for not sharing a know-how. Know-how means the formula for COVID vaccine. Profit on sale of import entitlement license. See guys, if you want to import any goods from outside India, it is not so easy. You have to take a license from the Indian government that we will be exporting so many quantity of goods. Let's say for example, you took a license to import 1000 kgs, to import 1000 kgs of product. Or let's say for example, you took a license and you mentioned in that license that we will be importing for 100 crores of imports. But in this year, there is no business, there is no demand for your product. You were only, importing 50 crores. Rest 50 crores balance, you have the credit, the license. So someone asked you, we want to import, but we do not have license. Can we use your license? Please give me your license to us. We will use that 50 crores for import of our products. In that case, if you transfer the import entitlement license to someone, and if you earn some profit out of that license, that is also taxable under PGBP head. Some received from key man insurance policy. Generally, companies take insurance for the key man like CEO, CFO of a company, and if any insurance amount has received by the business, that is also taxable under the PGBP head. Duty drawback against exports, like duty refund, if you receive any duty refund or subsidy on exports. If you export a lot, government will give you a lot of subsidies. All these subsidies are income for business, and that's why these duty drawbacks are treated as the business income and taxable in the hands of business. Profit on transfer of duty entitlement passbook. Duty entitlement passbook is also kind of, passbook which you have. If you export a lot, then you will get a lot of duty drawback or duty refunds. That is also, if you transfer that, and if you earn any kind of profit on duty entitlement passbook, that is also taxable under the PGBP head. The next section. So what we have discussed so far under section 28 are those items which are to be considered as income under the credit side in your profit and loss account as per the PGBP provisions. Now we will get into the debit side of profit and loss account. Later on, I will teach you at the end of section 41. 28 is done. Now we will get into the debit side of the profit and loss account, which we can claim as expenditures. The first section which we are going to discuss is section 30. Section 30 says that any rent, rates, taxes, repairs, insurance of a building if you pay, that you can claim it as expenditure. Of course, if you are using any building for your business purpose, then if you pay any rent for the building or any taxes for the building or any repairs, if you have done revenue repairs, you can claim. And if you have taken any insurance policy for the building, you can claim it as expenditure in your books of accounts. Correct or not? So that is dealt with in section 30. This is a expenditure section. But mind you, under section 30, we are discussing only about buildings, not other assets. So who is paying? And depending on who is paying, whether it will be allowed or not. If it is paid by owner, rent if it is paid by owner, then it is not allowed. Means, say for example, I am owning a building. This classroom setup is owned by me only. The building is owned by me only. I cannot pay rent to my own self. No, it is my own building. So it will not be allowed. But all other expenses will be allowed, even though I am owner of the building. If I pay any taxes for the building, it is allowed as business expenditure because I'm using the building for my business, coaching business purpose. If I take any insurance, the insurance premium is allowed. Revenue repairs, if I do any, that is allowed. But mind you, capital repairs, we generally do not claim it as a business expenditure because capital expenditures or capital repairs, you have to capitalize in your books of accounts and you have to claim depreciation on that. So capitalize that. If you are a tenant, you are not the owner of the building, you are a tenant, means you have taken on rent the building for your business purpose. In that case, of course, rent is a business expenditure in that case. So that is allowed. Taxes are allowed. Insurance is allowed. Insurance premium is allowed. And revenue repairs, if I any do for that building which I took on rent, even that is allowed as business expenditure because I am using it for my business purpose. But mind you, I am not the owner of the building. But if I do any capital repair, what will happen? Even then, if you have spent some capital expenditure on the building which you have taken on rent, still that also you will capitalize in your books of accounts and you will be treating that as, you will be treated as a deemed owner and you will be treating that as a deemed asset and you will claim depreciation on that. Capital repairs on building owned by, incurred by the owner. If you are owner and if you incur that expenditure, of course you will claim depreciation on that. You will capitalize it in books of accounts. But capital repairs on building incurred by tenant, in the hands of tenant, the capital expenditure will be treated as deemed asset. And mind you, even the tenant can claim depreciation to that extent of capital expenditure which that that tenant has incurred. So this was regarding section 30. The next section is section 31. This talks about repairs and insurance of plant and machinery and furniture. Section 30 was about building, but here we are talking about plant and machinery and furniture. Mind you, here we had taken rent also, but here rent is not available because it is not that you cannot claim rent as an expenditure. You can claim, but not under section 31. We will claim it under the general deductions section. So here only repairs and insurance of plant and machinery and furniture is covered. So if you are the owner of building which you are using for your business purpose, and of course you are paying rent, of course it is not allowed. But you are a tenant. I told you it will be allowed under general deduction section, under section 37. We will not allow under section 31. And insurance, revenue repairs, of course they are allowed. But capital repairs if you do in plant and machinery and furniture, not allowed. Of course you have to capitalize that and you can claim depreciation on that. Same provision as the earlier one. Now we will get into the next important, most important. Lot of times either a separate MCQ is asked on depreciation, or you will see that in the total income computation question, one complicated adjustment would be given on depreciation. You need to read this depreciation very, very carefully. Guys, whenever you want to claim depreciation under Income Tax Act under section 32, two conditions are very, very important. Both the conditions has to be met. Both the conditions has to be met. Condition number one, asset must be put to use, guys. Unless you put to use the asset, you cannot start claiming the depreciation. So you will start claiming the depreciation. You will calculate the depreciation from the day you started using the asset. Before put to use the asset, you cannot claim depreciation. First condition is that. The second condition is assessee must be owner of asset. If you are not owner of asset, you cannot claim depreciation under Income Tax Act. So these twin conditions has to be met. Now, when we say put to use, it can be two kinds of use, active use and passive use. Active use means actually you are using that asset. But passive use, fire extinguishers, you will just put it, you will mount it on the wall, that's all. When the fire will come, you will use it. But you have started using that asset, that is called as passive use. Both usage is good enough, but usage of the asset is very, very important. Next, in case of lease, depreciation can be claimed by lessor, because who is the owner of asset? Lessor is the owner of asset. And what I'm saying here, whoever is owner of the asset, they only can claim the depreciation. So in lease, lessor is the owner of asset, but giving on lease to lessee for usage of asset, but lessor only will always claim the depreciation. In case of hire purchase, what will happen, sir? In case of hire purchase, depreciation can be claimed by the buyer itself from the beginning. Are you getting it? Next. See, for depreciation purpose, the assets has been classified into different class categories. Class 1, building. Class 2, furniture. Class 3, plant and machinery. Class 4, intangible assets. Under this building also, we will see different kind of buildings, furniture, plant and machinery, intangibles. But keep in mind one thing. Building, furniture and intangible assets, apart from these three categories, whatever is there will fall under the plant and machinery category only. I repeat, whatever mentioned in building, furniture and intangible assets, apart from these three assets, whichever asset is there, that will fall always under plant and machinery category or class only, because this is a residuary class. Now, there are four assets on which depreciation is not allowed. Goodwill of business or profession, land, animals and tea bushes, you cannot claim depreciation. Now, we will look at what is the method of depreciation I need to use in case of PGBP under income tax. Guys, in your accounting, you might have followed different methods of depreciation. You have to forget about it when you read income tax subject. Under income tax, there are only two methods of depreciation. One is called WDV method. The other is called straight line method or SLM method. You know what? It is mandatory under Income Tax Act to calculate the depreciation under WDV method only. It is mandatory. But there is only one exception. In case of power generation and distribution business, guys, they have the option, either they can claim depreciation under SLM method or WDV method. But all other businesses are mandatorily required to calculate the depreciation using WDV method only. They do not have option of SLM method. Now, we will look at the rates of depreciation. See, in your accountancy, you might have read something else regarding the rates of depreciation. Here in income tax, the rates are prescribed. The rates are given separately. You have to follow these rates for claiming the depreciation. Building has been categorized into three categories. Residential building. You know what? Let's say, for example, Tata Consultancy Services, TCS, is providing building for residence of its employees. So there is a staff quarters which is owned by TCS company. So in the balance sheet of TCS company, on the asset side, staff quarters building is there. On that, TCS can claim depreciation at the rate of 5%. Other buildings, you can claim at the rate of 10%. Temporary building or structure. Some temporary structure is constructed. In that case, 40% depreciation can be claimed. Furniture, there is only one category, 10% you can claim on furniture. Intangible assets. patent, know-how, copyrights and all, you can claim 25%. In plant and machinery, the first one is motor vehicle. If you use motor vehicle for office use, in that case 15% you can claim depreciation, but due to government scheme, if you had purchased the plant and the motor vehicle between these dates, 23rd August 2019 till 31st of March 2020, in that case you are eligible for a higher depreciation. If you are into hiring business of motor vehicles, then you will get extra depreciation, which is 30%. And if you had acquired during this duration, then the rate of depreciation which you claim is 45% you can claim. If you have a ship, you can claim 20%. For aircraft, 40%. Computer and computer software, very, very important. Lot of times in examination, they will ask you 40% you can claim. Pollution control equipments, 40%. Any kind of book you have, whether it is an annual publication, normal publication, library, business, anything, you're having a book as asset, 40% you can claim as depreciation. Renewable energy devices, including e-vehicle, if you have, that 40% you can claim as depreciation. Windmill and equipment, if you purchased before 1/4/2014, 15% you can claim, and on or after 1/4/2014 you can claim 40% depreciation. Oil wells, you can claim 15% depreciation, and any other plant and machinery, guys, whichever is not mentioned specifically above, you can claim 15% as depreciation. Mobile phones and EPABX, you can claim 15%, and printer, scanner, UPS, these are treated as computer only, you can claim 40%. Now you will get a doubt, sir, do we need to remember these depreciation rates for our examination purpose? Yes, you need to remember. At least you need to remember plant and machinery 15%, computer 40%, furniture 10%, building 20%, 10%. Like this, you need to remember, very, very important. So, system of depreciation, I already told you. For a power generation business, SLM method or WDV method, whichever is beneficial for them, they can actually follow. But all other businesses are mandatorily required to follow WDV method. You know what, in accounting, what do? You calculate the depreciation for each asset separately, but you cannot follow that method in income tax. You have to follow something called as block of asset method. Means you will block the assets which are falling under the same class and same rate, and you will group the assets and you will create something called as block of asset. On the total block, you will calculate the depreciation. So same class of asset. What is the class of asset? Building is a class, furniture is a class, plant and machinery is a class, intangible asset is a class. Same class and same rate of depreciation asset. In building, there may be 5% depreciation building, there may be 10% depreciation building. But you cannot create a block using 5% building and 10% building. No. You will create a block using same 5% building 1, 5% building 2. Like that, you can create a block. Once you create a block, how will you calculate the depreciation is the question. First, always take the opening WDV of the block. To that, you will add 3 things. First, you will add into the block the asset which you have put to use more than 180 days. That value you will add here. Then you will add the value of asset which you have used for less than 180 days. And also you will add the asset not put to use. You acquired but not put to use, also you will add. But you will get a doubt, sir, for depreciation purpose, why are we adding the asset not put to use? Because it is not eligible for depreciation. Don't worry, that you will gradually know in some time. But we have to add it because ultimately it forms part of the block. You're not claiming depreciation on that, but it should form part of the block. And you will remove the selling price of asset, means any assets which you have sold during the year, that amount you have to reduce. The sale price you have to reduce of any of these assets. If you sold during the year, you have to reduce that. Then you will get WDV for the purpose of depreciation. This WDV for the purpose of depreciation, whatever is that, that you will take here separately WDV for depreciation purpose. And you will follow these steps to calculate the depreciation. Step 1. You have to, from the WDV for the purpose of depreciation, whatever it has come here, from that you have to reduce in step 1. First, you reduce those assets which you acquired and not put to use. So automatically you are not claiming depreciation on that. No depreciation, just ignore this. Then second, you will take asset acquired and put to use less than 180 days on or after 4th October. Guys, always remember, until 3rd October, if you use the asset, then you have used the asset for full year. If you started using the asset on 4th October and later on anytime during the year, then you have to claim half rate of depreciation because you are using the asset for less than 180 days. So asset acquired and put to use less than 180 days, whatever is there, on that you claim half rate of depreciation. And on the balance assets, you can claim full rate of depreciation because the balance assets are those assets on which you have used for more than 180 days. Now, rules for depreciation. If asset is acquired during the previous year and put to use for less than 180 days in that previous year, in that case, you will claim half rate of depreciation. Let's say, for example, you acquired an asset during the year and you put to use the asset in this year only in which you acquired for less than 180 days, you will claim half rate of depreciation only. But mind you guys, very, very important point. If you acquired an asset in this current previous year, but you did not put to use the asset in this previous year, you put to use the asset in the next previous year. And in next previous year, if you use the asset for less than 180 days, still you will claim full rate of depreciation only. Because the 180 days less high, more than 180 days, less than 180 days condition is applicable only if the asset is put to use in the year in which you acquired it. If acquisition year is different from put to use year, you will not check less than 180, more than 180 days. Next, always first calculate depreciation on asset, put to use less than 180 days and then balance WDV for depreciation. This we already have seen in the table. So what will happen once you will take this WDV for depreciation purpose, you will reduce the depreciation from here and the balance will be called as closing WDV of the block. So from this you calculate depreciation and reduce here and the balance will be called as closing WDV of the block. This closing WDV will be taken to the next year and that will be called as opening WDV for the next year. Important points, very, very important. If the asset is put to use for less than 180 days, of course, you will claim only half rate of depreciation. But mind you, this is applicable only in year of purchase. If you use it next year, not applicable like this. Put to use up to 3rd October means full rate. Means from 1st April of the previous year till 3rd October, if you start putting the use the asset, then you can claim full rate of depreciation. But if you put to use the asset on or after 4th October, always you can claim half rate of depreciation. Any asset sold during the year does not qualify for depreciation. That anyway gets reduced for the WDV purpose or depreciation. Additional depreciation. Whatever we have discussed so far above was a normal depreciation. This was normal depreciation. But there are some special cases in which you will be getting additional depreciation in addition to the normal depreciation. That is dealt with in section 32(1)(2)(a). But there are some conditions attached to it. Only if you satisfy the conditions, you can actually claim the additional depreciation. The first condition is the new plant and machinery should be there and that new plant and machinery only eligible for depreciation. If you buy second-hand plant and machinery, you cannot claim additional depreciation on that. And mind you, the additional depreciation is eligible only on plant and machinery and not on other assets. And the plant and machinery should be brand new. You cannot buy second-hand plant and machineries is not eligible for additional depreciation. You may claim a normal depreciation. And The assessee who wants to claim additional depreciation should be engaged in manufacturing business or power generation, distribution, transmission business. Only if you are into these two kinds of businesses, you are eligible for additional depreciation. And mind you, one more very important thing. This additional depreciation is not eligible under default tax regime. This is only available under optional tax regime only. And one more thing. If you want to claim additional depreciation, you must follow WDV method of depreciation only. If you follow SLM method of depreciation, you cannot claim additional depreciation. Sir, what is the rate of additional depreciation? You will be eligible to claim additional depreciation at the rate of 20%. But if you put to use the asset, the new asset which you purchase, new plant and machinery, if you used for less than 180 days, you can only claim half rate of depreciation. And mind you, this additional depreciation, let's say for example, you purchased the asset in this year, you used it for less than 180 days. So additional depreciation you will claim half this year. Means 20% half is 10% in the first year and the rest 10% you will claim in the next year. Got it? Next. Plant and machinery used in office or residence is not eligible for additional depreciation. Means the plant and machinery whichever you purchased, you should use that plant and machinery for manufacturing purpose only. If the plant and machinery which you purchased is used for other than manufacturing purpose, you are not eligible for additional depreciation. If you use that in office or residence purpose, then it is not eligible for depreciation. But there is an asset called as forklift truck. You know, in big factories you will see one mini truck will be there, which will, you know, lift all the raw materials and take it to the manufacturing machine. That forklift truck is eligible for additional depreciation because that truck you are using for manufacturing purpose only. So additional depreciation you can claim. Mind you, printing business is specifically mentioned as the manufacturing business only, and that is why in printing business, even if you buy any machinery, that is also eligible for additional depreciation, guys. Rule: additional depreciation is not allowed every year. Assessee can claim only in the year for the first time you put to use. So additional depreciation is not allowed for every year for the lifetime of the asset. No, only first time when you put to use the asset, in that year you can claim the additional depreciation. So that was from the standpoint of normal depreciation, additional depreciation, very important points. Now we will get into the actual cost of asset, what we need to consider. This is given under section 43(1). See guys, cost of asset will be capitalized in the books of accounts. But what are those items? What are those factors which we need to consider as cost of asset? Cost of asset may be different things. See, let's say for example, you purchased one plant and machinery. That price of the plant and machinery is actually cost of asset, no doubt. But apart from the price of machinery which you spent, you might have spent some additional cost like installation cost, trial expenditure cost, some taxes you might have paid, some interest on loan you would have paid, transport expenses from the from the seller till your factory, and installation expenses. These are some extra expenses which you might have spent for purchasing the asset. Are these expenses can also be capitalized and can we claim depreciation on that is the question. And that is clarified in this section 43(1), which says that actual cost of asset will include actual purchase price of the asset. To that we will add transportation expenses for getting the asset from the seller's godown to your factory, installation expenses which you spent to install the machinery, trial run or testing expenses if you spent something, taxes and duties. But mind you, taxes and duties you can only consider if the credit of that taxes you have not received. If you are receiving the credit of that GST credit, if you are receiving, in that case you cannot claim it. So if tax credit is allowed, then not claimed. Interest on loan. Always keep in mind one thing, guys. Interest on loan. If you have taken loan for purchasing an asset, in that case, you can capitalize the interest which you paid from the day you purchased the asset till the date you put to use the asset. Let's say, for example, you purchased the asset on, let's say, for example, 15th of July 2025, you purchased the asset. But you put to use the asset on 15 December 2025. So July to August, September, October, November, December, 5 months you did not put to use the asset. Mind you, if you had taken any loan for purchase of this asset, of course, you will be paying interest now to the bank from which you took loan. Now, 5 months interest which you paid for this asset, you have to actually add it to the cost of asset. That is called capitalizing the interest. And whatever interest you will pay after 15th of December has to go and hit your profit and loss account debit side. Because once you start putting use the asset, whatever interest you will be paying for the asset purpose, asset loan purpose, that you can claim it as revenue expenditure only. So up to the date on which the asset is put to use, you will capitalize and you will add it to the cost of asset, mind you guys. Then from the cost of asset, there are some things which you need to actually reduce. Sale of trial run product. So when you did the trial run, you got some products out of the machinery, that whatever products you sold outside, that you have to reduce. And if you got any government grant for the asset, that also you can reduce, and the net will be called as total cost of asset. On this asset, you will start claiming the depreciation. This asset will go and capitalize in your books of accounts. And very, very important point. Whenever you purchase an asset, you have to make the payment for that asset through the prescribed modes of payment only. You cannot make payment of more than 10,000 in cash for purchase of asset. Say for example, you purchased an asset, plant and machinery. Let's say for example, you purchased an asset, plant and machinery, for which you spent 4 lakh rupees. This 4 lakhs you made payment through NEFT, means banking channels, then that will go and you can easily capitalize that in your books of accounts. But let's say for example, for installing this machinery, 15,000 you made payment in cash. See, installation expenses generally you need to add to the cost of asset, but since you made the payment of more than 10,000 in cash, you cannot add that value to the cost of asset. Because more than 10,000 if you make any payment in cash for buying an asset, then to the extent to which you made cash payment will not be eligible for depreciation. You cannot capitalize that in your books of accounts. Let's say for example, you further spent transportation expenses of 9,000 in cash. This 9,000 you spent in cash is less than 10,000, that you can add to cost of asset, because this is a different expenditure. Now, important section 43(1). If any payment is made in relation to acquisition of asset more than 10,000, very, very important, more than 10,000 if you have made by any mode other than account pay check, account pay demand draft or electronic clearing system to a single person in a single day, then such expenditure shall not be included in the actual cost. Similar dialogue you will find in section 40A(3) also, correct? So, to a single person in a single day, if you have made any payment more than 10,000 in other than prescribed modes. What are the prescribed modes? Electronic clearing system, account pay check, account pay demand draft. These are the prescribed modes. If you do not make payment in the prescribed modes, then forget about depreciation on that. Forget about you will capitalize the asset in your books of accounts. You cannot capitalize. There may be some scenarios where personal asset is converted into business asset. Lot of times what happens, SSE will convert his personal asset into business asset. Let's say for example, there is your own building which you are using for your residence purpose. Suddenly you thought, why not I use this asset for my business purpose? In that case, what will happen? Let's say for example, there is a building which you purchased in the previous year 22-23, and you converted this building into business asset in previous year 25-26. In that case, there is a question mark, and the question mark is what should be the cost of asset in the business books which I have to consider. If you have to consider the cost of asset in the business books, you will first take the actual cost of building. From that, you have to reduce the notional depreciation. Notional depreciation will start from this day till the date you converted into the business asset. And the net amount will be treated as actual cost of asset in business books. Say, for example, the cost of acquisition was 15 lakhs when you purchased this building on 19th of February 2023. So you purchased in 22-23 February 22-23 financial year. Right from previous year 22-23 till 22-25-26, the asset was personal asset. Now you want to get into business. In that case, what will happen? First, you will take the actual cost of 15 lakhs and you start claiming the depreciation. Sir, why you took 5% here? Because you have purchased the asset in February. February means less than 180 days. So 10% has become half 5%. In 23-24 full depreciation, 25-24 to 24-25 full depreciation, and if you reduce this depreciation, this is the amount of actual cost of building which you will start adding to the block of asset, and you can claim depreciation on this value in your business books. You will have to always follow WDV method of depreciation. The above provision only applies in case of building, mind you. Here I am telling you personal asset converted into business asset. When I say this asset means only building. If you convert your personal car into business, personal asset of car into business asset, you will not use this kind of provision. This provision is applicable only in case of personal asset, business asset being a building. Sir, what will happen if I convert my personal car? Car is also an asset only, sir. If I convert my personal car into business car asset, what will happen? In that case, you will take the actual cost only. See, if a car is converted, personal car is converted into business asset, then see, cost of acquisition remains the same. You will not reduce notional depreciation. So, it is not applicable in case of any asset other than a building. If any other personal asset is converted into business asset, always take the actual cost of acquisition only without claiming the notional depreciation, mind you. Next, other important points. Any asset acquired by way of gift or inheritance or will, then actual cost will be cost to previous owner minus depreciation allowed to previous owner. Guys, let's say for example, someone gifted you asset, or you got the asset through will or inheritance from your ancestors. Then what should be the cost of asset in your books of accounts in business? In that case, mind you, you will take the actual cost to the previous owner. Means, let's say for example, you got the asset from your father as a gift. So what was the cost of acquisition in the hands of father minus depreciation which has to be allowed to the previous owner for the period for which your father was using the asset. Next, if any stock in trade is converted into capital asset, and if such capital asset is used in business, then actual cost shall be FMV as on the date of conversion. Let's say for example, you have some stock in trade. You want to convert that stock in trade into your capital asset in your business purpose. In that case, on the day on which you will convert the stock in trade into capital asset, the fair market value, whatever is there, that will be treated as the actual cost in your in your block of asset, because you are converting it to stock in trade into a capital asset. If any asset is acquired, let's say for example at a higher value, if you acquire any asset at a higher value just to claim more depreciation, in that case, mind you, the assessing officer will decide what should be the actual cost of asset. So if any asset is acquired at a higher value just to claim higher depreciation, let's say for example, an asset fair market value is just 10 lakh rupees, but You are acquiring the asset for 1 crore. Only this is book entry. You are not actually paying 1 crore to the seller. Seller is also known party for you. 10 lakhs worth of asset you are purchasing on papers for 1 crore. Now, if you purchase for 1 crore on a higher amount, you will start claiming the depreciation. In that case, the cost of asset will be decided by the assessing officer with the prior approval of a joint commissioner, guys. If any asset, let's say for example, you first transferred the asset and then you reacquired the asset at a higher value just to claim higher depreciation. In that case, the actual cost will become the WDV when you actually transferred, or reacquisition cost means at the price at which you actually reacquired. Whichever is lower, that price only will be considered as your cost of asset for your depreciation purpose. These are some special cases. Next one. If any asset is acquired from any person and leased back to the same person, then actual cost shall be the WDV of seller. So in these special cases, you have to take the cost of acquisition which is given here. Now, guys, one dialogue I'll tell you which has to be very important dialogue. And the dialogue is, a block of asset can be nil but cannot never be negative. I repeat, a block of asset may have multiple assets in it, because what is a block of asset? Same class and same rate of assets. You will create a block. Maybe you may be having 4 machineries, 5 machineries of the same class, same rate. That is called a block. A block can be nil, nil, but it can never be negative. With this dialogue, I will take you through one scenarios, different scenarios I will show you. Let's say for example, there is an opening WDV of a block of 10 lakhs. And in that block, there are 10 assets opening. Means at the start of the year, you had 10 assets in the block, for example. And during the year, you purchased 4 assets. So, and the 4 assets you purchased for 4 lakhs. If you remember that depreciation table, opening WDV, add purchases, then you reduce the sale value, you will arrive at the WDV for the purpose of depreciation. From that you reduce the depreciation and then you arrive at the closing WDV of the block. So opening WDV plus purchases. Opening WDV was 10 lakhs and 4 lakhs you purchased new assets during the year. 10 assets were in opening WDV at the start of the year. 4 assets you purchased during the year. Now, totally 14 assets are there in your hands. 14 assets value is 14 lakhs. Say for example, if you sell 8 assets out of 14 assets, are you selling all the assets in the block? No. You are only selling partial block. Means out of 14 assets, you sold 8 assets. But the problem is, 8 assets you sold for a value more than the total value of the block. Total assets, all the 14 assets put together, the value is 14 lakhs. But you sold only 8 assets at a value higher than the value of the block. Then block cannot exist. Because you just think logically, 14 lakhs worth of assets you sold for 18 lakhs already. In that case, what you will get? If you reduce 14 minus 18 lakhs, you will get negative figure of 4 lakhs. But just now I told you, block can never be negative, guys. Block can never be negative. So, the WDV of the block will become nil and block will cease to exist. But you will be getting a doubt. Sir, out of 14 assets, we sold only 8 assets. No, sir. 6 assets are still remaining. How can you say block has ceased to exist? The block is ceased to exist because of this effect. Assets are there in the block, but there is no value in the block. Because block can never be negative, you have to do it 0 only here. Nil it will become. And mind you, 14 lakh worth of assets, if you sold it for 18 lakhs, haven't you sold it for a higher value? If you sell any asset for higher value, capital gain will come or not. And that is why you see short-term capital gain 18 lakhs minus 14 lakhs, 4 lakhs of short-term capital gain will come. Sir, why we are not calling it as a long-term capital gain, sir? Because any depreciable asset you sell, all the time it will be short-term capital gain only. On depreciable assets, you can never get long-term capital gain. Always you will get a short-term capital gain only, irrespective of period of holding. You might be holding the asset for more than 2 years, 3 years, whatever. But all the time it will come short-term capital gain only, mind you. Next scenario I'll take. Opening WDV of the block was at 10 lakhs and 10 assets were there at the start of the year. You purchased 4 lakhs worth of assets, 4 assets you purchased. Totally 14 assets are there in the block, 14 lakhs worth of assets are there. During the year, you sold only 8 assets out of 14 assets. Still, 6 assets are there in your hand. But mind you, 14 lakh worth of assets are there, but you sold it only for 8 lakhs only. The sale value is 8 lakhs. Now, is there any issue? No. 14 lakhs minus 8 lakhs, naturally you do on whatever 6 lakhs remaining figure is there. That is your WDV for depreciation purpose and calculate depreciation on that. There is no capital gain or loss. You cannot say, sir, 14 lakhs worth of asset, I sold for 8 lakhs only, 6 lakhs should be short-term capital loss. No, that is not a short-term capital loss. Because, I'll tell you why. Because 14 assets you did not sell. You sold only 8 assets. Still 6 assets are remaining in your block. If you had sold all the 14 assets for only just 8 lakhs, then you can say 6 lakhs is a short-term capital loss. So the block is continuing, block exists here, and that is why there is no short-term capital loss coming here. And the block is existing, on this you will claim depreciation. No capital gain or loss. Third scenario I'll take. Opening WDV you had 10 lakhs, 10 assets you had opening at the start of the year. 4 assets you purchased for 4 lakh rupees. Totally 14 assets you have. Out of 14 assets, you sold all 14 assets. You sold all 14 assets. Is there any asset in the block now? No. 14 lakh worth of assets you sold for 20 lakhs, mind you. You have sold for a higher value. Then you will get short-term capital gain or not. Of course, you will get. So, short-term capital gain will be 20 lakhs minus 14 lakhs, which is 6 lakhs. And the block will cease to exist. Why? The block will cease to exist because all the 14 assets are sold in the block. There is no asset in the block. Next one. Opening WDV 10 lakhs, 10 assets were there. 4 assets you purchased for 4 lakhs. Total 14 assets you have worth of 14 lakhs. Now mind you, all the 14 assets you have sold during the year, but you sold only for 8 lakhs. 14 lakhs worth of asset, if you sell just for 8 lakhs, you have a loss or not there? Because you have sold all the assets, now you will get short-term capital loss of 6 lakhs and the block will cease to exist. Are you getting it? Now, based on these examples, now we will understand this table. Scenario, few assets are sold, all assets are sold. Whatever 4 scenarios I taught you, this has been given here in a summarized table manner. Scenario 1, Scenario 2, Scenario 3, Scenario 4. In Scenario 1 and 2, we are only selling few assets. In Scenario 3 and 4, we are selling all the assets in the block. Now, total number of blocks, total number of assets in the opening WDV were 10 assets were there. Let's take the Scenario 1. So, 10 assets opening were there. 4 you purchased. Total assets before sale. Total assets before sale was 14. How many assets you sold during the year? Only 8. But mind you, is the sale value more than opening WDV plus purchases? If it is yes, then of course your block will become nil. Because block can be nil but can never be negative. Short-term capital gain also will arise in this case. You see here, 1 star mark is given, means this point. Second scenario, 10 assets in the opening, 4 you purchased, totally 14 assets are there, out of which 8 you sold. But is the sale value more than opening WDV plus purchases? No. In that case, what will happen? Depreciation shall be computed because this is the balance, means the blocks exists and you can claim depreciation on the balance. 10 assets opening were there, 4 you purchased, total 14 assets are there, out of which all 14 you sold. And is the sale value more than opening plus WDV plus purchase? Yes. So you sold for a value more than opening WDV plus purchases, then you will get a short-term capital gain, and that's why here short-term capital gain will come. Last scenario, 10 opening assets, 4 assets you purchased, total 14 assets are there. Out of 14, all 14 you sold. But is the sale value more than opening WDV plus purchases? No, means you sold it for a loss, and that's why short-term capital loss will come. I hope that is clear. As per section 50, capital gain or loss on sale of depreciable assets shall always be short-term only, irrespective of holding period of the asset. Next, if asset used partly for business purpose and partly for personal purpose, what will happen? Of course, guys, under PGBP 1 dialogue, you remember always only business related expenses are allowed, personal expenses are not allowed. So if asset is used both for business purpose and personal purpose, only to the extent you used it for business purpose is allowed. To the extent you used for personal purpose is not allowed. Got it? So we'll use this, we'll see this with the help of one example. Let's say, for example, there is one car which you are using for personal purpose also, business purpose also. Business purpose you are using for 60% and 40% you are using for personal purpose. Now, on this car, since it is a business asset, you will claim depreciation on that. How will you claim the depreciation? Let's say, for example, opening WDV of the asset was 4 lakhs. On this 4 lakhs, you will claim depreciation at the rate of 15%, which is 60,000, but you cannot claim total 60,000 as depreciation. Out of the 60,000, only 60% you can claim is as business expenditure, because only 60% of the asset is used for business purpose. So 60,000 into 60%, 36,000 allowed as depreciation. 40% which you use for personal use will not be allowed as depreciation. So 24,000 is disallowed, not allowable. Next, sale of asset by power generation units following SLM method of depreciation. Guys, in case of power generation units, who is following the SLM method of depreciation, whenever this power generation unit will sell an asset, in that case, we will generally get two kinds of scenarios: balancing charge and terminal depreciation. Let's say, for example, if you are selling an asset and the sale price is less than WDV, what you will be thinking? If the sale price is less than WDV, it should become a short-term capital loss, you will be thinking, but it is not correct, because this is a special case in case of power generation units who is following SLM method. If the asset is sold for less than the WDV value, in that case, terminal depreciation will come. Means terminal depreciation, you have to claim it as expenditure in your profit and loss account. Sale price, if it is 80,000, WDV was 1 lakh, then the 20,000 will be called as terminal depreciation, and you can claim this as your profit and loss account debit side as an expenditure. This is called terminal depreciation. But if the sale price is more than WDV, what will happen? See, there may be two kinds of scenarios. If the sale price is more than WDV, you have to check whether the sale price is exceeding the cost of acquisition or not. If the sale price is exceeding cost of acquisition, you will get capital gain also, short-term capital gain. But if the sale price is more than WDV, but the sale price is not more than cost of acquisition, then you will get balancing charge, which you have to take it to the credit side of your profit and loss account. So if the sale price is more than cost of acquisition, two things will come. Balancing charge also will come, capital gain also will come, short-term capital gain. We'll take one example. Let's say, for example, WDV of the asset is 80,000, cost of acquisition is 1,50,000 and the selling price is 2 lakhs. Now you see here, you sold for 2 lakhs, which is more than the cost of acquisition, then you should get a capital gain. No, cost of asset is less than the sale price, means there is a capital gain. But 2 lakhs minus 1,50,000, of course you will get 50,000 as short-term capital gain, but you have to see cost of acquisition minus WDV. To this extent, whatever 70,000 profit you got, that will be called as balancing charge and it will go to PGBP income. So whenever a sale price is more than the cost of acquisition, you will get two kinds of income. One is PGBP income, the other is short-term capital gain. So to the extent of cost of acquisition, the difference between the cost of acquisition and WDV will be called as balancing charge, which is PGBP income. And the amount for which you sold, the sale price which is exceeding the cost of acquisition, that will be treated as your short-term capital gain. There may be scenario where your sale price is more than WDV, but it is less than cost of acquisition. Possible? We'll take one example. Let's say, for example, the cost of acquisition of your asset was 1 lakh. Sale price was 80,000 and the WDV was 50,000. Did you sell more than WDV? Yes, of course. But did you sell more than cost of acquisition? No. So in this scenario, you will not get a short-term capital gain, but you will get balancing charge, which you will take it to PGBP income. So what is the balancing charge? Simple. Your sale price is 80,000. Your WDV is 50,000. 30,000 will be treated as balancing charge and PGBP income will arise here. Next. Section 35, scientific research. Guys, in order to promote scientific research in the country, especially for pharmaceutical industries in India, government is giving one opportunity to all those people who want to come into the scientific research industry. If you start any scientific research business and if you do some research, whatever expenditure you incur, fully we will give as deduction, is what the government is saying. So there may be two kinds of scenarios. Either you do in your own business the scientific research, or you promote someone, or you donate money to some organizations who are doing the scientific research. There are two possibilities. If you do in-house research means in your own organization, in your own business, you are only doing the research. In that case, you can claim deduction of both revenue expenditure and capital expenditure. Revenue expenditure and capital expenditure, and mind you, before even you start your business, you might have incurred some expenditures. That is called a pre-commencement expenditure, or before commencement of your business, you might have spent some expenditure. In that case, before starting your business, if you have incurred any kind of revenue expenditures, only two kinds of revenue expenditure are allowed. One is a salary and the other is raw material. But mind you, here perquisites in salary will not be allowed. So before starting your business, up to maximum 3 years, whatever salary expenditure and raw material expenditure you incurred for in-house research, scientific research, that you can claim 100% as expenditure, it is allowed. But mind you, maximum 3 years it is allowed. But once you commence your business, whatever scientific research expenditure, revenue expenditure you incurred, full 100% it is allowed. There is no restriction at all. And when it comes to capital expenditure, whether it is before or after commencement, 100% of capital expenditure is allowed. But mind you, except land. Land is not eligible for claiming deduction under section 35 as expenditure. So very simple, guys. If you are doing in your own business scientific research, before starting your business, maximum 3 years before starting your business, revenue expenditure, only two kinds of revenue expenditure you can claim. Salary, but excluding perquisites, and raw material also you can claim. 100% of it is allowed. And before starting your business, before commencing your business, if you had done some capital expenditures, in that case, all kinds of capital expenditure are allowed. 100% it is allowed, except land. Once you commence your business, any kind of revenue expenditure is allowed. Any nature of revenue expenditure, 100% it is allowed. And capital expenditure also, any kind of capital expenditure, 100% it is allowed except land. This is in-house research, means in your own business, in your own company if you do research. But let's say for example, you are not having any research kind of a business, but you want to help someone who is doing research in the country. You want to donate some money for these kind of organizations, and if you donate that amount, whatever donation you make to these research institutes, 100% of the amount you can claim as expenditure whenever whatever amount you donate to this organization. Donation or contribution to notified or approved organizations. Only notified organization or approved organizations, if you give contribution, then only allowed. If you give contribution or donation to unapproved organization, then you cannot claim deduction. 100% allowed, guys. Let's say for example, you gave 100 crores to some organization for scientific research, fully allowed. You gave 50 crores to some organization, fully allowed. Who are these organizations, sir, to which we can give, contribute or donate money? Scientific research or social research or statistical research organization, any university, Indian Institute of Technology, college, national lab, or any Indian company which is into research business. Mind you, this donation expenditure you can claim only if you are paying tax under optional tax regime. Guys, mind you, in-house research, whenever you do in-house research in your own business, irrespective of what kind of regime you are paying tax, whether you are paying tax under default tax regime or you are paying tax under optional tax regime, under both the tax regime you are eligible for 100% expenditures, which is mentioned here. But whenever you contribute or donate money to other organizations, you will get the deduction only if you pay tax under optional tax regime. If you pay tax under default tax regime, forget about the donation or contribution expenditure, you will not get it. Important note for section 35. Depreciation is not allowed. Of course, guys, if you already claimed capital expenditure 100%, let's say for example, you have purchased one building for scientific research, already you claimed 100% as deduction under section 35, then there is no scope for depreciation further. Next, if land and building, if you purchase both put together, then what will happen? Of course, bifurcate the land value and building value separately. Land is not eligible, only building value is eligible. And guys, one more thing, in future, so you donated some money to some organization, any of this organization, you donated some money, and later on this organization's approval is withdrawn, that will not have any kind of impact on your calculation of tax liability. And mind you, donation is not allowed under default tax regime, only if you are paying tax under optional tax regime, then only whatever contributions you will make to the approved organizations you can claim as deduction under section 35. The next section is 35D, preliminary expenses. Just give me a second. 1 second, guys. Yeah. 35D, preliminary expenses. Guys, a lot of times there may be two kinds of scenarios. Either before starting your business, you are incurring some expenditures, or you already have an existing business, you want to expand your business, you want to start a new undertaking, new unit, new branch. In that case also you have to incur a lot of expenses because you have to establish that business. Or you want to start a new business altogether. In that case, of course, in order to start a new business, there will be a lot of legal expenses. No, you have to register your business, you have to draft MOA, AOA, like this. There are a lot of expenses incurred. So before starting any business, if you incur any expenditure, that expenditure you can claim as your business expenditure as soon as you have started your business. That is called preliminary expenses. Before starting your, preliminary means before starting the business. Cost of setting up a new business or expanding old business is eligible. Applies to Indian taxpayers only, not for foreign entities who establish their business in India. How much of expenditure is allowed, sir? 1/5 of eligible expenses only allowed. Now you'll ask, sir, what is eligible expense? Eligible expense is given here. Eligible expense is nothing but if you are a resident non-corporate. Non-corporate means what? You are not a company. You may be starting one sole proprietor. You may be starting one partnership firm. You may be starting one LLP. In that case, 5% of cost of project is eligible. Maximum eligible amount. And if you are a company, in that case, you have to compare two things: higher of 5% of the cost of project and 5% of capital employed. Whichever is higher will be maximum eligible amount. And the deduction will be, of course, 1/5 of the maximum eligible amount. Now, what is cost of project and capital employed, sir? You will get it out. See, cost of project means actual cost of all the fixed assets which you have as on the last day of the previous year in which you started the business. And capital employed means issued share capital plus debentures plus long-term borrowings, all these put together as on the last day of the previous year in which you commenced your business. But mind you, here you should not include reserves and surplus and securities premium. So this you will consider for cost of project and capital employed, and only 1/5 of the expenditure is allowed. Generally, what kind of expenses it can be, sir? Feasibility report, project report, MOA drafting, AOA drafting, legal charges, registration fee. These kind of expenses are allowed here. And 1/5 you will start claiming the expenditure. Let's say, for example, last year you incurred all this expenditure, preliminary expenses. So, of course, you will start claiming the expenditure from the year in which you started your business. For 5 years you will claim. This year 1/5, next year 1/5, next year 1/5, next year 1/5, next year 1/5. Like this 5 years you will claim 1 by 5, 1 by 5. Then in 5 years you will be eligible to claim all the expenditures. Amortization of expenditure incurred under voluntary retirement scheme. Guys, what is voluntary retirement scheme? A lot of times you give an opportunity to the employee to retire voluntarily. And if they retire, you have to compensate them. That is called voluntary retirement scheme amount, which you pay as being an employer. If you pay any kind of voluntary retirement expenditure, that is also allowed 1/5 only. 1/5, it will be allowed for 5 years. So summary of 35D and DDA is very simple. In 35D, preliminary expenses of business are covered for resident assessees only. Limit is 5% of COP or capital employed, whatever, and 1/5 is allowed. But in 35 DDA, under voluntary retirement, any assessee can take. There is no limit, but 1/5 only allowed. 1/5, like this, 5 years they will allow the expenditure. The next section which we are going to discuss is section 35AD, specified business. This is optional expenditure which you can claim. And one more thing, 35AD also you can claim only under optional tax regime. Under default tax regime, you cannot claim this. And now, what is 35AD? Guys, in order to boost infrastructure of the country, in order to boost some particular businesses in the country, the government is giving one option to the business people. If they invest in any of these listed businesses, if anyone starts any of these businesses and incurs any kind of capital expenditure, full capital expenditure will be allowed in the first year of business itself. Full 100% you can claim. Generally, if you incur any capital expenditure, you have to first create a block. Then a depreciation every year you will allow 10%, 5%, year on year you have to allow. So it will take some 5 to 10 years for you to claim the whole capital expenditure. But this option is amazing. If you start any of these businesses in the year in which you start the business itself, 100% of the capital expenditure you can claim in the first year itself. Beautiful this is. Or whenever, even after starting your business, whenever you will buy any kind of capital asset, in the year in which you buy the capital asset itself, you can claim the 100% of the cost of asset as expenditure. Beautiful opportunity this is. But mind you, there are 3 kinds of capital assets which are not eligible for deduction under section 35AD. One is goodwill, the other is financial instruments, and the third one is land. If you invest in these kind of capital expenditures or capital assets, you are not eligible for deduction under section 35AD. Apart from this, whatever you invest, you buy building, you buy plant and machinery, you buy a car, you buy anything, any kind of a capital asset, 100% of the capital expenditure is allowed in your books of accounts. Sir, what are these eligible businesses, sir? First business is cold chain facility for storing agriculture produce, fish, meat, etc. Warehouse, big warehouses will be there, no, for agriculture produce or sugar. Guys, you have to ratify this, you have to mug this list of businesses, because in examination they will not specifically tell this is 35AD business like that. They will simply tell assessee started this kind of a business. You have to connect that, okay, this is 35AD business like that. You have to understand, you have to remember, there is no option. Pipeline for gas, petrol, oil, iron ore, or hotel of 2-star or above, 2-star, 3-star, 5-star hotel like that if you start, or you have a hospital where minimum 100 beds are there. Housing project for affordable and slum redevelopment, or fertilizer production business, or inland container depot business, beekeeping and production of honey and wax business, semiconductor wafer manufacturing business, or develop and maintain infrastructure facilities. If you start any of these businesses and if you incur only capital expenditure, not revenue, only capital expenditure you incur in the year in which you will incur the capital expenditure, 100% will be allowed. But except these three, but there are some conditions attached to it. Conditions for claiming 35AD. It should be a new business setup and a new plant and machinery. It should be a new plant and machinery, but guys, old plant and machinery can be maximum 20%. Let's say, for example, you invested 1 crore in plant and machinery. Out of 1 crore plant and machinery, you can have maximum 20 lakhs of old plant and machinery, no problem. No problem. You will get total deduction. And one more thing, imported old plant and machinery will be treated as new only. Means in India, if you purchase any old plant and machinery, it is old. But if you import any old plant and machinery, it will not be treated as old. It will be treated as new only. No deduction under default tax regime. Just now I told you only under optional tax regime you can claim 35AD. Guys, remember under PGBP, remember one thing. 32(1)(2)(a) additional depreciation only available under optional tax regime. Section 35 donation to other institutions, research institutions only available under default only available under optional tax regime. And similarly 35AD is also such a section where you will be eligible to claim the deduction only under optional tax regime. Under default tax regime, these three are not allowed. Under default tax regime, only these three are not allowed, rest everything is allowed. What are these three things? Additional depreciation. 35, donation to scientific research organizations. And number 3, 35AD specified business. These three are not allowed under default tax regime, mind you. No depreciation allowed. Of course, no. Already 100% of the cost of asset, it is already allowed as deduction under 35AD. Where is the scope of depreciation? Pre-commencement capital expenses also fully allowed. Means before even starting your business, you might have spent some capital expenditure. Even that you can claim it as 100% deduction. Mind you guys, here lock-in period is there for 8 years. Once you purchase an asset and once you claim the 35AD deduction, minimum 8 years you should not sell the asset. Minimum 8 years. Whatever asset you purchased here and you claimed the deduction under 35AD, you cannot sell the asset for 8 years. Sir, what will happen if the asset is sold? Don't worry, I'll teach you in some time. Deduction is allowed in every year starting from the year of commencement. Means once you start any of these listed businesses, in any year in future, you purchase any kind of capital asset, on that asset 100% will be allowed. Hotel business can be outsourced for operations. Means let's say for example, you invested in a hotel, you constructed a hotel, but operations you outsourced to someone to operate that hotel. That is absolutely fine, no problem. Now, always remember, whenever you purchase an asset, more than 10,000 if you make payment to a single person in a single day, for purpose of that asset in more than 10,000 in other than prescribed modes, that value to the extent to which you made payment in cash or other than prescribed modes is not eligible for deduction, not eligible for depreciation. The same dialogue is given here also. So whenever you make payment for the asset for which you want to claim 35AD, you have to make payment through the prescribed modes only. What are prescribed modes? Account paid check, account paid demand draft, and electronic clearing system. And mind you, whenever if you sell the asset in future, this 35AD asset on which you claimed 100% deduction, if you sell the asset in future, the total sale value will be treated as business income only. And guys, in set off and carry forward of losses, you will read this section 35AD losses. You can set off only against 35AD income only. Now, sir, what will happen? Treatment if capital asset on which deduction under section 35AD you claimed has been sold within 8 years. You told no, sir, there is a lock-in period of 8 years. What will happen, sir, if I sell the asset within 8 years? Then, if you sell the asset to outsider, means some other person you sold, then I told you sale value will become total PGBP income. Total income it will become, and you have to pay tax on that. But if asset is transferred to other specified business, own business, let's say for example, you have one 2-star hotel and you have one hospital also having minimum 100 beds. Both are specified businesses only, no. So let's say for example, for a 2-star hotel which you have, you purchased one plant and machinery. That plant and machinery you transferred to your own hospital, which is again a specified business. Then there is no treatment, there is no impact on your income tax, because ultimately you are using within 8 years for the specified business only. Maybe you transfer to other specified business, but ultimately asset is being used for specified business only. So there is no treatment in that case. But let's say for example, if you transfer the asset to non-specified business within 8 years, then you are breaching the law. In that case, what will happen? PGBP income will come. How much income will come? First, you will take the amount of cost of asset which you claimed as deduction under section 35AD. From that, you will remove the notional depreciation. Means notional depreciation means for the period for which you use the asset for specified business, for that duration depreciation you will remove, and the net will be called as PGBP income, which will be taxed in the hands of that person who claimed earlier the specified AD 35AD deduction. If you transfer to non-specified business within 8 years, same just now I told you notional depreciation you have to remove. But if you transfer after 8 years, there is no problem after 8 years, because you have to just not sell within the lock-in period. After lock-in period you sell, there is no problem at all. There is no PGBP, absolutely. Next, section 36, certain deductions. There are some miscellaneous expenses which are given as a deduction under section 36. The first one is insurance premium for stock in trade. So for your business stock in trade, you may have some insurance. If some fire accident happens and if the stock in trade gets spoiled, in that case you should have insured. So you are insuring your stock in trade. That is a business expenditure, and that is why it is allowed. Simple guys, always remember one dialogue in your PGBP topic. If it is a business related expenditure, generally it is allowed unless it is specifically disallowed. Okay, next. Health insurance premium for employees allowed if premium is not paid in cash. So you took any health insurance premium for your employees, then whatever premium the business will pay for that will be allowed as deduction. Got it? Next. Animals used in business other than as a stock in trade. For dairy business, milk business, what is asset? The cattle is an asset. That animal which is used in business, for that, how to claim the deduction? How to claim the depreciation? Depreciation anyway not available. But mind you, once the animal will die or it becomes useless, it is not giving you milk anymore. In that case, whenever you will sell that cattle, that cow, in that case, you will get a deduction of the cost of animal when you purchased it, less the scrap value. Scrap value means the sale value. The difference will be claimed as deduction for your business. Now comes the bad debts. What is a bad debt? You sold some goods to someone, that person is not paying you amount, that is called bad debt. Mind you, in income tax, never claim provision as expenditure. In PGBP, always actual expenditure only is eligible for expenditure or deduction. So bad debts, actual bad debts only allowed. Provision for bad debts are not allowed. In your accountancy, you might have deducted in your profit and loss account, but in the PGBP, provision for bad debts is not allowed, guys. Always remember this. Actual bad debts, if it is related to sale, only allowed. If it is related to loan, it is not allowed. So you gave loan to someone. Why would you allow it? Because that is a capital expenditure. That is a capital transaction. So it is not allowed. If your business itself is lending business, money lending business, then it is a business expenditure. You can claim it as actual bad debt. But generally, only bad debts related to sales only allowed, guys. Next. There is no need to prove that that debt is bad and all. And for claiming bad debts, assessee should actually write off, means actually there should be bad debt. Simple. Bad debt recovery. Let's say, for example, in earlier years, there was a bad debt. But in future, that person came back to you and paid you the amount. That is called bad debt recovered. That bad debt recovery, it should be taxable in the year in which it is recovered. Got it? Next. Bonus and commission paid to employee, of course it will be allowed, but subject to 43B. We will read 43B in some time. Guys, in 43B it says that there are some expenditures which are listed under 43B. Those expenditures, payment has to be done on or before the due date of filing of return of income. And one such expenditure is bonus and commission to employee. So if you don't pay bonus and commission to employee before filing the return of income, you cannot claim it as business expenditure. Employer contribution to Provident Fund for benefit of employees. Guys, you know very well, there are two kinds of contribution. Employer contribution, employee contribution. What I am going to discuss here is employer contribution from his own pocket. So if employer contributes in statutory provident fund, recognized provident fund, approved gratuity fund, approved superannuation fund, and any fund as per law. See, mind you, these are all approved or statutory. In that case, they are allowed subject to section 43B. But mind you, if it is unrecognized, unapproved, they are not allowed, guys. Only approved, only allowed. And that too, employer contribution only I am talking here. For employer contribution, the payment shall be made on or before the date of filing of return of income under section 43E. This is regarding the provident fund contribution of employer. Mind you, guys, if it is an employee contribution, you cannot subject it to section 43B. You cannot say employee contribution, I will aram se pay before the date of filing of return of income. No, employee contribution should be paid before the due date of the respective fund's date. Next. Employer contribution to pension scheme under section 80 CCD or national pension scheme. Mind you, in this, employer contribution is allowed only to the extent of 14% of salary. And the salary definition here is basic plus dearness allowance in terms. And this is also subject to 43B. If the employer contribute more than 14% of salary, in that case, the excess contribution made by the employer will be disallowed in the books of accounts of the employer. So that's why actual contribution or 14% of salary, whichever is lower, is allowed as deduction. Employee contribution, very important. Employee contribution to PF, ESI, superannuation fund, etc. Guys, employee contribution has to be deposited by employer up to the due date of such fund. Means, let's say, for example, employer at the time of making salary payment to employee deducted the contribution of employee to the provident fund, but late deposited it. Means provident fund actual due date is 15th of subsequent month. Let's say for example, May month salary, when the employer is making payment to employee, from the May month salary, employer deducted 10,000 of provident fund as employee contribution. So for May month, the due date is maximum 15th of June. The employer should deposit in the fund, but the employer did not deposit in the fund. He deposited later. In that case, whatever amount has been deducted by the employer from the employee's salary will become income of employer, and the employer has to pay tax on that. It is not allowed as deduction. Family planning expenditure of employee. Lot of times, especially this is allowed only in case of companies. Companies spend some money for promoting the family planning of the employees. In that case, if it is a revenue expenditure, 100% is allowed. If it is a capital expenditure, 1/5 it will be allowed in 5 equal installments. Mind you, family planning expenditure is allowed only in case of companies. It is not allowed in case of other than companies. Next. Guys, if you want this handwritten notes, it is available on this website www.taxthailava.com. For all chapters, I have prepared beautiful handwritten notes. If you want, you can purchase. If you go under Books tab, under www.taxthailava.com, under Books tab, you will find handwritten notes. Only one product will be there for 999 rupees. You can purchase that. Now, discount on zero coupon bond. Lot of times zero coupon bond is issued. Zero coupon bond is issued at a discount, high discount, but later on at the time of maturity, at the face value it is remitted. In that case, whatever discount is there, that will be allowed in the hands of the company which is issuing the zero coupon bond on a pro rata basis, and that too based on calendar month. Now, interest on loan. Just give me a second. Just a minute. Interest on loan. If you take loan for business or profession purpose, it is allowed. But if you take loan for personal purpose, of course, that interest will not be allowed as your business expenditure because it is a personal expenditure. So if you take a loan for your business or profession, and if you take loan from banks or public financial institution or financial corporation or NBFCs, in that case, it is allowed subject to you make payment on or before the due date filing of return of income. So you have to make the payment of interest before filing return of income. If you do not make the payment of interest before filing return of income, then you cannot claim it as business expenditure. Actually, interest payment you should have made. If you took loan from others other than banks or public financial institution, in that case, even if you pay or don't pay, both the cases it is allowed. But if you take any loans from banking institutions or NBFCs mentioned here, you have to make the payment on or before filing of return of income. Then comes the security transaction tax and commodity transaction tax. Guys, security transaction tax are generally paid at the time when you purchase shares or sell shares. This STT and CTT is allowed as deduction only if you are in the business of trading in securities. So if you are engaged in business of trading of securities or commodities, it is allowed as deduction. Now, remember guys, when I started this chapter, I told you section 30 till section 37, we will be discussing about all those expenses which we can claim as deduction. Now, we have discussed only till section 36. You know what? From section 30 till 36, every section has one specific nature of expenditure. Section 30, rent rates for building. Section 31, rates and taxes for repair, insurance for furniture, plant and machinery. Section 32, depreciation. Section 35, scientific research. Section 35, AD, specified business. Like this, every section has a specified nature of expenditure. If you incur any expenditure Apart from section 30 to 36, any kind of expenditure you incur, all those expenditures you can claim it under this residual section, section 37. General deductions, all other expenditures. So section 30 to 36 are specific expenses, but under section 37 you can claim all other expenses, but provided these conditions are satisfied. First condition, everyone knows this, the expenditure should be wholly and exclusively incurred for business purpose. If it is a personal expenditure, of course you will not allow. The next thing is the expenditure should be revenue nature. If it is capital nature, you will go and capitalize it and you will claim depreciation on that, and the expenditure should be a legal expenditure. Illegal expenses you cannot claim here. Now, following expenses are treated as illegal expenditures. Sir, what is an illegal expenditure? You are paying any bribe to any officer, that is an illegal expenditure, or you are giving some freebies to doctor. Means, let's say for example, you are one scanning center, X-ray scanning center, and you are paying to the doctors some fees. Sir, you refer here, even the patient is not, even the patient is fully fine, you refer here, I'll share some commission to you. That kind of freebies. And if you have paid any kind of penalties for compounding any offense which you committed under any law, these are illegal expenditures you cannot claim under section 37. Then what are the expenditures which we claim, sir? Say for example, you paid any salary to employees, that is allowed. Salary to working partner allowed, but salary to sleeping partners is not allowed. This expenditure you cannot claim. And salary to any directors is allowed. Advertisement expenses allowed. But mind you, if you give any advertisement in a newspaper or a pamphlet or brochure of a political party, it is not allowed. In a political party, let's say for example, elections are going on. In Congress party or BJP party's pamphlet, you are giving advertisement, and for that you have spent money. That expenditure amount is not allowed. Diwali puja or any festival puja, Ramjan puja or Christmas puja, you want to do anything like that, and any office expenses you want to claim, you can claim here. Gift to employees or customers, you can claim here. Key man insurance policy premium, you can claim here under section 37. But mind you, CSR expenditure is not allowed. Corporate social responsibility is not a business expenditure. That is not allowed. Taxes. Guys, lot of times on this, the examination may test you. Always remember one thing. Any expenditure in the nature of income tax is not allowed. Only apart from income tax, any kind of taxes, municipal taxes, corporation taxes, goods and service taxes, customs duty, these are allowed. But income tax related expenses are not allowed. So, income tax including surcharge cess is not allowed, not allowed, not allowed. Even if it is a tax not allowed, interest also not allowed, penalty also not allowed. But GST and customs like indirect taxes, tax is allowed, interest also allowed, penalty is not allowed. Penalty, always remember guys, penalty for breach of law is not allowed, but penalty for breach of contract is allowed. Remember this section. This point you remember, penalty is never allowed under Income Tax Act, but if it is a penalty for breach of contract, it is allowed. Now mind you one thing, this GST, customs, whatever I told you, taxes are allowed, again subject to 43B. Don't worry, separately 43B I'll be teaching you in some time. 43B is very simple. If you want to claim expenditure of those expenditures which are listed in 43B section, you have to make payment on or before the date of filing of return of income. Only then you will get the deduction. If you did not make the payment for the expenditure before filing return of income, you will not get the deduction. Penalty for breach of law is not allowed, but penalty for breach of contract is allowed. Next, other expenses. Like there may be some miscellaneous expenses like telephone expenses, printing and stationery, audit fee, traveling, any kind of expenditure. If it is for the purpose of business or profession, it is allowed. So what we have discussed so far is Credit side, we have discussed the income, the list of incomes under section 28 we discussed, and we have discussed so far. And the debit side of your profit and loss account, right from section 30 till 37, what kind of expenses you can claim under the PGBP we have discussed so far. It is not ended yet. We have lot of provisions still which we need to cover under section 40 till 44. AD, ADA, AE we will cover now. Section 40, amount specifically disallowed. So far what we discussed, what is expenditure allowed like that. Now we will discuss what are the expenses which are to be disallowed. Means these are expenses not allowed. What are those? First one is 40A1. Payment made to non-resident or foreign company. We'll take one example. Let's say for example, there is a institute, coaching institute called as Thailava classes. Students requested, sir, please get one singer, sir, on our annual day. We will get Rema singer. He will come and sing a song. Baby, calm down, like that. We want that singer, sir. Beautiful, sir. He sings very beautifully. So I approached this non-resident. He is a non-resident. He is a foreigner, no, Rema. So we approached him for singing a song, and we have to make payment to Rema for that. Let's say for example, we made payment on 31st of December 2025. But we forgot to deduct the TDS while making payment to Rema. We did not deduct TDS. He is a professional, no. We did not deduct the TDS. TDS not deducted in previous year. TDS deducted or but not deposited within the filing of return of income. There may be two scenarios. Either I did not deduct TDS while making payment to Rema, or I deducted the TDS while making payment to Rema, but I did not deposit the TDS within the due date of filing of return of income. There may be two scenarios. In that case, whatever amount I paid to Rema, I cannot claim it as business expenditure. 100% of such expenses will be disallowed in the previous year 25-26. Sir, what if, sir, later on you went and deposited the TDS with the government? In that case, if TDS is deposited, let's say for example on 7th of Jan, then expenses allowed in which previous year? This is falling in previous year 25-26. In that previous year, I can claim it as deduction expenditure. 100% I can claim. If I deposited the TDS in 19 November 2026, then I can claim in previous year 26-27. But if I claim if I deposited the TDS on 15th of March 2027, then I will claim the expenditure in 26-27. But if I deposit in 15th of May 2027, I will claim it as deduction in 27-28, the payment which I made to Rema. So any payment made to non-resident without deducting TDS, or after deducting TDS but not deposited the TDS within the due date of filing of return of income, 100% of the expenditure will be disallowed. Nothing will be allowed. But you can claim the expenditure in the year in which you will deposit the TDS with the government. But if you make any payment to a resident and you did not deduct the TDS, in that case only 30% of expenditure will be disallowed. 70% you can allow. Let's say for example, Thailava classes. Students requested, sir, Rashmika Mandana is very beautiful. She dances really well, sir. Can we call her for our annual day celebrations? So I approached Rashmika Mandana and I told her, madam, please come for our annual day and you dance, madam. We will pay you this much of amount. And when I made the payment to Rashmika Mandana, either I did not deduct the TDS or I deducted the TDS but did not deposit with the government. In that case, of course, 30% of expenditure which I want to claim in my books of accounts as annual day expenses, I cannot claim up to the extent of 30%. So I made the payment on 31st of December 2025. But let's say for example, I deposited TDS on 7th of Jan 2026. It is well within the year only. So 25-26 itself, I will allow the expenditure. Earlier disallowed amount of 30% is allowed in which previous year? So earlier 30% of expenditure is disallowed. But now when I will deposit on this date, I can claim the 30% earlier disallowed. Now I can claim it as expenditure in previous year 25-26. So if I deposit the TDS on 19th November 2026, I can claim it in previous year 26-27. If I deposit in 15th of March 2027, I can claim that 30% earlier disallowed. Now I can claim that 30% in 26-27. If I deposit on 15th of 15th of May 2027, I can claim it in previous year 27-28. Got it? Now, there is one common note for 40A1 and 40A1A. If TDS is deducted in subsequent previous year, means these scenarios. In that case, you can claim that earlier disallowed 100% or 30% as TDS for that TDS in the previous year in which you deposited the TDS. Next. Exception to 40A and 1A. There is one scenario in which you did not deduct the TDS, or you deducted the TDS but did not deposit. But there is one case in which disallowance will not be attracted. What is that case? If any amount paid or credited but TDS not deducted, but payee means the person who received amount from you has offered such income to tax and has paid tax on such income to the government and filed his return of income and has furnished a certificate from a chartered accountant to you in form 26A. In that case, disallowance will not be attracted. Got it? Next. 40A3. TDS on salary payment outside India or to a non-resident in India. Always remember, whenever you make any salary payment to outside India or to a non-resident in India, you have to strictly follow the TDS provisions. Even if a single day if you miss, gone. In lifetime you will not get the deduction. Even if you go and deposit the TDS late. Any salary paid outside India or to a non-resident, if TDS is not deducted or you deducted but not deposited, in that case, salary will be totally disallowed and never be allowed again, even if you deposit the TDS late. If TDS deposited late even by 1 day, guys, salary is not allowed for lifetime. Next, tax on non-monetary perquisite of employee. You know, non-monetary perquisites in salary chapter we discussed. If an employer himself pays tax on the non-monetary perquisite of employee, that is not allowed as deduction in the hands of employer, because the tax actually belongs to employee. Employee should pay the tax. Now we will move on to next section 40A2, payment to relatives. Guys, if you make any excess payment to relative or unreasonable payments to relative, that is totally disallowed. Let's take one example. Let's say, for example, there is one coaching institute, Thailava classes. And there is one lady called as Thalaivi, wife of Thailava. So Thailava is owner of this Thailava classes and Thalaivi is wife of Thailava. She is not qualified for any job. She is illiterate, for example. But Thailava classes is paying 5 lakh rupees per month as salary to Thalaivi, in which reasonable is only to the extent of 6,000 per month. Unreasonable is 4,94,000 per month. So unreasonable expenditure is disallowed in the hands of Thailava classes, but only 6,000 which is reasonable to that extent is allowed in the hands of Thailava classes. If any payment made to relative, then assessing officer can disallow excess or unreasonable amount of expenditure. Sir, who is relative? It is given here. You can read it later. Now, section 40A3. Guys, remember one thing. If you want to claim any kind of a business expenditure, you should make the payment for such business expenditure through the prescribed modes of payment only. If you made for a particular expenditure payment to the seller or vendor to a single person in a single day, more than 10,000 in cash or other than in prescribed modes, in that case, to the extent which you made the payment in cash modes or other than prescribed modes will be disallowed. You cannot claim the expenditure. The limit of 10,000 will become 35,000 limit, higher limit in case if you make the payment to a goods transport agency. So if you make any cash payment more than 10,000 to a single person in a single day, sir, only cash is covered, sir. Only cash, sir. If I make payment in bearer check, not allowed. Cross check, not allowed. But you have to make payment in account pay check or account pay demand draft or electronic clearing system. These three are allowed, but these three are not allowed. Mind you, in a single day to a single person more than 10,000. We will take some examples. Let's say, for example, Thailava Classes is a coaching institute. It wants to print books. Thailava books it wants to print. So it engaged or it got into contract with the two printers. One is Samantha Printers, the other is Nayanthara Printers. To Samantha Printers, Thailava Classes made payment of 9,000 in cash. Is it allowed? Yes, because to a single person in a single day, you made payment up to 10,000 in cash is allowed. No problem. It is allowed as expenditure. Nayanthara Printers, you made payment of 10,000 in cash. Is it allowed? Yes, up to 10,000 it is allowed. No problem. More than 10,000 not allowed. Next example. Thailava Classes made payment to one single vendor, Samantha Printers, on a single day, 19th December, morning 9,000 cash, evening 8,000 cash. Now mind you, to a single person in a single day, you made payment more than 10,000 in cash. Total 17,000 is disallowed, not allowed as business expenditure for Thailava Classes. One more example. Thailava Classes made payment to Samantha Printers on different dates. Now mind you, we have to check what? Single person, single day we have to check, not all days put together. So in single day, 9,000 cash payments. These are all cash payments. Is it allowed? Yes, it is allowed. Less than 10,000. On a different date, 10,000 allowed? Yes, exactly 10,000 allowed. More than 10,000 not allowed. Again 8,000 allowed. Again 7,000 allowed. None of the payments are more than 10,000. Everything is allowed. One more example. Thailava Classes made payment to Tata Transporters. Tata Bye-Bye Transporters. Transporters, good transporters. Means I told that transporter, my books are ready. You please get it to my office. So the goods transport company will go in one truck. They'll put all the books and get to my coaching institute. I have to make the payment. In that case, up to 35,000, mind you, I can make payment in other than prescribed modes. In 29 December, I made morning 20,000 cash, 5,000 cash I made at the evening. Total in a single day, I made only 25,000 in cash. No problem, fully allowed. Because for goods transport, the limit is 35,000. One more example we will take. Let's say, for example, Thailava Classes purchased pens from Papa Pen Shops. Papa Pen Shops, there is one pen shop. And I purchased, Thailava Classes purchased pens on credit, means cash is not paid. On credit basis, you purchased 5 lakhs worth of pens to distribute to the students. In previous year 23-24, I purchased. Now, when I purchase goods on credit, I can claim it on expenditure, no, in that year. There is no restriction. It is not subject to 43B. So I will claim this 5 lakhs as my business expenditure, even though I have not paid it actually. So in previous year 23-24, I claimed it as expenditure. See, in previous year 23-24, in P&L account on accrual basis, I claimed as expenditure. 2 purchases, 5 lakhs allowed. Okay. Purchases or any kind of expenditure you can book. Now, but when I made the payment of 5 lakhs in future to this Papa Pen Shop, in previous year 25-26, I made the payment other than in cash, other than in prescribed modes. In that case, disallow 5 lakhs in the hands of Thailava Classes in previous year 25-26 because the payments were not made in prescribed modes. If I made the payment in prescribed modes, then no problem, no disallowance will happen. Next, Thailava tips for section 40A3. Same, whatever I told you here, in a single day, single person, more than 10,000, transporter 35,000. And if you take the expenditure, earlier you claimed the expenditure on credit basis and in subsequent year you paid in cash, in that case, whatever deduction you claimed earlier shall be withdrawn, means disallowed, and you have to pay tax and it will be taxable in the year in which payment is made. Got it? Next, Rule 6DD. Guys, there are certain scenarios in which even though you make payment to a single person in a single day more than 10,000 in other than prescribed means even if you make cash payment more than 10,000 to a single person in a single day, still it will be allowed. So cases in which cash payment can be made more than 10,000. What are these, sir? This is called exception to section 48(3) rule 6(dd) it is. This is the list of transactions. If you make any repayment of loan payment, or if you are making any payment to commission agents, or you are making any payment to banks or LIC or credit society or any government entity, or you are just making a book adjustment entry, or you are making any payment for purchase of any agriculture produce or animal husbandry, or you are purchasing anything, you are making any payment to any cottage industry where they work on a manual basis, or you are transacting in a village or a town where there is no banking facilities, or you are making payment for any retirement benefits up to 50,000 rupees, or you are posted, one employee is posted in a temporary basis in any area, and for that payment of salary is to be done maximum for 15 days. In that case also you can make a cash payment. And in case of foreign exchange dealer, of course they deal in cash, so there also you can make payment more than 10,000 in other than prescribed modes, no problem. You make in cash payment more than 10,000, it is allowed. These are exceptions to rule 6dd. Just have a look once and go for examination. Now comes section 40A7, provision of gratuity not allowed. I told you already, any kind of provision is not allowed under Income Tax Act. So provision for gratuity not allowed, but if you actually paid any gratuity amount, it is allowed. Contribution to approved gratuity fund, actual payment basis, it is allowed. The provision is not allowed. Now, at multiple places we have seen section 43B, 43B, 43B. What is 43B? Very simple. In 43B, there are some list of expenditures given. In these expenditures, you have to make payment before filing the return of income. All other expenditures, if you are following accrual basis of accounting, even if it is payable, still you can claim it as expenditure. But there are some list of expenditures given under section 43B, which you have to actually make the payment in order to claim it as deduction. Before filing the return of income, you have to make the payments. Expenses allowed only on payment basis. The first one is bonus and commission to employees. We read already. Any taxes, we read this also, indirect taxes. Employer contribution to PF, we already read this, covered. Interest on loan also we covered. Leave salary, leave encashment, and any payment to Indian Railways for use of any railway assets. These are the expenditures which you have to make payment must before filing return of income. Only then you are eligible to claim the deduction under section 43B. Otherwise it will be disallowed. Now, lot of times this is asked in examination. Payments to micro and small enterprises. Mind you, here medium enterprise is not covered. Only payments to micro or small enterprise is covered. Guys, let's take one example. Thailava classes is making payment to micro or small enterprise for purchase of any goods or services, for example. Now, payment to MSE shall be made as per section 15 of MSME Act. What is given in MSME Act? If there is an agreement between Thailava classes and this MSE enterprise, then the payment shall be done maximum within 45 days. If there is no agreement made, then the payment shall be done maximum within 15 days, mind you. Are you getting it? Next. What is a MSE, sir? How will I find out, sir, whether the vendor is a MSE or not? If the investment in plant and machinery or equipment of the enterprise is up to 2.5 crores and turnover is up to 10 crores, then it is a micro enterprise. But if the investment in plant and machinery is up to 25 crores and the turnover, if it is up to 100 crores, it is a small enterprise. These are the enterprises to which if you make any payment for any goods or services taken from these enterprises, you have to make payment within 45 days if there is agreement, and within 15 days if there is no agreement. Sir, what will happen if I make payment after 45 days or 15 days? Then whatever expenditure you spent Whatever amounts you are making payment to this MSE enterprise is not allowed as deduction. It will be totally disallowed under section 43BH. Got it? If payment done within the time limit, then allowed in the current previous year of purchase. If payment is done beyond the time limit, then allowed in the year in which actual payment is done. But in the year in which you did not make the payment within 45 days or 15 days, it will be disallowed. In my Thailava notes, one example is given. Go and check. It will be much clarity for you. Now, the above provision is not applicable for medium enterprise. This just now I told you. The next one is 43A, asset acquired from foreign country. Lot of times what happens? Let's say for example, I am buying one plant and machinery, one asset I am acquiring from foreign country. Now, if I purchase any asset from foreign country, then I have to make payment in foreign currency, correct? Because the invoice will be in foreign currency. Now, whenever, let's say for example, first I purchased an asset on credit basis for $5 or $1 lakh, $1 lakh. Now, as per $1 lakh, I will first capitalize the asset in my books of accounts. $1 lakh into 95 rupees per dollar, let's say for example. So 95 lakhs of worth of asset, I put it in my block of asset. Now, whenever I will make the actual payment of this $1 lakh, the dollar rate will fluctuate. If the dollar is strong, I will lose more money I have to pay to the vendor. If the dollar is weak or the rupee is strong, I have to pay less, so I will gain. So if there is a forex gain, always remember, reduce that amount of gain from the block of asset. If there is a foreign exchange loss, then add it to the block of asset, because that is adding to the cost of asset and you can claim depreciation on. Next, section 41, deemed income. If you remember, when we started the topic on the credit side of profit and loss account, I wrote only two sections, section 28 and section 41. Section 28 were actual incomes, but section 41 is deemed income. These are not actually incomes of a business, but these are actually deemed as income of a business, and you have to pay tax on this. So first one is section 41.1, recovery of any deductions claimed earlier. Let's say for example, GST refund. Earlier you claimed GST as expenditure, but you got a GST refund later. That is an income, deemed income. Seller of goods waived off credit. First, you debited your profit and loss account to purchases 1 lakh rupees like that. But the seller of the goods told, okay, you don't pay anything. Then you unnecessarily claimed that expenditure. You are not making any kind of payment to that. Then you have to reverse it. That will become income for you. Working capital loan waived off by banks. A lot of times, working capital loan you will take from bank and the bank will waive off under some government scheme. If that is the case, in that case, you will credit it to the profit and loss account as income under section 41.1. 41.1 to 14 already covered earlier, guys. Balancing charge and bad debts recovery is already considered. Now, 41.3, sale of scientific research asset. Guys, you know very well, scientific research asset, if you purchase, you are eligible for 100% deduction under section 35. Of course, you are not eligible for depreciation. But what will happen if you sell this asset in future? If you sell the asset without putting to use in the business, and if the sale price is less than the cost, then the sale price or deduction what you claimed earlier, whichever is lower, you will have to offer it to tax under section 43.1. 41.3 under PGBP. Sale after use in business. If you sell the asset after putting use the business, then of course add to block nil, but sale price section 50 shall apply. But if the sale price is more than cost, anytime you will get a capital gain. Now we will talk about the tax audit, section 44AB, tax audit for persons carrying on business or profession. Guys, what is the tax audit? The books of accounts which you prepared as per the PGBP, as per the income tax, whether it is correct or not, one auditor will check. That is called the tax audit. This may be happening in case of specified professions or businesses. We will discuss this 44AD separately, don't worry. So if you are in a profession and if your gross receipts are more than 50 lakhs, you are required to get your books of accounts audited. And if you are into some business and if your turnover is more than 1 crore, you are required to get your books of accounts audited. But this 1 crore limit will become 10 crores only if the cash receipts and cash payments of your business both are less than or equal to 5%. Means 95% or more of your business transactions, both the receipts and payments, should be through the prescribed modes, through the banking channels. Only then you will be enjoying the benefit of 10 crores of limit. And mind you, when I say the banking channels, it means payment received in cash or DD is not, check or DD which is not account payee shall be treated as cash. This I already taught you. Account pay check, account pay demand draft, it should be. It should not be bearer check and bearer DD, demand draft. And penalty will also be applicable if you do not get your books of accounts audited. Lower of 0.5% of turnover and 1,50,000, whichever is lower, will be levied as penalty. Now we will discuss three sections which are 44 AD, ADA, AE, presumptive basis of income for businesses and professions. Guys, under 44 AD, presumptive basis of income for business. Let's say, for example, you are a businessman. Small business people, this is actually applicable. If you are an individual or an HUF or a firm but excluding LLP, if you are any of these taxpayers and you have a business, but the business should not be any profession or brokerage business or commission business or agency business or transport business. And if your turnover is up to 2 crore rupees, then you know what? Government says you don't maintain any books of accounts. You don't get your books of accounts audited, nothing. You just offer me either 6% of turnover or 8% of turnover, enough. If your turnover is up to 2 crore rupees, you offer me 8% of your turnover as your profit. Under PGBP head, I will not ask you books of accounts. I will not ask you to get your books of accounts audited. I will presume that 8% is your profit. That's all. And mind you, this 8% also you can further less, 6% only you can offer, provided only to the sales on which you have realized through account paycheck, DD, or through electronic clearing system. Let's say, for example, we'll take one example. Let's say, for example, your turnover is 1 crore 80 lakh rupees. Out of 1 crore 80 lakh rupees, 60 lakhs you have realized in cash, and rest 1 crore 20 lakhs, 1.2 crores you realized through banking channels out of sales. So on this 60 lakhs, you have to offer 8% as profit. On this 1.2 crores, you have to offer 6% as profit. Then enough. No need to maintain books of account, nothing. That is called presumptive income. So whatever 6%, 8% we will calculate, that will be treated, that will be assumed as your PGBP. That's all. Then further, you are not eligible for any kind of expenditures, not even depreciation. And this 2 crores limit, you can increase it to 3 crores provided the transactions in your business more than 95% should be through electronic clearing systems, prescribed modes of payments. So higher limit of 3 crores you can enjoy if cash turnover is up to 5% only. So up to 5% you can do it in other than prescribed modes, but more than 95% of your transactions should be through the prescribed modes of payments. So if assessee offers minimum that 6%, 8%, no need to maintain books, no need to get the books of accounts audited. If assessee turnover is less than 2% or less than 2 crores or 3 crores, and sir, what if, sir, I don't want to pay 8%, 6%, sir. If my turnover is up to 2 crores, 3 crores, I don't want, because my business actually do not give me so much of profit. Why should I, offer 8% or 6%? I want to offer less, sir. Then you can offer less, but you have to then maintain books of accounts and get them audited also. So if assessee's turnover is less than 2 crores or 3 crores and wants to offer less than 8% or 6%, then it is must to maintain books of accounts and get them audited. But mind you, this you will do only if the total income of your year, in a year, if your total income is exceeding basic exemption limit. Now there is one very important point. If you want to opt for 44AD, once you opt, then for another 5 years you have to offer under 44AD only. If naturally your turnover is exceeding 3 crores, that is a different case. But if your turnover is well within 2 crores or 3 crores only, in that case, once you opt, let's say for example, in this year, you are offering to tax under 44AD. In that case, another 5 years you have to offer under 44AD only. If by chance in any of these 5 years, you are going out of 44AD presumptive case, in that case, another 5 years, you can never pay tax under 44AD, mind it. Got it? Next. 44ADA, presumptive PGBP for professions. For 44AD is for business, ADA is for professionals. This is applicable in case of resident individuals and firms other than LLPs. HUF is not covered here because HUF can never have a profession. Engaged in notified professions. If the gross receipt is up to 50 lakhs, straight away 50% of your gross receipt, you can offer it as PGBP income. No need to maintain books of accounts, no need to get your books of accounts audited. And this 50 lakhs, you can claim a higher limit of 75 lakhs if more than 95% of your transactions are happening through prescribed mode of payments. Next one is 44AE, presumptive basis of income in case of flying, hiring, leasing of goods carriage businesses. You know, small transporters will be there. They'll be having one trucks, mini trucks like that. So they can actually avail this 44AE business. This is also business only. 44AE benefit they can avail. Now what is 44AE? If you are a business of goods carriage business, if you have, and if you are owning only up to not more than 10 goods vehicle during any time during the year, in that case, you can offer this presumptive income and the government will accept it. What is this? For a heavy good vehicle, you have to offer minimum 1000 rupees per ton of gross vehicle weight or unladen weight for each month. So 1000 rupees per ton for each month you have to offer. Now, how will you know, sir, whether it is a heavy good vehicle or a light good vehicle? You have to check. Heavy good vehicle means exceeding 12,000 kgs, the gross vehicle weight. And if the vehicle weight is less than 12,000, it is a light vehicle weight. And if it is the other vehicle, means other than a heavy good vehicle, you have to offer straight away 7,000 rupees, 7,500 rupees per vehicle per month. This is per vehicle per month. This much if you offer, good enough. No need to maintain any books of accounts. No need to get books of accounts audited. The next section is 40B. Guys, you remember, in case of partnership firms, partner will get capital into the business. He will expect two things from the partnership firm generally. One is interest on capital. The other thing he will expect is remuneration. Remuneration may be salary, bonus, commission, whatever we call. Now, in the profit and loss account of partnership firm, whether how much ever interest will be paid to the partner is allowed, how much ever remuneration paid to the partner is allowed or not is a question mark. There is nothing like that. There is actually limit prescribed in the Income Tax Act. Means in the profit and loss account of a partnership firm, the partnership firm can claim only to certain extent as expenditure of interest paid to partner on partner's capital or remuneration paid to partner only to certain limit only is allowed as expenditure in the books of accounts of partnership firm. If the partnership firm pay anything beyond the limit, then the excess will be disallowed in the hands of partnership firm. Got it? So following amounts shall be disallowed in the hands of partnership firm or LLP. Any payment made to non-working partner. Guys, to non-working partner, any payment you make, any amount you make, it is disallowed. Only working partner, if you make any salary payments or interest payments, it is allowed. Number one, unauthorized payments to working partner. Let's say, for example, in the partnership deed, it is not authorized to make any payment. A certain payment is not authorized by the partnership deed, then also it is not allowed. Third, any payment before the date of partnership deed. Let's say, for example, you started your partnership firm on 15th of, let's say, for example, you started your partnership firm on 15th of June 2025. But you created a deed on 15th of September 2025, for example. Now, whatever payment you started the firm on June, but you created the deed on 15th of September. So whatever payments you will make in this duration is not allowable as expenditure. So any payments made before the date of partnership deed is not allowed. And interest on partner capital or loan exceeding 12% is also not allowed. So if you make any interest payment to partner exceeding 12% per annum, it is not allowed. Let's say, for example, firm pays 16% per annum as interest on capital contribution of partner. Only 12% is allowed. 4% excess interest is totally disallowed. Now, when it comes to interest payment, guys, lot of times partner would be representing another entity in the partnership firm. Let's say, for example, HUF. HUF is a partner, but partner is Kartano. In that case, what will happen? If partner is on individual capacity, means he is not representing any HUF. He is only partner. Let's say, for example, me. I am only partner in a partnership firm, and if I receive any interest in that case, I am receiving the interest on individual capacity. In that case, maximum 12% only interest allowed, because I am a partner, I am receiving interest from the partnership firm. But if I being a representative capacity, let's say, for example, I am actually representing partnership firm, my HUF in the partnership firm. My HUF is a partner in the partnership firm. I am not the partner, I am just a Karta. But I am receiving interest on representative capacity, then also 12% interest only maximum allowed. If I am partner on an individual capacity, I am only partner, but I am receiving interest in representative capacity. Means actually loan is given by HUF to the partnership firm. I am receiving interest. I'm not receiving interest. The HUF is receiving the interest from the partnership firm. Then limit is not applicable. And if I am partner on a representative capacity, but I am receiving interest on an individual capacity. Let's say, for example, I am a Karta of HUF, but I personally gave loan to the partnership firm. HUF is partner in the partnership firm. Then whatever interest I will receive, that will not be triggered by the limit of 12%. Very simple. In examination, if you don't want to get confused, simple remember, if both are same here, then only limit is triggered. Limit is cap of 12% is applicable. If you see here, both are different. Here individual capacity, representative capacity, individual capacity, then the limit will not be applicable. Remember like this in examination. Now whatever I told you, 12% is applicable only for interest on capital contribution or loan paid to partner, 12% maximum allowed. But whenever a remuneration is paid to a partner, there is a limit. Up to that limit only it is allowed in the books of accounts of partnership firm. What is the limit, sir? Remuneration to working partner only, mind you, non-working partner it is not allowed even a single rupee. In excess of below prescribed limit, even if authorized by deed, even if the partnership deed says, or even if the partnership deed is authorizing more payment, still Income Tax Act will not allow. What is that? First you have to take a book profit. What is a book profit? Profit as per PGBP before deducting remuneration, but after deducting all the expenditures. Guys, book profit is nothing but you have to take the PGBP profit of a partnership firm. After claiming all deductions, including the interest within the limit, whatever is there, you claim all the deductions except the remuneration for which we are calculating here. That is called book profit. On first 6 lakhs of book profit, or in case of loss also, you have to take higher of 3 lakhs or 90% of book profit. Higher you will take. And on the remaining balance book profit, you will take 60%. This is the limit up to which maximum you can pay remuneration to partner. Remuneration includes salary, bonus, commission, everything. We'll take one example. Let's say for example, 11 lakhs is the book profit. Remuneration actually paid to the partner is 9,50,000. Now, how much disallowance will be detracted? Simple. Book profit is 11 lakhs. So, on first 6 lakhs, you have to take 3 lakhs or 90% of 6 lakhs. That will be 5 lakh 40 or 3 lakhs. Whichever is higher is 5 lakh 40. Now, on the balance of 11 lakhs minus 6 lakhs, on the balance is what? 5 lakhs. Into 60%, 3 lakhs. So, 540 plus 3 lakhs will be 8 lakh 40. This is the maximum salary or remuneration which you can pay to the partner. But how much is paid? 9,50,000 is paid. So, how much disallowance will come? 9,50,000 minus 8 lakh 40. 11 lakh, 1,10,000 is a disallowed and firm has to pay tax on that. Got it? Next. Remember this, very, very important. Guys, I told you, interest maximum 12% is allowed in the hands of partnership firm, and remuneration also only to this extent it is allowed. Now, everyone will focus here. Guys, totally 9,50,000 is paid to the partner as remuneration. So, in the partner's hand, 9,50,000 is income. Now, actually, on 9,50,000, if it is income, under which head it will go in the hands of partner? PGBP head. Now, if 9,50,000 is taxable under PGBP, then it will become double taxation, because here 1,10,000 is getting taxed in the hands of partnership firm, and this 1,10,000 is nothing but forming part of 9,50,000 only, no, and that's why this 8,40,000, whichever is allowable in the hands of partnership firm, it is allowable means firm is not paying tax on that. So 8,40,000, on this 8,40,000, the partner will pay tax, and on this 1,10,000, the firm will pay tax. Means to the extent to which 8,40,000 is allowed in the hands of partnership firm, partner will pay tax. And to the extent to which it is disallowed in the hands of partnership firm will pay tax, and it will be exempt in the hands of partner. Same thing. See, partnership firm is paying remuneration to partner, remuneration or interest. If it is paid within the limit, then it will be allowed as deduction under 40B no in the hands of firm, and it will be taxable in the hands of PGBP. Because see guys, if it is allowed as deduction in the hands of partnership firm, then tax is not paid in the hands of partnership firm. Then who has to pay tax? Then it is paid tax, the partner will pay tax. But let's say for example, if the remuneration or interest is paid in excess of 40B, then disallowance will happen in the hands of partnership firm. Means the disallowance happening in the partnership firm means partnership firm already paid tax on that. In that case, it will be exempt in the hands of partner. Any one only will pay tax. So if it is disallowed in the hands of partnership firm is paying tax on that amount, then it should be exempt in the hands of partner. If partnership firm is not paying tax on the remuneration or interest, means it is totally allowed, then the partner will pay tax on the amount which he is receiving from the partnership firm. Now, there are some miscellaneous things, 2 things, and then we will close it. Guys, under section 140Y1, it says that method of accounting. Whenever you compute your PGBP income or IFRS income, you can either follow cash method of accounting or accrual system of accounting, guys. Anything you can follow. Now, there is something called as speculative business in your PGBP. Speculation means very simple, guys. You bet on the price. There is no actual delivery. Let's say, for example, you book 100 kgs of gold. Actually, you are not getting 100 kgs of gold here, but you are just booking the 100 kg of gold virtually at a particular price, and virtually you will sell that. Let's say for example, today you purchased 100 kgs of gold at 1000 rupees per kg, like that, and you sold it for 1200 per rupees per kg. So 200 is your profit. You will get the profit. That's all. You will not even pay that 1000 kgs of gold price. Neither they will pay you 1002 or that 1000 kgs at the time of sale. It is just a virtual transaction. There is no actual delivery. That is called speculation. You are just speculating the price. In that case, it means a transaction in which contract for sale or purchase is ultimately settled by otherwise than actual delivery. There is no actual delivery. But there are some transactions not regarded as speculation business. Guys, you have to remember these 3 things, because in examination, in set of carry forward of losses, speculation loss can only be set off with speculation business. In that case, you need to understand these three are not speculation businesses. Hedging contract, forward contract, and derivatives, any kind of futures and options are not speculation business. Speculation business and normal business are treated as separate businesses. Always remember this, guys. And that is the end of our PGBP discussion. Guys, if you genuinely think my teaching is helping you, write in comment section whatever you want to write. That will give me boost my confidence for the energy and the time which I have spent. And hit one like button and share with your friends regarding these amazing sessions which we are providing to you. And please do subscribe to my channel if you are new to my channel for this kind of amazing content. Before your examination, I will be coming up with lot of expected questions, super questions, super 50 adjustments, like this many things I'll be coming up with. And as I told you, if you want to download the Thailava notes, Thailava question bank, it is available in this video's description. You can definitely go and download that, or you can visit www.taxthailava.com under free resources. Anyway, you will find there also. If you want regular class or you want practice batch, it is available on my website www.taxthailava.com, or you can purchase it from CA Classroom. If you want income tax and GST combo, or you want full group 1 combo, like that, if you want to buy, you can go to www.caclassroom.com, which is owned by Karthik Manikonda sir, and we have officially collaborated. So if you have officially collaborated, you can buy my product there also, or on my website. There you can create combos. There are Amit Mahajan sir and a lot of ANM sir, Kaushik Mukesh sir. There are lot of options available for your GST also. You can go and buy from there. You can create a combo. You want only group 1, that is also possible. Everything is possible. You can buy it from there also. Okay guys, we'll see you in the next topic. Namaste, Namaskara, Vanakkam. You all requested for capital gains revision, and here I am with a full-fledged video. All the topics of capital gain will be covered in this video, guys. So be tuned in this video till the end. If you're new to my channel, I've already uploaded a lot of content for CA intermediate taxation coming attempt, like total income computation, PGBP master adjustments, set off and carry forward of losses, income from house property. Like this, I've covered a lot of topics on this channel itself. You will find, go and watch it on Tax Thailava channel, guys. You will find it. And if you're new to my channel, please do subscribe, because otherwise you will miss a lot of amazing content like this. And do like a hit button for all the hard work I'm doing, guys. Okay, with this brief introduction, let's start the next topics, which is capital gain. Guys, this topic is asked for minimum 4 marks in all the 5 previous attempts. You pick the CA intermediate taxation paper, you will find minimum 4 marks is asked from this topic. And this attempt, there are some amendments in this topic, so it becomes very important to cover this topic, guys. First section which we are going to discuss is section 45, which is charging section. It says that gain on transfer of capital assets shall be charged under the capital gains head. Now you would ask, sir, what is a gain, sir? Gain is nothing but your profit on sale. So let's say, for example, you have a building. This building, you're selling it off to someone for a profit. The profit whichever you will earn by selling a building, the profit you will tax it under the capital gains head. So gain is nothing but the profit, guys. Now, sir, what is this transfer, sir? You are using transfer term. Just now you told sale, because guys, transfer includes a sale, but it also includes some other things. Even exchange is included. Exchange is what? You are giving one asset, you are taking one asset. Even that is covered under transfer. Relinquishment means giving away the right in the property, guys. Let's say, for example, there are two brothers having a common property. One brother told, I am giving away my right in this building to you. So the one brother is giving away the right to another brother. That is called as relinquishment, giving away the right in the property. Even that is treated as transfer, guys. Extinguishment, let's say, for example, you took a loan on a building from a bank and you're not paying the loan on time. So the bank will come and take away the property from you. You're losing the right in the property. That is called extinguishment. So that is a transfer, guys. Compulsory acquisition means, let's say, for example, government wants to expand the road and your building is there on the road, so they want to demolish your building. Do you think the government will not pay you anything? Of course, government will give you money for acquiring your property. That is also treated as transfer. So you're losing the right in the property, right? That is called compulsory acquisition, treated as transfer. Conversion of capital asset into stock in trade. Let's say, for example, you have one building. You are starting one real estate company, or that real estate means what? In that real estate company, you will be selling buildings, selling land, buying land, like that. Now you have a building which you want to convert into stock in trade of that real estate company. In that case, once you convert the capital asset into stock in trade, that is also treated as transfer only, guys. Now coming to capital asset definition, guys, one thing you keep in mind: in capital gains, you will be taking only those gains or profits which you earned by transfer of a capital asset, right? Now you need to understand what is a capital asset. Capital asset includes and excludes something. Capital asset generally includes all kinds of properties, guys. It can be land, it can be building, it can be machinery, anything it can be. If it is a property, it can be movable or immovable also, or it can be tangible or intangible also. It should be a property, guys, whether or not connected with the business. Let's say, for example, I have a building. I do not have any business, but I have a building which I use for my personal purpose. Now I am selling this building, so whatever profit I will make by selling this building will be treated as profit or gain from a capital gains head only, because even this building, though it is not used for business purpose, it is a capital asset. I have sold it, I have made profit, all three conditions are met. So the profit whichever I will make, I will offer it under capital gains head only. Second scenario I will take: I am having a building which I use for my business purpose. If that building is sold and if I make a profit, even still then capital asset is sold, profit is made, and the transfer has happened. That is why that will be treated as capital asset, and capital gain will be still taxed under the capital gains head only. And then securities held by FIIs also will be treated as capital asset. But there are few things which are not treated as capital asset. The first thing is stock in trade. Think logically, guys. If you have a stock in trade for your business purpose, if you sell that to stock in trade, whatever profit you will make, you will offer it under PGBP, correct? Because that is a stock in trade. So stock in trade can never become a capital asset, guys. Next, movable personal effects. When I say personal effects, you need to understand watch is a personal effect. Car is a personal effect. The furniture, sofa which you use at your home is your personal effect. And these are the personal effects, means which you use for your personal purpose. These are movable items. Those are personal assets. So movable personal effects are not capital assets, but there is a list of assets which are given by the income tax department, and the income tax department says that if you sell these assets and if you earn some profit, that profit will be treated as capital gain only. What are these, sir? First thing is jewelry. Let's say, for example, you have a gold ring, gold bracelet, gold earrings. These will be treated as capital asset only. So movable personal effects has exceptions, and these are the exceptions, guys. So always remember, if a jewelry is sold in a question, if it is given gold ring is sold, gold jewelry is sold, treated as capital asset only. Though in the question they gives you that it is used for personal purpose. Drawings, archaeological collections, paintings, sculpture, work of art, gold utensils also. At home, if you are using gold plate for having food, gold spoon for having food, even those are treated as capital asset only. And gold or silver bars or coins also are treated as capital assets only, guys. So only these are the capital assets. Even though you use for your personal purpose, will be treated as capital asset only. All other movable personal usage, mobile, car, whatever you have, will not be treated as capital asset, guys. Next, rural agriculture land. Very, very important, guys. Agriculture land means the land which you use for agriculture purpose. There are two kinds of agriculture land: rural agriculture land, urban agriculture land. Means depending on the area where it is located, it will be treated as rural area or urban area. So if you have agriculture land situated in rural area, guys, keep in mind, rural area, that is not a capital asset. Means whatever profit you will make by selling this rural agriculture land is not treated as capital gain. Let's say, for example, I have a rural agriculture land in rural area. have agriculture land I purchased for 10 lakhs. Now I am selling this land for 1 crore. 90 lakhs profit is there. Still nothing will be taxed under Income Tax Act under capital gains head because the land, agriculture land is situated in rural area. Same agriculture land, if it is situated in urban area, let's say for example, and if I sell that, whatever profit I make will be treated as capital gains tax because that will be treated as capital asset. So only rural agriculture land is not a capital asset, guys. Sir, how do I know whether area is a rural area or urban area? Always keep in mind if the population of the area where the land is situated is up to 10,000, in that case, it is always a rural area, guys. Say for example, population is 6,000 in the area. Let's say for example, this is the area and my land is situated here. And if this area's population is up to 10,000 only, in that case, this is a rural area, guys. Next, if land is situated in below area, it is urban land. Otherwise, it is a rural land. Now, this limits will tell you the urban area limits. So, let's say for example, guys, this is the local limits. This is the local limits. Okay, one second. So, if this is the local limits, if this is the local limits of the area and another some extra kilometers they will give you in the provision. Let's see this. Population as per latest census is more than 10,000 but up to 1 lakh. Shortest aerial distance from local limits up to 2 kilometers. Now, this is the local limits and another 2 kilometers. Guys, always think logically, guys. If you are in a middle of a city, from middle of city, if you keep traveling outside the city, gradually you will see rural area. But if you are in middle of the city, it is called a urban area. So if this is the local limits of the place, then of course as you go out, this will be rural area, correct? So this is, sorry, wait a second. So this area is urban area. Whatever area outside this is called as a rural area, guys. So urban area is nothing but the local limits and another 2 kilometers outside that also will be treated as urban area only, guys. So if I have to say this total area will be treated as urban area, but outside this whatever area is there will be treated as rural area, guys. So if the population is more than 10,000 up to 1 lakh, in that case, from the urban limits, from this limit, another 2 kilometers will also be treated as urban area only. If the population is more than 1 lakh but up to 10 lakhs, up to 6 kilometers, you will see from the local limits will be treated as urban area only. If the population is more than 10 lakhs, then from the urban limits, another 8 kilometers also will be treated as urban area. Whatever outside area is there, that is a rural area. So if your land is situated within the urban limits will be called as urban agriculture land. If it is situated outside the urban limits will be treated as rural agriculture land, guys. I hope that is clear. Next, there are some specified gold bonds and gold deposit bonds not treated as capital assets, guys. Next, guys, always keep in mind one thing. Generally, capital gain is chargeable to tax in the year of transfer. Means the year in which you made the sale of asset. In that year only you are required to pay tax. But there are some situations in which capital gain shall be taxed in a different year. What are those situations, sir? Insurance receipts. Let's say for example, you have a building. In that building, fire accident happened. Okay, fire accident happened. Now, fire accident happened, you lost the property. Even if you lose the right in this property, that will be treated as a transfer only, guys. So you lost the property. Now, did you receive any money now out of this fire accident? No. When you will receive the money from the insurance company. Do you think insurance company will give you the amount in the same year on the spot? They will give? No. There are a lot of approvals, procedures and all will be there. So it takes time. Let's say for example, in 2024-25 fire accident happened. Now 2024-25 itself, you lost the right in the property, transfer happened. Now you are required to pay capital gains tax. But where is the consideration? Is there any consideration? Just you lost the property, that's all. There is no consideration. You will receive the consideration from the insurance company, correct? So the insurance company, let's say for example, they paid you in 2025-26. So unless the insurance company pay you the amount, How do you know what is your sale consideration? So whatever amount you will receive from the insurance company will be treated as your full value of consideration. So you will not pay the tax in the year 2024-25, mind you. You will pay the tax in 2025-26, in the year in which you receive company insurance receipts. So in the case of insurance receipts, taxes taxes tax in compensation received here. Full value of consideration will be cash plus the fair market value of asset received. So a lot of times insurance company will give you an asset also and cash also. So both will be treated as your full value of consideration for your capital gain calculation purposes, guys. Next, conversion of a capital asset into stock. Say for example, you have a building which you want to treat it as a stock in trade for your real estate business you want to convert. In that case, you will tax in the year of sale of stock in trade. Think logically, guys. You have a capital asset. You just converted that capital asset into stock in trade. Have you got any money out of that? No. When you will get that money, once that stock in trade is sold in the business, in the real estate business, then only you will get the money. So income tax department says, okay, if you convert your capital asset into stock in trade, we will not torture you to pay the tax in the year of conversion. We will wait till that stock in trade is sold in the business. So you will pay the capital gain tax in the year in which you will sell off that building as a stock in trade. So capital gain on conversion of capital asset into stock in trade. Full value of consideration less cost of acquisition, cost of improvement, everything, capital gain you will take. Full value of consideration will be fair market value of asset as on the date of conversion. Now this becomes very, very important. Let's say for example, guys, in the year 2024-25, you converted the capital asset into stock in trade. On, let's say for example, I'll take a date also here. Let's say for example, 15th of September 2025, you converted a capital asset into stock in trade, guys. And on that day, the fair market value is 15 lakh rupees. Okay, 15 lakh rupees. Now, this is capital asset you sold on, let's say, for example, 16th of October 2027. In the future year you sold. In that case, the actual sale value is, let's say, for example, 55 lakh rupees, guys. Now, always keep in mind one thing. The fair market value as on the date of conversion will be treated as full value of consideration, guys. Think logically. The day on which you converted, 15th September itself, capital asset nature is gone, because from 16th of September you will treat it as stock in trade, correct? So the fair market value which is there on the date of conversion will become your full value of consideration for capital gain calculation purpose. And this sale value 55 lakhs, you will take it as your business sale value, actual sale price of stock in trade. This 55 lakhs you will take. So then which purchase value I will take? Of course you will take this fair market value of 15 lakh rupees to compute the PGBP, guys. So whenever a capital asset is converted into stock in trade, two kinds of income will generate. Number one, capital gain. The other is PGBP. From the day you purchased the capital asset originally till the date you converted into stock in trade will be period of holding, and the date on which you converted, that date's fair market value you will take as full value of consideration for capital gain computation. For PGBP, once you convert a capital asset into stock in trade, then you future whenever you will sell off this building, PGBP income will arise. For PGBP calculation, you will always take the actual sale value of stock in trade, which is 55 lakhs, and you will reduce not the original cost of acquisition of the asset, because fair market value 15 lakhs you will take for PGBP income, guys. Both capital gains and business income are chargeable to tax in the year in which stock in trade is sold. If only part of the stock in trade is sold, then only partial capital gain will be taxed. Next, compulsory acquisition. I just now told you, for road expansion, government can compulsorily acquire your building. For that, government will give you something called as compensation. Of course, that compensation will be treated as your full value of consideration for capital gain calculation. So original compensation, enhanced compensation, what is this, sir? Let's say for example, initially when your building was acquired by the government told you that government will give you 50 lakh rupees, for example. Government told you that we will pay you 50 lakh rupees, and they paid you also. Original compensation you got. But you are not satisfied with this 50 lakhs. You went to court of law and you filed a case. And after 2-3 years, court gave a judgment that okay, 50 lakh should not be paid, it should be paid 70 lakh rupees. Now 50 lakhs originally you got the compensation, another 20 lakh rupees extra you are getting because government told, court told that 70 lakhs should be paid. Already 50 lakhs is paid to you, now 20 lakh rupees extra you are getting, that is called enhanced compensation. So original compensation is 50 lakhs, enhanced compensation is 20 lakh rupees. Guys, original compensation, tax in the year in which the compensation is received. So whenever you received this 50 lakh rupees, that year you pay tax on that 50 lakh rupees. Capital gain, how do I compute, sir? Very simple. Compensation, whatever you got 50 lakhs minus the actual cost of acquisition of the building which was compulsorily acquired, you will take. That will give you the capital gain on the original compensation. For enhanced compensation, think logically, guys. Enhanced means extra compensation you received in future. On that also you have to pay tax. Of course, you will pay tax in the year in which you will receive it. But let's read this first. A person may file a case in the court of law for enhancement of compensation. Additional compensation received shall be taxed in the year of receipt. Cost of acquisition for enhanced compensation will be nil because, guys, when you computed the capital gain for the original compensation, you already reduced the cost of acquisition. Then of course, for enhanced compensation of 20 lakhs, again you will not reduce the cost of acquisition, otherwise it will become double benefit, right? Next, important points. If initial compensation is received in installments, let's say for example, this 50 lakhs, government told that they'll give you in 10 lakhs, 10 lakhs, 10 lakhs, like 5 equal installments, they will give you. Government told like this. In that case, always keep in mind one thing, guys. If initial compensation, this 50 lakhs is given in installments, you will pay tax on the full 50 lakhs sale value. I mean, you will pay the capital gain tax in the year in which you receive the first initial installment, guys. Then it will be taxable in the year in which the first installment is received. So in the first year in which you get 10 lakhs, in that year only you will compute your capital gain. 50 lakhs minus cost of acquisition, full capital gain whatever you receive, on that you will pay tax in the year of first installment which you received. Compensation received in pursuance of an interim order shall be taxed in the year of final order. Let's say for example, first you filed a case in high court. High court told that you will get 20 lakhs extra. Then you went to Supreme Court also. In Supreme Court you got a different amount. So it is saying that compensation received in interim order. Interim order means high court, final order means Supreme Court. So interim order if you get shall be taxable in the year of final order. So again, a case is filed in the Supreme Court, you will not pay any tax when you received compensation because of a high court order. You will wait for the Supreme Court order and then only you will pay the tax. If the original or enhanced compensation is reduced by any court, then you have to repay the tax. Then recomputation of capital gain shall be happened. So let's say for example, initially court told we will pay you 70 lakhs. Then one more court told that they'll pay you only 50 lakh rupees. In that case, first you have computed as per the 70 lakhs. Now you will recompute the capital gain as per 50 lakh rupees. If transferor dies before receiving compensation, then tax in the hands of recipient. Next, if compensation is received as per RFCTLAAR Act, in that case, it shall not be taxable. Guys, one point you remember, sometimes in theory it may give right to compensation and Transparency Land Acquisition Act. If you receive any compensation under this act, it will not be taxed. Now, sir, at what rates shall I tax this capital gain, sir? I understood how to compute the capital gain, everything, but at what rate I should calculate this tax? Shall I use the slab rates? No. You will not use the slab rates for capital gains. You will only use the slab rate for short-term capital gain, that too other than special short-term capital gain. Don't worry. Now, rates of tax depends on the nature of capital asset actually. There are two kinds of capital asset. One is a short-term capital asset, the other is long-term capital asset. Sir, how do I decide, sir, whether asset is a long-term or short-term? That will depend on period of holding. Sir, what is a period of holding? Period of holding is the period which starts from the day you acquired the asset and ends with the day on which you transferred the asset. Say for example, in 2020, I purchased one asset. 2024, I am selling the asset. My period of holding is 4 years, 2020 till 2024. So, period of holding is nothing but the start date will start from the date you acquired the asset. End date will be the date on which you sold off the asset. Period of holding means the holding period you are owner of the asset. Now, always keep in mind a capital asset is classified as short term or long term based on the period of holding. In this case, guys, there is an amendment for the attempt. Before 2023 July 2024, the period of holding was different. Now, on or after 23 July 2024, the period of holding is different, guys. Always keep in mind one thing: before 23 July 2024, if you hold these three assets, listed securities other than units, units of equity oriented fund, and zero coupon bond, in these three cases only, guys, you will see 12 months duration. So if you hold the asset for more than 12 months, any of these three assets, that will be becoming long-term capital asset. If these three assets you hold for exactly 12 months or less than 12 months, that will become short-term capital asset. If you are holding unlisted shares or land or building or both, 24 months you will check like this. And all other assets apart from these assets, you will check 36 months. But after 23 July, if you are selling the asset, if you are selling means if you are transferring the asset on or after 23 July 2024, you will check the period of holding in this table. Means if you have listed securities including units and zero coupon bonds, you will check 12 months. All other assets you will check 24 months, guys. If I have to simply put in terms, guys, in the question in examination, if the sale date or the transfer date is before 23 July 2024, in that case, in order to check whether the asset which you are selling is a short-term capital asset or long-term capital asset, use this table. But in the question, if the sale value given of the asset is on or after 23rd July, then apply this table to find out whether that asset was a long-term capital asset or a short-term capital asset. Next. Important points, guys. If asset acquired by way of gift, will, inheritance, then include period of holding of previous owner also. Let's say, for example, my grandfather gifted me a property to me. Grandfather purchased the property in 2010 and he gifted me in 2015 to me. I sold this property in 2020 to someone, right? Now, I cannot say that my period of holding is only this, the day when I got from my grandfather. No. Period of holding in your case will be right from 2020 till 2010 till 2020 will be period of holding. So asset acquired by of gift, will, inheritance include period of holding of previous owner also. If inventory is converted into capital asset, consider period of holding from date of conversion. If you have a stock in trade, guys, which you convert into capital asset, in that case, guys, period of holding from the date of conversion only you will take. Are you getting it? Let's say, for example, you purchased one asset in 2010, guys, you purchased as a stock in trade. You purchased a building as a stock in trade. Let's say, for example, for a real estate business. In 2015, you converted this stock in trade into capital asset. And in 2017, you are selling this capital asset. Now, the period of holding for this capital asset calculation will be this 2 years only you will take. You will not take this previous year because here that building was in the nature of stock in trade. It got converted into capital asset only in 2015, guys. So that is why here it says, the provision says that if inventory is converted into capital asset, consider period of holding from date of conversion. Next, right shares, consider period of holding from allotment date. You know what is a right share, right? So from the date the allotment of right share will happen to you, from that date only you take your period of holding. Amalgamated company shares. You know, in amalgamated company like this will be there. For a new company, amalgamated company, the shares of the new old company shareholders will get new shares in the new company, right? In the amalgamation, guys, keep in mind one thing: in case of amalgamation, the period of holding will be starting from the amalgamated company date only. Let's say, for example, one shareholder had invested in one amalgamating company shares. Later that company got amalgamated with other company, new shares came in his hand. But for that new shares also, period of holding will include the period of holding of amalgamating company shares only, because this is just a replacement of amalgamating company shares with amalgamated company shares. Same exactly will happen in demerger also, guys. Period of holding of a demerged company will include the previous owned company also. Conversion of preference shares into equity shares. If you convert preference shares into equity shares, for the equity shares when you will sell in future, the period of holding always you will consider the preference shares holding period also, guys. Now, taxation in case of liquidation. Think logically, what happens in liquidation? In liquidation, company distributes all its assets to its shareholders, correct? Because ultimately shareholders are the owners of the company. In that case, who will pay tax on the distributed assets? Capital gains on distribution of assets by company in case of liquidation. Now guys, keep in mind one thing. If the assets are transferred to the shareholders, means owner is the shareholder, he is taking his own assets from the company, there is no capital gain taxation in the hands of a company, guys. So in the hands of company, if assets are directly distributed to shareholders, there is not a transfer of not a transfer in the hands of company, so there is no capital gain tax. Keep in mind thing. But in the hands of shareholders, guys, think logically. I invested my money in the company, in the shares of a company. Now, at the time when the company is getting liquidated, I am getting some money from the company. That is kind of consideration for the shares which I invested in the company only, correct? So, in that case, taxation will happen. In the case of liquidation, taxation will happen in the hands of shareholder, but not in the hands of company. Capital gains, how to compute, sir? Full value of consideration minus cost of acquisition, very simple. But keep in mind one thing. Full value of consideration means what? You may be getting money from the company at the time of liquidation, or you may be getting assets as it is from the company, correct? So money plus fair market value of assets distributed minus deemed dividend. Guys, in IFOS chapter there is a concept of deemed dividend in the case of liquidation. In that case, we have read, to the extent of accumulated profits which the company has at the time of liquidation, distributed to the shareholders will be treated as deemed dividend. So that deemed dividend you have to reduce here, because that deemed dividend will be taxed under IFOS in the hands of this shareholder. Next, we are taking one example. Mr. Raja holds 10,000 shares of Thailava Limited, for example. Cost of acquisition was 10 rupees per share. So 10,000 shares at the rate of 10 will become 1 lakh. So I invested. Let's say, for example, I am Raja. I invested in Thailava Limited 1 lakh rupees. 10,000 shares I purchased at the rate of 10. Company goes into liquidation. So Thailava Limited is getting liquidation. On liquidation, Raja receives, means I received the following. What I received? First, I received cash of 3,50,000 from the company, and the land also I received. The fair market value of the land is 1,50,000. So total amount what I received is 5 lakh rupees. 3,50,000 plus 1,50,000. But how much I invested? 1 lakh rupee I invested. Correct? Now see, company had accumulated profits to the extent of 1,20,000. So when I got this consideration of 5 lakhs, the company had accumulated profits up to the extent of 1,20,000, means this 1,20,000 will be treated as deemed dividend in my hands. Go and check IFOS topic. Now, taxation of dividend, which I just now told. Amount received to the extent of accumulated profit shall be deemed as dividend under section 222. Deemed dividend is 1,20,000, which I just now told. Under IFOS in my hands it will be taxed. But coming to capital gains. Capital gain taxation in the hands of the Raja. Full value of consideration is cash plus fair market value of land minus deemed dividend. Sir, 3,50,000 you received cash, 1,50,000 land you received, total 5 lakh consideration you received, but out of 5 lakhs, 1,20,000 already you paid a tax under IFOS. So we are removing that 1,20,000 here. So your net fair full value of consideration will become 3,80,000. You invested 1 lakh, so capital gain will be 2,80,000 rupees, guys. Next, buyback taxation. You know, a lot of times company buybacks its own shares. Now, what happens in buyback? Let's say, for example, I invested in particular company. For 100 rupees per share I invested. Now if the company buys back the share, it, let's say for example, for 150 rupees it is buying back my own share which I invested, so I'll get 150 now. Now first I invested 100, in the company. The same company is buying my share from me at 150. So 50 rupees profit for me, and the amount of profits which the company is distributing is how much? 50 rupees. Because 100 rupees I already gave to company. Company is giving me back 150, means 50 rupees extra profits distributed by company. This much you understand from this buyback taxation. There are two parties involved here. One is company, the other is shareholder. Now, guys, keep in mind one thing. Here also amendment is there. Before 1/10/2024, if the buyback has happened, there is a different treatment. But if the buyback happened on or after 1/10/2024, there is a different treatment. Capital gains tax on buyback. Taxability of buyback of shares before 1/10/2024 by domestic company. In that case, in the hands of company, in the hands of shareholder. I told you there are two parties here. One is company, the other is shareholder. In the hands of company, guys, tax on distributed income at the rate of 20% the company will pay. Now, in our example, company distributed 50 rupees profit to me, right? No, tax on distributed income means 50 rupees. On 50 rupees, company will pay tax at the rate of 20%. Though I only received, shareholder received the benefit of 50, but still, till 1/10/2024, before that law was like that the company only has to pay tax on the distributed income at the rate of 20%, guys, where surcharge will also be added. Distributed income means buyback price minus issue price. In our example, buyback price is 150, issue price is 100. So 50 rupees, on 50 rupees company will pay tax. But look at the shareholder exempt under section 10. Means in my hands, 50 rupees benefit which I received from the company, I need not pay any tax, because on that 50 rupees already company paid the tax. This was the scenario before 1/10/2024, but it changed on or after 1/10/2024, guys. Taxability of buyback on or after 1/10/2024 by domestic companies. In hands of company, no tax. So ulta happened. Earlier, in the hands of company, there used to be tax, but now company will not pay any kind of tax. In the hands of shareholder, now it will get taxed. Think logically. 150 rupees you received, 100 was your cost of acquisition, 50 you should pay tax on. Correct? With this logic, understand this. IFOS full buyback amount deemed dividend means the 150 rupees, whatever 150 rupees is there, the buyback amount full will be treated as IFOS in the shareholder's hand. But you will tell, sir, it should be capital gain. No, sir. It should be full value of consideration for the shares which was bought back. No, sir. Yes, it is. But the law says I will treat this 150 rupees as IFOS deemed dividend. I will treat under section 224F, 222F. Then, sir, what will happen for the cost of for the full value of consideration for the shares? Guys, full value of consideration. See here, guys. Capital gain I am calculating for the extinguishment of right in the share means when the buyback will happen in the hands of shareholder, capital gain calculation purpose, full value of consideration you will take it as nil, and actual cost of acquisition you will reduce. So 0 minus actual cost of acquisition, you will get a negative capital loss. Think logically, guys. If I have to apply this, I will apply this here. Very simple. See, IFOS, I will offer 150 rupees. Correct. As a deemed dividend. Deemed dividend I will offer. Now coming to capital gains, when I will compute my full value of consideration, I have to take nil. As per this provision, I have to take nil. Let's say for example, my cost of acquisition is 100. So I'll get a capital loss of 100. Capital loss of 100. Think logically, guys. Income you have 150, loss you have 100. Net effect is what? Income of 50 only. Income of 50 only. Just that they have changed the heads. There is no change in income. So if I have to summarize before, sorry, if I have to summarize, guys, before 1/10/2024, company used to pay tax. Shareholder used to not pay tax. But on or after 1/10/2024, company will not pay tax, but shareholder will pay tax. Shareholder will pay tax. Shareholder will pay tax, but under IFOS full consideration, he will offer as IFOS, and then for capital gain purpose, full value of consideration, he will take it as 0, like this here, and the cost of acquisition he will remove, Net effect is same profit is getting taxed in the hands of the shareholder. Here I have given one example. You can refer my Thailava notes in this video's description. You will find a link, Thailava free resources. Click on that. In that you will find this example. Go and read that. Now, sir, how to compute capital gains, sir? Capital gain you need to compute under section 48. It is given. Pro forma of computation of capital gains, guys. First, always take full value of consideration, means the sale value. Let's say transfer related expenses. So you incurred some expenses for selling this asset. That will give you net sale consideration less cost of acquisition, cost of improvement. Guys, cost of acquisition is the initial cost which you incur to purchase an asset. Cost of improvement means you made some improvements, capital expenditure still you made on the asset. That is called cost of improvement. Then you have to arrive at capital gain. Sir, here indexation is not considered, sir. Yes, because indexation concept is abolished from 23rd of July 2024. We will be discussing this very shortly. Securities transaction tax never allow. In case of sale of shares, STT will not be allowed as expenditure. Always keep in mind this thing. Now, indexation benefit which I was telling you. Guys, remember indexation means what? Say you purchased a property in 2010. Indexation means what? You purchased a property in 2010. Now you are selling the property in 2025. After 25 years, you are selling a property. Do you think the cost of acquisition which you had taken earlier is a very old amount? So the inflation impact will be given to this cost of acquisition by indexation concept. That is called indexation. Means you are increasing your cost of acquisition, that will benefit you. So indexation is a benefit. So indexation benefit it is called. Indexation benefit, if you had transferred the asset before 23rd of July 2024, it was available. But keep in mind one thing, guys. If you transfer an asset on or after 2024, indexation benefit is not available. You have to take the actual cost of acquisition only. Mind you, guys, this is not the date of purchase. This is saying the date of transfer. Means, let's say, for example, you purchased in 2010. Now you are selling in 2025. After 23rd of July 2024, you are selling. You cannot take index benefit. You purchased in 2010. Let's say, for example, you are selling before 23rd July 2024. Before you are selling off this property, index benefit you can take. That is the thing. Yes, next. How to compute the indexation, sir? Indexed cost of acquisition, very simple. Cost of acquisition you take. Cost inflation index, one number will be given in your examination. You need not remember anything. They will give you of transfer year. Means, let's say, for example, you are transferring in 2025-26 year. So the transfer year's CII number you will take divided by CII number of purchase year. In our example, purchase year was 2010. So you will take 2010 11's CII number. If you divide, you will get indexed cost of acquisition. Let's say, for example, after acquiring the property, you made some improvements in the asset. Let's say, for example, 2010 you purchased the asset, but 2015 you made some improvements. In that case, guys, whatever improvement cost is there, let's say, for example, 1 lakh you made improvement in the asset. So 1 lakh into CII year of transfer divided by 2015-16 year CII you will take. You will not take 2010 CII because 2010 to the duration of purchase, that is different. So you will take 2015-16 for cost of improvement when you will compute the indexed cost of improvement, guys. Okay, next, cost of acquisition. Wait a second. Cost of acquisition, section 55, very important in case of long-term capital asset under section 112A. Guys, you need to remember one thing. There are three kinds of assets. There are three kinds of assets which are given here. If you sell off this asset, if you sell off these assets as a long-term capital asset, that will be taxed under 112A. Now for 112A calculation, the cost of acquisition, you will not take the original actual cost of acquisition if you have purchased these assets on or before 31st of Jan 2018. Sir, what are these three assets, sir? Listed business trust units, listed equity shares, listed equity oriented units. In simple, if you have to remember in examination, honeybee, you know honeybee, BEE, honeybee. So E for business trust unit, E for equity shares, E for equity oriented units. Only in these three things, and these three should be listed. So if I have to simply put, if I had purchased any of these three assets, listed business trust unit, listed equity share, or listed equity oriented unit, any of these three things I had purchased on or before 31st of Jan 2018, and I am selling, means transferring after 31st of Jan 2018 in that case. And if it is a long term, guys, only in case of long term only, I have to not take the actual cost of acquisition. I will take the cost of acquisition which is computed like this. Cost of acquisition shall be higher of the following. First, I will take the actual cost of acquisition of any of these three assets. Then I will take lower of FMV as on 31st of Jan 2018 and the sale value which I am selling now, this price. So I will take this, whichever is higher will become my cost of acquisition. So I repeat, if I purchased either listed business trust units or listed equity shares or listed equity oriented units before, on or before 31st of Jan 2018, and I am selling after 31st of Jan 2018, and if it is a long term capital asset, these three long term capital asset, I will not take actual cost of acquisition for capital gain computation. I have to use this formula to compute the cost of acquisition. This is called grandfathering of your capital cost of acquisition, guys. Indexation benefit not available in this scenario, though it is a long-term capital asset. Next, capital gain in respect of slump sale, guys. In the recent attempt for Laddu, 6 marks capital slump sale question was asked. Separately, if a capital gain concept question has to be asked, lot of times from slump sale it is asked. Slump sale is very simple, guys. Generally, we in capital gains chapter we talk about sale of a building, sale of plant and machinery, sale of land. Individual asset wise we discuss, but slump sale means one business unit as it is you are selling off. Let's say, for example, you know that Tata has many businesses, right? Tata has many business. Tata watch, you know, Titan brand is the Tata's only. Tata has a Tata consultancy services software company like this. Let's say, for example, now Tata is a big company. In this, Titan is just one unit. Now Tata wants to sell this unit of Titan to Reliance Ambani, Mukesh Ambani. In that case, they will not sit and evaluate. Okay, in this Titan, I have one plant and machinery. This much value I will give. Nothing like that. They will value the total business of Titan like one shot. They will give one value. Okay, Titan valuation is 250 crores, like that. In that case, that is called a slump sale. So you are selling the business as it is, guys. Keep in mind that thing. Meaning of slump sale is transfer of one or more undertaking or units of a business for a lump sum consideration without valuing assets individually. Nature of capital gain, guys, always keep in mind one thing. In case of slump sale, if you have to decide whether the capital gain which will come will be long term or short term, it will depend on the number of years the business is in existence. Let's say, for example, Tata started the Titan business in 2010, or let's say, for example, I'll take 2020. Tata started Titan unit in 2020, guys, 2020, and Tata is selling this unit in 2022 to Ambani. In that case, you will see the year in which the business unit started and when you are selling this unit to someone. So that duration you will take. You will not take each individual asset what is there in that unit. No, you will not take. You will take the start day of the business and the day in which you are selling. So here in this case, you are selling within 2 years. That will become short term capital gain, whichever gain you will get by selling this unit. But let's say, for example, in this example, I will change the year as 2025, for example. If I sell, so I started the unit in 2020, I'm selling in 2025, which is after 3 years I'm selling. So that will be long term capital gain. So here the duration is, guys, 3 years only, guys. 36 months you have to see. Don't apply 12 months, 24 months and all. Individual asset, nothing will be applicable. Only straight away you can take, guys, 36 months. So if undertaking is held for more than 36 months, it will be long capital gain. Undertaking sold less than 36 months, that will be short term capital gain. Now, capital gain tax rates. Sir, at what tax rate I will apply, sir? If you are getting a long term capital gain, In that case, 20% you apply if the transfer happened before 23rd of July 2024, and if you sold the unit on or after 23rd of July, apply the long-term capital gain tax rate of 12.5%. Indexation benefit, always keep in mind, in slum sale it is not available. Short-term capital gain tax at normal rates, means for company rate, individual slab rates you will apply, guys, not triple 1A rate. Next, method of computation, sir. How do I compute, sir, when a business unit is transferred? Very simple. Full value of consideration you take, that lump sum amount, whatever is there, that we will have to compute here. You see here, full value of consideration, there is a method given. Higher of the following should be taken. So this full value of consideration, you will not take that actual 250 crore rupees, whatever I told you. You will compare two things: fair market value 1 and fair market value 2. Fair market value 1 is fair market value of capital assets as on the date of slump sale. Means the capital assets what are there in the business unit as on the date of slump sale happening, fair market value will take. That is fair market value 1. Fair market value 2 will be the consideration which you are receiving. This 250 crores rupees. Guys, lot of times 250 crores, Ambani may not pay to Tata in cash. Ambani may tell that, okay, out of 250 crores, 100 crores worth of cash I will give you. Rest I will give you some asset. One land is there, big land is there, I will give you off. So you have to take full value of fair market value of consideration received, whether monetary, non-monetary, whatever. These two you will compare. Whichever is higher, you will take it as full value of consideration. From that, always remove net worth, guys, because of course when you are selling a business, what are you selling? Net worth of a business. So how to compute net worth? Accountancy, net worth is nothing but total value of assets minus value of liabilities you will do. If net worth is negative, cost of acquisition, simply take it as nil, guys. Now how to compute net worth? Net worth means what I told you, assets minus liabilities. But guys, keep in mind one thing: valuation of assets and liabilities, whenever you will do for net worth calculation purpose, value of depreciable assets, always take WDV value only. Depreciable value, depreciable assets, that will have a WDV value, take WDV value. Self-generated goodwill, if you have, take it as nil. Assets on which deduction under 35 AD, remember PGBP, nil, you will consider amount. All other assets and liabilities, take the book value, guys, and ignore revaluation of assets. Yes, next. Section 50C. Guys, lot of times what happens, any taxpayer, guys, will not be happy to pay tax to the government. So let's say, for example, I am selling one land for 100 lakh rupees. What I will always think is to offer less, correct? Sell, for example, I want to, actually I am selling a land for 10 lakh rupees. Actual sale value is this. And my cost of acquisition, so this is full value of consideration, and my cost of acquisition is, let's say, for example, 2 lakh rupees only. How much capital gain I'll get? 8 lakh rupees capital gain I will get. Now think logically, guys. 8 lakh rupees, let's say, for example, tax rate is 20%, 1,60,000 rupees I have to pay tax to the government. So it is very painful for me to pay so much of tax. So what I will think, no, why to offer 10 lakhs? I will tell the government, I only sold this land for 5 lakhs only. So full value of consideration, I will tell them this 5 lakhs, and cost of acquisition will become 2 lakh rupees, and the capital gain will be 3 lakhs only, and on that 20% tax rate, if I see, that will be only 60,000. Now you see, if I reduce my full value of consideration from 10 lakhs to 5 lakhs, I can save 1 lakh of taxation here. This is the intention of the taxpayers all the time. They want to reduce the full value of consideration. And that's why government told, wait. Government told, wait. If you offer like this, do you think I will keep quiet? No. So government said, I will introduce a section called as section 50C, where I will tell you one method to determine the full value of consideration of transfer of land or building or both in the form of capital assets. So if you are selling land or building, in that case, whatever full value of consideration you are offering, that will not be accepted. Government says that I will compare that actual consideration with something called as 110% of actual sale value. So let's say, for example, the sale value which I am offering is 10 lakh rupees, which I am offering, full value of consideration I am telling. Okay, this will be compared with 110% of 10 lakhs will become 11 lakhs, correct? comparison value. Now let's say for example the government's stamp duty value, government will have one stamp duty value as per the municipal records of that area where the land is situated. So 10 lakhs is the value which you are telling to the government, and the government, let's say for example stamp duty value is 15 lakh rupees, guys. Now 15 lakh rupees, always keep in mind one thing. First you take the value which you want to offer, take 110% of this 110% you compare with the 15 lakhs. If the stamp duty value is exceeding the 110% of the value, guys, always take stamp duty value, because government is telling that as per the government records your land should be sold for 15 lakhs, but you are offering only 10 lakhs. You are trying to fool me. So I will not accept your 10 lakhs value. I will go with 15 lakhs only, because you want to save tax. So you are telling a less value. So stamp duty value is exceeding my actual sale consideration which I want to show. So government will take SDV value. But let's say for example in this scenario I am taking the SDV value is not 15 lakhs. The SDV value is only 10 lakh 50,000. Let's say for example SDV value is 10 lakh 50,000. Now see here, the value which you want to offer to the government is 10 lakhs. 1% is 11 lakhs. But the stamp duty value as per the government records is 10 lakh 50 only. But keep in mind one thing, guys. This stamp duty value is well within the 110%. Means this 10 lakh 50 is less than the 110% of 11 lakh rupees. That's why full value of consideration only will be considered by the government for capital gain computation purpose. So if I have to tell in a crispy manner, you will take the stamp duty value only if it will go beyond 110% of the full value of consideration. If the stamp duty value is less than the 110% of the actual sale consideration, always take the full value of consideration only. Because see, you may say, sir, 10 lakh 50 is still more than 10 lakhs. No, sir, 50,000 government is losing. Yes, but the bandwidth is given. Government is saying 10% above. Okay, I am agree. But beyond that, if my stamp duty value is there, then I will take stamp duty value. So this is well within 110%. So I will take this 10 lakhs only as my full value of consideration. With that understanding, let's understand this. Applicability for land or building sold as capital asset. Only for land or building you will apply this. Stamp duty value is more than 110% of actual sale consideration. Next, determination of full value of consideration. How do I determine, sir? Very simple. I just now told you, if stamp duty value more than 110%, the first example which I took, then sale value to be considered should be stamp duty value only. But if the stamp duty value is less than or equal to 110% of actual sale consideration, you take no problem. Only if it go beyond 110% of, if the stamp duty value goes beyond 110% of the actual sale consideration, then only you will take stamp duty value. Next. Sir, let's say for example, in our example here, government told, let's say for example, I will take this example. First scenario, government told 15 lakhs, but I'm not satisfied, sir. I'm thinking that government is over valuing this. It should be only 14 lakhs only, I think, sir. Then what can I do? Then you can refer this case to a valuation officer. If your case is referred to a valuation officer, let's say for example, valuation officer told not 15 lakhs, it should be 21 lakhs. Then it will be big shock for you. Yo, 15 lakhs only was good. No, why I took this for 21 lakhs? Then the government says, okay, don't worry. We will take 15 lakhs only in this case. So if a valuation officer gives a value more than the stamp duty value, still you will take the stamp duty value only. Means here I'll take 15 lakhs, no problem. But let's say for example, valuation officer did not give 21 lakhs. Valuation officer gave a value of 14 lakh rupees, which is less than the stamp duty value. In that case, you can take the full value of consideration as 14 lakhs only, guys. So very simple, I have to put, if the valuation officer gives a value more than the stamp duty value, take the stamp duty value only. If the valuation officer gives a value less than the stamp duty value, take that valuation officer's value. One second, sorry guys. Now consideration of stamp duty value is a date of, one second, here valuation officer, I'll tell that reference to valuation officer. If valuation given by valuation officer is less than the stamp duty value, consider such less value. Valuation officer is given more than the SDV value, consider SDV value only. Now guys, this one is Very, very important. Lot of times asked in examination, guys. If the date of agreement and the date of registration is different. Very, very important, guys. Very, very important. Please keep in mind this thing, guys. Guys, generally, first date of agreement, date of sale, guys, or registration. Correct. First, always you get into agreement, then only you will go for registration, right? So if the date of agreement and date of a sale or registration are different, always keep in mind one thing. If on the date of agreement, if you are taken any part payment in the prescribed modes, means through banking channels, always take the SDV as on the date of agreement. Because let's say, for example, on the 1st of July 2024, you agreed, you created one agreement on that date. SDV is 1 crore, 15 lakh rupees, for example. It is 15 lakh rupees. Another date of registration is 1 September 2024, for example. On the date of registration, it is the SDV has become 20 lakhs. Now there will be one confusion. Which SDV should I take? Correct? 15 lakhs or 20 lakhs? In that case, of course, you will not want to take 20 lakhs SDV. It will shoot up your capital gains tax. So if you want to take this 15 lakhs, the SDV as on the date of agreement, you have to meet one condition. You should have taken at least a part consideration of the transfer value in prescribed modes. If you have taken, let's say, for example, you are selling the asset for 15 lakh rupees or 10 lakh rupees, whatever. If advance you have taken already on the date of agreement to prescribed modes, you can take the SDV of this date. If you have not taken any advance on this date through prescribed modes, in that case, you will take SDV of the date of registration. Yes. Is date of agreement and date of registration same? No. Payment done in prescribed modes on date of agreement? Yes. Then take SDV as on the date of agreement. If date of agreement and date of registration same? No. Have you taken the prescribed modes payment advance before the date of agreement? No. Then take the date of registration, so stamp duty value. Is the date of registration, date of agreement same? Then there is no problem, only you take the date of registrations thing only. Now, advance money forfeited, what is this? Very simple, guys. Advance money at the time of sale, if any advance money, if you forfeited before 1/4/2014, you forfeited, deduct from the cost of acquisition when you will compute the capital gain in future. But if you forfeited on or after 2014, that amount will become IFOS. Now coming to the exemptions, guys, very, very important. Exemptions, there are hardly 4-5 sections, very easy. Exemption under section 54, very simple. If you have a house property which you are selling and you are reinvesting the capital gain amount in purchasing another house property, then the capital gain will be exempt, no need to pay any tax. Mind you, guys, this is applicable only in the case of individual HF. Asset sold is long term, guys. It is not short term. Long term residential house property. Residential house property. Sir, which asset should I purchase? Sir, again, residential house property, guys. Let's this nature of capital gain is long term capital gain only. Reinvestment only capital gain. Sir, give me one example. See, guys, let's say for example, I sold for 10 lakhs. Out of that, profit is only 2 lakhs. Capital gain, long term capital gain is 2 lakhs. Sale value is 10 lakhs. I need to reinvest only this 2 lakhs. I need not reinvest a total 10 lakhs. Okay. So keep in mind this thing, guys. One second. You need to reinvest only profit, guys. Here, see here, long term capital gain, you have to reinvest. Reinvestment amount only capital gain amount, not the total sale value. Okay. Long term capital gain, if it is more than 2 crores, this is very, very important. If the long term capital gain is more than 2 crore rupees, you can only buy or construct one house property. But if the long term capital gain is less than 2 crore rupees, you have the option to buy 2 house properties or construct 2 house properties. But this is once in lifetime option only, not every year you will find it. If you are buying a property, in that case, 1 year before or within 2 years you can buy, and in case of construction within 3 years you need to construct. Exemption, 100% of the capital gain amount whatever you will invest. maximum 10 crores you will get. Lock-in period is 3 years. The new property which you purchase or construct should not be sold in future for another 3 years. Sir, what if I sold in 3 years? In that case, whenever you will sell this new property, whenever you will compute the capital gain, you will reduce the cost of acquisition. From that cost of acquisition, earlier claimed capital gain shall be reduced from the cost of acquisition. So whatever capital gain you computed earlier, whatever you got exemption on the earlier capital gain, that you reduce from the cost of acquisition and then only compute the capital gain for the new asset which you are selling within this lock-in period of 3 years. So capital gain account scheme option available? Yes, it is available. So first section 54 which we discussed is you are selling a residential house property. Again, you are investing in a residential house property only, and it is a long-term capital asset. Now 54B, guys, 54B is applicable only when urban agriculture land is sold and you are maybe buying a rural agriculture land or urban agriculture land, no problem. Individual or HUF, it is available. Asset sold shall be urban agriculture land. Urban agriculture land means for at least 2 years you should have used that land for urban agriculture purpose. Guys, why here rural agriculture land is not covered? Because that is not a capital asset at all. First of all, asset purchase should be urban or rural, you can buy. Investment time limits are within 2 years of transfer you should buy a new urban or rural agriculture land. Agriculture land only you should buy. Here also you will invest or reinvest only the capital gain amount, not the total sale value. Nature of capital gain, long term or short term it can be, but section 54 only long term. Here short term or long term. Reinvestment, only capital gain amount you need to reinvest. Exemption to the extent of 100% of the capital gain amount which you reinvest. Lock-in period is 3 years. Guys, let's say for example, when I say 100% of capital gain, let's say for example, you have a capital gain of 2 lakhs. You purchased new land only for 50,000. So only 50,000 you will get exemption. Rest 1,50,000 rupees which you did not invest, that will be taxed. Lock-in period here also 3 years. And if you sell within 3 years, same adjustment from the cost of acquisition, you will reduce the earlier capital gain exemption which you took. And capital gain account scheme also available. If an urban agriculture land is compulsorily acquired, keep in mind one thing. If urban agriculture land is compulsorily acquired, it will be exempted, guys. Next, exemption under 54D. Lot of times compulsory acquisition of an industrial undertaking may happen by the government. So if a industrial undertaking is compulsorily acquired, land or building is compulsorily acquired by the government, in that case, guys, this will be applicable. Any associate can be. Asset sold should be compulsory acquisition of land or building used for industry purpose. Asset purchase. So once it is acquired, you have to reinvest the capital gain in buying or constructing other building or land for shifting your industry, guys. Investment time limit is given within 3 years of transfer. Okay, next. So you will have to invest within 3 years of transfer, guys. And the nature of capital gain can be long term or short term. Reinvestment, again capital account, same dialogues will apply here also, guys. 3 years is the lock-in period. Now comes the section 54 EC. Guys, always keep in mind this thing, guys. Any assessee this can claim this, being individual, HUF, IOP, BOI, anyone. And asset sold should be long-term land or building, guys. If you sell a land or building or both, being a long-term capital asset, you can claim 54 EC benefit. Simple. You have to invest the capital gain amount in these bonds, guys. Here there is one amendment. Earlier, HUDCO was not there in the list. Now HUDCO bonds also available. Housing Urban Development Corporation bonds, in examination they may ask you, guys, if HUDCO bonds are also invested in HUDCO bonds also, even they are eligible. Bonds maturity should be minimum 5 years. NHAI bonds, RECL bonds, PFC bonds, IRFC bonds, or HUDCO bonds. If you invest in these bonds, the capital gain amount which you got, long-term capital gain amount by selling the land or building, then in that case, whatever investment you do in these bonds will be treated as exemption, guys. Nature of capital gain should be long-term capital gain only. Reinvestment only in capital gain amount. Only capital gain amount you have to reinvest. Guys, keep in mind one thing. You have to reinvest within 6 months from the date of transfer, guys. Within 6 months from the date of transfer. Investment time limit is purchase bonds within 6 months from the date of transfer. Exemption, how much I'll get, sir? Maximum 50 lakhs. Sir, I invested 60 lakhs, sir, still you will get 50 lakhs. Sir, I invested 40 lakhs only, sir, you will get 40 lakhs. Yes, so maximum 50 lakhs. Even if invested in two different previous years, you will get still 50 lakhs only. Lock-in period is 5 years. You cannot sell these bonds, guys. If you sell up, then earlier took whatever capital gain exemption you took will be taxed as capital gain. Here, capital gain account scheme option is not available because you have to invest in within just 6 months. Next, 54F, guys. If you are an individual or HF, you are transferring any asset, shares, gold, any asset, but you are buying a residential house. So you can sell any asset. So whatever capital gain you will receive out of sale of any other asset, but you should not sell a residential house. If you are selling a residential house, then this section will not apply. If you are selling any asset other than a residential house, but you have to invest the capital gain in a residential house. So I may be selling shares. Whatever profit I received from selling of shares, I have to reinvest in residential house only. Then only I'll get 54F exemption. Asset sold can be any long-term capital asset other than a residential house. But asset purchased should be residential house property only. Nature of capital gain, long terms only, guys. Only long term. Reinvestment, net sale consideration. This is the only difference, guys. Right from 54, 54B, 54EC, 54D, every time I told you that you have to reinvest only the capital gain amount. See, first example I told you, if my sale value is 10 lakhs, my capital gain is 2 lakhs. In earlier sections, I told 54B, 54EC, 54D and all, I told reinvest this amount, I told. But in 54F says that you have to reinvest this at 10 lakhs and not just 2 lakhs. Total reinvestment shall happen. Yes, see here. Reinvestment, net sale consideration you have to reinvest. Next, investment time limit, buy or construct one house property. Same house property within 1 year or 2 years or 3 years. Exemption. If a new house property which you invested is more than the net sale value of consideration, full long-term capital gain exemption you will get. If the property which you purchased is less than or equal to, if the new purchase of the property price is less than the net sale consideration, in that case, proportionate only you will get. Let's say, for example, I'll take one example here, guys. So the sale value of the old asset is 10 lakhs. You invested only 8 lakhs. Here capital gain you got 2 lakhs, for example. So you reinvested only 8 lakhs, guys. In that case, if you reinvest only 8 lakhs, the exemption which you will get will be proportionate. Means out of this 2 lakhs capital gain, you will get only 8 lakhs divided by 10 lakhs. Only this proportionate capital gain only will be exempt. But let's say, for example, you did not invest 8 lakhs. You invested total 18 lakhs you invested. Means you invested more than the sale value, right? So full 2 lakhs will be exempt. Got it? Next. Maximum exemption here also 10 crores. Lock-in period is 3 years for the residential house property, and capital gain exempted earlier shall be taxed if you sold within the 3 years. There are some important conditions. You should not own more than one house property on the date of transfer, guys. Means on the when you will reinvest in one house property, at that time you should own one more extra house property. That's all. Let's say, for example, you already have two house properties, then you will not get 54F. Only if you have one, you will get a 54F exemption. Should not buy any other house property within 2 years or construct 3 years. Means once you take 54F exemption, you cannot again in future buy or construct new house properties, guys, within 2 years of or 3 years. Yes, next. Sir, what should be the capital gain tax rate, sir? Guys, keep in mind one thing. The honeybee example which I told you, units of a business trust, listed units of a business trust, listed equity shares, and listed equity oriented funds, BB. If those three assets you sell, and if it is a short term or long term capital gain, special rates will be applicable under section 111A and 112A. If you sell any of these three assets, honeybee, and it is a long term capital gain, apply the special tax rates under 112A. If you sell any honeybee, any of these three assets, and you are selling as a short term capital asset, then 111A tax rates you will apply. Okay, any other asset you sell as a short term capital gain, if you get tax at slab rates or actual rates. If it is a partnership firm, then a tax rate, you will apply the normal 30% or whatever. In individual HF, this slab rate will apply. And long term capital gain on all other assets will be under 112 special rates, guys. Sir, what is this special rate? Tax on listed B business trust unit, equity oriented share, and equity share and equity oriented fund. In that case, transfer of B, if it is happening before and after, guys, tax rates are different. If you are selling before 23rd of July 2024 and it is a short term capital gain, then 111A rate 15% will apply on the short term capital gain. Mind you, this is only on these three units, guys, these three items only, these three capital assets. Yes. Now, if you sell before 23rd July, the long-term capital gain under section 112A will apply at the rate of 10% beyond 1,25,000. Let's say, for example, your long-term capital gain is 5 lakhs. You will not apply on 5 lakhs total. 5 lakhs minus 1,25,000, whatever is there, the balance 3,75,000. On that, you will apply 10%. Keep in mind this. But on or after 23/7/2024, if you are selling the property, then selling any of these three capital asset, in that case, short-term capital gain 111A rate will be 20%. Long-term capital gain rate will become 12.5%. You see here, tax rates have changed after 23 July 2024. No index benefit will be given to you guys. Now, apart from this, whatever is there, that will be taxed at the rate of C. Apart from this, any other short-term capital gain will be taxed at the normal rates, and apart from this, any long-term capital gain will be taxed at 112A rate, which will be 20%, guys. Yes, so this is the brief discussion. One small topic I want to tell you guys at the end. If indexation, guys, very important. Indexation very important. If there is a building which you are selling, if you are selling a land or building or both, land or building or both, if you are selling 23rd July 2024, remember this. If you are selling before this date, indexation benefit is available, no problem. But if you are selling after this date, indexation benefit is not available even if it is a long-term capital asset. But keep in mind one thing. Whenever you will calculate for a long-term capital asset which is sold after 2023 2023 7 2024, if purchased before but the sale is happening after, guys, remember, if you are selling land or building or both after 23rd of July 2024, indexation is not available. But if you are selling before 23rd of July 2024, land or building or both, indexation is available for you. So before, there is no problem, indexation available, you take it. But if you're selling after 23 July 2024, indexation benefit is not available. But keep in mind one thing, that indexation benefit is not available at the time of calculation of the capital gain. When you will calculate long-term capital gain, when you will calculate full value of consideration, you will take the actual consideration less cost of acquisition only you will take. You will not index it here. And the cost of improvement you can reduce. That will become your long-term capital gain. Correct? Now, no indexation here. This is after 23rd of July 2024, sale is happening. But guys, remember this, if you are selling after 23 July 2024, so purchase will be before 23rd July 7 2024, correct? So purchased before 23rd July, but selling the property, land or building after 23rd of July 2024. Keep in mind one thing. On this long-term capital gain, whenever you will compute the tax amount, when you will compute the long-term capital gain tax, when you will compute, guys, there are two options available: 20% with indexation and 12.5% without indexation. You will calculate. So only for this tax amount calculation purpose, you will index that capital cost of acquisition, guys. So 20% with indexation 20% without indexation. So here you will index, guys. Simply for 20% purpose, you will take again, you will take here, you will take full value of consideration less indexed cost of acquisition less indexed cost of improvement. You will take, you will reduce, and whatever amount you got on that, you will apply 20%. You will compare this with this capital gain amount without indexation, whatever you got here, 12.5% without indexation, whatever capital gain is there. You will compare these two you will compare, whichever is more beneficial, that only will be taxed in your hands, guys. So simply, if I have to tell, land or building or both, if you had purchased before 23 July 2024, and if you are selling after 23 July 2024, in that case, for calculating the capital gain amount, you will not take the indexation. You will take actual cost of acquisition. But on this long-term capital gain, which you already computed now, on that you have to pay tax. No, that tax amount when you will calculate, you have two options. One, 20% with indexation, 12%, 12.5% without indexation rate. So on 20% with indexation, when I am saying, of course, you have to recompute your capital gain. So for this recomputation, you will take the indexation. On this capital gain, you will compute 20% tax amount. This amount you will compare with this 12.5% of this without indexed long-term capital gain, whichever is lesser, whichever is more beneficial, you will take as your ultimate long-term capital gain taxation payable. Is it clear? Yes. So this is all, guys. If you liked this video, please hit a like button and comment in the comment section. I am going to clear dam examination which is coming in the coming attempt. Yes, comment in the comment section, guys, because manifestation is real. If you comment today, you will clear your examination, guys. And let me know in the comment section how is the explanation of capital gains, and do like and subscribe to my channel. Share this video with you. TDS TCS Advanced Tax is one of the most important chapters for your examination. The reason is because there are a lot of amendments in this chapter for your attempt. And this becomes very important to give a lot of importance to this chapter. At least 4 to 8 marks we can expect from this chapter in your examination, guys. See, TDS generally, why it is even deducted, you need to understand the logic. If you know the logic, it becomes very easy for you. See, generally income tax has to be paid by the taxpayer on an annual basis, correct? But say for example, if you are working as an employee in some organization, and if your employer says that I will pay you salary only on an annual basis, would you agree? No, you will not agree, because you will tell that every month I have some expenditures, commitments for which I need money. I cannot wait for the year to end. Yearly payments I cannot accept. Exactly the same way, government also need a lot of money on monthly basis, and very often money is required for the government to run this country. And that is why advanced tax, TDS, these kinds of concepts are there, so that lot of money keeps flowing to the government, and government can give us better services to the society. So guys, TDS is generally deducted at the time of payment or credit in books of accounts, whichever is earlier. So in all the TDS provisions, you will see the same dialogue, that payment or credit in books of accounts, whichever is earlier. And there are few exceptions to this. At the time of payment, you have to deduct the TDS. But generally, TDS has to be deducted at the time of payment or credit in books of accounts, whichever is earlier. We'll take one example and try to understand. Say for example, Thailava classes, there is one coaching institute, and there is one faculty called as Karthik sir. Karthik sir has taken some classes in Thailava classes, and Thailava classes has to make payment to Karthik sir. Mind you, the batch completed on 15th of October 2025, and 50,000 payment has to be made to Karthik sir. Now, who will deduct TDS here? Thailava classes has to deduct TDS from the payment made to Karthik sir. Correct? So, entry in books of accounts of Thailava classes. As soon as the batch will get over, Thailava classes will make an entry in their books of accounts that fees payable to Karthik sir, like that entry would be made. But payment is done on 7th of November 2025, for example. Now, mind you, TDS will not be deducted at the time of payment. TDS will be deducted at the time of credit in books of accounts by Thailava classes or at the time of making payment by Thailava classes to Karthik sir, whichever is earlier. So here, whichever is earlier is from these two dates is this date. So on this date itself, it would be treated that you have to deduct TDS. Are you getting it? So TDS shall be deducted by Thailava classes on date of entry in books of accounts, that is 15th of October 2025, and accordingly the payment will be. Got it? Now, there are some transactions where the TDS will be deducted on payment basis only. Only at the time of payment you will deduct the TDS. At the time of credit in books of accounts, you will not make the TDS payments. So that are these 6 transactions. First one, 192 salary, 192A EPF Provident Fund payments. So in salary and Provident Fund payments, the TDS shall be deducted at the time of payment only. And likewise in case of winnings also, 194B, BB, BBA, everything we'll discuss in detail in this video, don't worry. And for dividend payments, LIC maturity payments, compulsory acquisition of asset, and for cash withdrawals. These are the transactions in which the TDS is deducted at the time of payment only. We will not compare the date of credit, date of payment and all. Nothing like that. Yeah, next. See, TDS, whatever rates are prescribed in the section, you have to deduct the TDS at that rate only without adding any surcharge and cess. So, TDS rates provided in the Act are flat rates. Say, for example, in 194C, the TDS rate given is 2%, for example. Now, you will not add to the 2% surcharge and cess. Flat 2% you have to deduct the TDS from the payment which you are making. So no need to add surcharge or cess. Whatever flat rates are given, 2%, 10%, 30%, you have to deduct TDS at the given rates in the section. But there is an exception to this also. TDS on salary and TDS on payment to non-residents or foreign company, you have to deduct the TDS after including the surcharge and the cess to the rate which is prescribed in that section. Yes, if it is applicable, you need to definitely add surcharge and cess to the amount on which you are deducting the TDS. Then, there are a lot of cases in which the payee, the receiver of the amount, will not furnish PAN to the payer. In that case, what happens? So TDS rate if PAN is not provided by the payee means the receiver of the amount. In that case, the payer has to deduct the TDS at higher of these two things. Actual TDS rate which is prescribed in the section or 20% whichever is higher. Mind you, this 20% will become 5% only in one section, 194Q. So, if a payee does not furnish PAN to the payer has to deduct TDS from the payment made to the payee at the higher of these two things. Actual TDS rate given in the section, respective section under which the TDS is being deducted, and 20% whichever is higher. But this 20% will become 5% in 194Q. Now, the first TDS section we are going to discuss is 192 TDS on salary. Who will make salary payments? Employer will make salary payments. To whom it will be made? It will be made to employees. So if an employer makes salary payments to employee on a monthly basis, every month the employer has to deduct a TDS on the salary payments made to employees. Now we'll get it out, sir. At what rate the TDS will be deducted? The TDS will be deducted at the slab rates, mind you guys. At slab rate only the TDS will be deducted. And mind you, the employee can be non-resident, resident ordinary, non-resident not ordinary, any kind of a employee. But the TDS will be deducted as per the slab rate. Means first, we will take one example. Let's say for example, there is a company called as Thailava Limited. and there is an employee called as Dinesh. Now, Thailava Limited is making salary payment of 1,20,000 per month to the employee. And let's say, for example, employee is paying tax under default tax regime. Now, how we will calculate the TDS in this case? Simple. You take 1,20,000 into 12 months. Means Thailava Limited on the very first month of the year will make this calculation. 1,20,000 into 12 months of a year, 14,40,000 will come. Standard deduction, they will deduct as per the default tax regime 75,000. So net salary will be 13,65,000. Basic tax on this, if you apply the slab rate as per the default tax regime on this amount, you will get 84,750. To that, of course, you will add 4% of health and education as 3390. The total tax amount of Dinesh employee will become 88,140. Guys, 88,140 is the annual tax, no? The tax for the whole year, because we have calculated this for the full year. So this 88,140 will be divided by 12, and the monthly tax which has to be deducted by the employer Thailava Limited will be 7345 per month. So TDS per month deducted by Thailava Limited while making payment to Dinesh. So whenever 1,20,000 per month salary is paid to Dinesh, every month the employer Thailava Limited will deduct 7345 rupees per month from the salary paid to Dinesh. So this is how you calculate the TDS in case of salary. Got it? Next. Employer shall consider following items from the TDS. So keep in mind one thing. Whenever employer will calculate the tax liability of Dinesh, the employer has to consider few things at the time of computing the total income of Dinesh, on which the employer will deduct the TDS. Income from other heads of income has to be considered. We have 5 heads of income. Other heads also, the employer will ask the employee, what other incomes you have earned during this year, please give me details, and Dinesh has to give the details to the employer Thailava Limited. House property loss can be considered for set off, but other losses will not be considered. Under chapter 6A deductions, maybe Dinesh is having a LIC premium, or he is having one health insurance, like that. Those things can be considered for the purpose of calculation of tax purpose or TDS purpose. And TDS or TCS deducted by any other payers can also be considered. Let's say, for example, Dinesh is having one FD in a bank, and from that every year he is getting interest. On that interest, of course, the bank will be deducting TDS. Those details, the Dinesh can give details to the employer. So employer will consider that, and accordingly the TDS will be calculated for the payments made to Dinesh. Got it? Now, I am going to tell you one very important tip and trick which will be helpful for you in throughout the TDS chapter. Very important point this is. Person not required to deduct TDS. Guys, there are some persons who are not required to deduct TDS, and they are called as hijacker. They are called as hijacker. HIJACR. The below persons are called as hijackers. They are not required to deduct TDS. Sir, who are these hijackers, sir? First one, individual or HUF not having business or profession. So individuals and HUFs not having business or profession, but they may have any other income. They may have capital gains, they may have house property income, they may have salary income, anything like that. But they do not have business or profession income. And individuals or HUF having business or profession income, but mind you, their turnover in business is up to 1 crore only, and gross receipts from profession is up to 50 lakhs only. So these are the people who are called as hijackers. They are not required to deduct TDS for whatever payments they make to other parties. Individual HUF not having business or profession. Individual HUF having business or profession, but their turnover is up to 1 crore in business, and in profession their gross receipt is up to 50 lakhs. They will be called as hijackers. They are not required to deduct any kind of TDS on the payments. You have to remember these hijackers Throughout the TDS chapter, whenever you read the provision, lot of places we will see these hijackers will be popping up. And the above provision apply only in below sections. So hijackers are not required to deduct TDS. I told you who are these hijackers. The hijackers are 194H, 194I, 194J, 194A, 194C, 194R. So whoever payers are there in these sections 194H, I, J, A, C, R. In all these sections, whoever payer is there, these payers are not required to deduct TDS. If the section is HIJACR, then these persons, these hijackers are not required to deduct TDS. I hope that is clear. So hijacker is not required to deduct TDS. Got it? Now we will jump into further sections and we will understand the TDS provisions. So 192, I already taught you how to find out. 192A, premature withdrawal of Provident Fund. You know, in Provident Fund, employee also contributes, employer also contribute, and from that Provident Fund account, that Provident Fund amount totally belongs to whom? Of course, employee. The employee, if he wishes, he can withdraw that amount from the fund. So if an employee withdraws the amount from the fund, Provident Fund, in that case, the Provident Fund will deduct TDS if the amount which is deducted, if the amount which is withdrawn is more than 50,000 rupees. So if the amount which is withdrawn is up to or less than 50,000 rupees, then TDS is not required. Otherwise, TDS will be deducted at the rate of 10% on the withdrawal amount. Then comes the next section, 193, interest on securities. What is a security? Say, let's say, for example, you deposited your amount in debentures. Once you deposit your amount in debentures, the debenture company will pay you interest. On that interest, the TDS will be deducted under section 193 at the rate of 10%. And mind you, under this section 193, there is no TDS if the amount of interest which you are receiving per annum, it is up to 10,000 rupees. So if you are receiving more than 10,000 interest on any of the securities, then only TDS will be deducted under section 193. And no TDS if interest is paid in following cases. There are some special bonds on which even if you receive interest more than 10,000 rupees, the company which is paying you interest will not deduct the TDS. The list is given: national development bonds, 7-year national savings certificates. You remember that 54 EC section in capital gains, IRFCL bonds, PFCL bonds, on those bonds and any bonds of central government, state government. Then interest received by individual or HUF up to 5,000 on any debenture of public company. So mind you guys, here if any individual or HUF is receiving any interest from the debenture of a public company up to 5,000 rupees, there is no TDS. But beyond 5,000 rupees, the TDS will be levied. But in these cases, irrespective of the interest amount, there is no TDS. But here up to 10,000 no TDS, here up to 5,000 no TDS. And again here, security is held by life insurance company and general insurance corporation. In that case, and their subsidiaries also, if these LIC or GSC or their subsidiaries invest in some debentures, and if any interest is paid to these organizations, TDS is not required to be deducted. And floating rate savings bond 2020 if interest is up to 10,000. So in this case, there is no TDS, but otherwise TDS will be deducted on section 193. Next section is 194A. And guys, this is one of the first sections of hijacker. I already told you, in hijacker 194A is coming or not? Yes, of course it is coming. So 194A, hijackers are not required to deduct TDS, and that's why you will see this dialogue. I'm going to highlight this dialogue. You see here, what dialogue is highlighted here? Payer means the person who will deduct the TDS. Means any person other than means these persons are not covered to deduct the TDS. Who are they? Individual HUF having last year turnover in the business up to 1 crore or gross receipts up to 50 lakhs. So you will see the last year turnover. Last year gross receipts, if it is up to 1 crore or up to 1 crore or 50 lakhs in case of business or profession, they are not required to deduct TDS. And of course, all those persons who are not having business or profession, they are also not covered here. So 194A section deals with interest other than interest on securities. See, here we discussed interest on securities. Means you are receiving interest from investment in a security. That was this section. But 194A is a different section. Here also TDS is on interest only. But this interest is not on, investment in a security. No. But it may be some other interest. What kind of interest? Say, for example, you have put some fixed deposit in a bank from which you are receiving interest. Now, is the fixed deposit a security? No, it is not an instrument. You are just depositing amount with the bank and bank is paying you interest. Those kind of interest are covered here. Or you gave loan to someone. That person, if he is not a hijacker, that person will be paying interest to you. That person will be deducting TDS. So these are the transactions other than interest on securities. All the things will be covered under section 194A. Mind you, here hijacker will apply. Hijackers are not required to deduct TDS here. Say, for example, you are a businessman. Your turnover in the last year was only 80 lakh rupees. And you are making any interest payment to some payer, to some payee. Are you required to deduct TDS under this section? No, you are not required to deduct TDS because you are a hijacker. Because your turnover for the last year was less than 1 crore. The rate of TDS under this section which will be applicable is 10%, guys. Next. Non-applicability of TDS. There are some transactions in which TDS is not applicable. Even though you are a hijacker or non-hijacker, does not matter. TDS is not applicable in these cases. No TDS if his interest is paid in following cases. If aggregate interest payment is up to 10,000 rupees only. So aggregate means in a full year, whatever interest you made payment to a particular single person, if it is up to 10,000 rupees, no TDS. But if the payment exceeds, the interest payment exceeds 10,000, you will deduct TDS. Interest paid by bank, cooperative bank, post office is up to 50,000 rupees. So, if a bank is paying you interest, in that case, bank will not deduct TDS if the interest paid by bank is up to 50,000 rupees. And this 50,000 will become 1 lakh in case bank is making any payment to resident senior citizens. So, any person other than bank, if they make payment to you, they will deduct TDS if the interest payment is more than 10,000. But if a bank is making payment to you, interest payment to you, in that case, bank will deduct TDS if the interest which is paid in a particular year to you is up to 50, is more than 50,000 rupees. Up to 50,000, no TDS. And if the bank is making payment to a resident senior citizen up to 1 lakh, there is no TDS. Interest by firm to partners, no TDS. Interest paid to bank means you are making a interest payment to bank. Possible, no? You took a loan from a bank, for example. Now you are required to make interest payments to the bank. In that case also, you are not required to deduct TDS irrespective of how much interest you are making payment. Next. Interest on motor vehicle accident compensation up to 50,000 rupees. So, you have taken one motor vehicle accident insurance. You met with some accident and that insurance company is making you payment. At that time, if the payment is up to 50,000 rupees, interest payment, in that case, there is no TDS. Interest by cooperative society if the turnover is up to 50 crores to its members. Interest on deposits with the primary agriculture credit society. So you made some deposit with primary agriculture society. In that case, whatever interest you will receive, no TDS on that. Interest on deposits with the cooperative bank, interest on zero coupon bonds. On these transactions, there is no TDS. Now, especially in case of bankings. See, State Bank of India is a bank, but State Bank of India may have multiple branches. Sir, let's say for example, sir, I have made one fixed deposit with one branch and I have made another fixed deposit with the another branch. Both branches belong to one bank only. So will I see this 10,000 or 50,000 limit or 1 lakh limit per bank or per branch, sir? You will see that limit of 50,000 or 1 lakh per bank and not per branch. Got it? So 50,000 or 1 lakh limit is bank wise, not branch wise. The next section which we are going to discuss is 194. You know, you must have read in your CA inter-syllabus, foundation, everywhere that companies give or declare dividend to the shareholders. So if a company is paying any dividend to the shareholders, the company has to deduct TDS on the dividend payments. And that is discussed under section 194. So of course, company will deduct the TDS while making dividend payments to the shareholders. The rate of TDS will be 10%, and mind you, the dividend paying company will not deduct TDS if the dividend is up to 10,000 rupees. Only if the dividend is more than 10,000 to a particular shareholder, TDS will be deducted. And TDS shall also be deducted on deemed dividend. If you remember income from other sources topic, I have taught you deemed dividend concept 222 A, B, C, D, E, F and all. So on those deemed dividends also TDS shall be deducted. But there is no TDS if dividend is paid to general insurance company or LIC companies. So say for example, one insurance company invested in particular company. Of course, general insurance company will receive a lot of funds from the public, no insurance premiums. What they will do, they will invest. So they invested in some companies. If the company pays dividend to these general insurance corporation or LIC, they are not, the company paying the dividend is not required to deduct the TDS. Next, winning from lotteries. This we will try to understand from this note. Okay. Guys, if you want handwritten notes, you can buy it from www.taxthailava.com. If you go on this website, under books, if you click, you will find one product, handwritten notes only, like that. I have made beautiful handwritten notes. This is just a glimpse. I'm not using the full notes here. I'm just using part and pieces of it. But if you want a full-fledged handwritten notes, you can go and buy from there. Now we will discuss 194B, 194BB, 194BA. All three are winning sections only. So in one shot we will discuss 194B, 194BB, 194BA. You see winning, winning, winning. But these three are different winnings. 194B is winning from a lottery. You know lottery, no? You will buy one lottery. Suddenly 1 crore rupees will come to you. You won a lottery. So when you win a lottery, the lottery company will make you lottery payment. At the time, the lottery company has to deduct TDS. Winning from horse race, like that. If you bet on a particular horse, you know, race horse happens in Bangalore. There is one horse race owned by Vijay Mallya. If you go there, you can bet on a horse. Okay, this horse number 5 will come first. I am betting on horse, like that. And you will win something from that horse race. On that amount, winning whatever you are receiving, the winning, the horse race company will pay you winning amount. On that, the horse race company will have to deduct TDS under section 194BB. Winning from an online game. You nowadays, we lot of people we play Free Fire, PUBG, like that, Dream 11. In Dream 11, what happens? You will deposit some amount into the account of Dream 11. Then you will pay. You will play the game. If you win anything, amount will be deposited or credited in your, the winning amount will be credited in your Dream 11 account. If you lose, amount will be deducted from your Dream 11 account. Like that, it will happen. So if 194B in case of lottery, 30% of TDS will be deducted. Say for example, you won a lottery of 1 crore. straight away 30 lakhs will be deducted from 1 crore. Only 70 lakhs they will give it to you. And horse race also same. 30% they will deduct TDS. But keep in mind one thing. 194B, 194BB, lottery and horse race, if you are winning, is up to 10,000 per transaction, per game. In that case, there is no TDS. If the winning amount is up to 10,000 per game, there is no TDS. Say for example, you purchased 2 lotteries. One lottery you won, you earned 5,000 rupees as winning. Another lottery you have won 2 lakh rupees. Now TDS will be deducted only on the 2 lakh lottery, not on the 5,000 lottery, because 5,000 is less than 10,000 rupees. The last one, 194BA, winning from online game, we will understand with one example. Online game 194BA. Say for example, what happens actually in this kind of a transactions and scenario? Say for example, you have one bank account, savings bank account, HDFC bank account you have. You will open one Dream 11 account to play online game. So from HDFC bank account, you will first deposit some amount in Dream 11 user account. Let's say for example, you deposited 50,000 in wallet of Dream 11. You deposited 50,000. But in this year, the opening balance already in the opening balance in this year was 7,000 in this Dream 11 account, for example. So 7,000 opening was there. Now you deposited 50,000, total 57,000 has happened. And the closing balance at the end of the year is 15,000 rupees in your Dream 11 account. And during the year, you have withdrawn 70,000 rupees from Dream 11 account. You credited to your HDFC bank account. Now, in this case, in this kind of a scenario, how to check, sir, on what amount the TDS will be deducted? Is it on the total withdrawn amount? You will get a doubt. Don't worry, we will understand this. If you follow this method, you will arrive at the net winnings amount on which the TDS will be deducted by the Dream 11 company. First, they will take aggregate withdrawal from the user account. Withdrawal means what? How much you have withdrawn? 70,000 they will take first. And to that they will add the closing balance in the user account as on the end of the year is 15,000. So that you will add. Total will become 85. From that they will remove deposits which you made during the year. 50,000 rupees they will remove. Then they will remove the opening balance during the start of the year. If they remove these two, you will get net winning of 28,000. Now this 28,000, on this 28,000, the Dream 11 company will make a TDS at the rate of 30%. And mind you, here there is no limit like 10,000 rupees. Even if here the winning will, even if it will come 8,000 rupees, still the TDS will be deducted. That's all. It is as simple as that. On the winnings, guys, the company which is making the game, they will deduct the TDS. The next section which we are going to discuss is 194C. C for contract. You remember like this. You know what is a contract? You are not able to do some work, so you are outsourcing the work to someone. That is called a contract. Simple as that. What kind of contracts we have? Let's say for example, I am calculator manufacturing company. I am a calculating manufacturing company. Okay. Now there is one company called Casio. Casio came to me and told, sir, you please manufacture calculators, but you generally manufacture like this brown color and all, no sir, ash color. We want in yellow color, red color, like that, very attractive colors of calculators we want. And as per our specifications, you are keeping the numbers like this, no, we want in some different format, like this, some specification you are giving. Who is giving? Casio company is giving to this manufacturer. So the manufacturer will take the contract and will manufacture the calculators. Of course, on that this branding will not be there, Casio. The Casio company will buy the calculators from the manufacturing company and will just do branding. On that, they will label Casio and they will sell in the market. The manufacturer is different. So Casio company is giving a manufacturing contract to the manufacturing company, and Casio will just label the product and sell into the market. That is called a contract. Or let's say, for example, you want to build one house. Of course, you will not go and take all the bricks, cement and all. You will not do. You will call one contractor. Contractor will come and you will give contract to him. Okay, you build the house like this. Like this, you will give one building contract. And he will build the contract and give, build the building and he will give you. But mind you, this section is also covered under hijacker. In hijacker, you see C is there, C 194C is here. So here hijackers are not required to deduct the TDS. And mind you, in 194C, there must be one work given to the contractor. Only if there is a work, then only TDS will be deducted under section 194C. If there is no work, the payment is made for some other purpose, not for doing some work, then we will not deduct TDS under section 194C. Who will deduct the TDS? The contractee will deduct the TDS, because contractee will make payment to the contractor. Contractor will do the work. Contractor will receive the payment from contractee. So who is the payer here? Contractee. The person who gave contract to the contractor will deduct the TDS on the payments made to the contract. Sir, at what rate the TDS will be deducted? There are two kinds of scenarios. You have to check whether the contractor to whom you gave the contract, is he an individual or HUF? If it is so, then deduct the TDS at the rate of 1%. If the contractor is one big company or a partnership firm or a LLP like that, in that case, the TDS will be deducted by the contractee at the rate of 2%. Even on subcontracts also, the TDS will be deducted. But mind you, there is a limit here. If the contractor is given only one contract, then you have to see TDS will be deducted only if the amount is paid to more than 30,000 rupees. So if a contract is up to 30,000 rupees, no need to deduct TDS. But let's say, for example, you gave multiple contracts to one particular contractor only. In that case, aggregate of all contracts put together, you will check the limit of 1 lakh. So all contracts put together, if it is more than 1 lakh, then the payment, whatever you will make to the contractor, you will deduct the TDS. If there is only one contract, then you will check only 30,000 rupees. So individually look for a contract amount of 30,000 and aggregate you check whether it is increasing more than 1 lakh or not. Let's say, for example, first you gave contract, first contract you gave to same single person only, you are giving contract of, let's say, for example, 25,000 you gave one contract. To one person only you are giving. Second contract you gave for 20,000 rupees. Third contract, these are all happening in one particular previous year only. Third contract you gave, let's say, for example, 28,000 rupees. Fourth contract you have given, another fourth contract you have given 29,000 rupees. Now, how much is the total? 25,000 plus 20,000 plus 28 plus 29,000. Now, 1,02,000 is coming here. Total. See, until here, is it required to deduct TDS? No, because single contract is not exceeding 30,000. And until here, is it required to deduct TDS? No, because single contract is not exceeding 30 and these two contracts put together also not exceeding 1 lakh rupees. And till here, till third contract also required to deduct TDS? No, because individually contract has not exceeded 30 and all these three put together also not exceeded 1 lakh. But when it comes to this contract, the last contract when you gave, of course, solely individually the contract has not exceeded 30,000. But if you total sum up till here, already the total amount of aggregate contracts which you gave to one single person in a previous year already exceeded 1 lakh. Now you are required to deduct TDS on the full amount of 1,02,000 rupees at the rate depending on who the contractor is, it individual HUF or a company or whatever. But mind you, TDS will be deducted on the full 1,02,000 rupees, and you will deduct that TDS from the payment which you will make for this 29,000 rupees of contract. Next. Sir, what kind of work is covered, sir, under 194C? See, advertisement, broadcasting, telecasting, or carriage of goods carriage contract you will give to someone, catering, food preparation, catering, or manufacturing of any product. These are the works which are given here. If you get done any of these works, in that case, TDS will be triggered. But there are some transactions in which no TDS will be deducted. The first transaction is where you gave contractor to a contractor to manufacture something, but you have only provided the material. In that case, TDS will come. But using raw material purchased from a person other than such customer, there is no TDS. So let's say, for example, you gave one contract to someone, to a contractor, to manufacture something. Let's say, for example, to manufacture this calculator. And you told to that contractor that you have to purchase the raw material for this from some other buyer, like that. In that case, there is no TDS. But if I only provide the raw material for manufacturing this calculators, then the TDS will be subtracted. Next, transport charges owning 10 or less carriage goods. So if I have given transport contract to someone, goods carriage contract to some transporter, if that transporter is owning during a previous year only to 10 or less goods vehicle, then there is no requirement to deduct TDS when the payment is made to this kind of a contract. And payment made by television channel or newspaper companies to advertising agency for booking or procuring advertisements. You know, television channel is different, advertising agency is different. First, advertising agency will find a customer for whom the advertisement has to be made. So first, customer will make payment to advertisement agency will make payment to the television channel. So whenever a advertising agency is making payment to television channel, no need to deduct TDS. But when a customer is making payment to advertisement agency, the TDS will come depending on work is given or not. Next, payment made by client to advertising agency. Just now I told you, TDS will be deducted. In case of construction contract, even if construction is done using material purchased from other persons, still it is considered as work only. So this is the only exception. If you gave any construction contract to a contractor, even if that contractor buys material from outside, still it will be considered as work only and TDS will be deducted under section 194C. In all other cases, TDS will be deducted only if you are only providing the material to the contractor for manufacturing. If value of material is separately given in invoice, then TDS is to be deducted excluding the material value, because material is not manufactured by the contractor. Material is just used as a raw material. But if the material value is not separately mentioned in the invoice of the contractor, in that case, TDS will be deducted on the whole invoice value. And the cold storage charges, you know guys, there will be one big cold chain facility. In that, if you keep your goods, they will charge you for keeping the goods in the cold storage. There is a big confusion whether that amount will be treated as rent or a contract. And it is clarified that you have kept your goods in the cold chain, but it cannot be treated as let out of a cold chain facility totally. You are just keeping part of your goods there. Big cold chain facility. Your goods are just little bit, and you are paying some amount for storing your goods there. You know what? Apart from just keeping your goods, They will also do some other extra activities. They will do some pesticides, and they will preserve that goods using some chemicals and all. They will take care of it, and that is why it is 194C contract and not 194I. 194I is for rental purpose. So the TDS will not be deducted under 194I. The TDS will be deducted under section 194C only, guys. And mind you, 194C section is not applicable if you are giving any contract for personal purpose. Only if you give contracts for a business purpose. You are doing business and for business purpose you gave contracts, only then the TDS will be deducted. For personal purposes, there is no TDS. The next section is 194D. In the old material, I mean, if you have received the updated one, okay. Otherwise, you will see 5% here. Please strike off and make it 2%. If it is updated already in your book, then no issues. Insurance commission. Guys, very simple. Wherever you see commission, the rate will be 2% and the limit is 20,000 only. Insurance commission means what? Insurance agents will be there. A lot of your parents also may be insurance agents. Okay. What insurance agent will do? He will sell the policies and the insurance company will give commission to the insurance agent. So if an insurance agent sells so many policies, the insurance company will give this to this agent commission based on how many policies he has sold. So in that case, the TDS will be deducted at the rate of 2% if it is other payee, and if the payee is a company, domestic company, in that case 10% will be deducted. And the amount is 20,000 limit. So if the commission is up to 20,000, no TDS. If the commission is more than 20,000, TDS will be deducted. Maturity of LIC policy. LIC, what is the concept? Every year you will pay premium. Once the premium is made, let's say for example, the policy duration is 10 years. 10 years you will make the policy premium amount payment you will make to the LIC company. After 10 years, the policy matured, and the amount whatever you paid on a every year basis, after 10 years you will get back that amount. They will add some bonus, interest and all to that amount whatever you deposited for 10 years, and they will give you back. That is called maturity of LIC policy amount. At the time when you are receiving the maturity proceeds of LIC policy, if the amount which you are receiving is more than 1 lakh rupees, then the insurance company will deduct TDS at the rate of 2%. Sir, on what amount they will deduct TDS? Will they deduct the TDS on the full maturity proceeds, sir? No. They will deduct the TDS only on the difference between maturity amount and premium paid. Let's say, for example, you are getting maturity amount of 5 lakh rupees, and during the life of policy, you paid policy total premium of 3 lakh 20. Only on this 1 lakh 80,000 rupees, they will deduct the TDS. And mind you, here no TDS if maturity profit is exempted under section 10D. What is that exemption? If you remember 80C section, if the policy is taken before 1/4/2012, 20% of sum assured, you have to maximum pay the premium. If the policy is taken after 1/4/2012, maximum 10%, like that it is there. If you made during the life of policy the premiums within the limits prescribed, then whenever the maturity of the policy will happen, the maturity proceeds will be exempt. So if the maturity proceeds are exempt, then there is no TDS here. Got it? Next, 194G, commission on sale of lottery tickets. I told you wherever you see commission 2% and 20,000 you see. Now commission on lottery tickets. So I am a lottery ticket agent. I will sell lottery tickets to the public. The lottery company will pay me commission. On that commission, if the commission is up to 20,000, no TDS. But if the commission is more than 20,000, the lottery company will deduct TDS on my payments, commission payments. Commission and brokerage. So apart from two commissions we have seen here so far, one is insurance commission. The other what we have seen is lottery commission. Now, apart from these two, whatever commissions are there and brokerage is there, everything will fall under 194H, And mind you, H is a hijack section. So in hijacker 194H, any payments you make, only if you are other than a hijacker, you will deduct the TDS. Hijackers are not required to deduct TDS here. So here also same thing, guys. All other commissions are covered here. Any kind of commission brokerage, if you are making payment to 20,000, no TDS. And if you are making payment more than 20,000 rupees, TDS will be deducted at the rate of 2%. The next section is 194I, very famous section. See, 194I, 194C, 194J, these are all famous section. Hijackers say famous. So 194I is also a hijacker section. Here also, hijacker is not required to deduct TDS. See, 194I says that if you pay rent on plant and machinery or building or furniture or land, if you pay, I repeat, if let's say for example, I took on plant and machinery on rent. Now I have to make payment of rent to the owner of the asset. At the time of making rental payments to the owner of asset, I have to deduct TDS from the rental payments. Likewise, building I took on rent or furniture I took on rent or land I am taking on rent. In that case, the TDS will be deducted under section 194I. If I am not a hijacker, I should not be a hijacker. Apart from hijacker means only business people will come in this. And that too having more than turnover of 1 crore or gross receipts of 50 lakhs, only those people will come under this category. If you are making rental payment for plant and machinery or equipment, then TDS you will deduct at the rate of 2%. But if you are making rental payment for land, building or furniture, you will deduct TDS at the rate of 10%, mind you. 10%. And there is a limit also given here. No TDS if rent is up to 50,000 rupees per month or part of the month. Part of the month means, let's say for example, actually the rent is 1,20,000 per month. But you used the asset only for half month. Then half month means, of course, you will not pay 1,20,000. No, you will pay 60,000 rent. So this 60 also more than 50,000. Still, you will be required to deduct TDS. To a single person, it says. To a single person. Let's say, for example, there is one person, and from that person, you took on rent one plant and machinery, and you took one building on rent, and you took, let's say, for example, one furniture also on rent. And now, let's say, for example, plant and machinery, you are required to pay 10,000 per month as rent. Building, you are required to pay, let's say, for example, 45,000 rupees as rent per month. And furniture, you are required to pay another 10,000. So, total how much you are required to pay? 65,000 rupees of rent per month. You will pay 65,000 rupees to a single person. Correct? Now, we will not check 50,000 limit separately for each asset. We will see the limit of 50,000 to a single owner in a year. So to this owner, we are paying 65,000 rupees per month. No, it already crossed 50,000 rupees per month. So TDS will be deducted on the 65,000 of payment which we are making payment to the owner on a monthly basis. TDS will be deducted at the rate of, depending on the rate what is given here. To a single person, very, very important during the financial year. Note. Pay need not be the owner of asset. Sir, if he is not a owner, how will he give me on rent, sir? The asset, he may be a sub-let out transaction. Or I took on asset on lease from the owner and I further sub-let out that. Then I will be the letting person. So the TDS will be deducted on in my case. Payment made by customers on account of cooling charges to cold storage. Just now we discussed in 194C that we will not treat it as rent. So the same point is coming here also. No requirement of TDS under 194I on passenger service fee made by airline to airline operator. You know, let's say for example, Air India is a airline company. Bombay Airport is there. Airport is different company. Air India is a different airline company. Airport company itself is different. Now, in order to run the airlines or in order to park the Air India flight on the airport of Bombay, the Bombay Airport Company will collect the charges from the airline company like Air India. On that, at the time that Air India will make payment to the airline, to the airport, whether TDS is required to deduct it or not is the question. And the law says there is no requirement to deduct the TDS under section 194E for the passenger services. When the Air India will come, Air India passengers will land on Bombay Airport and they will use a lot of services of the airport, Bombay Airport. There may be toilets which will be used by the passengers. They will drink some water for free. All these are passenger service only, and one bus will come to take the passengers from the runway to airport. All these charges, whatever paid by the airline to the airport operator, is there a TDS required? No, because it is not rent, which is directly collected from the passengers. No TDS on refundable deposits. Of course, refundable means why? It is first of all not an income, then no TDS. No TDS on lump sum lease premiums. Lump sum lease premium means you're not paying it as a rent. One bulk amount you are giving. 194 IA. Transfer of immovable property. What is a immovable property? Land or building or both. Transfer means what? Sale. So when you are selling a immovable property, who will make payment to whom? Buyer will make payment to seller for buying the property. Now, the buyer has to deduct TDS on the payments which are required to be made to the seller. Say for example, I am purchasing property from you. I am purchasing one building from you. Now, when I will make payment to you for the building, for purchasing the building, I will deduct TDS on that amount. Sir, at what rate? The rate given here is 1% on sale value or stamp duty value, whichever is higher. If you remember the capital gains chapter, I taught you particular sections, 50C, 43CA and all, if you remember. In that case, we compare 110% of the sale value with the stamp duty value. Whichever is higher, we will take. So, the TDS will be deducted at the rate of 1% on sale value or stamp duty value, whichever is higher. TDS applicable only if stamp duty value or sale value is 50 lakhs or more, mind you. If, let's say for example, you are purchasing a property worth only 30 lakhs, immovable property only 30 lakhs, then no TDS. But if you are purchasing a property worth 60 lakhs, on the whole 60 lakhs TDS will be deducted because it already exceeded 50 lakh rupees. The sale value or the stamp duty value, whichever is higher you will take here. That value, if it is exceeding 50 lakh rupees on the total purchase or the sale value, the TDS will be deducted at the rate of 1%. Buyer has to deduct. But no TDS on rural agriculture land. First of all, rural agriculture land itself is not a capital asset, if you remember the capital gain chapter. And mind you one more thing. Whenever you will purchase a property, lot of times the seller will tell that for building this much, for the club membership we will collect this much, for car parking we are collecting one-time fees this much. Like this they will collect some extra amounts. On that extra amounts also the TDS has to be deducted. So you will see the value of property total including the building value, club membership, gym fees or parking fees, car parking, whatever is there, all put together you will see. That total amount you will take and you will check the limit of 50 lakh rupees. That is given here. Sir, if there are more than one seller, then there are two sellers, sir, two owners are there, joint owners. I am purchasing property for 60 lakhs, sir. For single owner, I will give 30 lakhs, 30 lakhs. In that case, I am required to deduct TDS or not? Of course, you are required to deduct TDS. Because you have to see property wise, not how many owners are there. Are you getting it? So, you have to deduct TDS. The next section is 194IB. Payment of rent by certain individual or HUF. Guys, here in this section, those persons, those payers, those tenants who were not covered under 194I, they will be covered here. If you remember 194I, if you remember, hijackers were not covered here. So, under 194IB, hijackers will be covered here. So, I will write it here. Hijackers are covered. Hijackers are covered here. So, whoever were not covered under 194I will be covered here. Means who will be covered? Those persons who do not have business or profession. Those persons who have business or profession, but the last year turnover was up to 1 crores or last year gross receipts were up to 50 lakhs, they will be covered here. And the TDS rate here will be 2%. Mind you, here the TDS is only on the rent if it is paid more than 50,000 rupees per month or part of the month. And there is one small twist here. In 194I, I told you that every month whenever you will make the rental payments, you will deduct the TDS every month. But 194IB is not like that. In 194IB, the TDS will be deducted in the last month. In the last month of the year. Sir, what if I vacate the property during the middle of the year? Then in the year in which you are vacating the property, you have to deduct the TDS. And mind you, the TDS amount should not exceed the last month's rent. So at the time of credit of rent for the last month, you will deduct the TDS, time of deduction. Or the last month of tenancy. If the owner does not furnish PAN, that 20% I already told you, that is a common thing. TDS shall not exceed the last month rent, mind you. The next section is 194J. This is also forming part of hijacker. So hijackers are not required to deduct TDS here. Mind you, in 194J, fees for professional or technical services are covered. There are multiple services like professional services, technical services, remuneration to director, royalty and non-compete fees. These are the payments. If you make any of these payments to anyone, then TDS will be deducted under section 194J. If you are not a hijacker, you will deduct the TDS. First one. There are two kinds of tax rates here, TDS rates. If you are making payment for professional services, then TDS will be deducted at the rate of 10%. But in all other cases, you will deduct the TDS at the rate of 2%. FTS, royalty, payment to call center and all. So generally 10%. But in these three payments only, the TDS will be deducted at the rate of 2%. Fees for technical services, royalty on cinematography films and payment to call centers. Threshold limit is given up to 50,000 for each type of service, guys. Very, very important. Let's say, for example, there is one company and this is you. For your business, you took some services. Three kind of services you took. First, you took fees for professional services you took. Let's say, for example, you took for 40,000 rupees. Fees for technical services. You took some technical services for, let's say, for example, 20,000 rupees. And you took another royalty, let's say, for example, for loyalty services, you took another, let's say, for example, for 80,000 rupees. Now, mind you one thing. You will not deduct TDS at the time of making payment to this company. You will not deduct TDS on FPS and FTS because individually you have to see for each transaction separate professional fee. For each type of service, you have to see the limit of 50,000 rupees. So on this and all, we will not deduct TDS on 40,000, 20,000, but we will deduct the TDS on this 80,000 rupees whenever payment is being made to this company. because this 80,000 exceeded 50,000 for each type of service it is. I hope that is clear. Next. Limit of 50,000 is applicable separately for FPS, FTS, royalty, NCF. You cannot say, sir, to a single company only the payment is made. No. Yes, single company only payment is made. But the law is like this here. But in 194C, if you remember, 194C is separate. 194C says what? To a single person, if you make payment, even for multiple contracts, all contracts put together, you will check 1 lakh of limit here. But it is not like that. Here under section 194J, for each type of service, though you have taken from one particular person, does not matter. Next. No limit of 50,000 for payment made to director. So whenever you make any payment to director remuneration, even a 10 rupees is paid, you will deduct TDS. Yes, there is no limit like that. Note, individual HUF not required to deduct TDS on royalty and SUF payments. So mind you, for royalty, there is no, so here I took example as royalty as an individual. Just for example, I took, okay, let's take, this is not an individual. We will change the example as another partnership firm. Okay, so individual or HUF are not required to deduct TDS on royalty and NCF payments, non-compete fees. And for personal purposes also, if you take, there is no required to TDS. No need of TDS if you take any services for personal purposes. There are some third-party administrators. Who is a third-party administrator? Let's say, for example, you take one health insurance policy. You fell some sick. You got sick. You have a policy. Now you will go to one hospital for getting treatment using the policy. So first what will happen, the hospital will collect payment from the third party administrator, TPA. So first the TPA will make payment to the hospital and the treatment will be done to the patient. Then the TPA will collect amount from the health insurance company to whom the policy actually belongs to. Now, whenever third party administrators are making payment on behalf of insurance company to hospitals, they are liable to deduct a TDS under section 194J. So when the TPA will make payment to the hospital, the TPA will deduct the TDS on the payments made to hospital. Consideration for use of right to use computer software is royalty and shall be liable to TDS. So right to use a computer software if you are taking, for which you are making payment of royalty, you have to deduct TDS. But mind you, if you directly take the software as such as a product, TDS is not required. So software is acquired in a subsequent transfer. In that case, there will not be TDS. And if earlier also already 194, if already on purchase of software, TDS is already deducted, then in further transactions, there is no TDS required to be deducted, and you can provide one declaration in this regard. Next, 194K. Income from units of UTI, Unit Trust of India or mutual funds. Lot of times you may invest in units, mutual fund units or Unit Trust of India units. What they will give you in return? They will give you probably dividend or interest like that. Whatever return you are getting, income from units you are getting, that the mutual fund company, when they will give you income, that income will be required to be deducted TDS at the rate of 10%, and if the income is up to 10,000, there is no TDS. Next, 194 LA. Compulsory acquisition of immovable property. You must have read compulsory acquisition in your capital gains chapter. So if a compulsory acquisition is happening, you will get a compensation. Who will pay you the compensation? Government will pay you compensation. So the government at the time of giving you the compensation amount, they will deduct TDS. If the compensation amount is more than 5 lakh rupees. If the compensation is up to 5 lakhs only, then they will not deduct TDS. The government will not deduct TDS. If the compensation is more than 5 lakh rupees, the government will deduct TDS at the rate of 10% on the payments which is being made to you. But mind you, the government will not deduct TDS if the asset which is compulsorily acquired is a urban or rural agriculture land. So simple, if it is agriculture land, whether it is urban land or a rural land, if that is being compulsorily acquired, then TDS will not be deducted. The next section is 194M, M for mixed masala. M for mixed masala. Other than hijackers, whoever are there, will be covered here. Payment by individual HUF under section 194C, J and H. Other than those covered under 194C, J, H means actually here hijackers will be covered. Hijackers will be covered in this section 194C, J and H. So let's say for example, if you were not required to deduct TDS under 194C or J or H, then you will be required to deduct TDS under section 194M. So I can say here hijackers are covered. I can say here hijackers are covered. So if you are not required to deduct TDS under section 194C, 194J, 194H under those sections, in that case you will be required to deduct TDS here. But provided the payments which you make aggregate payments in 194C, J and H put together, if it is more than 50 lakh rupees. Let's say for example, we'll take one example. You are a person who took 194C service, 194J service, 194H service from one particular person, and you have to make payment. Let's say for example, this is the person, for example, and the amount here is for 194C, let's say for example 15 lakhs. 194J, another, let's say for example 30 lakhs, and another 20 lakhs for 194H. Mind you are a person whose turnover is up to 1 crore or up to 50 lakh rupees, and you are an individual or HUF. If you are an individual or HUF having turnover up to 1 crore or 50 lakhs, of course you are not required to deduct TDS under 194C, J and H because you are a hijacker. So people are escaping. So government told if a hijacker takes any of these services from one particular person in a year, and if the total amount is exceeding 50 lakh rupees, now see how much it is total, 15 plus 30, 45, this is totally 65 lakh rupees. Is it exceeding 50 lakhs? Yes, from a single person, and from these sections put together it is more than 50 lakh rupees. Then this person, hijacker, whenever he will make payment to this person, he has to deduct TDS at the rate of 2%. So individual HUF having turnover in last year up to 1 crore and gross receipts up to 50 lakhs are covered here. And mind you, for personal purposes not. Only if these services are taken for business purposes, then only TDS will be deducted. That is 194M. For those persons who are not covered under 194C, J and H. The next section is 194N. TDS on cash withdrawal. Lot of times you will go to bank to withdraw the cash. If you withdraw more than 1 crore rupees in a year, not in one shot, you might have withdrawn first 20 lakhs, then 50 lakhs, then 60 lakhs like that. But in a year from a particular bank, one bank, if you withdraw an amount more than 1 crore rupees, then the bank will deduct TDS at the time of making payment to you. Bank or cooperative bank or post office, whatever is covered here. But the 1 crore limit will be applicable only if you filed the last 3 preceding previous years return of income. All 3 years. Even if you miss a single year, the limit will not be 1 crore. So let's say for example, I filed my return of income for the last 3 years. I filed my all 3 return of income. Then the TDS will be deducted at the rate of 2% for the amount exceeding 1 crore rupees. Mind you, the TDS will be deducted only on the amount exceeding 1 crore. Let's say for example, I withdrawn 1 crore 20 lakhs. They will not deduct TDS on the total 1 crore 20 lakhs. They will only deduct TDS on 20 lakhs only. Next, return of income for any of the 3 preceding previous year not filed. If you have not filed return for any of the last 3, even a single year you missed, in that case, TDS at the rate of 2% will be deducted on amount exceeding 20 lakhs up to 1 crore. And if you withdraw more than 1 crore, in that case, TDS will be deducted at the rate of 5% on 1 crore. In my regular class, I have beautifully explained with a lot of examples. If you are lacking in the conceptual clarity, you can go and purchase the exam-oriented regular course batch. Amazingly, we have covered a lot of examples. Only if you think that by watching the marathon, you will clear examination, you are mistaken. If you don't know the practicality of these things, whatever I am discussing, there is no point. Yes. If cash withdrawn by cooperative society. So if a cooperative society is withdrawing cash from a bank, then TDS will be deducted at the rate of 2% if the cash withdrawn is more than 3 crore rupees. Okay, and no TDS if cash withdrawn by government, bank, cooperative bank, post office, and for ATM operators. Next, 194P. This 194P section is applicable in case of senior citizens. A lot of times senior citizens who are retired, they don't have any other income. Only one pension will come and they may be having one deposit with the bank. That's all. For those senior citizens, this section is applicable. 194P. Let's say, for example, there is one retired person, senior citizen. He is getting pension income in one particular bank account. In that bank itself, out of that pension itself, he has created one recurring deposit. On that recurring deposit, this person will get interest income. Correct or not? Now, the bank who will make interest payments to the senior citizen has to deduct the TDS from the payments being made to the senior citizen. But the TDS will be deducted on the total income, including pension and the other interest payments what is being received by the senior citizen. The senior citizen here is not a 60 years category, age of 75 years or more. And the TDS will be deducted using the slab rate. You remember 192 when I taught you how to use the slab rate, exactly the same way. Senior citizen has income in the nature of pension and no other income except interest from a specified bank in which he is receiving pension. Only they are covered here. Next, TDS on purchase of goods more than 50 lakh rupees under section 194Q. Let's say, for example, I am a buyer of goods. I am a business person. If my last year turnover was more than 10 crore rupees, if my last year, I am a buyer of goods, if my last year turnover was more than 10 crore rupees, and if I buy any goods from a particular vendor for my business purpose, if from one single seller, if I purchase goods for more than 50 lakh rupees in a year, in that case, whenever I will make payment to my seller, I have to deduct the TDS under section 194Q at the rate of 0.1% on the payments exceeding 50 lakhs. Let's say, for example, I purchased goods for 80 lakhs from one particular seller. Then I will deduct TDS only on 30 lakh rupees at the rate of 0.1%. But if the seller did not provide me the PAN, then I will deduct TDS at a higher rate of 5%, guys. There used to be one section 206C1H. If both 206C1H and 194Q applies, you always should deduct TDS under section 194Q only. And if 206C1, 1F, 1G also applies simultaneously TCS provisions also, then in these cases TCS provision will be applicable. Sir, you are telling the last year turnover should be more than 10 crores. What if I am a new business person, sir? Last year my business itself was not there. Then you don't deduct TDS because last year the turnover is nil. So you are not required to deduct the TDS in that case. Now mind you, you will not deduct the TDS on the GST component. You know, sale means in the sale figure, GST would also be included, but you will never deduct the TDS on the GST component, mind you. Only on the raw sale amount, the gross sale amount only, you will deduct the TDS on that amount. Sir, what if, sir, I purchased some goods, on that I already deducted TDS when I made the payment to seller, but I returned the goods to my seller, sir, what will happen? Then on the future payments, whenever you will make payment, on that you will set off this TDS amount which you already deducted. Got it? Next. Ignore non-business turnover or gross receipts. Non-business means other than sale, whatever revenue is there, that on that you will not deduct the TDS. Next section is 194R. Hijacker. Here also hijacker will come, because hijacker means what? Hijacker. Hijacker. Last R is hijacker only, no. So hijackers are not covered here. Other than hijackers are covered here. In business, lot of times you get lot of perquisites, benefits. If you receive any kind of perquisites or benefits, the person who is giving you that benefit or perquisite has to deduct TDS. If they are making you the benefit of more than 20,000 rupees, they will deduct TDS at the rate of 10%. Now, that officially ends our discussion on TDS provisions only. We will now discuss some miscellaneous provisions which are important. Grossing up of income. Let's say, for example, you and your vendor, you entered into transaction, entered into agreement that you will make payment of 1 lakh to the person. Let's say, for example, you have entered into contract that you will make 1 lakh payment to the person who will receive the payment. Now, 1 lakh is the amount which you promised to the person. Now, can you make 1 lakh payment totally? No. You have to deduct, let's say, for example, at the rate of 10% TDS you have to deduct, for example. But the other party is saying that, no, I want 1 lakh in cash on hand. Then what you will do, you will gross up the transaction. You will have to deposit this 10% TDS. How you will gross up? If 1 lakh is after TDS payment, if 1 lakh is net of TDS, if it is net of TDS, then this is 90%, I can say. Now, if it is 90%, how will you gross up? 1 lakh divided by 0.90 you will do. That will be how much? So, the gross amount will be 1,11,111. And the TDS will become what? 11,111 will become TDS. And the net of TDS amount will become 1 lakh, because your party, the customer or your business fellow is asking you to make the payment net to 1 lakh on hand. So 1 lakh if you pay, you will do the grossing up. That is called grossing up if the agreement between the payer and payee is like that. You have to gross up the income. Next, no TDS on interest, dividend or any other sums payable if it is paid to government RBI. Guys, tax whatever you will deduct, you will pay to the government only. Then how can you deduct the TDS from the government itself? If you make any payment to government, why you will deduct TDS? Because government itself is collector of taxes. Next, lower deduction certificate. Let's say, for example, during COVID, actually, everywhere there is a cash crunch. There is no cash only. There is no business only. So there is a lot of cash crunch. Let's say, for example, one vendor called you. Sir, I am making a payment. We will deduct TDS at the rate of 20%, sir. Then you thought, if you will deduct to 20%, already I do not have cash, and he will deduct TDS, then I will get less amount on my hand. And I have to make salary payments to my employees, rental payments. These are all fixed costs. And here there is no business. So you immediately went to income tax department and you requested the assessing officer, the tax officer, sir, please give me one certificate, lower deduction certificate. What is this lower deduction certificate? You know, if the lower deduction certificate you get, the vendor told that he will deduct the TDS at the rate of 20%. But you can get a lower deduction certificate from the income tax officer asking please deduct the TDS at the rate of 5% only. Please give me one certificate, sir. That certificate I'll give to my vendor. He will rather deducting 20% TDS, he will deduct only 5%. At least 15% extra cash I will get on my hand. I can serve my business. It is called lower deduction certificate. Deduction for receipt of dividend without TDS. If let's say, for example, you are an individual, you invested in a shares of a company. Now you will receive dividend. Let's say, for example, you are a retired person, you do not have any kind of income apart from this dividend income. Then you can give one declaration to the company which will pay you dividend that my total income is not even exceeding basic exemption limit. And if you pay me dividend, you will deduct TDS. But my total income, including the dividend itself, is not even exceeding basic exemption limit. I am actually not required to pay tax for this year. But simply, unnecessarily, you will deduct TDS that will get stuck in refund, and the refund will come after many months, and it is loss for me. So please give me dividend without a deduction of TDS. Like that one declaration you will give in form number 15G, that is called declaration for receipt of dividend without TDS. Due date of payment of TDS. Now, I have taught you that you have to deduct TDS from the payments which you are making to the vendors, I told you. But once you deduct the TDS, what you will do with the money? What you will go and enjoy? No. You have to, once you deduct the TDS from the payments, whatever you made to the parties, then whatever amount you deducted, you have to deposit with the government, with the income tax department. Sir, when we will deposit? If you are deducting the amount of TDS from April to February month, then the 7th of next month immediately you have to deposit. Let's say, for example, in July month, you deducted 10,000 TDS. Well, while making payment to any of your vendors, you TDS you deducted 10,000. In July, when you made payment, you deducted. Now this 10,000 you have to deposit with the government by 7th of August maximum to the government account. Got it? Next. Same with the TCS also. TCS also I'll discuss in just some short of time. Don't worry. But TCS also has to be deposited by 7th of next month. Next. Only for March month, keep in mind, extra time is given. See here, April to February, immediately next month 7th you have to deposit. But for March month alone, you will not deposit 7th of April. They have given 30th of April. 1 month time they have given, because the logic is what you know. In March month, you have to close your books of accounts. Every accountant will be busy in closing the books of accounts. So they have given one more extra month time, that is 30th of April, you have to deposit. Both in case of TDS or TCS. But mind you, in case of TDS which is deducted under 194 IA, IB and M, the TDS shall be deposited within 30 days from the end of the month in which it was deducted. So in these payments, all section payments are covered, but only these 3 sections TDS shall be deducted, deposited within 30 days from the end of the month in which it is deducted. So very simple. Next month end you have to deposit. Sir, what will happen, sir? What will happen if I don't deposit this within time? You have to pay interest. That I will discuss in some time. Once you make the TDS payments, you have to file one return called as TDS return or TCS return with the government. What is TDS return? What will be there in that? This TDS return is filed quarterly basis. See, you are making payment of TDS on a monthly basis, but the return will be filed on a quarterly basis. So first quarter of a financial year or previous year will be what? April, May, June. 3 months is a quarter. So April, May, June, whatever TDS you deducted and whatever you deposited with the government, you have to fill one form which is called TDS return, and you have to file one return with the income tax department saying that, sir, these are the parties from which I deducted TDS. This is the amount on which I deducted TDS. This is the section which I used to deduct TDS. This is the rate of TDS which I deducted, and these are the payment challans, sir. I made the payment on so and so date with the government. Like that, one detailed return you will file with the income tax department. That is called TDS return or TCS return. Quarterly, I told you. So quarter ended 30th June. You have to file the return before 31st of July or 15th of July. So for TCS it is 15th, 15th, 15th. For TDS it is 31st, means end of the month. This is mid of the next month, immediately after the quarter which is ending. So if the quarter is ending on 30th of September, you have to file TDS return by 31st October. You have to file TCS return by 15th of October. For 31st December quarter which is ending, you have to file TDS return by 31st January and by TCS return by 15th of January. For 31st March alone, I told you the accountant will be busy. They have given 2 months of time, April and May here, and here 1.5 month of time is given. And here the TD, what is the form 24Q, 27Q, depending on the type of TDS which you make, you have to. If you delay in filing these TDS returns, if you delay, let's say for example, instead of 31st May, you filed the return on 31st July. In that case, what will happen? If the TDS return is filed after due date, then fees will be collected from you. Late penalty fees, 200 rupees per day they will collect under section 234E. Mind you, the fee which you pay should not exceed the total TDS amount. Got it? Next. Interest on late deduction or late payment of TDS. Just now I told you here, if you deposit the TDS late, what will happen? Interest you have to pay. How much interest you will pay? For late deduction is different from late deposit. What is late deduction? Let's say for example, I taught you when I started the chapter, the TDS shall be deducted at the time of credit or at the time of payment, whichever is earlier, I told you. Say for example, you are actually required to deduct the TDS on 10th of July 2025. You are supposed to deduct the TDS. But you deducted the TDS on, let's say for example, 20th of September 2025. This is called late deduction. Later deduction. So interest will be levied at the rate of 1% per month on the amount of TDS which you late deducted from the date on which you were supposed to deduct to the date on which you actually deducted. So from date on which TDS was deductible means you were supposed to deduct, to date on which TDS was actually deducted. Let's say for example, you deducted on 20th of September 2025, but you have to deposit also. No, when you have to deposit, what is the law saying? Immediately after 7th of October 2025, because in September month, whatever you deducted TDS, you are required to deposit before 7th of October 2025. Correct? No, see here, I taught you just now. You will deposit by 7th of next month. So this is the due date to deposit. But let's say for example, you deposited on 13th of December 2025. 13th of December 2025. Again, there is a delay in deposit. See, this was a delay in deduction of TDS, but this is delay in deposit of TDS. So late deposit, if you are doing the TDS, the interest rate will be 1.5% of the amount of TDS which you are late depositing. So from the due date till the, guys, now one more point here. Be very careful. You will not calculate the TDS interest for the late deposit from 7th of October. That is the test here. You will not calculate from this date. You will always calculate the interest from the date you actually deducted the TDS till the date you actually depositing. Date on which TDS was actually deducted. So we will not consider this date, the due date, if you delay for interest purpose. Of course, you are required to deposit the TDS by this date, but interest always will be calculated from this date to this date. From the date you actually deducted, the date on which TDS was actually deposited. So you actually deposited on 13th of December. So from 29 to 20 September to 13 December, the TDS interest will be will be calculated at the rate of 1.5% per month for late deposit. So remember, for late deduction 1%, for late deposit 1.5% per month or part of the month. Even part of the month. See here, part of the month is there. Still for full month they will consider the interest. And this I already taught you at the start of the discussion itself. If PAN is not provided, 20%, and in 194Q it will be 5%, whichever is higher. Next. So now we will discuss the TCS. Yes, what is the difference between TDS and TCS? You know, TDS means tax deducted at source. The buyer or the payer will deduct TDS from the payments made to the vendor. But TCS means a tax collected. The receiver of the payment will collect extra tax from you. In TDS, what happens? The payer will deduct TDS from the payments. But in TCS, it is not like that. The collector of the amount will collect extra amount called as tax collected at source. Let's say, for example, you are buying some goods from someone. The seller will collect TDS from TCS from you, tax collected at source. But in few particular transactions which are mentioned in this sections. The first section is 206C1, TCS on sale of certain goods. Sir, what are these goods, sir? Alcoholic liquor for human consumption, scrap, minerals being coal, ignite, timber, forest produce, and tendules. Only in these kind of products, the seller at the time of selling goods to the buyers has to deduct TCS, has to collect TCS, collect TCS at these rates. Sir, when they will collect, sir? They will collect the TCS at the time of debit. Guys, in TDS, we learned at the time of credit in the books of accounts or at the time of payment, whichever is earlier. But here it is ulta. Debit will become credit, payment will become receipt. That's all. Debit in the books of accounts or receipt, whichever is earlier. Here also hijackers are there. Same here also, other than hijackers. Hijackers are not covered here. Person other than personal consumption. So if you buy liquor for your personal consumption, they will not collect TCS. Or if the buyer is public company or central government, state government, embassy, from these persons, the seller will not collect TCS. Only for business persons, the collection of TCS will happen. Time of collection, I told you. No TCS if goods are utilized in manufacturing of generation of power. So any of these products, if they are used for generation of power, then TCS will not be collected by the seller of goods. Next. TCS on lease or license of parking lot, toll plaza, mine or quarry. You know, on highways, toll will be there. Toll plaza. That toll plaza is generally given on an auction basis to lot of vendors. If you want to go and participate in the auction, you can also go and bid, and if you win the contract, you will only run that toll plaza. So in that case, whatever amount paid by the toll plaza bidder to the government will collect a TCS. Yes. So any person other than public sector company is what? Public sector company is a government company only. Again, if a government company will pay tax to the government, no. So any person other than public sector company participates, and if they are making any payment for toll plaza, mine or quarry or licensing or TCS on lease, parking lot, mine, big mines will happen on a land for that purpose. TCS rate is 2% will be collected. Next. 206C1 of TCS on sale of motor vehicle. Guys, here motor vehicle does not cover two-wheelers. More than two-wheelers, whatever is that. Generally four-wheelers. Here also hijackers. Mind you, if you purchase a motor vehicle, means car, in that case, TCS will be collected. TCS will be collected only if a seller is selling a motor vehicle to another buyer. The seller will collect a TCS, tax collected at source. You will get a doubt, sir. Let's say, for example, Maruti Suzuki company is manufacturing cars. So Maruti Suzuki, when it will sell the cars to local dealer of cars, will the TCS will be applicable? No. TCS will be applicable only when car is sold to retail buyer. And that too, the amount given is 10 lakhs on each individual purchase. Let's say, for example, you are a buyer. There is one car company. You are buying two cars from this company. One car is 8 lakhs. Another car is 7 lakhs. You are buying from one particular car company only, that too on same day. Still, the car company will not collect TCS from you, because for single transaction you have to check 10 lakhs exceeded or not. And you are buying car for your personal consumption at retail level, so TCS generally has to be collected, but since the amount is not exceeding, TCS will not be considered. Let's say, for example, you purchased 18 lakhs car 1 and 7 lakhs car. So TCS will be collected on this 18 lakhs car from you, because you are a retail buyer. But on this 7 lakhs, they will not collect TCS. At the rate of 1%, they will collect TCS, the selling company or the selling retail agent. TCS will apply only in case of retail level. No TCS when manufacturer sells cars to dealer or distributor. Two-wheelers are not covered here. 206C1G, liberalized remittance scheme or overseas tour program. Remittance of money more than 10 lakhs under liberalized remittance scheme or sale of overseas tour program. Guys, let's say, for example, you want to go and pursue MBA abroad. How will you go? You will first apply for one university abroad. Then you have to make payment of the fees. Then only you will get the visa. How will you make payment? In Indian rupees, you cannot make. You have to convert your rupees into foreign currency, dollars. Then you have to remit money outside India for education purpose. Then you will make payment to the foreign university. That is called remittance of money. If you remit the money for the particular prescribed transactions for more than 10 lakh rupees under liberalized remittance scheme of Reserve Bank of India, then this TCS provision will apply. And the next one is sale of overseas tour program package. You know, if you want to go abroad, you will consult one travel company, travel agency, and they will sell you one tour package. In that case, you have to make payment to tour company. That transactions also covered here. So who will collect TCS here? Here the TCS will be collected by the foreign exchange fellow, and here the overseas tour program package vendor or seller will collect the TCS. Next. Mind you, the TCS will not be collected from non-residents visiting India, central government, state government, embassy and all. And if already TDS is deducted, that also will not be collected. Here, there are small mistakes in the book. Please make correction. Here, 7 lakhs is there. Please make it 10 lakhs, guys. Please make it 10 lakhs. And here, 0.5% is there. Please make it nil. If already it is updated in your book, then good enough. Now, remittance more than 10 lakhs under LRS, Liberalized Remittance Scheme. Education or medical purpose is given for either for higher education or medical. Let's say, for example, you want to take treatment from one foreign hospital, then also you have to send money abroad, or any other purposes. Two columns are there. If you are sending money for education or medical, then rate of TCS will be 5%. When you want to convert the money and you want to send abroad, they will collect TCS at the rate of 5% on the amount excess of 10 lakh rupees. But now, mind you, in case of LRS, if amount is remitted out of education loan, see, there may be two possibilities. One, either you only have your own money which you want to send abroad for education or medical, or you will take one education loan and then send money. Two possibilities, but here only education loan is covered. So if you take an education loan from a bank and then convert that into foreign exchange reserve, foreign currency, and then send abroad, remit abroad, in that case the TCS will be nil instead of 5%. So if you don't want to pay any TCS, then take a loan and then send money. For education only. For medical, it will be 5%. And for other purposes, 20% in amount of excess. So apart from education or medical purpose, if you want to send abroad the amount, then you have to pay TCS at the rate of 20%. And in case of sale of overseas tour program package, if you buy for any purpose you buy, in that case up to 10 lakhs worth of package if you are taking, TCS will be 5%. If you are taking a package more than 10 lakh rupees, TCS will be 20%. Next. Like in TDS we have seen, the payer of the amount will deduct TDS and has to deposit with the government. Exactly the same way, in TCS what will happen? The collector of the money, the seller of the goods have to collect the TCS and has to deposit with the government. Same thing here also. If there is any delay in deposit of the TCS or there is a delay in collection of the TCS, in that case the interest will be levied at 1%, 1.5%, like we exactly what we read in TDS chapter, TDS topic. From the date on which TCS was collectible to the date on which actual TCS was collected. From the date on which TCS was collected till the date the deposit of TCS happened, the interest will be levied. And if the buyer of the goods do not provide you the PAN, in that case the collector of TCS will collect TCS at twice the actual rate of TCS or 5%, whichever is higher. But only in one section, 206C 1H, actually 206C 1H it is 1% in case of that. Guys, 206C, one second, 1H was actually there earlier, but now it has been removed. So just for that purpose it is given here, but just ignore, you can ignore this point. Yes, from 1 July 2023, the higher TCS rate for non-furnishing PAN is 20%. Now it should not exceed 20% in any case, because here twice of actual rate it says. What if the actual rate of TCS is 15%, then twice will become 30, but it should not exceed 20%. I hope that is clear. Okay, advance tax will be dealt in a next one. Namaste, namaskara, vanakkam. Guys, last 5 attempts CA intermediate income tax question paper you pick and check. Question number 4A, every attempt it is asked from set off and carry forward of losses for 6 marks, guys. Out of 50 marks of your CA intermediate income tax paper, 6 marks, almost more than 10% of the marks is given weightage to this small topic. Lot of students have commented in my YouTube channel, sir, please prepare a video on set off and carry forward of losses. It is very confusing, sir. So this video, if you watch, guys, till the end, I can guarantee you laddu 6 marks in your pocket, guys. So watch this video till the end. First of all, guys, you need to understand these two terms. What is set off? What is carry forward? Guys, I'll explain you with this example. Let's say, for example, you have two businesses. Business 1, you have a profit of 2 lakhs. Business 2, you have a loss of 5 lakhs. Now, the Income Tax Act says that if you have a profit under one source, if you have a loss under one source, you can set off the loss with the profit. Now, guys, 5 lakhs of loss, if I able to set off with this 2 lakhs of profit, that is called set off. I am setting off this 5 lakhs of loss with the 2 lakhs of profit. Of course, I will be able to set off only to the extent of 2 lakhs profit. But you understood what is set off. Set off is nothing but you having a loss which you can set off with the profit. Now, out of this 5 lakhs, I am able to only set off 2 lakhs. Still remaining 3 lakhs of excess loss is there. That loss I will be able to carry forward to the next year, and next year I will set off with the other incomes. Yes, so out of 5 lakhs of loss, I am able to set off only 2 lakhs. 3 lakhs loss is remaining. which I have to carry forward to the next year. So set off and carry forward is nothing but this, guys. So set off I did to the extent of 2 lakhs in this year, and carry forward of the remaining loss I am doing the remaining 3 lakh rupees, guys. So if someone asks you what is a set off and what is a carry forward, the answer is very simple. Set off is nothing but adjustment of loss in the year of loss, and carry forward is nothing but carry forward of the balance losses and adjustment of loss in the subsequent year, guys. Now you need to understand two concepts: intra-head adjustment, inter-head adjustment. Guys, intra-head adjustment means setting of the loss with the same head income. Let's say, for example, you have two house properties. House property 1, you have a loss. House property 2, you have a profit or income. In that case, you will be eligible to set off the house property 1 loss with house property 2 profit, guys. This is called intra-head adjustment. Within the same head, two source of income you have, and you are able to set off the loss with the profit. Inter-head adjustment means, let's say for example, house property you have a loss, PGBP you have an income. PGBP profit, house property loss, you will be eligible to set off this house property loss with PGBP income. That will be called as inter-head adjustment. Different heads you are using and setting off the losses. So intra-head means set off of loss with the same head of income. Inter-head means set off of loss with other head of income, guys. Now you need to keep in mind one thing, guys. Intra-head adjustment is possible both in the year in which you incur the loss and after you carry forward. But inter-head adjustment you can do only in the year in which you incur the loss. Once you carry forward the loss, in our example, see here, once you carry forward this 3 lakhs of loss to the next year, you will not be able to set off this 3 lakhs of loss with other head income. Means you cannot set off with capital gains, you cannot set off with house property income, you cannot set off with income from other source once you carry forward this 3 lakhs. Are you getting it? So inter-head adjustment is possible only in the year of the loss which you incur. Don't worry, I have a beautiful example right before you. We will cover all the concepts in this chapter, set off and carry forward, with the beautiful examples, guys. Be tuned in this video till the end. Year 1 I am looking at. Don't look at year 2 for now. Year 1, business 1, business 2. You have two businesses and you have a house property also. Guys, business 1 has a profit of 5 lakhs. Wherever you see this positive figure is profit, negative in brackets whatever you see is a loss. Okay, so business 1 has a profit of 5 lakhs. Business 2 you have a loss of 8 lakh rupees. Guys, always follow these steps. Step number 1, do intra-head adjustment first, because intra-head adjustment is nothing but within the same head. If you have income and loss, first do set off in the within the head. Still, if loss is pending, then only you go to the other heads to check whether set off is possible or not. So step 1, you do always intra-head adjustment within the same head of income. Then if still loss is pending, still loss you have on hand, then you go and do inter-head adjustment, guys. So in this business 1 and business 2, business 2 you have a loss of 8 lakhs. Obviously you will be able to set off business 2 loss with business 1 income, correct? So out of 8 lakhs, if you set off with 5 lakhs of profit, still 3 lakhs of business loss is there in your hand. That do you have any other PGBP head income? No. Already you had 5 lakhs, you exhausted with this 8 lakh rupees. So still 3 lakhs is there. Now step 2, you will go to inter-head adjustment. What you have done here in business 1 and business 2 is intra-head adjustment. Still loss is there in your hand. You will go to other head to seek help from income from house property. Out of the remaining 3 lakhs, you will be eligible to set off 1 lakh of loss with 1 lakh of profit from income from others, income from house property, guys. Still 2 lakhs loss is pending. That loss you will carry forward to the next year, guys. I hope this is clear. Now let's come to year 2. What is happening in year 2? Business 1 has a profit of 50,000. Income from house property, you have 3 lakhs of profit. Brought forward loss, of course, this loss what is there of the previous year, you carry forward to the next year, it will become brought forward loss of 2 lakhs. Guys, I told you already, Inter-head adjustment means one head loss with other head profit is possible only in the first year in which you incur the loss. Once you carry forward the remaining loss, you cannot do inter-head adjustment. Now see, this 2 lakhs is loss is carried forward loss to the next year. You cannot do inter-head adjustment in the next year. You can only do intra-head adjustment. Means this business loss, this is a PGBP loss, no, this is a PGBP loss. This PGBP loss you cannot set off with other heads income. Now you see here, you have a business income of 50,000 only, but you have a brought forward loss of 2 lakhs. This out of this 2 lakhs 50,000 you will be able to set off with this business income, but still 1,50,000 loss is still pending, business loss. You cannot set off with house property income, guys, not possible, because this is the year 2, this is subsequent year. In subsequent year only intra-head adjustment only possible. But you see here, in year 1, in the year in which you incur the loss for the first time, you were able to do inter-head adjustment with house property income, you were able to do. So thumb rule is very simple. Inter-head adjustment can only be done in the year of loss, guys. Carried forward loss cannot be adjusted against other head income. I hope this is clear. Yes, carried forward loss cannot be adjusted against other head income, means inter-head adjustment is not possible. So you see here, PGBP loss carried forward, again you will carry forward this 1,50,000 to the next year, and your gross total income here will be this 3 lakh rupees of income from house property. I hope this is clear, guys. Now, sir, loss can happen under any head, sir. Guys, salary, it is not possible to have a loss. But yes, of course, house property you can have a loss. Sir, house property, how can I have a loss, sir? Guys, remember, in house property you can claim interest deduction, right? If the interest deduction is more than your net annual value, in that case you will end up with a loss. PGBP, business can have a loss. Capital gains, you sold property or capital asset for a value lesser than the cost of acquisition, in that case you can have a loss. And income from other sources, from winnings and all, you can lottery also, you may have a loss. So all the heads loss is possible, but except the salary head, all the other heads loss is possible. Now guys, sir, can I set off how much ever I want, whichever head I want, can I set off like that, sir? No, it is not possible like that. Sir, how many years I can carry forward the loss, sir? You can carry forward to limited years. So everything we will discuss in this one summary table, guys. In this one summary table, all the adjustments of set off and carry forward of losses is given. Don't worry, you can pause the video and you can take the screenshot later, but now focus on the video, guys. I will first tell you what is there in this heading of the table, so that you will understand this table in a beautiful manner. One table, all your set off and carry forward of losses, all adjustments will be done, guys. First, here in this column you will find head of income or loss. Then in this I have taken set off of year of loss, means in the year in which you incur the loss, whether you will be able to set off under the same head and the other head also. Means this column is intra-head adjustment, this column is inter-head adjustment. Then carry forward and set off in subsequent year. So this column will tell you, once you carry forward the loss, will you be able to do set off under the same head income, and will you be able to do set off under the other head income also or not? So this is carried forward to the next year, intra-head adjustment. This is carried forward to the next year, loss, inter-head adjustment. Then time limit for carry forward of a loss and set off, means how many years you can carry forward this loss. I told you here in our example, see here in our example, you can carry forward this 3 lakhs, but how many years? So this table, this column will tell you how many years you can carry forward the loss. And the last column will tell you, is return of income filing mandatory before the due date of 139(1). Guys, it becomes very important, because there are some losses which you cannot carry forward to the next year if the return of income is not filed within due date. So this one summary table will summarize all the concepts, guys. Number 1, we will take income from house property loss. So income from house property loss, if you have, in the year in which you incur the loss, can you do intra-head adjustment under the same head? Yes, it is possible. Means you have two house properties. One house property has a loss, other house property has a profit. Can I set off? Of course I can set off. Sir, is there any limit, sir? How much I can set off? No, unlimited amount, whatever is there. If you have a respective income in the same head, please go ahead and set off. No restrictions at all. Sir, still loss is pending with me, sir. Can I do inter-head adjustment, sir, under other head in the same year, in the year in which incurred loss? Yes, you can do, but maximum 2 lakhs only. That too under optional tax regime only you can do. Guys, you know very well there are two tax regimes: optional tax regime, default tax regime. Guys, under optional tax regime only, inter-head under other head adjustment is possible. Income from house property loss. You have a house property loss under the same head, intra-head adjustment fully possible. But inter-head adjustment, if you want to do, means this house property loss you want to set off with PGBP income, you want to set off with capital gains, you want to set off with IFOS. If you want to do it only under optional tax regime, you can do that to maximum 2 lakhs only. It is eligible, guys. Sir, I am paying tax under default tax regime, sir. Can I take this house property loss and set off with other sources income, sir, other heads of income? No, you cannot do. Even a single rupee you cannot do. Only under optional tax regime, that too a cap is given of maximum 2 lakhs. Okay, sir, this year still I did this also, sir. Inter-head adjustment also I did. Still loss is pending, sir. What should I do? Carry forward to the next year. Sir, once I will carry forward to the next year, can I do adjustment with other heads income, sir, PGBP, house property and all? No, 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 no. That's what this column says. Carry forward and set off in subsequent year. Under same head, can I do, na, sir? Once I carry forward the excess loss to the next year, I have house property income, sir. Can I set off with that? Yes, because this is house property loss. No, take and set off with house property income. Yes, it is possible under optional tax regime only. Guys, keep in mind one thing. If you pay tax under default tax regime, you cannot carry forward the house property loss, also not possible. Yes, so under other head, is it possible, sir? No, it is not possible. I have to summarize. If I have to summarize house property loss, guys, see this important notes. Inter-head adjustment of house property loss only under optional tax regime, maximum 2 lakhs you can do. Inter-head adjustment of house property loss under default tax regime is not allowed at all. Under default tax regime, carry forward of house property loss also not possible. So if I have to quickly summarize house property loss, guys, very, very important, 100% question may be framed under this concept, guys. House property loss, I have this year I have incurred a loss. First, I will check, is there any other house property income within the same head? If it is there, I will set off. If still loss is pending, I will check other heads of income, PGBP, capital gains or IFOS. If I can I set off? Yes, you can set off, but only under optional tax regime, that to maximum 2 lakhs. Sir, what if I am paying tax under default tax regime, sir? You cannot do inter-head adjustment even in the current year in which you incurred the loss. Okay, next. Sir, still loss is pending, sir. I am paying tax under optional tax regime. I did inter-head adjustment also, sir. Still loss is pending. Carry forward that loss to the next year. But in the next year, that too, if you are paying optional tax regime, only then you will be able to carry forward. So once you carry forward, you will be eligible to set off this loss, excess loss, only with house property income only. Under other heads, you cannot do. Sir, what if I am paying tax under default tax regime? Don't carry forward that loss which you have on hand. Yes, sir, how many years I can carry forward like this, sir? 8 assessment years you can carry forward. Sir, do I need to file the return of income within this due date, sir? No. Return of income to be filed within due date? No. Even if you file the return of income belatedly, still you will be able to carry forward of the loss under optional tax regime only. Under default tax regime, what is the condition? You cannot do inter-head adjustment in the same year, and under default tax regime you will not be able to carry forward the loss also. Now coming to example, we will take, guys, examples we will see. House property loss under optional tax regime. You understand this example from optional tax regime standpoint only. Example number 1. House property 1, you have a loss, negative figure of 4 lakhs. House property 2, you have a profit of 3 lakhs. What I told you under optional tax regime, first do intra head adjustment. So these are all, these both are same head, means these 4 lakhs of loss I can set off with this 3 lakhs of income. Correct. Now still 1 lakh loss is there on my hand. This I can carry forward to the next year because I do not have any other head income, nothing is there here. So 4 lakhs negative I will set off with 3 lakhs positive. I will be able to set off only 3 lakhs. So still 1 lakh loss is pending. I do not have any other head of income. I will have to carry forward. But at the time of carrying forward, always check in examination question paper whether it is default tax regime or optional tax regime. This is optional tax regime. Okay, appa, I will be eligible to carry forward this loss. So house property 2 income 3 lakhs less house property 1 loss of 3 lakhs. See, gross total income will become nil. House property 1 loss to be carried forward is 1 lakh rupees. Next. Example 2, this is not year 2, this is not year 2, this is example 2. Okay, house property loss you have 4 lakhs, PGBP income you have 3 lakhs, and you do not have any other income. Now guys, first of all, house property loss you have 4 lakhs. First check within the same head, intra head adjustment, any other profit you have. No, there is no other profit from house property. Then you will go to other head of income, that to PGBP income you will go. This is also under optional tax regime only guys, because under default tax regime inter head adjustment also not possible. Guys, PGBP income you have 3 lakh rupees. Can you set off? Of course you can set off, because I told you house property loss you can set off with other head income under optional tax regime, but there is a cap of maximum 2 lakhs you can set off. So out of 4 lakhs, though I have 3 lakhs of profit under PGBP, I will not be eligible to set off total 3 lakhs. Maximum 2 lakhs I will be able to do. PGBP income 3 lakhs less house property loss set off. Maximum 2 lakhs I will be able to set off guys. Taxable PGBP will become 1 lakh. Next sir, out of 4 lakhs, only 2 lakhs I am able to set off. No, what about the rest 2 lakhs? You will carry forward to the next year, because this is optional tax regime. House property loss to be carried forward is 2 lakh rupees, 4 lakhs minus 2 lakhs. One more example I will take. House property 1 profit 3 lakhs, house property 2 loss of 7 lakhs, PGBP profit 5 lakhs. Guys, first of all you will do intra head adjustment with the same house property profit. Total loss you have 7 lakhs, you will be eligible to set off only 3 lakhs, still 4 lakhs loss is pending. Now you will go to other head, which is PGBP profit, but once you set off with other head, maximum 2 lakhs possible. Guys, within the same head there is no limit, how much ever you want you set off, but if you want to set off with other head income, you can set off only maximum 2 lakhs guys. So out of the remaining 4 lakhs of loss, you will be eligible to maximum only 2 lakhs of loss you can set off guys. So house property 1 income 3 lakhs, house property 2 loss, out of this 3 lakhs you are setting off the 3 lakhs of loss here. PGBP income you have 5 lakhs, house property 2 lakhs, maximum 2 lakhs only you will be eligible to set off guys. So balance loss of house property 2 lakhs you will carry forward. Sir, how 2 lakhs sir? 7 lakhs. Out of 7 lakhs of loss, 3 lakhs you set off with house property 1 and 2 lakhs you set off with the PGBP income. So still 2 lakhs is pending. That 2 lakhs you will be carrying forward to the next year. I hope this is clear guys with examples. Now we will go to the next PGBP. Guys, keep in mind one thing. PGBP has 3 kinds of businesses: normal business, speculation business, specified business. So what is a normal business? Whatever business other than speculation business and specified business is a normal business. What is a speculation business? Speculation business means dealing in shares. In the shares, within the same day, you purchased the shares today and you are selling off the shares today itself. That is called the intraday sale of shares. Now think logically guys. Who deals in shares? Rich people only can buy and sell shares. Can a poor person buy and sell shares? Not possible. Only rich people can buy and sell shares. So speculation business, I call it as rich person. Guys, understand the story. I am giving you the hints which will be helpful for you to remember in examination. Guys, normal business means one small kirana store, general store, okay, electricity shop. Normal is a poor person. Shares, who deals with the rich person. So intraday selling of shares is done by rich person, speculation business. Now Who does who does a specified business like 5-star hotel? Remember that section 35 AD, specified business means 5-star hotels, 2-star hotels, 100-bed hospitals and all. That is possible only if you are ultra rich, guys. So I personally categorize business into three things: normal business, speculation business means rich person who deals in shares, intraday trading of shares, and specified business is done by ultra rich. Ultra rich, you Ambani, Adanis, they can only build 5-star hotels, 100-bedded hospitals and all. Yes, this story you remember, you will never get confused in examination, guys. So ultra rich means Ambani, Ratan Tata and Adani. So these are the three kinds of businesses you have on hand. Correct? Now understand. First we will take normal business means poor person, normal provision store person, general store person. This normal business person, if he has a loss, if a normal poor person has a loss, can he set off this loss with any other income? Yes, it is possible. Yes, it is possible. But guys, is a business person greater? Is a business person greater? Employee greater? Business person always great, because self-employed person. Employee is just an employee. Business person only will employ some employee person. Are you getting it? Business person can hire employees. So employee is a small person, business person may be poor but always a big person. So you will be eligible to set off business loss with any head income, but he will never go and ask help from salaried person because he is an employee. So that's why you remember always business loss you can do intra-head adjustment, you can do within the business, you can do, but once you want to do inter-head adjustment, he will ask help from any person, but he will never ask help from a salary person. So guys, a normal business person will will ask help from any other person, but except a salary person, guys. Next, if you still have loss pending in your hand, you will have to carry forward that loss to the next year. Once you carry forward a loss to the next year, I told you already, you will be eligible to claim the loss only with the same head income. You cannot claim with other head income. So, is the intra-head adjustment possible once you carry forward? Yes, any business income you can set off it. Sir, can I set off this normal business loss with the speculation business income? Is it possible, sir? Yes, possible. Okay, one poor person can take help of a rich person? No. Are you getting it? Of course he can take help. And can a poor person take help of ultra rich person? Yes, he can take, because these are all big businessmen. Rich person and ultra rich person or poor person can always go and seek help. So if you have a normal business loss, you will be eligible to set off with rich person profit and ultra rich person profit, because only these two persons can help. No, ultra rich person can help a poor person and a normal rich person also can help a poor person. So if you have a normal business loss, you can set off with any business income, be it a speculation business income or a specified business income, you can set off. But when it comes to the other loss, still loss is pending. Ultra rich person also helped you how much ever he can, and the rich person also helped you, still you have losses. You want to go and set off with other heads income, you will never go to an employee, because ego issues. I am a business person, how can I go and ask a salaried person? So except salary, you can set off business loss with any income in the same year. Once you carry forward, you will be setting off with same head income. Other head income, it is not possible. How many years I can carry forward normal business loss, sir? 8 years only you can carry forward. Sir, do I need to return file my return of income within 8 years, within the due date of filing of return of income? Yes, it is mandatory. If you do not file the return of income within the due date 139(1), you will not be able to carry forward the losses, guys. Next. Now coming to the speculation business, which I told you, rich person. Guys, mind you, rich person is different from ultra rich. I may be rich, I am earning 5 lakhs, 6 lakhs per month. I may be rich, but ultra rich like Ambani, Adani, Tata, they earn thousands of crores, hundreds of crores. They are ultra rich. But speculation business means rich person. Rich person only can do shares trading, no. So intraday trading of shares is nothing but your speculation business. But the poor person is a general stores, provision store is running. He do not have knowledge of this shares and all. So poor person is different from rich person. Both are doing business only. Yes. Now rich person, you think logically, guys. If a rich person has a problem, can he go and ask help from a poor person? Rich person, how can he ask help from a poor person? Poor person, name itself is the poor person. So he will not be eligible to set off with normal business income. Correct? So if you have a speculation business loss, you will not be eligible to set off with a normal business income. Next, can a rich person go and ask help from ultra rich person? He can ask, but ultra rich person, why he will help a rich person? Ultra rich person like Ambani, Adani, they only help poor people. If a rich person go and ask help from ultra rich person will tell, you are already rich. Why should I help you? I will only help a poor person. I will never help rich persons in this country. So so this rich person speculation business do not have any option. He cannot ask help from poor person normal business. He cannot ask help from specified business ultra rich person. He has only one option. Go and ask one more rich person. Means if you have a speculation business loss, you can only set off with speculation business income. Are you getting it? So intra-head adjustment also not possible in speculation business loss, guys. Sir, can I go and ask other person? Guys, within your family only, no one is ready to help you. How will you expect help from outsider? So your family members itself is not helping you. You cannot expect help from others. Means you cannot expect help from salary, house property, and capital gains and IFOS. Like this story you remember, you will never forget, guys. Now, sir, if I do not have any other rich person also to help me, what can I do with my loss? Carry forward to the next year. But in next year also, only another rich person can help you. Poor person, you cannot take help because he is already poor. Ultra rich, even if you want to take help, ultra rich will never help a rich person. Ultra rich only helps a poor person. So only one option you have. Check for other rich person. Means if you have a speculation loss, you can only set off with other speculation income, guys. Yes. Next, sir, can I take help of others? No. Within family itself, you are not getting help. Who will outsider help you? Not possible. Sir, how many years I can carry forward this loss? You can carry forward for 4 assessment years only. Sir, do I need to file return of income within the due date? Yes, you need to file return of income within the due date. Now, coming to specified business, I told you who is a specified business. Section 35AD. Recall 35AD. Big 5-star hotels who can build or construct, or who can build a 100% 100 beds hospital. Ultra rich people like Ambani, Adani only. So whenever you will read specified business laws, you will recall or you will you will remember like Ambanis and Adanis. Now guys, imagine if Ambani or Ratan Tata or Adani is in losses. Okay, they want help. Now they want help. Losses they have. Can they go and ask help of poor person? Not possible. Can they go and ask a normal rich person? No, not possible. Who can they can ask? If Ambani has a loss, he can go and ask Adani or Ratan Tata. Means ultra rich person only can help another ultra rich person. So if ultra rich person, one specified business loss is there, if a specified business has a loss, it can only set off with a specified business profit. It cannot set off with any other thing. So only, yes, it is possible, only from specified business you can set off. Sir, can I check with others? No. With only ultra rich persons only you will check. You will not take help from others. If you have still loss pending with you, you will carry forward to the next year, and in next year also you will seek help from ultra rich person only. Only from specified business profit you will be eligible to set off, and you will not ask help from others. But you have unlimited years, you can take this benefit of carry forward in this. And yes, return filing is mandatory. Now we will solve some questions practically based on that, but first let's understand this important note. Business loss cannot be set off with a salary income. I told you, ego issues. I am a business person. How can I ask help from my employee? Yes. Now, poor person means normal business can take help from any person. Help means what? Poor person has a loss. He want to set off with other profit. So poor person means normal business person profit. Normal business person has a loss, can take help from any person. No, he can ask a rich person. He can ask ultra rich person. Both will be happily helping if they have a profit. If a rich person has a profit, if ultra rich person has profit, they will help a poor person, no problem. Rich person never ask help from poor person, ego issues, correct? So rich person means who? Speculation business. If you have a loss, this person will never go and ask help from normal business profit. He will not be eligible to set off. Rich person, again speculation business loss, takes help from other rich person only. He cannot take even a help from ultra rich specified business profit, because that specified business person, Ambani Adani says that we will only help poor persons in the country. We will never help the normal rich guys in this country. So rich person do not ask help from unknown persons also, because within the family itself this rich person is not getting help. How can he expect help from house property, capital gains and other persons? So unknown persons means other heads income. It is not possible. Are you getting it? Next, ultra rich persons helps poor people only. So I told you already, ultra rich persons means Ambanis, Adanis. Ambanis and Adanis can help only poor people. Now, building a hospital with minimum 100 beds and all. Who does? Ultra rich persons under specified businesses. They only help poor people. Ultra rich person do not help rich people because they are already rich. Why to help them? Ultra rich person takes help from ultra rich person only. Ambani takes help from Adani only. Ultra rich do not ask help from unknown persons. Okay, because they take help from big shots only. Next, we will take some practical examples. PGBP normal and speculation loss we will check first. Example 1. This is example 1. Focus on this. General shop means what? Poor person has a 5 lakhs of profit. Okay, poor person has a profit. Speculation means rich person. Rich person has a loss. Guys, why can't a rich person also has a loss? Possible? No. This year I am rich, but this year I incurred loss. Possible? Yes. So speculation business has a loss. Now think logically. The logic which I told you apply here. Rich person has a problem. Rich person, will he go to poor person to ask help? No. He will never. Ego issue will come here. Poor person has a profit, no problem. But rich person has ego. No, he can never ask help from a poor person. So here set off is not possible. So gross total income will this 5 lakhs as it is, and the speculation loss you need to simply carry forward to the next year, because set off is not possible because of ego issues. Next, this is example 2, not year 2. Don't get confused. This is not year 2. This is example 2. Another example. General shop means now poor person has a problem, 3 lakhs loss. Speculation means rich person has a profit, 5 lakhs. Guys, if a poor person has a problem, he can go and take help from rich person, ultra rich person also. So this poor person will go and take help from this rich person, and rich person will help. So 5 lakhs of profit is there. You set off this 3 lakhs of loss, 2 lakhs of profit, gross total income will be there. Carry forward of losses will be 0. See, speculation income 5 lakhs. General shop, poor person, loss of 3 lakhs. Gross total income is 2 lakhs. Losses to be carried forward is nil. Next, one more example. Example 3, PGBP, guys. Speculation means rich person has a he traded in 2 shares, Reliance shares and Tata shares. Reliance shares he got 3 lakhs of profit. 2 lakhs of loss from Tata shares means rich person 1, rich person 2, correct? So next, normal business means poor person 1, poor person 2. There are 2 poor persons and 2 rich persons. Guys, first, rich person 1 has a profit of 3 lakhs. Rich person 2 has a loss of 2 lakhs. First, rich person will ask a rich person only. He will not ask poor person, and he cannot ask ultra rich person, because ultra rich person anyway will not help a rich person. So now now rich person 2 has a loss of 2 lakhs. He can ask help of rich person 1, because rich person 1 has of 3 lakhs of profit. So set off possible? Yes, possible. So this 2 lakhs will get set off with this 3 lakhs of profit. Now 1 lakh speculation business income will be there, on which tax has to be paid. Now general shop means poor person has a profit. Poor person 1 has a profit of 5 lakhs. Poor person 2, normal medical shop, 7 lakhs of loss. Guys, poor person will first ask help with another poor person. So 7 lakhs loss. Poor person 2 will ask help of poor person 1. Is it possible? Yes. 7 lakhs out of 7 lakhs, 5 lakhs is helped by poor person 1, guys. Now still 2 lakhs of loss is there with this poor person 2. Can he ask help of rich person? Yes, yes, yes. Poor person can ask help from rich person. So this rich person can help, but only to the extent of 1 lakh, because already out of 3 lakhs, 2 lakhs is helped to another rich person, 1 lakh only pending. So out of this remaining 2 lakhs, 1 lakh you will be setting off here. So poor person 2, another 1 lakh loss will be there, which is to be carried forward. So gross total income will become 0. Normal business loss of medical shop, 1 lakh will be pending, which has to be carried forward, guys. Next, example number 4. Speculation. Again, rich person 1, rich person 2. Normal business 1, normal business 2. So 2 rich persons, 2 poor persons. Guys, now rich person 1 has a loss, rich person 2 has a profit. Can he ask help from rich person 2? Yes, possible. Out of 3 lakhs of loss, 2 lakhs only possible to set off. Now 1 more lakh loss is there with this rich person. Can he go and ask help from poor person? No. So this 1 lakh of loss will be carried forward, guys. Speculation business loss of carried forward, Reliance shares loss will be carried forward as it is. Now coming to a poor person. Poor person 1 has a profit of 7 lakhs. Poor person 2 has a loss of 5 lakhs. Poor person can take help from another poor person. Total 5 lakhs this person will be eligible to help. So there is no carry forward of poor person 2's loss. Full 5 lakhs will be set off with this 7 lakhs of income. 2 lakhs of gross total income will be there of the poor person 1, that is general shop business income. Next, specified business loss, ultra rich like Ambanis and Adanis. Example 1. Normal business means poor person. Speculation means rich person. 35 AD means ultra rich person. Now guys, poor person has a problem. 5 lakhs loss he has. Speculation means rich person has a profit. He will not ask help from anyone. 35 AD has a profit, no problem. Now, when a poor person has a problem, he can take help from rich person. He can take help from ultra rich person also. First, he will go to rich person. Hey, please help me know. Out of 5 lakhs, 2 lakhs only rich person has a profit. So this rich person will help this poor person to the extent of 2 lakhs. Now still 3 lakhs loss is there with this poor person. He will go to ultra rich person. Ultra rich person has profit of 4 lakhs. But the poor person need help of only 3 lakhs. So ultra rich person will help for 3 lakhs. So there is no carry forward of losses, because out of this 5 lakhs of loss, 2 lakhs already set off with the rich person, 3 lakhs set off with the ultra rich person. So no carry forward of losses. Gross total income will become 1 lakh, which is pending here. Next, example number 2. Normal business, poor person has a profit. Speculation business, 1 lakh of loss. Rich person has a loss. Specified business, ultra rich person also has a loss. Guys, rich person, can he ask help from poor person? Not possible. Rich person, can he ask help from ultra rich person? Not possible, because ultra rich will never help a rich person. Ultra rich person only can help a poor person only. So this 1 lakh he cannot do anything. This rich person has to carry forward. Now ultra rich person also has a loss of 1 lakh 50. Guys, ultra rich person can never ask help from poor person. Ultra rich person can never ask help from rich person, because I told you, if Ambani has some problem, he will go and ask help from Adani or Ratan Tata. He will not go and ask some general Tukda rich person, Tukda poor person. Yes, so he will simply carry forward the loss. So in this case scenario, carry forward of loss is happening. No set off is possible. Next. So this was from the business standpoint, guys. Now let's understand the unabsorbed depreciation, scientific research and family planning, unabsorbed expenditures. Guys, these are expenditures. This is not loss, correct? So unabsorbed depreciation or scientific research or family planning, can I set off with within the same head any income? Yes, under PGBP, any income you have, you set off. Sir, can I set off with other heads? Sir, still pending is there. You can set off, but mind you, this is forming part of business head. You will never ask, business person will never ask help from an employee. So except salary, yes, go ahead and set off with anything. Next, sir, once I carry forward to the next year, unabsorbed depreciation, can I set off within the same head? Yes, possible. Sir, can I set off with other heads? Yes, possible. Except employee, except salary, you set off with anything. Sir, how many years I can carry forward? Infinite years. Do I need to file my return of income within the due date? No. Even if you billate the return, these unabsorbed depreciations you can carry forward to the next years, guys. Now, we will now read short-term capital loss and long-term capital loss. Guys, whenever you read this, remember like this: short-term capital loss is a minor sister. Minor means what? Age less than 18 years. Minor sister she is. And long-term means big brother or father. You can remember like this: short-term means chukku sister, small sister. Long-term means big brother. Okay, sister and brother. Like this you remember. Okay, now small sister if has a problem, this is intra-head, means within the head, within the family member. Small sister, when she has any problem, can she take help from big members in the family? Yes, yes, yes. The sister can take. If the small sister has a problem, there is one more small sister or small brother. One more. See, short-term capital loss is there and there is another short-term capital gain. Can it set off? Yes, possible. Yes, possible. So if a small sister has a problem, another small sister or a small brother is there who can help her. Can she take help from them? Yes, possible. Means short-term capital loss, you can shut off with another short-term capital gain. It is possible. If let's say for example, there is no other short-term capital gain, there is no other small sister or brother, can you take help from big brother? Yes, it is possible. So short-term capital loss, you can set off with the long-term capital gain. Yes, it is possible. But let's say for example, your big brother also do not have money to help you. So if a small sister has a problem, if big brother also not able to help, will you go and ask help from third parties, means other heads of income like PGBP or IFOS or salary or house property? No, no, no. Big brother will tell, wait, sister, don't ask help from others. We are a family members. You want to ask help, you only ask help from a family member. Don't trust outsiders. What if someone kidnap you? Okay, so small sister, you don't go anywhere. Don't ask help with anyone outsiders. Only if a family member is ready to help you, you take help. Otherwise, keep quiet. Okay, so short-term capital loss if you have, means a minor sister if has a problem. If first she will go and ask help from another minor sister or minor brother, short-term capital gain, she will ask help. If a minor sister or minor brother also not able to help, she will go to big brother, which is long-term capital gain. Long-term capital gain, she will ask help and take help. If my major brother also not able to help, she will not ask help from outsiders, guys. So short-term capital loss if you have, you can set off with short-term capital gain and long-term capital gain. But you can never ask help from outsiders. No interhead adjustment possible. Only with long-term capital gain you can do it. Sir, what if still loss is pending? Carry forward of the loss to the next year. Sir, next year can I set off with short-term capital gain? Yes. Next year can I set off with the big brother long-term capital gain? Yes. But you cannot take help from outsider, because outsider will kidnap that small chitku baby. Yes. Next, how many years I can carry forward, sir? 8 years you can carry forward. Is return filing mandatory? Yes, it is mandatory. Now coming to big brother, long-term capital gain. Small sister is small, short-term capital gain. Big brother, long brother. Yes, major brother. Now think logically, guys. If you are a big brother in your family, will you go and ask help from your small sisters and brothers? No, ego issues. So, long-term capital loss if you have, you will not ask even help from short-term capital gain. So, if there is a long-term capital loss, you will not be taking the help of short-term capital gain. So, only with long-term capital gain you will set off. If you have a problem, if you are a major brother, big brother, long-term capital gain, if there is a loss, you will only seek help from another brother or maximum father or mother. Majors only you will ask. You will not ask help from even within the family member, small persons who are there because of ego issues. Whoever are younger than you, you will not ask. Only whoever are elder than you or of your equal age, you will ask help. So long-term capital loss can only set off with long-term capital gain. It cannot set off with short-term capital gain. Now, big brother already put one rule to small sister. I will not ask help from outsiders. So exactly same rule happens for this family. Guys, short-term capital gain, long-term capital gain is one family, guys. Family never ask help from third parties, from outsiders. Whatever problem is there, we will solve it to the best possible in our family only. We will not ask help from outsiders, third party. So long-term capital loss, if still anything is pending, inter-head adjustment not possible. Whatever loss is there, carry forward to the next year, and again in next year also same dialogue. Long brother will never ask help from short, small, minor children in the family. He will only ask help from the majors in the family, which is long-term capital gain only he will be able to set off. No third party helping here. 8 years you can carry forward. Return filing is mandatory. Next. See here, I have written minor sister can take help of major brother. Means minor sister means short-term capital loss. Major brother means long-term capital gain. Major brother means long-term capital loss cannot take help from minor sister. Correct? Ego issues. Next, major brother can take help of another major brother only. Means long-term capital loss can only be set off with long-term capital gain. Major brother cannot take help of minor sister means long-term capital loss cannot be set off with minor sister means short-term capital gain. Family members do not take help of outsiders, but family members can help outsiders. Means if you have a short-term capital gain or a long-term capital gain and other heads has a loss, you can set off, but a family member will not go and take help of outsider, guys. Next, I'll take examples, last examples this is, then we will wrap it in 5 minutes. Capital losses examples. Short-term capital gain, small sister has a problem because loss. Big brother has the capacity to help, 2 lakhs. There is outsider PGBP 5 lakhs. Now guys, small sister has a problem, 3 lakhs loss. But big brother can only help to the extent of 2 lakhs. So first sister will come and take help of big brother up to the extent of 2 lakhs. But the sister still has a problem of 1 lakh rupee because out of 3 lakhs only 2 lakhs only big brother help. 1 lakh still problem is there. But there is an outsider who can help. But big brother and sister decided whatever problem we have, we will solve it within the family. We will never take help of outsider. So no set off will happen with PGBP, guys. So 1 lakh whatever small sister loss is there, that will be carried forward. Gross total income will be this PGBP income of 5 lakh rupees. Short term capital gain loss of carry forward is 1 lakh rupees. Next. Again, small sister has a problem, 3 lakh rupees. Big brother has the capacity to help for 6 lakh rupees. Then one poor person is there, normal business. Understand, poor person, I told you, poor person can take help of anyone. Yes, so 2 lakhs loss is there with the poor person. So first sister will go to big brother. Big brother has lot of money. So out of this 3 lakhs of loss, 6 lakhs you can aram se set off. So another 3 lakhs of profit is there with the big brother. Now this poor person came to this big brother. Big brother can help outsiders, but big brother will never take a help of outsiders. Yes, so this 2 lakhs will be set off with this 6 lakhs also. So 3 lakhs and 2 lakhs if you set off, out of 6 lakhs already you set off 5 lakhs of losses. So 1 lakh is your gross total income. There is no carry forward of loss because full losses already set off here. Next, short term capital gain means sister has a profit, small sister has a profit, big brother has a problem now, and a poor person is there, one poor person is there, 1 lakh. Guys, I told you, family member will not take help from outsider, but a family member can help outsider, correct? Now sister has a problem, big brother sister has profits, big brother has a problem. I told you, ego issues. Big brother only takes help from another big brother or a father or mother, big major people only. He will never ask minors, ego issues. So this 3 lakh as it is carry forward. And this big brother will not take help of outsider also, correct? Yes. Next, poor person has a problem, he can take help from this small sister. Yes, because family members can help outsiders, but family members will never take help of outsiders. So this 1 lakh, if it will set off with 5 lakhs, gross total income will become 4 lakhs, and carry forward of loss will become this 3 lakhs of big brother's losses. Okay guys, now owning and maintaining racehorse. Guys, owning and maintaining racehorse business actually started in India by Vijay Mallya. Guys, in Bangalore there is a race course road. First time in India it was started by Vijay Mallya. Do you think Vijay Mallya is a good person? He is a fraud fellow. So government says, what you know, understand this. Owning and maintaining racehorse losses, if you have, you can only set off with the same income. So government told Vijay Mallya, if you have any loss from this owning and maintaining racehorse business, in that case you set off with the same income. You are not eligible to set off with any other income. We do not trust you. So yes, it is possible within the same head, that too with the same income, it is possible. Can you, Vijay Mallya, take help from anyone? No, no one will help him. Yes. Next, so he can carry forward that remaining loss to the next year, but he can set off with the same nature of income, which is owning and maintaining racehorse. He cannot take help from anyone. No one will help him. 4 years only he can carry forward. He is mandatory to file the return of income within the due date. Now, all other incomes means income from other sources. If you have from one source income from other sources loss, if you have other source income, you can set off. Yes, you can set off. Sir, I have other sources loss. Can I set off with other head income, inter head adjustment possible? Yes, but you cannot carry forward income from other sources losses. So not applicable, because there is no carry forward. There is no carry forward concept itself. So there is no concept of return filing within the due date, guys. So this is the crux of the set off and carry forward with adjustments I have told you, guys. Guys, watch this video, guys, multiple times. 2 times you watch at 1.5 speed. I bet you 6 marks laddu in your pocket. Watch this with the same dialogues you remember and go in your examination hall, guys. Trust me, 6 marks you're done. I have already uploaded total income computation question 15 marks in just 1 hour. I have explained how to get that total income computation PGBP 25 adjustments on this YouTube channel. Only you will find it, guys. Go and watch that. Let me know in the comment section, this much of hard work I have put. Let me know in the comment section if you are getting that comfort or not. If you liked it, let me know in the comment section, super sir, I have liked it. If you have not liked it, write in the comment section, no, I hate your teaching. Whatever comments you have, please put it in the comment section. Hit the like button, like button, guys, because I at least deserve a like button, and do share with your friends who is confused in set off and carry forward of losses, guys. Okay, that's all from my end, guys. Do subscribe to my channel if you are new. Okay, take care and bye bye. So income from salaries is one of the biggest chapters in income tax, and a lot of students try to mug up these provisions, but if you try to mug up, you will definitely get confused in examination. We will slowly take the logical side of each and every provision, and we'll try to understand in a very practical manner. If you learn anything practically, you need not mug up anything, and it will flow in your examination also. You will be easily getting these marks. So guys, every year, every attempt, You will see definitely questions are asked from almost every topic in income tax subject. They do not leave any topic as such. So everything is important naturally. Okay. So from salary, you can expect like 4 to 5 marks in your income tax paper. So guys, let's start. So generally, you need to keep in mind one thing. Under salaries head, if you want to tax anything, first there has to be employer-employee relationship. If you receive anything in your employment, everything is taxed under income from salaries head. So any payment made by employer to his employee is fully taxable. So of course, the relationship of employer-employee must exist. Let's say for example, a partner is receiving salary from a partnership firm. Now the partner is receiving salary only. But mind you, partner is not an employee of a partnership firm in which he is a partner. Partner is part owner in that partnership firm. That is why salary received by partner is not taxable under the salaries head. It will be taxable under PGBP head. You got the logic? So relationship of employee-employer must exist. Only if it exists, then only whatever employee receives from an employer during the employment, fully it will be taxable under the salaries head, guys. So we'll take some examples. Commission received by director from a company. See, there are two kinds of directors. If a director is an independent director, he is not an employee in the organization, but an executive director will be employee in the organization. So, if a commission is received by director and provided that if the director is an employee in the employer's organization, in that case, whatever commission received by employee will be taxable in the hands of employee as salary only. But if the director is not an employee, independent director, in that case, commission will not be taxed under salaries head. Got it? Then salary paid to partner by a firm, just now I told you, it is taxable under PGBP because partner is not employee of the organization. Remuneration received by MP MLA, Member of Parliament, Member of Legislative Assembly. This MP MLAs, they are not employees of government. They are people who serve the government. So guys, here mind you, whatever salary or remuneration received by MP or MLA from the government is not taxable under salary because they are not government employees. And sir, any kind of employment is taxable, sir, part-time, full-time, any kind of employment, whatever salary you receive is fully taxable. You may be doing a part-time employment or you may be doing full-time employment. Both the cases, whatever you receive in your employment, salary fully taxable under the salaries head. Let's say, for example, an employee is yet to receive salary from his employer. Let's say, for example, you worked for 1 month. Now, employer is about to give you salary, but beforehand itself, you told your employer, don't give me salary. I want to forgive my salary. You only keep and enjoy. Or you told that you utilize this salary for some other purpose like that to your employer. In that case, will it be taxable? You may argue that, sir, I have not received my salary only and I waived off my salary. In that case, even though you waive off your salary or even if you forego your salary, does not matter. It will be taxed in your hands because why a salary is being paid? Because you worked as an employee for the previous month. And that's why it says once salary accrues, salary accrued, subsequent waiver does not exempt it from tax. You have to pay tax on it. And one more thing, keep in mind. Lot of times employer pay tax on salary income. Let's say, for example, your employer told that whatever salary I am paying you, on that tax, whatever is coming, that tax also I will pay to the government on behalf of you. Even that is a benefit flowing from the employer to you. So even that tax will be taxable in the hands of employee. Guys, one logic keep in mind whenever you read salary chapter. One logic you keep in mind. Anything your employer will give you benefit, be it in the form of salary or any kind of benefit, any kind of money, any kind of benefit, whichever is flowing from the employer to you, everything is treated as salary under this head. Everything is taxable. Everything is taxable. Nothing they will leave unless specifically if they have mentioned that particular thing is exempt or deductions you will get. Got it? Next. Tax paid by employer on non-monetary perquisite. Again, mind you, here this is specifically mentioned that this will be exempt in the hands of employee. So if specifically they have mentioned, that's a different thing. But generally keep in mind, any kind of benefit flowing from the employer to the employee, fully it is taxable. But keep in mind, if any tax is paid by the employer on non-monetary perquisites, that is only exempt. But employer, if he pay tax on the salary income, that will be totally taxable in the hands of employee. Surrender of salary under government scheme. Earlier, not now, or sometimes it may come, that government is requesting the government employees to surrender their salary. Let's say, for example, COVID kind of a situation came, and the government is saying, whoever government employees are there, if they surrender 1 month of their salary for the betterment of society, we will not tax that salary. So that will be totally exempt. Now, sir, when should we pay tax on the salary income, sir? See, generally, salary is taxable either on due basis or receipt basis, whichever is earlier. What is due? What is receipt? Due means 1 month you served in your organization, employer's organization. As soon as the 1 month will get over, the salary is due to you. But receipt basis means what? Before even due, you received it. Or after it got due, you are receiving that. That is called receipt basis. Whenever you are receiving it, that is called received. Due means you served in that organization for 1 month. Now the salary has accrued or due. You are yet to receive that. That is called due. So even if you receive any salary in advance, that is also taxable, because due or receipt, whichever is earlier, it has to be taxed. So you received earlier itself, then you have to pay tax on that salary. Or due basis means the salary is due now, but the employer will pay you in future. Even then, you have to pay tax now itself on that salary. So advance salary means salary which you received in advance. Let's say, for example, you requested your employer, sir, next year's salary also please give me now itself, sir. I'm in an emergency need of funds. So your employer gave you that advance salary to you. Though that for that salary, have you worked for next year? No, you will be working later in the next year. But you received the salary earlier itself. So due basis or receipt basis, whichever is earlier, based on that, if you look at it, you received the salary earlier, so you have to pay tax on that, even though that salary belongs to future year. Arrears of salary. Lot of times what happens, your salary may undergo a revision. Say for example, you joined the organization 6 months back. Your 6 months performance is so good that, or 6 months or 2 years, let's say for example, 2 years salary, it has been 2 years since you joined your employment. In this past 2 years, you worked or performed so well that your employer is fully impressed and he thought that you should have paid more salary. But they are paying you less salary. So the employer told, okay, from today onwards, I am increasing your salary by 10,000. But mind you, for the last 2 years, what you worked, we underpaid you. For that 2 years also, we will pay you now. Extra 10,000 for the last 2 years, I will pay you today. That is called arrears of salary. If you receive arrears of salary, then of course you have to pay tax, though it belongs to earlier years. So arrears of salary was already taxed on due basis in earlier year, then same cannot be taxed again when it is paid. So if arrears of salary already is taxed in the earlier year, not taxable in this year. But if the arrears of salary was not taxed in the earlier years, then it will be taxed in the year in which it is paid to the employee. Advance against salary. Guys, always remember, advance salary is different from advance against salary. Advance salary means in advance you are taking salary. Means next year salary, give it to me, sir, now. That is called advance salary. Advance against salary means you are telling to your employer that you give me some loan and you keep deducting from my salary later. That is called advance against salary. Nothing but a loan against salary. So you will take one bulk amount as loan or advance from your employer, and you are instructing your employer that you please deduct the loan amount from my salary every month. That is called advanced against salary. Mind you, advance against salary is not taxable in the hands of employee because it is not salary. It is a loan which you are taking. Now, method of computation of salary. Lot of times students think that salary means very simple. How much monthly salary we are getting is the salary. I'll multiply with 12 months and I will calculate tax on that. It is not as simple as that, because salary has lot of components in it. You will find basic salary, dearness allowance, commission, bonus, like this. Many things are there in salary, and not that whatever you will receive fully taxable. No. Once you receive it, you will check whether you are eligible for exemptions or deductions, and you will remove those exemptions and deductions from that. And there is a method given how to compute the taxable salary. So you'll add all these components that will give you gross salary. From that you will get deductions, and net salary you will arrive at that net salary is actually taxable under the salaries head. Now we will be discussing all these components, each single item wise in detail. First thing is basic salary. If you take any pay slip, there will be basic salary. Generally, what salary is actually payable to you. To that, they will add all other components like bonus, commission, and all. So, basic salary is always fully taxable, guys. When we say salary, you know what? Wages also included. Wages is generally, there are two kinds of jobs, blue collared and white collared jobs. Blue collared means, laborers, like that, laborers. White collar job means professionals. So even wages are considered as salary only. Got it? Dearness allowance. Guys, generally dearness allowance is paid in order to compensate the inflation in the expenditures in the country. So to the employee, to compensate the inflation, dearness allowance is paid. Dearness allowance, there are actually two types. Dearness allowance in terms, dearness allowance not in terms. In examination, or a lot of places you will find DA in terms, DA not in terms. If it is written like this, it means DA not in terms. If it is written like this, it is called DA in terms. Are you getting it? Or you can say DA full. DA full means both in terms and not in terms. But generally, just keep in mind, if like this, if it is written DA in bracket T, it is written, that means DA in terms. Yes. So there are two kinds of DNS allowance, in terms, not in terms. What is in terms, sir? What is not in terms, sir? In terms means that a DNS allowance is eligible for forming part of retirement benefit calculations. You know what are retirement benefits? Gratuity, you have pension, leave encashment, lot of things. So if dearness allowance in terms, it says, it means that a dearness allowance can form part of retirement benefit calculation. Sir, lot of times in question, the question is silent. Means in the question it will just tell dearness allowance. That's all. It will not tell specifically whether that dearness allowance is forming part of retirement benefits or not. In that case, what we should do? In that case, always treat that dearness allowance is not in terms. If the question is silent about the type of DNS allowance, always treat the DNS allowance is not in terms or not forming part of retirement benefit. Next one is commission. See, commission, there are two kinds of commission. One is turnover commission, the other is other commissions. Turnover commission means based on turnover. In question, they will tell turnover of the organization is so and so rupees, and they'll give percentage of commission. Percentage commission, they'll give 5% commission, 10% commission, 1% commission. If they give this kind of percentages, always apply on turnover of the employer, turnover of the employer. So there may be two kinds of commissions. It can be fixed commission. Fixed means they'll give you 15,000 commission or 2 lakhs commission. This is fixed, and this is percentage turnover commission. If it is given as a percentage, it is percentage turnover commission. This is called fixed commission. Okay, so commission is fully taxable, guys. Remember always, commission is fully taxable. Next is bonus. Bonus also fully taxable. Yearly bonus, quarterly bonus, whatever bonus is there, fully taxable. Now comes the allowances. Guys, employees are given monthly fixed amounts by the employer. So employer will give monthly fixed amount. Say, for example, the employer will tell, okay, you buy some uniform, I'll give you this much of amount. Now it is up to you whether you will buy the uniform at a lesser price or higher price, does not matter. He'll give you uniform allowance. Allowance means fixed installments or fixed amounts paid by the employer to the employee. One fixed amount they'll give you. That's all. You might have spent more than that or less than that. Let's say, for example, children education allowance is given here. The employer will give you one fixed amount. Out of that, you might have spent total amount, or you might have spent less amount, or you might have spent more amount. Let's say, for example, employer will give you 1000 rupees per month as children education allowance for your children. You have one child. 1000 rupees per month means per annum it is 12,000 rupees. But you might have fees, you might have paid fees of 1 lakh rupees for your child, or you might have not even sent your child to school. Does not matter. But fixed amount will be paid by the employer. He will not check how much you actually spent for that expenditure. So that is called as allowance. Whenever you receive allowance, generally it is fully taxable in the hands of employee. But there are some exemptions or allowances, exemption of allowances given under this table. So if you receive any of these allowances, from the amount whatever you received from your employer, these amounts will be totally exempt. First, children education allowance, maximum 100 rupees per month per child, maximum 2 child. Let's say, for example, your employer is giving you 1000 rupees per month as education allowance for your children. So per month it will become how much? 12 months means that will become 12,000 rupees total. 12,000 rupees you received. You received 12,000 from the employer. That is fully taxable. But out of the 12,000, you can take actually deduction, or you can say exemption. How much is exempt, sir? Maximum 100 rupees per month per child, maximum 2 child. Let's say, for example, you have 2 child. Now, out of 12,000 which you received from your employer, you will take less exemption. 100 rupees per month into 12 months into 2 child you will do. That will come how much? 100 into 12 into 2, that will become 2,400. So out of 12,000 which you received from your employer, 2,400 will be exempt from your hands. You need not pay tax on that. So if I remove that, only 9,600 is taxable in the hands of employee. Like this, we calculate the exemption part. Actual amount received from employer less the exemption which is mentioned in this tables. If you receive children hostel allowance, in that case, maximum 300 per child per month, maximum 2 childs will be totally exempt from the actual amount which is received from the employer. Likewise, a transport allowance. Transport means what? Transport generally means from your residence to your work location if you transport. That is called transport allowance. Mind you, transport allowance is exempt only in case of blind, deaf, handicapped and dumb employee only. And that too maximum 300 rupees, 3,200 rupees per month it is exempt. If you are a normal employee, you are not blind, deaf, something like that, in that case you will not get this exemption. It will be fully taxable in the hands of employee. Underground allowance for mines. You know, a lot of times big mines will be there. In Kolar, there are big mines, gold mines. In that mines, if an employee works and if the company gives extra allowance for working in the underground areas, in that case, the employer may give you some extra amount as an allowance. From that maximum 800 rupees per month, you can claim it as exemption. Tribal area allowance. If you work in some tribal area, in that case, from whatever amount you are receiving for as a allowance, tribal area allowance, from that 200 rupees per month, you can claim it as exemption. Allowance to employees of transport entity. Transport entity means if a organization, if the employer's business itself is a transport business and you are getting any benefit out of that, in that case 70% of allowance or 10,000 rupees per month, whichever is lower, you can claim it as exemption. Next one is house rent allowance. Employer will tell, I will pay you monthly this much of fixed amount which you can use for your rental purpose. You may be, see, employee may be staying in rental house. Now employer is telling that from my pocket I'll give you 10,000 rupees per month. You utilize for your rental expenditure purpose. That is called house rent allowance. This is available under optional tax regime only, guys. This may be asked in your examination. HRA exemption list of the following. So your employer is giving you some house rent allowance every month, but if out of the total amount which you are receiving, that fully is taxable, but out of that, the section 1013A says that least of the following will be given as exemption. Let's say for example you are receiving 1 lakh rupees per month as house rent allowance from your employer. First you will consider that 1 lakh rupees per month as a taxable allowance, from which you will calculate the exemption under 1013A. And you will reduce that amount, exemption amount you will reduce from the total HRA received, and the net amount you will offer it, tax under salary set. If you receive HRA from your employer and if you are working in metro cities, your metro city, you may be thinking in whichever city metro is there, that is a metro city. That is wrong definition. Metro city for HRA purpose is only 4 cities: Delhi, Kolkata, Bombay and Chennai. In Bangalore you will find metro, you will in Pune you will find metro. In Hyderabad also you will find metro, but they are not metro cities for HRA purpose. Only 4 cities. So you are working in any of these 4 cities. You have a house which you have taken on rent. Your employer is paying you something on a monthly basis called as HRA, house rent allowance to you. In that case, whatever paid by employer should be actually taxable in your hands, but from that taxable amount, you can claim exemption under section 1013A. Sir, how much exemption? You will take lower of these 3 things. Lower of 3 things. First, you will take actual HRA received for relevant period. Sir, what is relevant period? The period for which you took the property on rent. Then you will take rent paid minus 10% of salary for relevant period and 50% of salary for relevant period. If it is other cities apart from these metro cities, one small change, that's all. Whole provision remains the same. Just remember, this 50% will become 40% here. And one more thing you need to keep in mind for examination, this salary, whatever is there, that salary means basic salary plus dearness allowance in terms and commission as a fixed percentage of turnover. Mind you, very, very important point I am going to tell you. In examination question, if the question says commission equals 10,000 rupees, then that commission will not be forming part of this definition of salary, because this is fixed commission. This is not percentage turnover commission, because in the formula it says commission as a fixed percentage of turnover. And the dearness allowance also, be very, very careful. If the question simply says dearness allowance 1 lakh rupees, we will not consider this 1 lakh rupees dearness allowance here for the purpose of salary definition, because this dearness allowance is silent. If the question says out of this dearness allowance of 1 lakh, 60,000 forms part of retirement benefits, then we will take 60,000 here, only forming part of retirement benefits, because here in the formula it says DA in terms only, mind you. DA in terms it says, so we have to take only that DA which forms part of retirement benefits. So we'll compare whichever is lower, that we will reduce from the actual HRA received from the employer. The net amount will be taxable in the hands of employee under the salary set. Then there are some common allowances. Traveling or tool allowance. Guys, traveling, transport and conveyance. Don't get confusion. Transport means from your house till workplace. From workplace till your house. That is called transport. Travel means out of station. You are going some other state, some other place apart from your workstation, workplace. Conveyance means from your workplace to your client place. From your client place to your workplace. Don't get confused. So for travel, tour, conveyance, uniform, daily allowance, helper allowance, research allowance, for these, exemption will be based on actual amount what you spend. Say for example, you are receiving 1 lakh from your employer for any of these allowances. You spent 60,000 only, then 60,000 will be exempt, 40,000 will be taxable. You received 1 lakh from your employer, you spent 1 lakh 20,000 rupees. In that case, you received only 1 lakh only, that 1 lakh will be totally spent. Totally will be exempt. All other allowance fully taxable, guys. Fully taxable. Next, conveyance, daily traveling transport allowances or transfer allowances are exempt under both the tax regimes. Transport allowance for handicapped is exempt under both the tax regimes, but HRA only under optional taxes. So under these allowances, there are some specific allowances tax exempt under both the tax regimes, and HRA is exempt only under optional tax regime. Now comes the next one, which is pension. Guys, pension, we all know what is pension. Pension generally means once you retire from your employment, you will get a amount because you served for so many years in organization. Now once you retire, you would have some expenses, rental expenses, food expenses. You became old now. So your employer will pay you something called as pension. Pension, there are two kinds of pension, guys. Commuted pension, uncommuted pension. Commuted pension means you are taking bulk amount. Uncommuted pension means you are taking every month or every quarterly, like that. Installments, you are taking in installments. Pension, if it is a accumulated or commuted pension, always remember, in case of government employees, it is fully exempt. So if a government employee is getting retired, and that government employee is receiving means commuted pension means bulk amount he is taking. Say for example 10 lakhs in bulk he is taking as pension. The pension, you have the choice. Employee has a choice. If he wishes, he can take it monthly basis. He will tell his employer, please don't give me in bulk amount. You give me in monthly, I will come and take, or you will monthly deposit in my bank account. That is called uncommuted pension. But if you tell your employer at the time of retirement, I want full pension now only, full accumulated amount in the lump sum amount I want, that will be fully exempt in the hands of government employees. But commuted pension, if it is received by other employees, in that case, there are two things. You have to check whether you received gratuity or not. If you received gratuity also, now think logically, okay? Think logically. You are receiving pension and you are receiving gratuity also. In that case, exemption will be total pension into 1 by 3. Guys, 1 by 3 means 33.33% it will come, guys. 33.33%. But you are receiving pension and you are not receiving gratuity. In that case, they will give you 50% of exemption. Now, you will think, sir, it is very confusion for examination. How do I remember this? Simple logic, I'll tell you. Guys, you are receiving pension and gratuity also, means you are taking two benefits. Gratuity also you received, pension also you received. Then benefit of exemption will be less. See, when I compare 50% with 33%, it is less only, no? But you are receiving pension, but you are not receiving gratuity, means you should be given more exemption. That's why when compared to 33%, you are getting more exemption. But mind you, one very important point here. Total pension means what, you know? Total pension means commuted pension plus uncommuted pension, both put together will be called as total pension. Okay. Now, in case of uncommuted pension, means you are taking the pension in installments, monthly, quarterly, like that. In that case, it is fully taxable, guys. It is fully taxable. Total pension means commuted plus uncommuted pension. Lot of times in examination, what they will give, commuted pension 60%, 2,40,000 amount they will give. That's all. They will not directly give you total pension amount. But this information they'll provide in your examination question paper. In that case, you have to find out the total pension. How will I find, sir? Very simple. If the commuted means the lump sum amount, if it is 2,40,000 and the percentage is given 60%, very simple. 2,40,000 you divide by 0.6, you will get total pension amount 4 lakhs. That you multiply with 1 by 3 or 1 by 2 depending on your scenario, and you will claim the exemption. So under both the regimes, you will get this exemption, no doubt. Pension received by Param Veer Chakra, Mahavir Chakra, Veer Chakra, these are gallantry awards given by the government. In that case, those people exempt, full pension exempt. In case of death of an individual, pension received by family also shall be exempt. In case of disabled personnel of armed forces also, pension is totally exempt. Now comes the next retirement benefit, which is gratuity. Guys, generally gratuity is paid if you serve with one particular employer for a longer time, generally more than 5 years. If you serve, gratuity is received. Now gratuity also, see, in pension you can only take, or you are eligible for pension, I must say, you are eligible for pension only once you retire. You are eligible. Before retirement, how will you take pension? Pension concept itself is what? After retirement, you would get pension. That is a concept of pension. But gratuity is not like that. Gratuity you may get even before retirement. Are you getting it? Because, say for example, your employer told you, you work for 5 years and I will give you gratuity. Does that mean that after 7 years you are leaving that employment, for example, you are going to some other company? So you worked for 7 years and you are taking that gratuity now. You are not retired. You are just changing the employer. So if you received any gratuity during employment, in that case it is fully taxable. But if you received the gratuity at the time of retirement or at the time of death, your family is receiving the gratuity, in that case, if it is a government employee, fully exempt. So gratuity at the received during employment, it is fully taxable. But gratuity received at the time of retirement or death, in case of government employee, it is fully exempt. And if gratuity is received at the time of retirement or death, in case of other employees, you will have two kind of scenarios. Scenario number 1, POGA employee, non-POGA employee. POGA employee means that employee who is covered under Payment of Gratuity Act. Payment of Gratuity Act is an act which governs the gratuity. If the employee is registered with Payment of Gratuity Act, in that case, whatever gratuity is received at the time of retirement, let's say for example, you are receiving 25 lakhs of gratuity from your employer at the time of retirement. From that 25 lakhs, you can claim little bit as exemption. How will I know, sir, how much exemption? You have to compare lower of these three things. That will be exempt in your hands. Out of 25 lakhs, whatever lower will come here, you will exempt. You will reduce, and on the net amount only we will offer it to tax under the salary schedule. So in case of POGA employee, lower of these three things we will take. Number 1, 15 by 26 into salary per month into number of years of completion of service. Guys, why 15 by 26 is taken? Actually, 15 by 30 should be there, no? 4 days, 4 Sundays they are leaving as holiday. So 15 means average they want to take. So 15 by 30 it should be taken, but because of 4 weeks weekends. So they have removed 4 days, which has become 15 by 26. Into salary per month you will take and number of years of completion of service. Means how many years you completed your service, that you will multiply. But mind you, rounding off is allowed here. Sir, what is rounding off? Let's say for example, you worked for 20 years, 9 months. There is a partial year which you worked, that can be rounded off. That is called rounding off allowed. And actual gratuity received, how much in our example? 25 lakhs. And maximum 20 lakhs means 20 lakhs. These three you will take and compare, whichever is lower will come, that we will be exempting from the actual gratuity received. If you are not a POGA employee, non-POGA employee, you are not registered under the POGA Act. In that case, you will compare these three things. Number 1 by 2 into average salary per month into number of years of completion of service. Here rounding off is not allowed. I'll teach you rounding off, don't worry. Actual gratuity is received and maximum 20 lakhs, whichever is lower you will take, that will be totally exempt from the actual gratuity received. Now you will think, what is average salary per month, sir? Here only salary per month is given. Average salary per month means the immediate last 10 months salary you will take and average that. That is called average salary per month. Now, whenever we read this salary here, the definition of salary is given here. The definition of salary is here. For a POGA employee, the salary means last drawn basic salary plus a DA both. DA both means DA in terms, DA not in terms, both we have to consider. In case of a non-POGA employee, I told you last 10 months average salary you have to take. But salary here means basic salary plus a DA in terms plus a percentage turnover as commission. These three you will take last 10 months, and you will average the last 10 months here. Mind you, you have to take the last 10 months. Don't include the retirement month here. Before retirement, whatever 10 months are there, that you will consider. Now, I'll teach you what rounding off actually means. Here it says rounding off allowed. Here it says rounding off not allowed. Rounding off allowed means if it is more than 6 months, you round off to the next year. If it is 6 months or less than that, you round off to the earlier number of years. But rounding off not allowed means, even let's say for example, it is 20 years, 11 months. Still you will not do it 21. You will keep it 20 years only. We will take some examples. 25 years, this is under POGA employee, guys. 25 years, 6 months. Is it exceeding 6? No. So we will treat it as 25 only. 25 years is 7 months. More than 6 months happened in the partial year. So 25 plus 1 year we will add it as 26. 25 years, 3 months. Again less than 6 months. So we will treat it as 25 only. That is how you do rounding off for gratuity purpose. If you are a non-POGA employee, rounding off not allowed. So not allowed means 25 years 6 months also 25, 25 years 7 months also 25, 25 years 3 months also 25 only. Sir, what if I receive gratuity from more than 2 employers? In that case also this maximum 20 lakhs will remain same. Maximum 20 lakhs you can take exemption. Got it? Next one is leave salary or leave encashment. In your book you might have missed this. Printing mistake is there. This employment word is not there. You please write it with your pencil or pen. Now, what is leave salary? You know, the employer will tell you generally in a year you can take 10 days leave like that. If you don't take leave, I will convert that leave into cash, into salary. Means say for example, 10 days leave is given to you. You took only 4 days leave. 6 days you worked even on a holiday. So the employer will pay you for the 6 days salary. That is called leave encashment. Encashment means you are converting that leave into cash. That is called leave encashment or leave salary. If you received this leave encashment or leave salary during the employment, then it is fully taxable. During employment, if you take, it is fully taxable. But if you received on retirement, guys, then in that case, in case of government employee, it is fully exempt. And in case of other than government employee means private employers, you will compare these four things, whichever is lower will be exempt. Number one, actual leave salary received you will take. Then 10 months into average salary per month. Guys, mind you here, average salary per month is exactly the same as this non-POGA employee calculation. Ditto same. In regular batch, we have taken examples and we have done all this. Correct? So leave credit into average salary per month. Now guys, here leave credit you always have to do in number of months. See here, leave credit in number of months. Got it? Leave allowed minus leave taken will be called as leave credit, and you have to take maximum 30 days only for every completed year. Means the leave allowed, let's say for example, your employer allowed 45 days of leave per year, but still you will take only 30 days. You will not consider 45 days. So number of years you will take and leave allowed. First, how many days of leave is allowed in a year into number of years which you served, that will give you leave allowed, minus you will take leave taken. How many leaves you have actually utilized. The net balance will be called as leave credit. You will get in number of days actually. Let's say for example, you worked for 20 years in one organization. Per month they have, per year they have given 20 days of leave. So how many total it will become? 400 days of leave you will get. Actual leave allowed is 400 days of leave allowed. From that you have to remove how many days you actually taken leave. Let's say for example, you took 120 days of leave actually. Leave availed, leave taken is 120. Now how much it will be? 400 minus 120 will be 280 days. 280. One second. Yeah, one second. I'll take one more example. Just I'll change this because it will create a confusion otherwise. 360 minus 100. Yeah. Okay. 120 I'll take. So 240 days you will get. 240 days. 360 you got. Let's say for example, this is 18. 360 divided by 20. This is 18 days. So in a year, the employer is giving you 18 days of leave. For 20 years you worked. So total leave allowed is 360 days minus 120 days you actually leave taken. So 240 days of credit of leave is available. Now 240 days leave you will divide by 30 days per month, you will get 8 months. That is called as leave credit, which you will use here 8 months into average salary per month. And maximum 25 lakhs, whichever is lower you will take, and you will actually calculate the exemption which is available under leave credit or leave encashment. See here, average salary per month shall be sum of the following. So this is the calculation exactly same in case of non-POGA employee also. Got it? Next. Next one is Provident Fund, guys. Next one is Provident Fund. Guys, just give me a second. Now, what is Provident Fund? I'll teach you. See, Provident Fund is kind of a account, guys. This is a account. There are two parties, employer, other is employee. Employee also will contribute, employer will also contribute. Employee will contribute from his salary, employer will contribute from his business income. So they will deposit the amount, that is called PF contribution. Employer contribution, employee contribution. Once they deposit the amount in this account, Provident Fund account, interest will be paid both on employer contribution and employee contribution. So 4 components will be there in this provident fund account. 4 components will be there. Number 1, employee contribution, then employer contribution. These two, and another 2 are interest on employee contribution, interest on employer contribution. Guys, if you deposit any amount in your bank account, you will get interest. No, exactly the same way on the employer contribution and employees contribution, the provident fund company or the provident fund will actually pay you interest. So you will get interest on 2 components, interest on employee contribution, interest on employer contribution. So employee contribution will be there, interest on employee contribution will be there, employer contribution will be there, interest on employer contribution will also be there. Now, there are actually 4 kinds of provident funds, and we will see the tax treatment of these 4 funds. Slowly we will check. First one, recognized provident fund. Guys, this provident fund is recognized by Commissioner of Income Tax. Unrecognized provident fund, the name itself says it is not recognized by the government, not recognized by the Commissioner of Income Tax. Statutory provident fund is actually a government provident fund for the benefit of government employees. Public provident fund, it is not only for employees, it is for employees and the non-employees also. Self-employed also can easily come and participate in this public provident fund. The name itself says for everyone in the public. You may be employee, you may be non-employee, you may be self-employed, you may be businessman, you may be pensioner, anyone can participate in this public provident fund. Now, first thing we will discuss, recognized provident fund. Guys, the name itself says it is recognized. Means government is fine if you deposit in this kind of recognized provident fund. First, employer's contribution. If you know the concept which I taught you in the regular class, in employer contribution, what will happen? How much ever employee contributes, equal amount employer will also contribute from his pocket for the employee. Now, if employer contribute more than 12% of salary, in that case, exempt up to 12% of salary in the hands of employee. Let's say, for example, employer contributed 16% of a salary in the provident fund in this year. In that case, up to 12% is exempt, 4% is taxable in the hands of employee. Employee's contribution, guys, you know very well, employee, if he contribute anything in the recognized provident fund, he is eligible for deduction under 80C. If you open 80C section, you will see recognized provident fund if you contribute any amount, you will get deduction under 80C. But mind you, 80C is eligible only under optional tax regime. So employer contribution up to 12% is exempt in the hands of employee. I told you at the beginning, the logic is very simple. Any kind of benefit flowing from the employer to the employee is fully taxable in the hands of employee. But here it says up to 12% of salary, whatever employer contributed, that is totally exempt. Say for example, employer contributed 20% of salary in the provident fund. Employer contribution is 20% of salary. Then up to 12% is exempt, 8% is taxable in the hands of employee. 12% is exempt. Now, employee will also make his own contribution into the fund. I just now showed you here. See, employee also will contribute. This employee contribution is eligible for 80C in the hands of employee, but under optional tax regime only. Now, interest on employer contribution. So, whatever employer contributed, on that interest on employer contribution will come. That is also exempt up to 9.5% per annum. Say for example, fund paid 12% interest in this year. Out of 12%, 9.5% is exempt in the hands of employee. Only the balance will be taxable in the hands of employee. Interest paid on employee's contribution also exempt up to 9.5% per annum. And we have to see note below. What is this note? Note. Exemption of interest on employees' contribution to statutory provident fund and recognized provident fund before 1/4/2021, interest was fully exempt. But now the law has changed after 1/4/2021. Interest on, just give me a second. Just give me a second. The screen is freezed, guys. Just give me a second. Just a moment. The law has totally changed after 1/4/2021. Interest on contribution made in excess of 2,50,000 is taxable. But now, amount withdrawn on retirement or termination. So, first employee will contribute, employer also contributes, then interest on both the contribution is coming. But that fund amount ultimately belongs to employee only, no? That amount, if the employee wants to withdraw from the provident fund account, what will be the tax liability? That is given in this table. Guys, simply keep in mind one thing. These are 4 scenarios in which if the employee withdraws the amount from the provident fund account, it is fully exempt. In all other cases, it will be taxable. What are those cases, sir, in which it is exempt if the provident fund amount is withdrawn from the provident fund account by the employee? Taxation of withdrawal of accumulated balance of recognized provident fund account. If employee completed 5 years of service, after completing minimum 5 years of service, if you withdraw the amount from the provident fund account, it is fully exempt. Employee served less than 5 years only, but he is withdrawing the amount due to ill health or discontinuance of employer's business. Or you are withdrawing before 5 years for transferring the account to another recognized provident fund account maintained by the new employer. Let's say, for example, you have switched your company from one company to other. So your previous employer has maintained provident fund account with other fund and the new employer has other fund. So from old fund, you want to transfer the amount to the new fund. In that case, it is absolutely fine. It will not be taxable. And you worked for less than 5 years, but transferred the account amount to NPS account, National Pension Scheme. So from recognized provident fund, you are transferring the amount to National Pension Scheme. In these cases, it will not be taxable. In all other cases, if the employee withdraws the amount, then it will be fully taxable as unrecognized provident fund. So the taxability of unrecognized provident fund we will check now. Okay, unrecognized provident fund means it is not recognized. The government will not be happy. The income tax department will not be happy if you deposit your amount in these unrecognized provident fund. First, employer's contribution, it is fully exempt. Now you will think, sir, if the government is not recognizing the provident fund, then why it is being exempted, sir, here? Don't worry, at the end it will be taxable at the time of withdrawal. And employee's contribution, since it is unrecognized, you will not get deduction under 80C. Interest on employer's contribution also exempt initially. Interest on employee's contribution is also exempt initially. But mind you, at the time of withdrawing the amount, employee's contribution not taxable because here deduction was not given. But interest on employee's contribution taxable under IFOS, and the employer's contribution and interest on employer's contribution will be taxable under the salary set. So simple, guys, under unrecognized provident fund, initially they are exempting, but later on they are taxing. Initially, when you are not got any deduction, at the time of withdrawal it will be totally exempt. Like this logic you remember. Next, statutory provident fund is generally created by the government organization for the government employees. Okay, see, employer contribution also exempt, interest on employer contribution also exempt. Here employee will get 80C deduction and the interest also exempt, but same here also we will check. In case of statutory provident fund and recognized provident fund, employer has not made any contribution, then exemption is as under. So generally these 2 points I already discussed. But if in any of these funds employer has not made any contribution, then simply this will become double. From 2,50,000 this will become 5 lakh rupees. So before 1/4/2021 it was fully exempt, but after 1/4/2021 interest on contribution made in excess of 5 lakhs is taxable, guys. Up to 5 lakhs it will not be taxable if employer has not made any contribution. If employer also made contribution, in that case only up to 2,50,000 it is exempt. Got it? Next, public provident fund. I told you public provident fund, it is not for only for employees. Public provident fund is open for everyone. An employee can solely go and participate in the fund, or even a business person can also participate. Of course, there will be no employer contribution. Intentionally, employee is separately participating in this public provident fund. Employee's contribution eligible for ATC, whether you are a self-employed or employee. Interest on employer contribution, of course, it will not come because there is no employer contribution concept in public provident fund. Interest on employees contribution is fully exempt, and even when you withdraw the amount also it is fully exempt, guys. Next, mind you, here salary for PF purpose, provident fund purpose, will become basic salary, dearness allowance in terms, and commission as a percentage of turnover. Guys, don't worry, at the end of this salary chapter I'll give you the brief of salary definitions. Okay, don't worry. Next, superannuation fund. Superannuation fund, there are two things: approved funds and unapproved funds. In approved fund, there are two kinds of scenarios: during employment or retirement. During employment, if it is a approved fund in which you are participating, in that case employee contribution ETC deduction is allowable under optional tax regime. Employer contribution up to 7,50,000 it is totally exempt. And interest on employee contribution, employer contribution is also exempt because you're doing this during employment. If it is at the time of retirement, lump sum received by employee is fully exempt, guys. Lump sum amount received is fully exempt. Unapproved fund, of course, treatment shall be same as unrecognized provident fund, means it will be taxable as URPF. You see here URPF taxation. So same URPF, in the same manner it will be taxable. Got it? Next, contribution. Taxation of National Pension Scheme. Guys, National Pension Scheme is the latest concept of Indian government. So exactly like Provident Fund, you can also participate in National Pension Scheme. If there is an employer contribution to NPS, then whatever employer is contributing on behalf of employee, of course it should be first taxable as salary in the hands of employee. But out of that amount which you are taxing, you can claim deduction under the chapter 6A. Under 80CCD2, if you remember chapter 6A deductions, which we discussed in regular batch, 80CCD2, employer's contribution. Against that employer's contribution, you can claim the deduction under 80CCD2 under both the tax regimes. But employee's contribution, you will get the deduction under 80CCD1 and 1B. 1B you will get extra 50,000 if you remember. So employee's contribution also you will get, but under optional tax regime only. Likewise, there is 80CCH section, Agnivir Corpus Fund. So whatever government will contribute in the Agnivir Corpus Fund on behalf of that army person or the employee will be treated as a salary first in the hands of employee, but later on the employee will get deduction under 80CCH2 for the employer's contribution and CCH1 for the employee's contribution. Here employer is central government only. Next one is profit in lieu of salary. Guys, profit in lieu of salary means apart from salary. Salary means what? Every month you will work and you will get a certain amount, that is called salary. But this is profit in lieu of salary, means in the place of salary, they are giving you something else. If there is an early termination of employment, let's say for example, you entered into employment contract with your employer where it is mentioned that for 10 years they are hiring you, but after 2 years only they fired you. In that case, their early termination of employment is happening. So you should be compensated for that. That compensation which you will receive from your employer will be treated as profits in lieu of salary and it will be taxable in your hands. Or modification in terms of employment. Let's say for example, initially the employer told that they will make you work only for 8 hours, but they are actually making you work for 10 to 12 hours a day. In that case, they are modifying the contract now. Then whatever extra amount you will receive, that will be treated as profits on lieu of salary. Or key man insurance policy if you receive anything. Are you getting it? And before joining employment or after cessation of employment, if you receive anything from your employer, that is also joining bonus is the best example. Lot of companies, they'll give you joining bonus. Just to join their company, they'll give you 2 lakhs, 5 lakhs as bonus. That is also treated as profits in lieu of salary and fully taxable in the hands of employee. There are two concepts called as retrenchment compensation and voluntary retirement receipts. What is a retrenchment compensation? Lot of times, especially at the time of industrial disputes, or let's say for example, one big some industrial dispute happened. All the laborers have started objecting. Big strike is going on, due to which the total undertaking, the industry is totally shut down. In that case, whatever employees are working in that organization should be paid something called as retrenchment compensation. Compensation paid on transfer of employment or closing down of an undertaking or industry due to industrial disputes. In that case, whatever compensation received by the employee will be treated as retrenchment compensation. It is fully taxable. Out of the taxable amount, you can claim exemption of lower of the following: 15 by 26 into average salary of 3 months into completed number of service, round off is allowed. Exactly the same way what we did in case of gratuity. And 5 lakh rupees, whichever is lower, we will take. In this case, salary will be basic plus DA incomes plus turnover commission. Voluntary retirement receipts. Lot of times, central government will tell we are over staff. Means, say for example, in a particular department, let's say for example, especially post department. Earlier, people used to write a lot of telegram, postcard. Now, who is writing post? Everywhere WhatsApp message is going on. And people are more taking the service of DTDC, Maruti, like this. There are multiple private players in the courier service. Hardly anyone goes to Indian Post. But Indian Post, Indian government already hired so many people in the past. Now staff are more, work is less. So the government is telling or giving an option to the employees, you please retire voluntarily because there is no work in this organization. You retire and do something else in your life. We'll pay you compensation for that. That is called voluntary retirement receipts. So if any employee receives anything, employee receives from the government at the time of voluntary retirement, that is fully taxable and you can claim exemption of the lower of the following. Exemption will be salary per month, 3 months into number of years of service, ignore fraction here. Salary per month into number of remaining months of service, actual salary received or 5 lakhs, whichever is lower you have to take. And mind you, salary here means basic plus DA in terms plus turnover commission you will take. The next concept is perquisites. Guys, you need to understand the difference between allowance and perquisite. Allowance is one fixed amount they will give you every month, irrespective whether you are spending that amount, you are spending more than that or less than that, does not matter. But perquisite is not like that. Perquisite will be given to you whether in cash or kind they'll give you, but only based on the actual expenditure only they'll give you. Lot of times they'll give you one house accommodation to live in, or they'll give you some furniture, they'll give you some motor car. Like this, perquisites are given. So allowance is a fixed amount given every month, but perquisites are based on actual expenditure. The first perquisite which I'm going to discuss is house accommodation. Especially in government employees, government will give you, one colony or one bungalow they'll give for IAS officers and all, IPS officers and all. The house accommodation can be two types. Number one, unfurnished accommodation means there is no furniture, only house they'll give you. Furniture you only have to get. Or furnished accommodation. House also they'll give, furniture also they'll give. So first one is rent-free or concessional rent house accommodation. What is rent-free and what is concessional rent? Rent-free means not even a single rupee of rent will be collected from the employee. Freely house they will give for using. And concessional rent means they will collect, the employer will collect rent from you, but little bit they will collect. Say for example, actually the rent is 10,000 rupees per month, but they are collecting only 2,000 rupees from you. That is called concessional rent. If not even a single rupee is charged, that is called rent-free accommodation. In this house accommodation, there are multiple scenarios or cases. Case 1, the first case is accommodation provided to government employee. Accommodation provided to a government employee. In case of government employee, how to compute the perquisite value in the hands of employee? Of course, who is getting the benefit of rent-free house? Employee. So if employee is getting any kind of benefit from the employer, it should be taxable. So first one, accommodation provided to government employee in case of unfurnished accommodation. Guys, remember one thing. If a furnished accommodation is given, even then, first you will calculate the perquisite value of unfurnished accommodation. To that you will add furniture accommodation, furniture perquisite value. Then it will become totally furnished perquisite. I'll tell you. First you will tell unfurnished. I'll write, wait a second. First you will take unfurnished accommodation perquisite you will take. To that you will add furniture perquisite. Furniture perquisite. The total will become furnished accommodation perquisite. Are you getting it? So first one, in case of unfurnished accommodation, let's say for example, the employer has not given you any furniture, only accommodation, only house is given. License fee determined by central government you will take, less rent actually collected by the employer, that will give you the perquisite of unfurnished accommodation. Guys, think logically, no need to ratify. I totally agree. Salary is very dry, lot of theory is there, but logically if you think, it is very easy actually. Yes. So guys, remember, say for example, employer is giving you, think logically guys, employer is giving you one accommodation which is value 20,000 rupees per month value, actually it is. Rent should be 20,000 per month. But the employer is collecting 4,000 rupees per month from you. Then of course you will reduce from that, no, to check how much benefit you are enjoying. Your benefit enjoying is 16,000 rupees per month, you are enjoying the benefit. So this is the accommodation value provided by the employer. From that you are removing the value of rent which is collected by the employer from you. Then the net will be called as, this 16,000 will be called as taxable perquisite. Same thing guys, everywhere remember this logic. You have to remove the amount which is collected from the employee by the employer. Yes, only the net amount will be treated as perquisite in the hands of employee. So license fee you will take determined by the central government. Then less rent actually paid by employee, that you will remove, that will give you unfurnished accommodation value. In case of unfurnished accommodation, What you will do in case of furnished accommodation, how to find out the perquisite? Very simple. First you find out for unfurnished accommodation. We already found out. To that you will add furniture perquisite. See here, perquisite value of unfurnished accommodation this much, add furniture if it is owned by government this much value you will take 10% per annum of cost of furniture. Think logically, if the furniture is owned by the employer, by the government, and the government is giving you to use that furniture, then the cost of furniture should be forming part of your perquisite value. So 10% of cost is taken as perquisite. If the furniture is owned by the government, if the furniture is hired from a third party by the government, so your employer is hiring the furniture on rent, then whatever rent paid by the employer is actually benefit for you. So higher charges paid by government you will take, less any charges collected from the employee you will reduce. That will give you total perquisite value of furnished accommodation. Next, accommodation provided to non-government employee. Accommodation provided to non-government employee. So in government employee, we have taken license fee, but here we will not see license fee. In case of unfurnished accommodation, always first you will start with that. Accommodation owned by the employer. Say for example, Tata Consultancy Services. TCS is providing one house to you. You are an employee in that organization. In that case, how will you find the perquisite value in case of unfurnished accommodation? Accommodation owned by employer. Let's say for example, the house which is provided by the to the employee is actually owned by TCS only. In that case, it will depend on the population. If the population in the place where the accommodation is provided is up to 15 lakhs only, less populated area, in that case, the perquisite value will be 5% of salary. And if the population is more than 15 lakhs, but up to 40 lakhs, in that case, the perquisite value will be 7.5% of salary. And if the population is more than 40 lakhs, then the perquisite value will be 10% of salary. See, as the population is increasing, the perquisite value is also increasing. And commonly they have reduced rent collected from employee. Everywhere you have to remember one point in common, guys. Rent collected from employee must be reduced. Only then you will get the net benefit which is flowing from the employer to the employee. Accommodation taken on lease or rent by employer. Let's say for example, accommodation in the first scenario was owned by the employer. But here, if the employer itself is taking a house on rent and then giving it to you, in that case, lower of the following will be treated as perquisite value in the hands of employee. Number one, amount actually paid by the employee as a rent, employer as a rent, and 10% of salary, whichever is lower you will take. Actual amount of rent paid by employer and 10% of salary. From that, always reduce rent collected from employee. In case of furnished accommodation, what we will do? First, we will take the perquisite value, whichever we computed here. The perquisite value of unfurnished accommodation. To that, we will add what? Perquisite value of furniture. The total will become perquisite value of furnished accommodation. So, first we will take perquisite value of unfurnished accommodation above whatever we calculated. To that, add again in furniture. Furniture may be owned by employer, or furniture might have been taken on rent by employer and then given to employee. If it is owned by employer, same thing will come, 10% per annum of the cost of furniture you will take. And if the furniture is hired from a third party, in that case, higher charges paid by employer, less any charges collected from employee. Same dialogues will come here. Total perquisite value will become this amount. Furnished accommodation perquisite value. Accommodation, if it is provided in a hotel, lot of times employer will provide you accommodation in a hotel when you join as an employee. So in that case, 24% of salary or actual charges paid to hotel, whichever is lower you will take. From that, if any charges collected from the employee will be reduced, and the net will be taxable as perquisite provided in a hotel, that is taxable in the hands of employee. Hotel accommodation provided by any employer, whether government or non-government, both are covered here. So guys, three scenarios we have seen in case of house accommodation. First one, house accommodation provided by the government as an employer. or house accommodation in case of non-government employees, and house and hotel accommodation. Got it? Next. For these purposes, guys, for this house accommodation purpose, the salary has been defined here. You just look at this table and you just remember this bad CM. Basic salary and bonus. B square means basic salary and bonus. A means allowances all taxable. DNS allowance only in forming part of retirement benefits. DNS allowance in terms. Commission, all commission and monetary items, monetary incomes you have to consider. And exclude these things which are given here. Those things only considered as the salary for the purpose of house accommodation. Lot of times, accommodation provided on account of transfer plus one place to another, especially in case of government employees. If they are transferred from one place to another place, accommodation for temporary basis you will find at both the places. How it will happen? Let's say, for example, one employee is deployed in one place. Let's say, for example, one employee, government employee is already employed in Jaipur. From Jaipur, he is transferred to Delhi, for example. Now, from Jaipur, he has to take all his belongings to Delhi. No. So, for a few days, he has to do packing and all in Jaipur. Then he has to get the goods, all his goods to Delhi. So, for a few days, he can have two houses. So, provided accommodation provided on account of transfer plus one place to another. Accommodation can be provided at new place of posting along with existing place only for maximum 90 days. So, an employee can have maximum 90 days simultaneously two accommodations. If beyond 90 days, if an employee is owning or if the employee is living in more than two accommodations, then both will be taxable. Up to 90 days, only the one accommodation will be taxable. Accommodation can be provided at new place only maximum of 90 days. Value of perquisite shall be lower of perquisite value of both accommodations. If duration exceeds 90 days, the value of perquisite shall be taxable both such accommodations if it is exceeding 90 days. If hotel facility is provided at the time of transfer, maximum 15 days, it is not taxable. But beyond 15 days, if a hotel facility is given, in that case, it will be taxable. And lot of times, guys, accommodation is provided and the employee lives in that accommodation for more than 1 year. Let's say, for example, you got accommodation 5 years back. And since 5 years, you are still living in the same accommodation provided by your employer. In that case, how to find out the perquisite value every year, sir? In that case, value of perquisite, if same accommodation provided for more than one previous year, you have to do indexation. You know indexation in capital gains. Value of perquisite for first year when you got the accommodation, that you will multiply with CII of year of computation, means the CII of the year for which you are doing the computation, and you divide it with CII of the previous year in which you first got the accommodation. Got it? Next. The next perquisite is, the first perquisite which we discussed was house accommodation. The second perquisite is interest free or concessional loan. Interest free or concessional loan. Lot of times employer will give to employee loan at a concessional rate of interest. In that case, let's say, for example, bank is charging 15% rate of interest outside, but your employer gave you, bank is charging 15%, but your employer gave you loan at rate of 8% only. In that case, 7% is benefit for you, that will be taxable in your hands. Mind you, this taxation will happen only if the loan amount is more than 20,000 rupees. So always keep in mind one thing, that the rate of State Bank of India rate will be compared with the actual rate charged by the employer. If any gift is provided by the employer to employee, even that gift is taxable. Gift, if it is provided in cash, fully taxable, guys. But if it is gift is given in kind, in that case, the fair market value of the gift, if it is up to 5,000 rupees, it is not taxable. But if it is more than 5,000 rupees, it is taxable. Next, usage of movable assets. Lot of times, employer will give you movable assets for use purpose. What is a movable asset? Other than immovable property like land and building, whatever other assets are there are movable assets. So if the employer is giving you for usage, guys, he is not transferring on your name, just for usage purpose of movable assets. In that case, if laptop is given, then there is no perquisite value because laptop is given for every employee. But if any other asset is given, like let's say for example TV is given or bike is given for usage, that's all. Once you leave employment, you have to deposit back with the employer. If asset is owned by employer, so let's say for example your employer is owning that asset and then given to you, then 10% per annum of actual cost will be treated as perquisite. From that they will remove whatever amount collected or paid by the employee. If asset is hired by employer and then given to employee, then value of perquisite will be rent paid by employer less amount paid by employee. Then transfer of movable asset. In the first case I told you use of movable asset. But here I am telling transfer means the totally asset is given to employee only. The employer will not take back the asset. In that case, computer and electronic items if it is given, in that case the value of perquisite will be depreciated value of asset. How will I calculate depreciation? Depreciate at 50% of WDV for each completed year of usage. And if it is a motor car which is given to employee, then the value of perquisite will be depreciated value of asset at the rate of 20% on WDV basis. And in any other asset case, the value of perquisite will be depreciated value of asset at the rate of 10%. Mind you, here the method of depreciation is SLM method. And of course, reduce any amount collected from the employee. The next kind of perquisite is employee stock option. Lot of times, employer being a company, it will give one option to the employees to purchase the shares of the employer company. Let's say for example Reliance. Ambani has given option to its employees to purchase the shares of Reliance at a discounted price. Then let's say for example the fair market value of Reliance share is 120, but employee is cost of acquisition is actually 40 rupees only. Means Ambani is telling to its employees the actual price of the share is 120, but we are giving you the share only for 40 rupees like this. In that case, 80 rupees will become taxable perquisite in the hands of employee because this is the benefit. No, 80 rupees benefit is flowing from the Ambani, from the employer to the employee. So taxable amount will be fair market value of share minus issue price. You will get a doubt, sir, fair market value on which date shall I take? You will take on the date on which option is exercised, means when the employee purchased the share, that will be treated as the date on which the fair market value has to be considered. And where from you will take the fair market value? If the share is listed on recognized stock exchange, the fair market value you will take average of opening and closing in that stock market. If the stock is listed in more than one stock exchange, in that case you will take the average in that stock market which had the highest volume of trading in that on the date. If there is no trading happened on the day on which employee exercised the option, in that case you will take fair market value on the closing price on the last trading session. If the shares are not listed, you will take the price which is given by the merchant banker. Now, employer contribution towards recognized provident fund, approved superannuation fund, NPS in excess of 7,50,000. Guys, this provision is very simple. What it says is, if employer contribution to all these three funds put together, if it exceeds 7,50,000, then the excess shall be taxable in the hands of employee as perquisite. Let's say for example, your employee contributed in RPF, SAF and NPS like this. 2 lakhs, 5 lakhs, 3 lakhs. How much is this total? 10 lakhs. This is employer contribution in a year. But the employer should contribute maximum 7,50,000 only, but he contributed more than 7,50,000. So 2,50,000 rupees excess, whatever is there, it is taxable as perquisites in the hands of employee under section 1727. So if an employer contribute in any of these funds or all the three funds put together, recognized provident fund, approved superannuation fund and all, together, if a contribution is made more than 7,50,000 rupees, the excess will be taxable in the hands of employee. Now, annual accretion to the balance in these three funds, guys. If employer will contribute in excess of 7,50,000 in any of these funds, then remember, interest on such excess contribution should be taxable. See, in this account, RPF, SAF, NPS, recognized provident fund, superannuation fund, national pension scheme. If employer contributes more than 7,50,000 rupees, then whatever excess is there, that is taxable under 1727. Now, here in our earlier example, I told you that 2,50,000 is excess contribution, correct? I'll write it here. Excess contribution was 2,50,000 rupees. Now, this 2,50,000 is taxable under 1727. Now, on this 2,50,000 excess, the fund will pay interest, correct? On this 2,50,000, interest will come. So, on that excess amount, whatever income will be generated in the form of interest, even that interest has to be taxed. And that interest will be taxed under 1727B. So, annual accretion means the income which is arised out of that excess contribution which is made by employer. So, annual accretion to the balance in recognized provident fund, national pension scheme or superannuation fund which relates to employer's contribution exceeding 7,50,000 means here you will tax interest on excess contribution. How to calculate? Very simple. This formula is given. TP equals PC by 2 into R plus PC1 plus TP1 into R. Don't worry, this looks like very complicated, but actually this is very, very easy. I'll tell you what it is. TP is the taxable perquisites which we are finding under 1727A. 1727A. TP, this TP is nothing but the taxable perquisite which we are finding. What we are finding? The interest amount which is accrued on the amount of contribution more than 7,50,000 is TP, taxable perquisite. Now, what is PC? You know, PC is this excess contribution of 2,50,000 is called PC. The contribution made more than 7,50,000 in all these three funds is called as PC. So this 2,50,000 will be treated as PC, guys. This 2,50,000 is PC. This 2,50,000 is PC. So PC also we understood. TP means we understood. Now, what is PC1, sir? PC1 is the sum total of all the earlier years PC. The sum total of all the earlier year PC will be called as PC1. And TP1 is the sum total of all the previous year TPs. PC1 and TP1 is nothing but the sum total of the PCs and TPs of the previous years. Like, see, for this year we are calculating TP, no? For this year, if you are calculating TP like this, all the previous years also we would have calculated TPs, no? That total is called TP1. What is PC1? PC is what? PC is what? The excess contribution which we made more than 7,50,000 is called PC. Current year PC is 2,50,000, but in the previous years, all the previous years put together, whatever PCs have come, that total will be called as PC1. Now, what is R, sir? R is nothing but I divided by F average. And here I is nothing but that income which is accrued. I just now told you whatever income will accrue on this 2,50,000 rupees, whatever interest will accrue, we have to consider. So I is nothing but interest which is getting, income which is getting accrued on the excess amount. And average of F is what, the average of the balance which is credited in the recognized provident fund or the national pension scheme, the total balance of opening balance and closing balance average we have to take. So you see here, F average is nothing but average of the opening, first day means opening balance and the last day balance divided by 2. So I repeat guys, very simple it is, don't worry, don't get confused. If you have contributed more than 7,50,000, employer contributed more than 7,50,000 in any of these three funds, the excess will be called as PC. It is taxable under 1727 here. And the income which is generated on this excess will be taxable under the 1727A under, and it is called as TP. TP is nothing but the taxable perquisite, and you have to apply this formula. So you know what is PC, you will divide by 2 into R. R is nothing but I by FAVG. I means the income which is generated. F average means opening plus closing by 2 of means average of opening and closing balance of the fund for which we are calculating this amount. And PC1 and TP1 is the sum total of last year's TCs and TPs. Got it? Next. Tax-free perquisites. There are some perquisites which are totally tax-free. Number 1, telephone, transport facility provided by airlines or railways. Perquisites allowed outside India by the government. If you remember, in residential status, I taught you, if any perquisite is given by the government to the government employees who are deployed outside India, will not be taxable. Employer's contribution to group insurance scheme. Annual premium by employer on personal accident. So, if accident insurance is taken and if any premium is paid by employer on behalf of employee, that is also exempt. Refreshments during working hours means any tea, snacks like that provided. That is also not taxable in the hands of employee. Subsidized lunch. If the employer gives you lunch, up to 50 rupees of lunch, it is fully exempt in your hands. But if a lunch is provided for more than 50 rupees, that is totally taxable. Recreational facilities like club, like that, any new facilities are provided for the employees, club facilities and all, that is totally exempt. Amount spent on training of employees. So your employer has sent you to some institution for training, that is also totally exempt in your hands for whatever training benefit which you got. Some payable by employer to a recognized provident fund or approved superannuation fund up to the limit prescribed. Then leave travel concession. What is leave travel concession? Employer will sponsor your leave travel. You want to go to some tour in India, within India only, you want to go with your family. So when you go on tour with your family, the flight charges are there. Or you want to go by train, then train 3-tier AC, first tier AC like that. Or you want to go by road in bus, in that case luxury bus travel, that whatever travel expenditure is there, if it is paid by employer, that is also exempt in the hands of employee. So travel can include your family also. Family means spouse, children, dependent parents, brothers and sisters. Mind you, children can be maximum 2 only. And the exception is twins in second delivery. In first delivery itself, you had twins. Then third children is not eligible. But in first delivery, you had only one child. In second delivery, you had twins. In that case, all the 3 children are eligible. So journey should be performed. So how many travel sponsors I will get as exemption, sir? Maximum 2 journeys in 4 calendar year you will get. How much exemption I will get, sir? Mind you, this is available under optional tax regime only, and whichever is lower, you will get it as exemption. If you are performing journey by air, maximum limit of exemption is economy fare in flight. if you went by business class, but still you will get exemption up to economy fare only. If you went by rail, then AC first class fare you will get as exemption. If you went by recognized public transport for other than rail, means in bus you are going, in that case first class or deluxe class bus fare is eligible for exemption. Means the fare which is equal to these classes will be exempt. And if there is no public transport existing, in that case to the same amount of distance, how much AC first class rail charges, that will be totally, that to that amount of extent it will be exempt. The next one is medical facility. See, lot of times the employer will provide medical facility either in his own in his own hospital, or he will tell you go get the treatment outside, I'll reimburse you the amount. That is called medical facility. Always remember, if the medical facility is provided in the hospital of employer, or if the employer sponsors the medical facility in case of government hospital, so you got treatment in government hospital and employer reimbursed the amount, that is also exempt. If you are getting treatment in employer's own hospital, let's say for example Ratan Tata has one big hospital and you are an employee of a Tata company, you are getting treatment freely in Tata hospital, then nothing is taxable in your hands. Third one, you are getting treatment in a private hospital but only for specified diseases. If you are getting treatment, then also it is exempt. And if employer pays any premium for health insurance of employee, but that policy should be approved by central government, in these four cases you will not be paying tax on the perquisites. There is no perquisite, it is fully exempt. In all other cases, whatever benefit is flowing to you from the employer, fully it will be taxable. So hospital maintained by employer also exempt. Reimbursement for a government hospital treatment exempt. Private hospital fully taxable, but in private, I told you, in private hospital only prescribed diseases you can get treatment, that is exempt. And COVID-19 treatment, I'll come to it in some time. Premium paid on health insurance approved by central government exempt, and reimbursement of premium of employee or family, it is also exempt. Lot of times there is no treatment in India, you have to go abroad. In that case, what are the expenses covered there? First, you have to go outside, travel expenses are there. Then you have to live somewhere there in a hotel, accommodation is there. Then the treatment is there. Three kind of expenses are available. So travel and stay abroad of one attendant. Why attendant is required? If you are a patient, one attendant is required for you. And medical treatment of employer or family member also covered. So if your employer gives you money for treatment outside India for you or your family member, in that case, how much will be taxable? Now, conditions. Exemption only to the extent of approved by Reserve Bank of India. So your employer gave you 10 lakh rupees, but RBI is allowing only 3 lakh rupees. Then 7 lakhs is taxable in the hands of employee. Travel expense of patient and attendant exempt only if gross total income is up to 8 lakh rupees. So let's say for example, you are an employee for whom the salary or the gross total income is 20 lakh rupees. So your gross total income is 20 lakh rupees. You will not enjoy this exemption. So you will get the exemption only if the employee's gross total income is up to 8 lakh rupees. Even for personal accident premium, if your employer is paying, that is also exempt. Guys, now one more thing. COVID-19 treatment also covered here. If COVID-19 treatment is getting done by the employer, that is also totally exempt. Next. Rent-free official residence to High Court judge, Supreme Court judge and all are also exempt. Perquisite taxable only in hands of specified employees. There are some employees and there are some specific perquisites which are given, which are to be taxed only in hands of specified employees. Who is a specified employee? Director, or an employee who has substantial interest in the company. Substantial interest means having more than 20% of voting power, or an employee whose salary exceeds 4 lakh rupees. These three are covered under specified employees. If any of these employees receive any of these perquisites, in that case, these are taxable in the hands of employee. What are these perquisites? Let's see. First one is motor car facility. The next one is transport facility to employee by transport company itself, or education facility, or free servant gas, electricity, water and supply. First, motor car facility. As in motor car facility, the value of perquisite will depend on who is the owner of car, who is paying the personal, who is paying the reimbursement of the, who is paying the expenses of the car, running and maintenance expenditure, and for what purpose the car is being used. Okay, first you have to read this table like this. These are the three columns which you need to remember. Usage of car by employee, for what purpose the car is being used, and what is the cc of the engine, whether it is up to 1.6 liters cc or the car is more than 1.6 liters cc. If you are using the car which is owned by the employer, if the car is owned by employer, think logically, car is owned by the employer and you are using the car only for office duties. Is there any benefit you are deriving? No. Car is owned by employer, you are using it for office purpose only, so there is no perquisite. But if the car is owned by employer and you are using for personal purpose, then a perquisite will come. And you are using for you are using for personal purpose and car expenses are met by employer, then there is a perquisite. How much perquisite? Expenses reimbursed by employer which you are using for personal purpose. To that you will add salary of driver and normal wear and tear you will add. From that you will reduce amount collected from the employee. Same thing here also will come. But if the car is owned by employer and if the car is partly used for office purpose, partly for personal purpose, so for both purposes if you are using, in that case, if expenses are met by employer, means the running and maintenance expenses are met by employer, in that case 1800 rupees per month will be treated as perquisite in the hands of employee, plus 900 rupees per month will be treated as driver if driver is provided. But if the cc engine is exceeding 1.6 liters, 2400 rupees will come in the place of 1800. If the expenses are met by employee itself, then less perquisite will come. So that's why this 1800 will become 600 rupees here. And this 2400 will become 900. Of course, the 900 rupees of driver or chauffeur salary should be added. Next. Value of perquisite if car is owned by employee and expenses reimbursed by employee. So here the car is owned by employee. If the car is owned by employee and expenses of running and maintenance are reimbursed by the employer. If the vehicle is used only for office purposes, is there any perquisite? No. So there is no perquisite here. But if the car is used partly for personal purposes, partly for office purposes and expenses are reimbursed by the employer, means there is a perquisite. So expenses reimbursed by the employer less 1800 rupees per month, or if the cc of the engine is more than 1.6 liters, you will reduce 2400 rupees per month. Mind you, if driver is provided, plus 900 rupees you have to reduce. That is called motor car facility perquisite. Now, transport facility for employees of transport business. If any free tickets are given, or lot of times for airport, air hostess and for the captain of the crew or the ship, or for airplane, the pilots, the flight company itself will provide transport facility. In that case, that will be fully exempt. For airlines and railway employees only exempt. For all other transport means road transport, for them it is fully taxable. Value of free or concessional education facility. So if any company provides free education to the employees' children, in that case perquisite will come. But there will be no perquisite if it is up to 1000 rupees. If it is more than 1000 rupees, it is fully taxable. And gas, electricity and water, if it is provided, then expenses incurred by employer less amount collected from employee will become perquisite in the hands of employee. Next, once we calculate, if you come here guys, if you come here in the first page, I told you salary means all these things are treated as salary and taxable. From that we can claim some deductions, and once we claim deductions from this gross salary, the net salary will be taxable. Now we will look at the deductions which we can claim from the total gross salary which we will receive. The first deduction, very important for your examination, is standard deduction. Under default tax regime, the standard deduction will be lower of salary income or 75,000, whichever is lower. Under optional tax regime, the standard deduction will be lower of salary income or 50,000 rupees. Then the entertainment allowance. Mind you, entertainment allowance is available only in case of government employees. And the amount of deduction shall be lower of these three things. First, you will take 20% of basic salary, 5,000 rupees, and actual amount received. Whichever is lower will be allowed as deduction as entertainment allowance only in case of government. And the third type of deduction is professional tax. Professional tax, based on actual payment basis, you will claim the deduction. There is no limit to that. And the next concept, which is the last concept, is relief when salary is paid in arrears or in advance. Lot of times employees receives arrears of salary, means last year's salary and all. You will, if you have attended my regular batch, we have taken one big example and we had done that. Arrears of salary means in the previous years the salary was something else, but now in this year the employer is revising your salary on a retrospective basis. From the last years also they are increasing your salary. In that case, there are 7 steps which you need to follow. Because mind you, the salary which you are receiving in this year will be pertaining to some other previous year. But in that previous year, the tax rates are different. You are receiving the salary now, but the tax rates of that particular year should be different. So how will you find out the relief? So government is giving you relief because, say, let's say for example, 2013-14 arrears salary, if you are receiving in 2025-26, now the tax rates are higher now. At the time tax rates were lower. So a relief should be given to employees. How to calculate the relief? Step number 1. Calculate tax payable of the current year of current previous year by including arrears in your total income. So in this year, whatever actual total income is there, to that you add the arrears of the previous year salary. On that you calculate tax. Step number 1. Step number 2, calculate tax payable of the current previous year by excluding arrears. So in this year, whatever income is pertaining to this year, on that you calculate tax, but don't include arrears in that. Step number 2 is that. Step number 3 is very simple. Step 1 minus step 2 you will do. Step number 4 shall be calculate tax of the year to which arrears belong by including arrears. Let's say for example, your salary which you received today, arrears of salary, belongs to 2013-14 year. In 2013-14, you would have some total income apart from the arrears of salary which you are receiving now. So that year's total income you will take. To that you will add arrears and you will calculate tax as per the rates of that year. So calculate tax of the year to which the arrears belong by including arrears in the total income of that previous year. Then step number 5, calculate tax of the year to which arrears belong by excluding arrears in the total income of that year. So 2013-14, you don't include the arrears. Only that years, apart from arrears, whatever other total income is there, on that you calculate tax. So step number 6 will be 4 minus 5. And the last relief you will get under step number 7, subtract step number 3 and step number 6, you will get relief of the arrears of salary which you have received. And that relief you reduce from the tax liability which you are getting in this current year, and on the balance you will have to pay tax. There are some tips given here at the end. You have to go through that personally, guys. Okay, this is the end of salary chapter, guys. Salary is very dry, very theoretical. Small things are there. Unless you do multiple revisions, you will not remember this chapter. Yes, I hope that is clear. Okay, chalo. So guys, return of income is one of the most important chapters in your CA intermediate income tax paper. Why I say this is because almost every attempt, one 4-mark theory question is 100% asked in all the attempts. At the last end of the last question which you get in your income tax paper is from return of income, and you would have a choice also here. So this chapter becomes very important. I will take you through all the concepts of return of income chapter. Okay, so first thing is mandatory filing of return of income. First of all, what is a return of income? Return of income is a paper, is a statement. Nowadays everything is online actually. So you put all the details of your total income, under which head how much you earn income, then you will put all the gross total income, then you will take all the chapter 60 deductions, total income, what is your tax liability, everything, all the details will be provided in a particular form called as income tax return. This income tax return has a different forms, ITR 1, ITR 2, ITR 3, like this. Depending on which ITR is applicable, income tax return is applicable to you, you have to fill the details in that particular return and you have to file it with the government, and you have to pay tax also. So income tax return is nothing but, return of income is nothing but a form in which you put all the details of the income which you earned during a previous year, and you show what are the deductions you have claimed, under which sections you are claiming, and you will also show how much is your tax liability and the details of the taxes which you paid during the year. All these details you will file in a return, in a form. It is called a return of income. Now, who is required to file this return of income is a big question. Mind you guys, companies and firms including LLP are mandatorily required to file the return of income. Mandatory, even they do not have any income, or they do not have any kind of business, or they did not do any kind of business, they do not have any kind of income, they have losses, whatever it can be, company and firm are mandatorily required to file the return of income. But any taxpayer apart from a partnership firm, LLP and company are required to file return of income only if the total income before claiming the chapter 60 deductions and before claiming, you remember capital gains exemption series is there, 54, 54B, D and 54 EC and 54F. If it exceeds the basic exemption limit, only then you are required to file return of income. So I repeat, if you are a company, partnership firm or LLP, you are mandatorily required to file return of income. Mandatory means in any case you have to file return of income. But in case of all taxpayers other than company, firm and LLP, you have to file return of income only if your total income before claiming chapter 60 deductions and before claiming section 54 series capital gain exemptions, if the basic exemption, if the total income exceeds the basic exemption limit, only then you are required to file the return of income mandatory. Now, every resident person other than a resident, not ordinary resident, shall file return of income if such person. So, in these two cases, you are required to file return of income, but there are some certain criteria of people who are mandatorily required to file return of income. If any resident person holds any asset outside India or has any financial interest in any entity outside India or has any signing authority in any account outside India, means either if you have any asset outside India, or you have invested in any company shares, or if you have signing authority in any bank account, or if you are a beneficiary of any asset outside India, in that case also, in these 4 cases also, you are mandatorily required to file the return of income. Now, Persons other than a company and firm not covered in above points also required to file return of income. These are additional people who are required to also file return of income mandatorily. Number one, if you deposited in a year aggregate more than 1 crore rupees in any of the current accounts, then you are required to file return of income. Or you deposited 50 lakhs or more in any of the savings account in a year, or any one or more savings account in a year, in that case also you are required to mandatorily file the return of income. If you went abroad for a foreign travel and you spent more than 2 lakh rupees, in that case also you are required to file return of income mandatory. And if you spent any kind of electricity expenditure, electricity bill you paid per year exceeding 1 lakh rupees, in that case also you are required to file return of income mandatorily. Turnover of business, if you're doing some business and if your business turnover is more than 60 lakhs, or gross receipts from the profession is more than 10 lakh rupees, in that case also you are required to file mandatorily return of income. Or if your TDS TCS someone already deducted more than 25,000 rupees, in that case also you are required to file return of income. If you are a senior citizen, the 25,000 will become 50,000 rupees. So guys, very simple, return of income, these are the cases in which you are required to file return of income. Lot of times in MCQs, case-based scenarios, they may test you on these things. You have to read this chapter without fail, guys. Very, very important chapter. Next one is due date of filing return of income. So when shall I file the return of income, sir? If you are required to get the transfer pricing audit. See, transfer pricing audit is actually, you will learn in your CA final. So if you are required to get a transfer pricing audit, in that case your due date is 30th November of assessment year. What is the previous year and assessment year, you know very well. So for the previous year, whatever incomes you earned, you will file the return of income in assessment year. So 30th November of assessment year is the due date. If you are a company other than the TP audit case, because TP audit case 30th November is given. So if you're a company other than a TP audit case, or you're a person whose books of accounts are audited under any law, or you're a partner of a firm which is liable for audit, if you are any of these cases, then 31st October of assessment year is the due date. So you're a company or you're a partnership firm whose books are required to be audited, tax audited. In that case, 31st October. In all other cases, it is 31st of July. Now, here partner is given. Very simple, guys. If the partnership firm is required to get the books of accounts audited, in that case, the partner of such partnership firm is also, for that partner also, the due date will become 31st of October. And if the partner is governed by Portuguese Civil Code, even that partner is covered here. Got it? Next. Loss return. Guys, you must have read in your set off and carry forward of losses. There are some losses which you cannot carry forward if you did not file the return of income before the due date of filing return of income. So loss return means what? For carry forward of losses below losses, it is mandatory to file return of income on or before the due date. Sir, what are those losses which we cannot carry forward if the return of income is not filed within due date? First one is business loss, speculation loss, specified business 35 AD loss, capital loss, or loss from owning and maintaining race horses. These are the losses you cannot carry forward if the return of income is filed after the due date. It is mandatory to file the return of income before the due date itself. But mind you, house property loss and unabsorbed depreciation, you can carry forward even if the return of income is filed lately. Belated return means, let's say for example, if you missed the deadline of these due dates, still you can file return of income. But up to what date? You can file the return of income maximum before 31st of December of assessment year. So this is called belated. Belated means what? After the due date of filing of return of income, you are filing. Second chance the government is giving. But that due date is 31st of December of assessment year or before completion of assessment, whichever is earlier. But what will happen, side effects of belated return. If you file return of income lately, what are the consequences? You cannot carry forward specified losses, which we just now spoke about. You cannot claim certain deductions like 80JJAA, 80QQB, RRB. You cannot claim 10AA deduction. You have to pay 234A interest if you remember, and 234F late fee also you have to pay. The next one is revised return. Say for example, you filed one return, original return, you made some mistakes in that. You want to revise, you want to rectify the mistake. Then in order to rectify that, you can file a revised return. Sir, can I file, let's say for example, sir, I filed my original return itself belatedly. Can I revise my belated return? Is a doubt. Sir, I am already filed a loss return. Can I rectify that? Can I revise that return also? Yes, you can rectify. Just a second. Excuse. So guys, you can revise original return, belated return, loss return, any return you can revise if you have done some wrong or if you filed some misinformation. And the due date, guys, very surprisingly, the due date of revised return and the due date of belated return both are same. Both are same. Here also the due date is given same 31st of December of assessment year. So before completion of assessment or before 31st of December of assessment year, whichever is earlier, you have to file the revised return. Once you file revised return, it will replace the original return whichever you filed. Sir, how many times can I revise, sir? Let's say for example, first time I revised, sir, there also I did some mistake. Again, I want to revise. Can I do it? Yes, you can revise any number of times, but you have to revise it before 31st of December or before completion of assessment, whichever is earlier. Any number of times you can revise. Then comes a defective return. Let's say for example, while filing return of income, I told you there are different forms, ITR 1, 2, like this, different forms are there. You are actually required to file return of income under ITR 1, for example. But by mistake, you filed in ITR 2. Is it correct? No, it is a defective return. Or let's say, for example, you forgot to attach a proof of payment of tax. Even then, it will be called as defective return. And let's say, for example, along with the tax return, you forgot to attach the tax audit report. Even then, it will be called as defective return. So, if it is a wrong form, wrong ITR form, or proof of tax is not attached, or you forgot to attach the tax audit report, in these cases, the return will be called as defective return. Once it is a defective return, the income tax department will send you one notice. Please rectify this defect, they will tell. You have to rectify the defect within 15 days or whatever date is mentioned in the notice. If you do not rectify within the date given, then it will be treated as invalid return and it will be treated as if you have not filed any return of income at all. Then comes self-assessment tax. Guys, there are two kinds of taxes. Advance tax, self-assessment tax. Advance tax is the tax which you pay during the previous year in which you earn income. Self-assessment tax is the tax which you pay in the assessment year at the time of filing return of income. So at the time of filing return of income, how will you compute self-assessment tax? First, you will compute your total income and tax liability. You will reduce all your advance tax, TDS, TCS, everything. Then you will arrive at self-assessment tax. This self-assessment tax, you have to pay the self-assessment tax before you file the return of income. So before filing return of income, the assessee shall pay the self-assessment tax. If you do not pay self-assessment tax or you paid short, means you paid less self-assessment tax, in that case, you may be required to pay fees, interest and balance towards taxes. Are you getting it? So whatever short payment of tax has happened, and when you will adjust the tax already paid, you will adjust in the bill order, fees, interest and bill balance towards the taxes. So let's say for example, you paid 10,000 of self-assessment tax. Out of the 10,000, they will first adjust with the fees, then they will adjust with the interest, then the balance they will adjust with the taxes. Next one, updated return. Guys, say for example, the last due date of filing belated return and revised return is 31st December, correct? 31st December of assessment year. Say for example, that due date is also gone away. Then do you have a chance to file return of income or not is a question. Or let's say for example, you filed a revised return. Just give me a second. You filed revised return. You rectified some mistake. Still some mistake is persisting in your original return. You want to rectify that also. Is the option available after 31st December is the question. Yes, the option is available, and that is called as updated return. From 1st April 2022, government introduced updated return concept, where you can file a return belonging to earlier previous years, even though the belated return due date, revised return due date is already expired. But the updated return should be filed only if certain conditions are met. So, updated return can be filed even if original return, revised return, belated return is filed or not, does not matter. You can still file an updated return. Due date shall submit updated return within 48 months. 4 years time they are giving extra from the end of relevant assessment year. From the end of the assessment year for which you want to file return of income, 4 years time they are giving 48 months of time. Now, this is the most important part. You cannot file an updated return in the following cases. Number one, if you want to claim any loss in the updated return, it is not possible. Updated return cannot be a loss return. You should only offer income and you should end up paying taxes. Updated return is already filed. You already filed one updated return, you cannot revise updated return. Only one chance. Updated return, if it results in decrease of total tax liability or generates a refund or increases existing refund, you cannot file an updated return. So I told you already, you cannot increase your losses, you cannot increase your refund, you cannot decrease your total tax liability. You have to either nil, there is no impact, or there should be impact of high tax liability. Then only you can file updated return. If original return of income is a loss return, updated return can be filed only if it is a positive return. So earlier you filed loss return earlier in the assessment year. Now if you want to file updated return, it should be a positive return only. It can never be increase in losses. If filing of updated return results in decrease in quantum of carry forward of losses on unobserved depreciation or AMT credit, updated return shall be filed for each such subsequent year. Say for example, there is a change in the carry forward of losses in a particular updated return which you are filing, then for all the subsequent years you have to file updated return, because of course 1 year if you are changing the carry forward of loss, it will have an impact on the other coming years also, no? So you will have to file return. Now, computation of additional tax. Whenever you will file updated return, you have to pay additional tax apart from the original tax which you are required to pay. If the updated return is furnished after expiry of a time under section 139(4) or 5, but before 12 months from the end of relevant assessment year, means from the end of relevant assessment year within 12 months if you are filing updated return, in that case you have to pay additional tax of 25%. 25% of tax plus surcharge plus cess plus interest. If you're filing after expiry of 12 months from the end of relevant assessment year, but within 24 months, before 24 months, in that case 50% additional tax. Let's say for example your tax liability is 1000, you will pay 1500 rupees as tax. 50% extra tax you have to pay. And if you're filing updated return after 24 months but before 36 months, in that case 60% additional tax you are required to pay. If you're filing return of income after 36 months of end of relevant assessment year, but before 48 months of end of relevant assessment year, you have to pay 70% extra additional tax. Next, permanent account number. In this table, we will understand who are required to have a PAN, who are required to apply for a PAN. Your parents must have also applied for PAN, no? But who are the persons actually required to hold a PAN in India? If your total income is likely to exceed basic exemption limit, in that case, you have to apply for a PAN in that year. Or if you have a business or profession where the turnover or gross receipt is likely to exceed 5 lakh rupees, in that case also you are required to apply for a PAN. If you think you want to get into a financial transaction of 2,50,000 or more, any kind of a financial transaction, you are required to have a PAN. Or if you are a managing director, director, partner, trustee, author, founder, karta, CEO, any of these positions you are holding, in that case you are required to have a PAN. And anyone wants to create a trust, in that case also they have to apply for a PAN. Persons thinking to enter into following transactions. If you plan to enter into any of these transactions, you are required to have a PAN. Cash deposit, if you want to do in a bank, aggregating 20 lakhs or more in a financial year, PAN is required. Cash withdrawal, you want to withdraw from bank 20 lakhs or more, PAN is required. If you want to open a current account or cash credit account, PAN you have to apply. First, you should have a transactions requiring quoting of PAN. Lot of times, when you go to bank, they'll tell write PAN number here like that. So, what are those transactions in which you have to mandatorily quote the PAN number? Whenever you purchase a motor vehicle other than two-wheeler, you have to quote PAN number there. You have to write the PAN number in the form. If you want to open any account with any bank or a cooperative bank, PAN you have to mention. If you want to apply for a credit or debit card, PAN number is required. If you want to open a demat account, PAN is required. If you want to go to hotel or restaurant where you want to pay a bill of more than 50,000, they will ask you PAN number. If you want to travel to a foreign country and if you want to spend more than 50,000 for forex, foreign exchange, in that case also PAN is required. If you want to purchase or make any payment for a mutual fund, that is also PAN required. If you want to acquire any debentures or bonds, or you want to make any payment to RBI for acquiring bonds, or you want to purchase any bank drafts, or you want to make any fixed deposit with bank, all these transactions require mandatorily to have quote the PAN cards. If you want to go and buy prepaid payment instruments, like you want to take one bank draft, demand draft, there also PAN is required. The limits are given here. If you want to take any life insurance and you want to pay life insurance premium, or you want to sell or purchase any securities, you want to sell or purchase any unlisted shares, you want to sell or buy any immovable property, or you want to sell or buy any goods above 2 lakh rupees, in this case you have to mandatorily required to quote the PAN number. Just have a glimpse and go for examination, because maybe one MCQ they may be asking. Now, person not required to update PAN. Sir, are there any people who are not required to have a PAN? Yes, minors are generally not required to have a PAN. They can quote the PAN of their parents. Getting it? Yes. Interchangeable use of PAN and Aadhaar. Sir, I do not have PAN card, sir, but I have Aadhaar number. Can I write Aadhaar number there, sir? Yes, you can write, provided your Aadhaar is linked with PAN, then only you can quote. Or has not been allotted a PAN. If you are not allotted a PAN, then only you can quote Aadhaar number. That too, if the PAN is linked with Aadhaar, then only you can quote. Got it? Next, penalty for failure to comply with 139A. Let's say, for example, you did not apply for PAN. In that case, what will happen? 10,000 penalty will be levied. Now, quoting of Aadhaar number. There are some places in which you need to quote Aadhaar number mandatorily. Two are the scenarios. Whenever you apply for a new PAN card, you must write your Aadhaar number. And whenever you file return of income, it is mandatory to write and quote the Aadhaar number. Sir, if the person do not have Aadhaar number, what he will do? Earlier, there was an option of quoting of enrollment ID of Aadhaar. When you go to apply an Aadhaar card, they'll give you an enrollment ID, acknowledgement. That number you can quote. But mind you, recently there has been amendment. Now you cannot quote enrollment ID of Aadhaar number. Aadhaar number itself is required. Enrollment ID is not valid nowadays. From 1st October 2024, this change has happened. Enrollment ID option is not available, and if any person applied for PAN on basis of enrollment ID, he is mandatorily required to intimate Aadhaar number to department up to 31st of December. So earlier you obtained PAN by quoting the enrollment ID, then now within 31st of December 2025, you should go to Income Tax Department and give your Aadhaar number. After 1/10/2024, you cannot quote enrollment ID of Aadhaar. You have to give the Aadhaar number only. Next, Every person already holding PAN on 1st July 2017 shall link Aadhaar with PAN. I told you already, linking of PAN with Aadhaar is very, very important and mandatory. Otherwise, your PAN will become inoperative. But there are some cases in which having Aadhaar number is not mandatory. First one, the persons who reside in Jammu and Kashmir, Meghalaya and Assam, for these people, having Aadhaar is not mandatory. Next one, non-residents or a person having age of 80 years or more, or a person who is not a citizen of India. These people are not required to quote Aadhaar number. Now, where a person fails to link his Aadhaar with PAN, of course, the PAN will become inoperative. If you want to link now after the last date which was given 1st of April 2022, you have to now pay a fees of 1000 rupees under section 234H. Scheme for submission of return through tax return preparer. Guys, everyone do not have knowledge of Income Tax Act. You need some help to file the return of income. How do you know without learning the income tax law? How do you know how to compute total income? What is your tax rate and how to compute tax liability and all? How do you know? So you need some help. So government came up with a scheme called as tax return preparer scheme. In this scheme, so government, the income tax department conducts examination. Even if you clear your CA intermediate, after that you can write this exam, tax return preparer exam. If you write that exam, you will get one certificate, TRP certificate from Income Tax Department. You are an authorized TRP person and you can file return of income of people and you will get fees. So CBDT frames a scheme where it conducts examination for tax return preparers. TRP means an individual who is authorized to act as a TRP by the CBDT. But mind you, following persons cannot become a tax return preparer. Number one, full cleared chartered accountant, legal practitioners, office of a scheduled bank, any employee of a specified class of person cannot become a TRP. Means a semi-qualified CA, semi-qualified CMA, semi-qualified CS, they can write exam and they can become TRP. But if you are qualified, then you cannot. Are you getting it? But sir, can I do tax audit also, sir? No, you cannot do. And you cannot file return of income of a company. Other than company, any taxpayers return you can prepare, but you cannot do tax audit also. So specified class of person means a person who is required to file return of income other than a company, and you cannot do tax audit as well. Are you getting it? So basically a TRP can actually file return of income only of individual and HUF only, not of other taxpayers. Next, verification of return. What is verification of return? Means once you file all the details, in the end you will write, I hereby declare that whatever information given in the tax return is correct. Like that you will write and sign. That is called verification. Who can sign the return of income? If you are an individual, you yourself can sign the return of income. But let's say, for example, if an individual is not mentally proper, then any competent person can actually sign. In case of HUF, actually Karta can sign the return of income. Who can sign? Verify means signature in the tax return. Who should do it? If Karta is not competent, then any adult member of HUF can sign or verify. In case of partnership firm, managing partner. If that managing partner is not there, then any other adult partner can sign. In case of limited liability partnership, designated partner can do. If there is no designated partner, then any other partner can do. If it is a company, then managing director should sign. If there is no managing director, then any other director. If the company is going into liquidation, then liquidator will sign. If the company is going for insolvency, then that IB professional will do. If it is a political party, the CEO of the political party shall verify. If it is a local authority, principal officer will verify. And if any other person, then competent person should verify. Mind you, if the return of income is not verified, then it will be called as invalid return. So this is a small chapter, guys. Return of income. Just read. Definitely 4 marks definitely will come from this chapter. Pakka it will come, no doubt. So guys, this ends up the full marathon of the income tax paper for your CA intermediate examinations. If you genuinely, guys, genuinely, if you liked it, please hit a like button and write in comment section what are your thoughts about the way we taught the marathon. And guys, I believe in manifestation. If you really think you want to clear your examination, start manifesting. On Instagram, you must have seen how many big celebrities claim that they manifested their destiny and that is why they achieved their goals. So if you keep manifesting, I am going to clear my examination, I am going to clear my examination, you will definitely clear. So write in the comment section with positivity, I am going to clear my so and so attempt examination. You will definitely clear. Manifestation is true. Trust me on this. If you write in the comment section, you will clear, guys. 100% I'm telling you. Manifest, manifest, manifest. Whatever you think, always think that you are going to clear examination. Always think that you are hard, working hard, hard. Guys, marathon is not just the only video which I provide for your examination. I will be coming up with super questions, super adjustments, all this before your examination. So if you are new to my channel, please do subscribe to the channel, hit the like button and share this video with your friends also who want to take the benefit of this kind of marathons. Okay guys, chalo, all the very best for your examination. See you in the next video. Take care. Bye bye. So let's begin our next topic, which is income from other sources. First, see, we already know there are 5 heads of income under Income Tax Act: salaries, PGBP, income from house property, capital gains, and income from other sources. If you look at those 4 heads, salary or PGBP or capital gain or income from house property, there are specific incomes which are getting taxed under these heads. So if any income is not specified under those 4 heads, it will automatically get taxed under this head, which is income from other sources. Any income which is not taxable under the head salary, income from house property, PGBP or capital gain shall be taxed under income from other sources. Is it clear? Now, there is a charging section which is the section 56, which gives you a list of incomes which will be taxed under income from other sources. The first income given is dividend income. What is a dividend? If a company earns very good profits, it will give away those profits to owners of the company. Who are the owners? Shareholders. So if any profit is given to the shareholders, that is called as a dividend, and that income whatever received by the shareholder is called as a dividend income, and that dividend income will be taxed in the hands of the shareholder. Is it clear? Now there is a concept called as a deemed dividend, boss. There is a concept called as a deemed dividend. Sir, what is this deemed dividend? It actually is not a dividend, but the income tax act will deem that as a deemed dividend. Let me take one example. In the first example which I told you, that if any profits of the company are distributed to the shareholders, then whatever shareholder is receiving, that income will be taxed as dividend. Yes or no? But let's say, for example, the shareholder is majority shareholder in the company. He controls all the management in the company. Then let's say, for example, he don't want to pay tax on the profits which he is taking from the company in the form of dividends. He don't want to pay any tax on the dividend income which he is taking from the company. In that case, he will think to do one thing. What you know? Okay, boss, don't give me the profits in the form of a dividend. Let me take the asset of a company. Let me repeat. Let's say, for example, the shareholder who is having the majority shareholding in the company wants to plan is a tax planning in this way. Rather than taking the profits in the form of dividend, what he will do, he will take off one asset from the company. Even in that case, that will be deemed as dividend and that will be taxed. So in the first scenario, if he receives profit as it is, it will be called a dividend in his hands and it will be taxed. So what people started doing, rather than taking the profits in the form of cash, they started taking the profits in the form of asset. If he will take, he will go and outside the market, he will sell it off and he will convert into cash. Are you getting this? These kind of transactions are also deemed as dividend, and the deemed dividend is a concept given under section 2 clause 22a to clause 22f. Are you getting this? So under section 2 clause 22, whatever whatever transactions are notified, all those transactions will be deemed as dividend. They prima facie may not look like dividend, but they are deemed as a dividend by the income tax department under section clause 22. First section is 222A. Under this, what does it say? Distribution of assets from the accumulated profits of the company. Now, let's break this in a bits and pieces. Distribution of asset from the accumulated profits. Distribution of asset, the very example which we just now discussed. Distribution of asset from the accumulated profits. What is accumulated profit? Accumulated profit is nothing but reserves. Reserves, there may be two types: revenue reserve, capital reserve. Are you getting this? There may be these and all you would have already read in your accountancy. There are two kinds of reserves. One is revenue reserve, the other is a capital reserve. Yes or no? So whatever reserves the company has, that is accumulated profits only. No, if once the company earns profits, out of that little bit is already given as the dividends to the shareholders. Whatever is left out, that will be called as reserves only. Where you will see reserves in the balance sheet, on the liability side, just below the share capital, you will see reserves. Are you getting this? Any distribution of accumulated profits, whether capitalized or not, by a company to its shareholder is deemed as dividend. Sir, I am not understanding, sir. Any distribution of accumulated profits, we are understanding that the distribution of accumulated profits, reserves in hand. Whether capitalized or not, what is this, sir? See, whether capitalized or not, we will understand with the help of a example. What is that example? Let's have a look. Meaning of accumulated profits, whether capitalized or not. What does the term accumulated profits, whether capitalized or not, means? Let's have a look with this example. You will first not look at this table first. You will only look at this balance sheet which I have given here. Are you getting this? So you will not look at this balance sheet. Sorry, you will not look at this balance sheet for time being. You will only look at this balance sheet first. Let's understand what is there in the balance sheet. Balance sheet before bonus issue. So this company has not given any bonus yet. Plain balance sheet it is. Share capital is 100, reserves it is 75, liability it is 25. Fixed assets 125, current assets 75. Total is matching. Yes, matching. 200, tallied. Now, if the above company, Thailava Limited, declares bonus issue of 1 bonus share for every 4 equity shares held, then bonus shares will be of 25 crores. Yes or no? 100 crores is the share capital. If for every 4 shares, for every 4 shares, 1 share if it is given as bonus, then 100 by 4 will be 25. No, that much bonus means the share capital will now increase from 100 to 125. No, earlier it was 100 plus bonus issue if it is done 1/4 of 100, in that case plus 25 it will add. So total share capital will become what? 125. Yes or no? So share capital, let's see, has it become 125? Yes, it has become 125. But where from this 25 crores of bonus amount will come? It will come from the revenue reserves which are there with the company. So revenue reserves with the company are 75 crores. If from 75 crores 25 crores is used for bonus, then it will reduce or increase. The revenue reserve will reduce or increase. It will reduce, no da, because 25 out of 75 is already used for a bonus issue. In that case, the revenue reserves will fall down to 50. Yes or no? Yes, it has been fall down to 50. Now that 25 out of the revenue reserves, whatever you utilized for a bonus issue, you have capitalized. No, from reserves it has converted into share capital. So this transaction is called capitalization of reserves. So from a revenue reserve, that reserve have been converted into capital reserve. Are you getting this point? This is called a capitalized reserve. Now, whatever reserve is still pending 50 crores, it is called what? Non-capitalized reserve. No, wherever you will read accumulated profits, whether capitalized or not, in this thing, capitalized is at 25, which you have converted into bonus share. Not capitalized is that 50 rupees, which is a. Now, even in this balance sheet, total reserves is 75 only. Even in this balance sheet, total reserves is 75 only. Just that here 75 total is a non-capitalized reserve. here 75 total reserve, out of that 25 is capitalized reserves and 50 is non-capitalized reserve. Are you getting this point? Are you getting this point? This point is very, very beautiful point. Now accumulated profits after bonus issue will remain 75 crores only, capitalized profits of 25 crores and revenue reserves are of 50 crores. Now what is the link of this example with this section 222A which you are teaching, sir? Any distribution of accumulated profits, whether capitalized or not, by a company to its shareholder is deemed as dividend. I told you. If accumulated profits are distributed in cash, it is dividend in the hands of shareholders. Yes or no? Where from you will give dividends? From the reserves only? No. If you give in the form of cash directly, that is called as a dividend directly. But if accumulated profits are distributed in kind means what? You have given a asset. You did not give any cash. Asset means maybe a machinery is taken by the shareholder. Then the market value of such asset distributed on the date of distribution shall be deemed as a dividend in the hands of shareholder. Let's say for example, in the example which we saw, out of this fixed assets of 125, boss, let's say for example, out of 125 total amount of fixed assets, you have given 10 out of 125, only 10 rupees worth of asset if you have given to a shareholder. In that case, that 10 rupees will be deemed as a dividend. I repeat, up to 10 rupees whatever you have given will be deemed as a dividend. Now let's say for example, we already saw that the total reserves in this company's hands is how much? 75. No, total reserves in the hands of a company is 75. Yes or no? And the total assets is 125. Yes or no? Let's say for example, you have given, slowly I am repeating, so just to focus. 75 is total reserves with the company, total assets with the company are 125. Let's say for example, you have distributed 90 rupees worth of assets from this 125 to the shareholders. In that case, to the extent of reserves, it says, what is the language used in the section 222? To the extent of reserves, whatever assets you distribute, only to that extent it will be deemed as a dividend. So out of 75 of reserves, let's say for example, fixed assets you distributed to the shareholder is only 90 rupees. Out of 125 of a fixed asset, 90 worth of a fixed asset you have given to your shareholders. In that case, total 90 will not be deemed as dividend because your reserves are only 75 rupees. So to the extent you have the accumulated profits or reserves, only to that extent whatever assets have been distributed to the shareholders will be treated as deemed dividend. In this example, if let's say for example 60 rupees worth of assets are given, then total 60 will be deemed as dividend because 60 is less than 75, means within the reserves only. If the fixed assets are distributed 100 rupees, in that case only 75 will be deemed as dividend. Are you getting this? If 80 rupees worth of assets are given to shareholders, then only 75 will be deemed as dividend. If 50 rupees worth of assets are given to shareholders, in this case only 50 will be deemed as a dividend in the hands of shareholders. This same concept of whether capitalized or not and to the extent of accumulated profits will apply throughout section 222 A, B, C, D, E, F. Are you getting this point? Okay. In case of a bonus shares, there is no release of assets, hence there is no deemed dividend, because we saw that in the case of a bonus issue, just that the capitalization of profit happened, but no asset has went out of the company. Next, distribution of debentures, deposit certificates to shareholders and bonus share to preference shareholders. If you give to your existing equity shareholders any debentures or deposit certificates or bonus shares to the preference shareholders, in that case, to the extent the company has accumulated profits, whatever you gave the worth of debentures or deposit certificates will be deemed as a dividend under section 222B. In the case of liquidation, you know that in the case of liquidation, the company, what it does, whatever is left out assets are there, it will distribute to its shareholders. If in that event of liquidation, any assets are distributed to the shareholders, to the extent the company has accumulated profits, whatever distributed to the shareholders will be deemed as dividend in the hands of shareholders. 222D. Distribution and reduction of capital. Reduction of capital is what? Let's say for example, the face value of the share. The face value of the share is 10 rupees. And by 2 rupees, the share is getting reduced. Then the face value of the share will convert into 8. No. So if you are reducing the face value, means you are giving back 2 rupees to your shareholders. At the time of giving back this 2 rupees, to the extent of accumulated profits, whatever are there with the company, will be deemed as dividend in the hands of shareholders. Now, so this is a very beautiful section 222E. If to a shareholder, any closely held company, let me explain you in a pictographic form. There is a private limited company, boss. Technically, in the section 222, it call it as a closely held company. It is called closely held company. Generally, closely held company means a private limited company. If a private limited company gives any loan to its shareholder who has a substantial interest in the company, if a private limited company gives a loan to a shareholder who has substantial interest in that company, in that case, to the extent of the accumulated profits held by the company, that loan amount will be treated as a deemed dividend. So loan also, sir, yes, even if a loan is taken by a shareholder, in that case it will be deemed as a dividend in the hands of shareholder. Are you getting this? Now let's look at this. Advance or loan. Advance or loan by a closely held company means a private limited company to its shareholder. Advance or loan given by closely held company to shareholder who is having beneficial owner of 10% or more of the, so that shareholder should have at least 10% of the share capital, and that kind of a shareholder, if he is taking any loan from the company, that will be deemed as dividend in the hands of that shareholder. Now, advance or loan given to concern means, let's say for example, if your loan you are giving, if the company is giving loan to shareholder, that is treated as dividend, deemed dividend in the hands of shareholder. But rather, if the company plans to give not loan directly to the shareholder, if I am a shareholder, if I am receiving loan from the company directly, it is getting taxed in my hands as deemed dividend. So what I'll think, okay, let me do one thing. This is a company which is giving loan. I am a shareholder. So if I am receiving loan, I am getting taxed deeming this loan as a deemed dividend. Correct or not? Deemed dividend. Like this, I am getting taxed. So I'll do one thing. I am a partner in a partnership firm. I am a partner, shareholder. I will tell my company, don't give me loan directly. I am getting taxed on that amount which I will receive. So rather you do one thing, you give that loan to my partnership firm in which I am partner. From there I will take the money. Are you getting that? So if you do any kind of this transaction, in that case also, even if this private limited company, the closely held company, if it gives loan to any concern, means what? Partnership firm in which this shareholder has substantial interest, and then whatever loan given by the closely held company to this concern in which a shareholder has a substantial interest will also be deemed as a dividend only, means you cannot escape taxation altogether. Now, advance or loan by a closely held company to a specified concern. Now, what is a concern, sir? It may be HUF in which you are a member, or it may be firm in which you are a partner, or AOP or BOI, or a company in which another company. The shareholder of the company holding more than 10% of the equity shares is a member or a partner or having substantial interest. What is a substantial interest in the concern, sir? At least 20% income share you have in that concern, that will be called as a substantial interest. Exceptions. If loan is granted in the ordinary course of business, let's say for example, the company in which you are a shareholder is a bank, and the bank's general business itself is giving loan. In that case, a deemed dividend concept will not apply. Next section is 222F. Very beautiful and recent brand new section. We have seen this already in the case of capital gains chapter, which is a buyback of shares. There is a cutoff date before 1/10/2024 and after 1/10/2024. Now, if the buyback happens before 1/10/2024, the company is liable to pay tax on that buyback. If the buyback happens after 1/10/2024, then whatever, to the extent of accumulated profits, whatever buyback amount the shareholder will receive, straight away total buyback amount will be deemed as a dividend in the hands of a shareholder. Okay. So after 1/10/2024, nothing will be taxed in the hands of company, only in the hands of shareholder who is getting that buyback amount will be treated as a deemed dividend under section 222F. Are you getting this? We have already discussed in detail the buyback concept in the capital gains chapter. Now, there are some casual income. So whatever we have seen so far, it is only from the standpoint of dividend income. So much story was that. Now we will look at other incomes which are taxable under the head income from other sources. Casual income means you casually play some games, winning from lotteries, crossword puzzles, races, card games, other games, that will be straight away taxed at the rate of 30%, and the head under which it is taxable is income from other sources. Interest on compensation received on compulsory acquisition. You remember compulsory acquisition we have read in PGBP, yes or no? If compulsorily your asset has been acquired in capital gains chapter also we have read, if any capital asset has been compulsorily acquired, that is deemed as a transfer and all, yes or no? So if any compulsorily asset has been acquired and any compensation you will receive, no, they will generally delay the compensation. Let's say for example, in this year my asset was compulsorily acquired, but I will receive my compensation after 2-3 years. So for 2-3 years the government will also pay you something called as interest on this compensation. Are you getting that? That interest will be taxed under income from other source. Now mind you, up to 50% of that interest on compensation whatever you will receive will be exempt. Interest on compensation or enhanced compensation for compulsory acquisition is taxed under IFRS. 50% of such interest is exempt. Advance money forfeited. Do you remember in the case of capital gains we have read? There is one section which says if the advance money forfeited before 1/4/2014, it will be reduced from the cost of acquisition. Now, if you forfeited the amount advance money after 1/4/2014, in that case it will be taxed under IFRS. That is getting taxed here. Now, money or property received without consideration or for inadequate consideration. Sir, please explain what is this without consideration or for inadequate consideration. Without consideration means freely you are receiving, boss. You did not pay even a single rupee. With inadequate or for inadequate consideration means you paid some money, but you did not pay for the full value of the asset. Let's say, for example, there is a 1 lakh worth of asset I am buying. 1 lakh worth of asset I am buying. I only paid 20,000 to that person and he gave me asset. That is called inadequate consideration. Without consideration means what? Freely I got 1 lakh worth of asset. Are you getting that? Now, these are the assets which are mentioned if you receive without consideration or for inadequate consideration. In that case, that whatever you have received, the benefit only. No, if you receive something for free, that is benefit for you. Or if you receive something for lesser value, actual value is 1 lakh, you paid only 20,000, then 80,000 is benefit for you. No, that benefit will be taxed in the receiver's hand, means your hand under the head income from other sources, and that will be taxed under section 56(2)(10). Money or cash. If someone is giving you freely cash or money, in that case whole amount will be taxed under IFRS if the same exceeds 50,000 rupees. So let's say for example someone gave you 60,000 rupees, full 60,000 will be taxed in your hand. Someone gave you 40,000 only, then it is not taxed. Are you getting this? So only if it exceeds 50,000, then whole cash amount will be taxed in your hand. Immovable property, land or building you received without consideration. Who will give you? Of course, your parents, boss. You're a parents, but parents are covered under relative definition. If a relative gives you this land or building, that will not be taxed. But let's say, for example, some of your friend has become, your chatti batti dost has become big crorepati, and he saw you poor guy, let me give him a 1 crore worth of building to him. So he gives you freely 1 crore worth of building. He is a friend, not a relative. Then in that case, if a friend gives you anything like that, then whatever value of the stamp duty value of the building is there, that will be taxed in your hands, provided the total amount or the value of the building should be more than 50,000. Just remember one thing, boss, in 56(2)(10, in the case of gifting, if the gift is more than 50,000, only then in that case it will be taxed in your hands. Immovable property you received by paying amount, but you paid only inadequate consideration. In that case, whatever benefit is there, no, that benefit if it is exceeding 50,000 rupees, then it will be taxed in your hands. Taxable if a difference between the SDV and consideration is more than higher of, if the benefit, if it is higher of 50,000 or 10% of consideration, in that case it is the tax in your hands. Movable property. If you remember property definition, we have read in a capital gains chapter also. Property of any kind, what it will include, what does not include. Likewise, if you receive any movable property without consideration, and if aggregate fair market value is exceeding 50,000, then it will be full FMV will be taxed. If you received for inadequate consideration, then whatever benefit, the difference of FMV and consideration will be taxed if it exceeds 50,000. Now, we will see non-applicability of 56(2)(10). I told you while explaining that if you receive building from a friend, it is taxed, but if you receive from your family, it is not taxed. Why I told? Because it is given exclusively under section 56(2)(10), not applicability of 56(2)(10). There are few transactions in which even if you receive benefit of more than 50,000, but from specified persons or organizations, then it will be not taxed under income from other sources. Any sum of money or value of property received in the following cases shall not be taxed. Shall not be taxed. From any relative. Sir, who's a relative? We will come to that. But any relative. Your definition of relative may be different. But you have to look at the definition which is given under Income Tax Act. On occasion of marriage of the individual, from anyone, boss, on your marriage, whatever you will receive, fully exempt. Yes or no? By will or inheritance, let's say for example a person has written a will that when I will die, whatever belongs to me goes to this person, and you received any properties and cash, that will be totally exempt. On the death of a payer or a donor, from any local authority, from any university, fund or foundation, from any fund or foundation or university or other educational institution, hospital, medical institution, trust, from or by any trust or institution registered, then other educational institutions, transaction not regarded as a transfer, if you remember section 47. Then one more important thing here, by an individual from any person for COVID-19 treatment of self or family members subject to conditions notified by central government. If you satisfy the conditions which are given by the central government, and for COVID treatment, if you had received any money from any person, in that case it will be totally exempt. By a member of family of a deceased person, means let's say for example due to COVID someone has died, and his or her family member, the person whoever has died, his or her family member has received some compensation from anyone, that will be exempt. In the case of death due to COVID, within 12 months from the death, if the family members receive, amount of exemption will be, if the amount is received from the employer, then there is no limit. If any other person gives them the amount, then maximum 10 lakhs will be exempt. What is the conditions prescribed by the central government? Death the person should die within 6 months from the date of COVID positive report, and he should file, the family should file a declaration regarding the amount whatever they received in that financial year. Now just now we saw property or a family, those definitions are given here. What is a property, sir? Means whatever you are receiving, no, if it falls only under this category, that will be taxed. Any other movable assets you are getting, that will not be treated as a gift. Immovable property being land or building or both, if you receive as gift, that is treated as a property. Cash and securities, jewelry, archaeological collections, drawing, painting, sculpture, any work out of bullion, and virtual digital asset. What is a virtual digital asset? Bitcoin, Dogecoin. Are you getting that? Even those, if you receive, all these will be treated as gifts and will be taxable. Relative. Who is a relative, sir? Whenever you read this relative definition, think of yourself first. You are an individual. In case of an individual, your spouse means your wife. Brother or sister of the individual means your brother and sister. Brother or sister of the spouse of the individual, your macha machi means your wife's brother, wife's sisters. Brother or sister of either of the parents means your parents' brothers and sisters, your mamas, whatever you call bua and all. Okay, atte or auntie, whatever. Lineal ascendant or descendant of the individual. Lineal ascendants, descendants means your tatas, muttatas, or dadas, pardadas, and your chotus, whatever your next generation. Lineal ascendant or descendants of the spouse means your spouse's parents, spouse of any other person referred in the 1 to 6. So spouses of whoever are mentioned here 1 to 6, all these will be relative, and if anything received from them, then nothing is taxable in your hands. Family means the family will receive during COVID. Now what is a family? Meaning spouse and children of the individual, parents, brothers, sisters of the individual, mainly dependent on the individual who died. Compensation or other payment received from termination of employment will be taxed here. Interest on compensation on compulsory acquisition, we already discussed, 50% will be exempt. The manner. Income chargeable under IFOS only if not chargeable under PGBP. There are few incomes which will be taxed under IFOS only if they are not getting taxed under PGBP. What are these incomes, sir? Income from letting out of or on hire of machinery and plant and machinery. Machinery, plant, furniture, sorry. Furniture and plant and machinery, if you are letting it out. Means if you are not doing business of letting out a furniture or plant and machinery, in that case only it will be taxed here. If your business itself is letting out of a furniture or plant and machinery, then that income will be taxed under PGBP. Letting out of buildings is inseparable from a letting out of machinery and plant. We already discussed this income from house property. Any sum received by employer assessee from his employees as contribution to PF, other fund of a welfare, in that case, whatever employer contribution is there, that will be taxed. Any amount received from keyman insurance policy received by a person who took the policy other than the employer. If other than employer someone took a keyman insurance policy for the employee, in that case it will be taxed in the recipient's hand. Salary received by MP MLA will be taxed under IFRS. We already discussed this in PGBP income. As I told you, sorry, income from salaries, because MP and MLA is not an employee. So no. If you do some offline games, if you participate in some offline games and you win some money out of that game, offline game means lotteries, crossword puzzles, races of horse races, anything, straight away 30% you will have to pay tax. No basic exemption limit, no set off of losses, nothing. 30% plus surcharge pluses, no chapter 6 deduction. Adjustment of unexhausted basic exemption limit is also not available. No chapter 6A deduction, no adjustment of a unexhausted basic exemption limit. Then the same story for online games also. Nowadays a lot of online gaming is happening, no? Yes or no? So if you participate in any of these online mobile games, you won some cash money, that money will also be taxed under section 115 BBJ at the rate of 30%. No, same provision here also. Chapter 6A deduction also not available, and the unexhausted basic exemption limit also you cannot claim. The last one is deductions allowable. Now, what we have seen so far is those incomes. We were only discussing about income which is taxable under IFOS, income which is taxable under IFOS. Now we will look at those deductible expenses against those incomes so that we can reduce our income on which we have to pay tax. Interest expenses spent for earning dividend income or income on units of a mutual fund, maximum to the extent of 20% of such income will be allowed. So if you let's say for example you earned a dividend of 1 lakh, then maximum 20,000 rupees you can claim as a deduction, but that should be interest deduction. Next, no deduction in respect of expenditure is allowed in case of a deemed dividend. So for deemed dividend, you cannot claim any kind of a deduction. Any commission or remuneration you pay to a banker, means to a bank for earning interest on securities will not is allowed. If you are earning some income from letting out of a machinery or a plant or a furniture, which we just now discussed, in that case if you did any current repairs or if you paid any premium for the insurance or normal depreciation also you can claim. In case of a family pension, deduction against income from family pension, if you receive any family pension, if family pension is received, for that a deduction is given to the lower of these three amounts, which is 1/3 of such family pension received, 15,000 in case of optional tax regime, and 25,000 in case of default tax regime. Whichever is lower will be claimed as a deduction against the family pension income. There are some exempt incomes, means these incomes are straight away exempt, boss, under section 10. Interest or money received by us in the credit of non-resident external account. See, non-resident Indians can create account called as non-resident external account, in which they can deposit some amount. On that, if any interest is received, that will be totally exempt. Compensation received on some disaster. Let's say, for example, earthquake happened, some person lost his life. So any compensation received by family members of that deceased person will be exempt. Scholarship, if any, granted for you for some education purpose, that is also exempt. Daily allowance and constituency allowance given to MLAs or MPs are exempt. Payment in cash or kind in respect of government awards. Let's say, for example, you got Padma Bhushan with 1 lakh rupees. In that case, that 1 lakh is totally exempt. Interest on post office savings bank account. In post office savings bank account, if you deposited some amount and if any interest has been received, in that case, if you receive interest up to 3,500 in a single account, in that case it is exempt. If it is a joint account, then maximum 7,000 will be exempt. So this ends our discussion on income from. The next topic of our discussion is clubbing of income. Was everyone hates to pay tax. No one happily pays tax to the government. So whatever income is earned by the taxpayer is generally the taxpayer will try to pay as much as a less tax. He will not want to pay more tax. So what he will do? He will do a lot of tax planning so that he can save his tax and he can pay very less taxes. But the government will always want the taxpayer to pay more taxes. In this chapter, we will see all those kind of tax planning which a taxpayer does to reduce his taxes, and alternatively also we will see how the government keep a check on these kind of malpractices so the government can get more revenue in the form of taxes. First example, let me take one example, boss. It is a very beautiful example. Let's say, for example, Virat Kohli and Anushka Sharma. We know that these two are what? These two are married, no? Couple, yes or no? So you can say Anushka Sharma is a spouse of Virat Kohli. Let's imagine Virat Kohli is a salaried employee. Virat Kohli is a salaried employee and his salary, for example, is 10 lakh rupees per annum. So Virat Kohli has a salary income which is 10 lakhs per annum, for example. Okay, and also he owns a house property. He owns a house property for which rental income is 3 lakh rupees. Rental income is 3 lakh rupees. So if you look at this, total income of Virat Kohli will become 13 lakhs. 13 lakhs. Yes or no? Yes or no? Now, in the case of individual, let's imagine this person is paying tax under optional tax regime. Optional tax regime. In that case, what is the slab rate? Do you know what is the slab rate? 0 to 2.5 lakhs, it is 0. 2.5 lakhs to 5 lakhs, it is 5%. 5 to 10 lakhs, it is 20%. And beyond 10 lakhs, it is 30%. Yes or no in the case of individual? Now, just imagine what kind of a tax planning Virat Kohli wants to do. 10 lakhs up to 10 lakhs salary, so he cannot do anything because that is salary income. He cannot change that. But one change he can do in his total income. You know what it is? This 3 lakhs of rental income, if he plans to tax it in hands of Anushka. Let's imagine Anushka is at a housewife only. She does not have any kind of income. So if Virat Kohli gifts the house property to Anushka, then rental income will be credited in Anushka's bank account, and here from no income, Anushka will get 3 lakhs of income. Then you will be thinking, sir, in Anushka's hand it will get taxed. No, no, boss, because in the case of an individual, there is a concept of a rebate. To 5 lakhs, if you are under optional tax regime, up to 5 lakhs, you don't need to pay any taxes. Or even if you look at this 3 lakhs, 0 to 2.5 lakhs, 0, 2.5 to 5 lakhs, whatever, 0, 2.5 to 3 lakhs, that 50,000, 5% is how much? 2,500 something. That will get as a rebate. No, nothing, she'll pay tax. Means on this 3 lakh rupees, if it is received by Anushka, then tax on this 3 lakh will become 0. Whereas if that rental income is received by Mr. Virat Kohli only, in that case, 10 lakhs plus 3 lakhs, the income will become 13 lakhs. And on this 3 lakh, which is beyond the 10 lakhs, the tax rate will become 30%, no boss. So on 3 lakhs, 30% is how much? I think it will be, 1 second, 3 lakhs into 30%, 90,000, boss. 90,000 Virat Kohli will pay tax. Why 90,000 he will pay tax? Already up to 10 lakhs of salary, he will be paying tax at the rate of 20%. And extra 3 lakhs, whatever he will get, that will be taxed under a 30% slab. No, because the income is exceeding 10 lakhs already. So by doing one transaction, Virat Kohli can save 90,000. What is the transaction? He can gift the house property as it is to Anushka. Now you will be thinking, sir, gift will be taxed. No, no, boss. Remember section 47, transactions not regarded as transfer under capital gains head we have discussed. If you gift a property, gift is not regarded as transfer. So very simple, Virat Kohli rather keeping a house property in his own hand and rather taking a rental income on his in his own account, he will do what? Simply he will take the property and gift it to his wife Anushka, and Anushka can happily claim that income as her income, and can claim basic exemption limit or a rebate, and no need to pay any tax on that rental income. Very simple. People used to do this, and that is why government caught all these kind of transactions and changed the law so that even if Virat Kohli gifts the property to spouse who is Anushka Sharma, then the rental income, whatever 3 lakhs fetched by that property, will be taxed in the hands of Virat Kohli only. Now, what Virat Kohli thought, no, okay, if I transfer the property without consideration to my wife, then problem is arising. Let me do one thing. Without transferring the property, I will transfer the income only. How? They see, Virat Kohli went to one that agreement fellow, notary people, and he written he prepared one agreement. In that agreement, he wrote, I am not transferring the property, I am transferring the right to receive the rent to my wife. In my property, I do not have right to take that rental income. I am transferring the right to receive the rental income to my wife Anushka Sharma. He wrote one agreement, he prepared and got it notarized, and like that he wanted to transfer the rental income without transferring the without transferring the house property itself. Even those kind of transactions are regarded as clubbing transactions, and that rental income will also be taxed in the hands of Virat Kohli. Are you getting this? So these kind of transactions we are going to look at. So what we are going to discuss is an assessee is usually taxed on his own income, but in some cases he may be taxed on other person's income. So in our case, we have seen Virat Kohli's income actually, but he transferred the income to Anushka Sharma. Though it is Anushka Sharma's income, it will be taxed in the hands of Virat Kohli only. Income transferred to family members will be taxed in the hands of the transferor. Who is the transferor? Virat Kohli is a transferor. Transfer of income without the transfer of asset. In the example which we have seen, if any person transfer the income with transferring the asset, then such income is to be included in the hands of transferor. Now understand, there are two kinds of transfer. Let's take one more example. Now Virat Kohli understood that, boss, if I transfer asset without consideration or with inadequate consideration to my spouse, then clubbing provisions are getting attracted. If I don't transfer the asset but only transfer the income, still clubbing provisions are getting attracted. Let me think of some other route, and that route is called as a trust route. What is a trust route? See, Virat Kohli simply will create a trust. It is an entity, trust entity, and transfer the house property to trust. Rather transferring the house property directly to Anushka, because if directly it is gifted to Anushka, clubbing provisions are getting attracted. So what Virat Kohli thought, let me create one trust. I will transfer this, I will donate my house property to the trust. Trust beneficiary, trust owner is everything is Virat Kohli only. Who created the trust? Virat Kohli. In that trust, Virat Kohli will donate or transfer the house property, and in the trust deed it will be written that the beneficiary of the rent should be Anushka Sharma. So rather directly transferring the rental income to Anushka Sharma, indirectly by way of a trust it is getting transferred. Now remember, in the hand of trust, whatever income gets generated, that gets exempted. Yes or no in the case of a trust? So beneficiary is made as Anushka Sharma, and in the hands of a trust it will not get taxed. So happily that rental income is escaping taxation. This kind of a transaction is the by way of a trust. Now, in the case of transfer to trust, there are two kinds of transfer, boss. One is called as revocable transfer. The other is called irrevocable transfer. Irrevocable transfer. Revocable transfer means the transferor has the right any time to take back that property from the transferee. Irrevocable means the transferor, once he has transferred the property to the transferee, he can never in lifetime he can get back that property ownership. Are you getting that? So in revocable, you have the right to again take back the property from the receiver, but in the case of irrevocable transfer, you can never get back the ownership in that asset. Now let's say for example, let's look at this example which I have given here. In the case of transfer of income without a transfer of asset, if Mr. Vijay gives to his wife Mrs. Basanti the right to receive rent from his property without transferring the property, the rental income will be taxed in Mr. Vijay's total income. Income arising from revocable transfer of asset. See boss, if it is a revocable transfer, means you have the right to take back the property. In that case, clubbing provision will apply. If it is an irrevocable transfer, means once you transfer the property in lifetime, you can never get back that property in your hands. In that case, clubbing provisions will not apply. So if it is a revocable, clubbing will apply. All income arising to any income by way of revocable transfer of asset is to be included in the total income of transferor. Who is transferor here? Mr. Virat Kohli. As per section 60, the transfer is revocable if it allows the transferor to regain the control over the assets. The clubbing provision applies even if only part of the income from the transferred asset benefits the transferor. Now, if the transfer is revocable, all income from the asset is included in transferor's income. Are you getting it? So the income will be taxed in the hands of Virat Kohli only, even if he transfers the asset to a trust, because it is a revocable transfer. Exception. There is only one exception, boss. If in the transfer of in the transaction of transfer of asset to trust, if though it is a revocable transfer, but you do not have the right to take back the control of the asset during the lifetime of the transferee, only in that case clubbing will not apply. I repeat, let's say for example, in the trust deed it is written that the transferor of the asset does not have right in the asset until the transferee or the beneficiary dies. Until the beneficiary dies, that kind of a revocable transfer, if it is, means once the beneficiary dies, this transferor can take back the property. But until the beneficiary of this asset, if the beneficiary of the asset is alive, until then, if the transferor does not have any right to take back the property, in that case clubbing provisions will not apply. So clubbing will not apply in below case even if it is revocable transfer. If the transfer is by way of a trust or any other form which is not revocable during the lifetime of the beneficiary or a transferee, but can be revoked after the death of a beneficiary or transferee, in this case clubbing provisions will not apply. Example, Mr. Rajesh transfers his house property to a trust for Mr. Ramesh's benefit until his death. The income from the property is taxed in the trust's hand during Mr. Ramesh's lifetime. After his death, since the transfer becomes revocable, the income is included in Mr. Rajesh's income. Is it clear? Next, clubbing of income arising to spouse. Let's say for example, Virat Kohli is already working with one organization, boss. Please understand this. Virat Kohli is working in an organization where he draws a salary of, let's say for example, 10 lakh rupees he is drawing a salary. Okay, 10 lakhs rupees he is drawing a salary. And also let's say for example, in the same organization, Virat Kohli has more than 20% of a shareholding also. More than 20% of a shareholding he is holding already. So means Virat Kohli has a substantial interest in this organization. Substantial interest in this organization, and Virat Kohli is drawing a salary of 10 lakhs for example. Now, 10 lakhs if he is drawing a salary, then we can easily say that from 2.5 to 5 lakhs, the tax will be at the rate of 5%, and 5 to 10 lakhs of income, the tax is at the rate of 20% out of this 10 lakhs, yes or no? But he wants to escape tax. What he will do? He will tell the organization, boss, do one thing, pay me only 5 lakhs of a salary. Rest 5 lakhs you pay to my spouse. We will add Anushka Sharma as an employee in the organization, and you split my 10 lakhs of salary, like 5 lakhs in my hands and 5 lakhs in my spouse's hand. Why it will be, how it will be beneficial for Virat Kohli? Boss, if it is a 10 lakhs, then 1,12,500 tax is levied on Virat Kohli's salary. But if the salary is getting split in 5 lakhs in the hands of Virat Kohli and 5 lakhs in the hand of Anushka, then both individually they are getting only total income of 5 lakhs. Both can take a rebate under section 87A. Then zero tax on this total 10 lakhs of salary. No, then 1,12,500 of tax is saved. No, totally. Are you getting this? So how do they want to save the taxes? So if Virat Kohli plans to do this, in that case, clubbing provisions will apply. Let's have a look at this provision. Income by way of remuneration from a concern in which the individual has substantial interest. So Virat Kohli has substantial interest in an organization, and spouse is getting salary from such organization. In that case, clubbing provision will apply. But let's say, for example, Anushka Sharma is getting salary because of her own talent. She is actually, let's say, for example, she is employed as a finance head in that organization. If Anushka Sharma is really a chartered accountant and really genuinely she is working in the organization in which Virat Kohli has substantial interest, in that case, clubbing provision will not apply. Any income such as salary, commission, fees received by his or her spouse from a business where the individual has substantial interest has to be included. What is the substantial interest in a concern? If the concern is a company, in that case, if 20% or more of the voting power is with a person, it is called as a substantial interest. In all other cases, minimum 20% or more of the profit share, if any person is having, that will be called as a substantial interest in the organization. However, clubbing does not apply if the spouse earns income on her or his own professional skills. Now, the next one, income arising to spouse from asset transferred without adequate consideration. The first example I took, where Virat Kohli transfers his asset to Anushka Sharma without any consideration or for inadequate consideration. In that case, clubbing provisions will apply. If one spouse transfers to another without adequate consideration, except in cases of separation, if Virat Kohli and Anushka Sharma plans to get separated, in that case, if asset is transferred to Anushka Sharma, then in that case the clubbing provision will not apply. Any income from the asset will be included in transferor spouse's total income. If an individual transfers a house property without adequate consideration, the transferor is still the owner, considered the owner, and the property's income is taxed in the hands of transferor's hand. Income arising on transferred assets alone have to be clubbed. Income earned from reinvesting the income cannot be clubbed. Let's say, for example, out of the rental income, whatever Anushka got, she has invested that income in some shares and got some dividend income. That dividend income cannot be clubbed in Virat Kohli's hand. Only that rental income which she fetched from the asset can only be clubbed. The next point is, if assets are transferred to spouse or invested in business. Let's say, for example, Virat Kohli gifts some money to Anushka, and that money she invests in some business. If any profit is earned out of that business, or even if interest on that capital contribution is received by Anushka, even those will be clubbed. If asset is transferred to spouse or invested in business, the income from such investment, including interest from capital contribution, will be included in transferor's income. How much of the PGBP income will be clubbed, sir? Income from business, if you multiply with the amount gifted by assessee, means amount gifted by Virat Kohli divided by opening capital of business on first day of previous year. If you do this, what is that amount which has to be clubbed in Virat Kohli's hand? You can know that much will be taxed in the hands of Virat Kohli. Transfer of assets for the benefit of spouse. If you transfer the asset for the benefit of spouse to someone, and if any benefit is received by Anushka, still that will be clubbed. So the next thing is clubbing of income arising to son's wife. If a mother-in-law or father-in-law transfers an asset without adequate consideration, or without any consideration to daughter-in-law, in that case, if any income is generated out of that asset, in that case, that will be clubbed in the hands of a mother-in-law or a father-in-law. Next thing is clubbing of minor's income. If the child of a parent earns some income out of his or her own talent, in that case clubbing will not happen. Let's say, for example, the child participates in some national TV program, some competition, and earns some money, prize money. That kind of a money will not be clubbed in the parent's hand, because it is earned by way of his or her own talent. But otherwise, let's say, for example, if the parents transfers any property to the children without any consideration, or even if without a inadequate consideration, in that case, if any income is generated out of the asset, that income will be clubbed in the hands of parent. Sir, in which parent the income has to be clubbed? That parent whose income is higher, in that parent's hand the income will be clubbed. If the parents are divorced, the parent who takes care or maintains the child, in that parent's hand the income will be clubbed. But keep in mind one thing: whenever you are clubbing a minor child's income in the hands of parents, exemption to the parent up to 1,500 will be provided. Let's say, for example, if the child is a disabled person, under section 80 you see disability, we had discussed in the chapter of deductions. So if a child is a 80U disabled children, and if he receives any compensation from the government, that income cannot be clubbed in a parent's hand. So let's look at these points. All income of a minor is to be included in the income of his or her parents. Manual work, if out of manual work or skill or talent, that should not be included. Parents income whose total income is higher, in that parents hands it will be clubbed. If once a minor's income is clubbed with one parent, it won't be included in other parents in future unless the AO wants to change. So if you start clubbing the income in one parent's hand, then you should keep continuing in that same parent's hand only. If parents are separated, then whoever maintains the child, in that person's hand it will be clubbed. If a minor child has a disability of 80U, then it will not be clubbed. Clubbing provisions are attracted even in respect of a minor married daughter also. Exemption, as I told you already, 1,500 will be given. If a house property is transferred, then in that case clubbing will happen. Now, cross transfer. What is this, sir? See, if Virat Kohli transfers a asset to Anushka Sharma without consideration, then clubbing is getting attracted. Let's say, for example, Virat Kohli has a own brother, and that brother is also married to his spouse. So there are four parties: Virat Kohli, Anushka Sharma, wife and husband, Virat Kohli's own brother, and the brother's wife. So these are the four parties. Now, if Virat Kohli transfers asset to Anushka Sharma, clipping is happening. But if Virat Kohli transfers asset to brother's wife, clubbing will not happen. No. So what Virat Kohli will do? They will get into one agreement. See, boss, he will tell to his brother. Virat Kohli will tell to his brother. See, if I directly transfer her to Anushka Sharma, clubbing provisions are getting attracted. Income is getting taxed in my hand. We will do one thing. You transfer the asset to my wife. I will transfer my asset to your wife. So income you only take. My property's income I will take. Your property's income you take. But on papers it should look like they are only earning income, so that they can claim rebate. If that kind of a cross transfer transaction happens, then also it will get taxed. Let's see one example. Mr. X gifted 12 lakhs to brother's wife, Mrs. Y, and his brother Mr. Y gifted 8 lakhs to Mrs. X. Mr. X's wife, gifted amount deposited in bank at the rate of 9%. So if the gifted amount transferred to, if the gifted amount is deposited in bank for interest, then the interest income is getting generated. No, that interest income will be clubbed in those transferor's hands. But here you one very important point. Clubbing would apply only to the extent of cross transfer of gift. In above example, 8 lakhs is the cross transfer. See, Mr. X gifted 12 lakhs and Mr. Y gifted 8 lakhs. So how much is cross transfer happened? 8 lakhs only. Are you getting this? So Mr. X gifted to Mrs. Y and Mrs. X got a gift from Mr. Y. Whatever interest 48,000 is there no on 8 lakh rupees, that will get clubbed. Conversion of self-acquired property into property of HUF. Let's say for example, one of the members of HUF wants to convert his own property into HUF's property. He want to get his individual name's property into HUF's name property. In that case also, clubbing provisions will apply. Next, very important point, boss. Income only we are discussing so far. Income, not only just income. Even if a loss is generated out of the transferred asset, even that will be clubbed in the hands of a transferor. Not just income. Even if a loss is generated out of the transferor asset, even that can be clubbed in the hands of transferor. Okay, thank you. Next comes advance tax. Very simple, boss. Advance tax means during the financial year itself, you have to assume how much your total income will be and you have to make a tax payment in installments. You need not wait for the last month to end and then pay tax at the end of the year. Are you getting this? So advance tax means during the financial year in which you will earn income, every quarter you will assume or you will estimate your total tax liability for the year, and in installments you will pay tax, which is called as advance tax. How much you have to pay tax? And this advance tax concept applies only if you think that or you estimate that your total tax liability for the year is going to be more than 10,000. If your total tax liability for the year is less than 10,000, you need not pay any advance tax. Advance tax means tax paid in the previous year in which the income is earned. How to estimate? Method of calculation, very important. Step 1, estimate the current year income. You have to estimate how much income you are roughly going to earn in this year. Step 2, compute advance tax liability on estimated income. How to compute, sir? If you are individual, apply the slab rates. Are you getting this? And you can consider any TDS already deducted by any person. Applicability, applicable only if advance tax liability is 10,000 or more. Note, in the case of a senior citizen who is not doing any business, in that case, no need to pay any advance tax. How much to pay, sir? To 15th of Jan, I told you quarterly you have to pay advance tax. To 15th of June, you have to pay at least 15% of total advance tax liability. 15th of September, 45%, 15th of December, 75%, and 15th of March, by 15th of March, 100% of the advance tax liability means your estimated tax liability has to be fully paid. If the assessee opts for presumptive basis of taxation, PGBP, remember 44 AD, minimum 8%, 6% of the gross receipts he has to pay tax. In that case, 100% of the advance tax liability shall be paid before 15 March. Means if you are paying, if you are opting for 44 AD optional, what do you call presumptive taxation under 44 AD or ADA or AE, in that case you have to pay advance tax only in a one shot on 15th of March. You need not pay in 4 equal installments. Any tax paid till 31st of March previous year will be considered as advance tax only. Simply to put, during the previous year in which you earned income, you paid any kind of tax, that will be called as advance tax only. Whatever income tax you will pay after the previous year in the assessment year before filing your return of income will be called as the self-assessment tax. Next, delayed payment interest 234A, 234B, 234C. There are 3 sections, boss. 234A says you have to pay interest if you have delayed filing your tax return. Means, let's say for example, your return of filing, your due date of filing return of income is 31st July, for example. But you filed return of income in the month of December. Then by how many months you delayed? August, September, October, November, December, 5 months. For these 5 months, you have to pay interest at the rate of 1% per month. On what amount, sir? On the total tax liability which was pending payable with the tax return. Let's say for example, in the tax return 10,000 tax was outstanding payable, then on that 10,000 into 1% into 5 months you will pay interest under section 234A. Interest on delay in filing of return of income. Formula for interest computation: unpaid tax as per return of income into rate of interest into period. Unpaid tax is what, sir? Remaining tax liability as per return of income after deducting all the TDS, TCS, whatever reliefs you have. Rate of interest is 1% per month from the date after the due date of filing return of income till the date of actually filing return of income. You have to pay interest under the section 234A. Next interest is 234B. Let's say, for example, the advance tax which you paid during the previous year is less than 90% of the total tax liability of the year. Assessed tax means first you paid the advance tax, then the return of income was processed and they will assess some tax under the normal processing of a tax return. At that time, whatever assessed tax is there, that will be compared with how much advance tax you paid. If you paid more than 90% of the assessed tax, then there is no interest under 234B. If the advance tax what you paid is less than 90% of the assessed tax, what assessed tax means, that tax which you finally you paid a tax on. Advance tax you pay on estimated income. Assessed tax is on the actual income. Are you getting that? Formula: advance tax short paid. Short paid means how much a difference. Rate of interest period. Advance tax short paid means what, sir? Assessed tax minus advance tax already paid. On the difference you have to pay interest at the rate of 1% per month. From when I have to calculate interest, sir? From 1st April of the assessment year till the actual date of payment of that short tax. Note: interest not applicable if assessee paid minimum of 90% of advance tax payable. 234C. See, advance tax I told you 14%, 15%, 45%, 75%, 100% of the advance tax liability you have to pay in 4 equal installments, no quarterly. If you have delayed those advance tax payments, then interest under section 234C will be levied. Interest payable for deferment of advance tax payments. How, sir? Deferred amount into rate of interest into period. How much is the deferred amount, sir? Deferred amount is given in this column. 15% of tax you are required to pay. 15, 45, 75, 100. Remember that advance tax table. Less advance tax paid till that date. So whatever difference will be there will be what? That advance tax which you did not pay. You were supposed to pay 15% of advance tax liability, but you did not pay. In that case, interest will be levied. First 3 columns, if you see, it is given 3 months. Last month it is given only 1 month. Why? Because last month, if you remember the last installment of advance tax, the date given is by 15th March you have to pay the last installment. So from 15th March only till 31st March you have to pay interest. No. So that 15 days is treated as 1 month and you have to pay interest. Now there is one important note. If the advance tax paid by the assessee on the current income on or before 15th June and 15th September is not less than 12% and 36%, in that case there is no need of interest. Means in these 2 installments, boss, if you had paid minimum 12% here, minimum 36% here, you are required to pay 15% and 45%, but you paid 12% minimum and 36% minimum in the second installment, then interest will not be levied. Next, fees for a delay in a default in furnishing TDS returns. Let's say, for example, you belatedly filed the TDS returns. In that case, 200 per day will be levied as a penalty or a fees, you can say, for delay in filing TDS TCS returns. But mind you, the total fee which you are supposed to pay should not exceed the TDS amount. 234F will be levied if you file your tax return, income tax return belatedly. How much, sir? If the income which you offered in the tax return is up to 5 lakhs, 1000 rupees you will pay as a delayed fees. If you have a paid, if your total income is exceeding 5 lakh rupees, in that case you have to pay fees of 5000 rupees. And one more provision, recently Modi told you have to link your Aadhaar with PAN. If you don't link, in that case 1000 penalty. Now currently 1000 rupees is the penalty. You have to pay penalty and then link the PAN and Aadhaar. Okay guys, this ends up our discussion Hi guys, let's begin our discussion on the next topic, which is deductions from gross total income. First question is, what is gross total income? Gross total income is nothing but the sum of incomes from all five heads of income. What five heads of income we have? Income from salaries, income from house property, PGBP, capital gains, and income from other source. All these individual incomes, if we put together, if we sum up all these incomes, we arrive at something called as gross total income. Gross total income. From this gross total income, an assessee is eligible for claiming deduction under Chapter 6A. Chapter 6A, right from Section 80C till 80 QQB RRB, he can claim deductions. Lot of deductions are given under Chapter 6A. What happens by claiming this deduction? By claiming this deduction, he can reduce his taxable income. So whatever gross total income is there, from that if chapter 6A deductions are reduced, that will become your total income or taxable income. So your income tax is finally calculated on this total income, on this total income. Now there are few important points to be noted here. This chapter 6A deduction is not eligible against special incomes like 112A, 112, 111A, under special winning incomes and all. Are you getting this? So deductions you cannot claim against these special incomes. You cannot claim deduction under special income. So whenever you will take this GTI here, you will not include 112A income, 111A income, 112 income, other special incomes. So one more thing, this chapter 6A deductions cannot exceed your gross total income. Your chapter 6A deductions, all deductions put together, can never exceed your gross total income, because if it exceeds, then your total income will become negative. So maximum chapter 6A deduction you can claim is up to the maximum of gross total income. Is that clear? Let's get into the book now. So whatever we have discussed just now is written here. Deductions under chapter 6A are allowed from the gross total income to arrive at the total income or taxable income, on which you will compute your tax liability. Amount of deduction cannot exceed a gross total income. Deduction 6A is not allowed against 112A, 111A, 112 and special incomes. Unclaimed deductions cannot be carried forward to subsequent year. Means, let's say for example, your gross total income is 1 lakh. Your deductions total deductions are 1,20,000. But we just now discussed maximum deductions we can claim is how much? 1 lakh only. So that left out excess 20,000 deductions which are there, you cannot claim. You can neither carry forward to the next year. Now, very, very important. We know that in the case of individual HUF, AOP, POI, AJP and all, there are two kinds of tax regimes. What are the tax regimes? Optional tax regime and default tax regime. Now, keep in mind, very, very important point whenever you read deductions chapter. Number one point. Under optional tax regime, all kind of deductions are allowed. Under optional tax regime, all kind of deductions are allowed, but under default tax regime, only three deductions are allowed. What are those, sir? 80 CCD, 80 CCD2, 80 CCH2 and 80 JJAA. Under default tax regime, only these three deductions are allowed, boss. Rest all deductions are not allowed. So what is 80 CCD2? Employers contribution to national pension scheme, and 80 CCH2 is central government's contribution to Agnipath scheme, and 80 JJAA is deduction with respect of employment of new employees. These three deductions we will discuss in detail wherever it will come. Now, as I told you already, there are a lot of deductions, boss, under chapter 6A. The first deduction is under section 80C. Under section 80C, this deduction is specifically in respect of specified investments. So in order to claim the deduction under section 80C, you have to make some sort of investments. You have to spend some money. If you invested this money in this list of things which are given under section 80C, you can claim deduction. There is a huge list given. If you invest in any of these things, you can claim deduction under section 80C. First, let's see to whom it is applicable. So it is applicable for individual and HUF. It is applicable only for individual and HUF. HUF. Maximum deduction you can claim under this section is 1,50,000. Sir, 1,50,000 for each of the investment? No, boss. For all the investments what are given under 80C, for all the investments put together, maximum it is 1,50,000. What are these investments, sir? The first investment given is premium paid on life insurance. Premium paid on life insurance. Sir, is it only with the life insurance corporation, LIC corporation only? No, da. Any kind of insurer, even it is a HDFC insurance or ICICI Lombard insurance, any kind of insurance it can be. If you have taken an insurance policy, if you are paying premium for the insurance policy, in that case, that is eligible for deduction here. Sir, for whom the insurance should be taken? If you are an individual, you can take insurance for yourself, means individual, spouse, child, and child can be either minor or a major child. If you are a HUF, in that case, you can take the HUF can take policy for the members of HUF. Now, how much of premium which I am paying is allowable, sir? See, very simple, boss. If you have taken life insurance policy before 1/4/2012, in that case, maximum you can get up to premium of 20% of a sum assured. I repeat, if you have taken policy before 1/4/2012, in that case, the amount of deduction what you can claim under section 80C is actual premium which you are paying, or 20% of a sum assured, whichever is lower will be eligible for deduction under 80C. But if you have taken policy on or after 1/4/2012, in that case, actual premium paid or 10% of sum assured. Sum assured means what? How much of assurance is given by that policy. That. So if the person who is taking the policy is a person with the 80U or 80 DDP disability, and if the policy is taken after 1/4/2013, in that case, up to 15% of sum assured is eligible for deduction under section 80C. Premium paid towards a deferred annuity. Now, whatever we have seen is only LIC, life insurance premiums. There are other items also which are eligible for deduction under section 80C. Let's look at them quickly. Deferred annuity, if you have a deferred annuity premium, if you have paid anything, statutory contributions to statutory provident fund, recognized provident fund, public provident fund, if any of in these funds, if the contribution is made, that also is eligible for a deduction. Even for a public provident fund, the deduction, the contribution can be made for either individual spouse or child, or for any member of a HUF. If you have made contributions to superannuation fund, or if you have deposited any amount in Sukanya Samriddhi account. Sukanya Samriddhi account is for girl childs. If their parents wants to deposit some amount in this account, that is also eligible. If you have made any investments in the national savings certificates, if you have purchased any annuity plan of a LIC, if you have made some contribution in ULIPs. ULIP is what? Unit linked insurance plans. Or if you have purchased any notified mutual fund units or a unit trust of India units, or if you have made contribution to notified pension fund of a mutual fund or a UTI, or if you have made some term deposits, or if you are paying the tuition fees for your children, but maximum for 2 children it is allowed. Sir, what is a tuition fee? If any college fees, university fees, school fees, or other educational fee, if you are paying for your children, that is also eligible for deduction under section 80C. If you have repaid any loan, now interest on a housing loan is available under income from house property section 24 deduction, but here the principal repayment it is talking about. Okay, so repayment of housing loan principal borrowed from a employer or government or bank, from anywhere. If you have borrowed, if you are repaying the principal part of a loan for house, then it is allowable here. If you have subscribed or purchased to certain equity shares or debentures or mutual fund, that is also eligible. If you have put your money in 5-year term deposit or notified bonds or 5-year post office time deposit or senior citizen savings scheme or national pension scheme. So there are totally 20 items given, boss, right from LIC, first one which we discussed, till national pension scheme. 20 items, 20 options you have. Wherever you want, you can invest. But mind you, all these 20 items investments put together, the maximum deduction you can claim under section 80C will be 1,50,000. It is not for each item. Is it clear? Now, next one is 80CCC. 80CCC is for a pension fund of LIC. So, if you are making contribution in a pension fund maintained by a life insurance corporation or any other insurance corporation, in that case, maximum 1,50,000 you can claim deduction under section 80CCC. But this is also subject to CCE. One section is there. We will come to that. The next section is 80CCD. So deduction under 80CCD. This is also contribution to a pension fund only, but this pension fund is maintained by the central government. What we have discussed in 80CC, the pension fund was maintained by LIC, but here the pension fund is maintained by National Pension of Central Government. Are you getting this? Now, who is eligible here? Individual is eligible. Mind you, under 80CCD, there are three subsections. 80CCD has three subsections: 80CCD1, 80CCD1B, 80CCD2. 80CCD1, 80CCD1B, 80CCD2. See, in 80CCD, you can either be an employee or a self-employed person who is making contribution in this pension fund. And 80CCD1B also same, but it is in addition to 80CC1, you are getting additional benefit. So if you are already contributing in 80CCD1, in addition to whatever benefit you are getting in 80CCD1, you will, in addition to that, you will get a benefit under section 80CCD1B also. 80CCD2 is generally for the employer's contribution. 80CCD1 is for employee or self-employed person who are making contributions. And 80CCD1B is in addition to 80CCC1. Are you getting this? Now let's have a look at this. 80CCD1, if you are an employee, in that case, lower of actual contribution or 10% of salary will be given as a deduction under 80CCD1. If you are a self-employed person, in that case, lower of actual contribution or 20% of gross total income is eligible for deduction. Now your doubt will be, sir, what is the salary, sir? What is salary? Salary is nothing but the basic plus dearness allowance in terms. Are you getting this? Next. As I already told you, 80CCD1B is in addition to 80CCD1. How much, sir? Additional deduction of 50,000 other than 80CCD1 you will get. How does this work? Let's take one example. If assessee's national pension scheme contribution is 1,40,000, for example, and the gross total income is 5,50,000. Why they are giving gross total income? Because I told you 80CCD1 is applicable for self-employed also. So self-employed will not have salary. No, he will have what? Gross total income. See here, 20% of GTIE is eligible. Yes or no? So his gross total income is 5,50,000. He made contribution for 80CCD enough of 1,40,000. Then what is the eligible amount which he can claim deduction? 20% of maximum 20% of GTI means 20% of 5,50,000 is how much? 20% of 5,50,000 is 1,10,000. So 1,10,000 he can claim under 80CCD1. And I told you, in addition to 80CCD1, you can claim another 50,000 under section what? 80CCD1B. Yes or no? So 20% of 5,50,000 is 110 here. Another 50,000 if he can get from 80CCD1B, then total eligible is how much for him? 1,60,000. But how much he has made contribution? 1,40,000. Means up to the extent of 1,40,000 he can claim deduction. But first he can claim deduction of 1,10,000 under 80CCD1 and remaining he can claim under 80CCD1B, or he can do ulta also. First 80CCD1B he can claim total 50,000 and then remaining he can claim 90,000 under 80CCD1. Is that clear? So 80CCD2, employer contribution by central government or state government or any other employer. So if employer makes a contribution, then automatically it will be taxed as salary in the hands of employee first, then he can claim deduction under chapter 6A. So how much deduction he will get, sir? Deduction if contribution is made by central government or state government, means the employee is a government employee, in that case up to 14% of salary under both the tax regime is eligible. But if the contribution is made by any other employer, so if the employee is employed by a private organization, in that case up to 10% of salary, if the employee is paying tax under optional tax regime, and up to 14% of salary if the employee is paying tax under the default tax regime. Now keep in mind one thing. If out of this national pension scheme, if the employee withdraws the amount at the time of closure of the national pension scheme account, in that case only 60% will be exempt and 40% will be taxable. Whereas if he withdraws a partial amount before the closure itself, in that case only 25% will be exempt, rest 75% will be taxable. Now there is a section called as 80CCE. There is one big twist here, boss. What is the twist, sir? Very simple. For section 80C, please keep in mind this thing. For section 80C, I told you maximum deduction available is 1,50,000. Yes or no? For again 80CCC, if you remember that pension scheme of a LIC, for that also we discussed that maximum deduction allowed is 1,50,000. And 80CCD1, we have just now seen that 20% of GTI or 10% of salary, whatever. All these three put together, now this section says that all these three sections put together, maximum I'll give 1,50,000. 80C, they told individually 1,50,000 is the maximum cap. 80CCC, the section told that 1,50,000 I will also give maximum cap. And 80CCD1 also has the different limits. But all these three sections put together, now 80CCE says that all these three sections put together, maximum you can get is 1,50,000. OP for you all. Okay. Okay. Next. There is a section called 80CCH. 80CCH is applicable in the case of Indian youth who are in the Indian Armed Forces, and if the government makes any contribution to the Agnipath scheme, in that case 100%, if the contribution made by government or a contribution made by that young person who is the employee, means that Agniveer, if he also contributes, in that case 100% is allowed as a deduction. Next comes the very important, which is 80D. See, under 80D you can claim deduction for four kinds of expenses, boss. One, medical insurance. If you take a health policy, health insurance policy. Central government health scheme, if you deposit some amount or contribute some amount in a central government health scheme. Preventive health checkup and medical treatment. So I repeat, there are four kinds of payments you can make in relation to your health. Number one, you can either take a health insurance policy. Number two, you can contribute in a central government health scheme. Number three, preventive health checkup you can go for. Preventive health checkup. And number four, treatment of a disease which is there. Out of these four expenses, three expenses are given here, and fourth expense, medical expenditure, is given here. Whenever you read this table, you have to read like this only. Whenever you will read this table, you read like this. Three expenses are given above, one expense is given here. What are these three above and one under, sir? Three out of three. First one is medical insurance premium, which I told you, central government health scheme contributions, and preventive health checkup. Here what is given is medical expenditure. We will look at it in a short while. Before that, for whom this 80D is available, sir? 80D is available for individual and HUF. And for whom these expenditures should be done, sir? For this medical insurance, central government health scheme, preventive health checkup, treatment, for whom? If you are an individual, in that case, yourself, spouse, parents, and dependent children only. Simply you can keep in mind, D means dependent children. Parents can be dependent or independent, no issues. In the case of HUF, any member of a HUF. So next one, mode of payment. Only if you make a payment other than a cash mode other than cash, in any of these four expenditures, then only you are eligible to claim deduction under 80D. Now we will look at, sir, what is the amount of deduction I can claim under section 80D? See, you need to bifurcate this 80D into three categories, boss. Number one, you are taking for yourself, for your spouse, for your dependent children. Parents are not allowed. For parents separately, they are giving one limit. For your family means what? Who? You, your spouse, and your dependent children. You are categorized as a family. Your parents are separate, and the HUF, for HUF again there is a separate limit. So first look at only this column, boss. Only this column. Okay. If you have a spent for medical insurance premium, central government health in scheme you have contributed, or for preventive health checkup if you have spent anything, all these put together, maximum you can get is 25,000 of a deduction. But let's say, for example, if you or your spouse or dependent children, any of these three people is a senior citizen, anyone, not everyone, any one of you or your spouse or dependent children is a senior citizen, in that case, another 25,000 will be added. Means if anyone is a senior citizen, this 25,000 cap will become 50,000 maximum cap it will become. Now, let's say, for example, in any of these three people, you don't have a health insurance policy. In any of these three people, you don't have a health insurance policy, then you can claim medical expenses. You can claim deduction of medical expenses. That medical expenses only for senior citizen it is available, which is maximum 50,000. I repeat, if you are taking a health insurance policy or central government contribution, contribution if you are making, or preventive health checkup if you have taken, generally the limit is 25,000. But any of these three people are senior citizen, in that case the cap will become 25,000 plus 25,000, which is maximum 50,000. But let's say, for example, any of these three, in any of these three, if a person is a senior citizen of 60 years or more, and if there is no insurance, in that case, you can claim something called as a medical expenditure, the actual medical expenditure for which you have spent money. In that case, maximum will be 50,000. Are you getting this? Next, if you are taking a policy for your parents, but for your parents, you cannot contribute for central government health scheme, it is not eligible. If you have taken preventive health checkup for your parents, separately another 25,000. So for your family 25,000, for your parents also 25,000 separately you will get. But if your parent, any of your parent is a senior citizen, there also 25,000 will become a 50,000. So another 25,000 in addition you will get. So if for your parents also, if they are a senior citizen and they don't have a health insurance policy, then they can claim they can claim deduction of a medical expenditure which is spent to the extent of maximum 50,000. In the case of a HUF, for the members of HUF, if the HUF has made payment for any of these expenses, maximum 25,000 is allowable. If any member is a senior citizen, in that case, another 25. So 25,000 is eligible. So 25 plus 25 will become 50,000. If the members do not have the insurance, in that case, whatever medical expenditure they are spending, that is eligible for deduction to the extent of maximum 50,000. Now, one thing you keep in mind: for medical expenses, preventive health checkup, insurance premium, even for contribution to central health scheme, even if you are a senior citizen, normal citizen, anything, full maximum deduction you will get is 50,000 only in each case, boss. Though it may look like here the 25 plus 25 plus 50, oh 1 lakh, no da. Full all these three put together, again maximum under A plus B. What is A plus B? I told you here A. This is all coming under A. This is B. Both A plus B, again it is telling 50,000. Generally in our mathematics, what we were taught, A plus B means what? 50 plus 50, it should be 1 lakh. But in income tax, 50 plus 50 is still 50 only. Are you getting this? So maximum you can get is 50,000 only. And for preventive health checkup, for you, your spouse, dependent children, parents, everyone put together, it should be maximum 5,000 only. For parents separately, 5,000 is not applicable. Are you getting this? Next. If you are paying lump sum premium of a health insurance premium, in that case, how will you how will you compute the deduction? Very simple, just to follow this formula. Lump sum premium, whatever you are paying, divided by total number of previous years of a policy tenure. If you want to understand, you can just have a look at this example. You will understand in a better way. Number of previous years you have to take. Now, the next one is 80DD. Dependent disabled person. For a dependent disabled person, you are taking care of a dependent disabled person. Are you getting it? Maintenance and medical treatment of a handicapped dependent disabled person, for whom it is available, resident individuals and HUF. Payment qualifying for deduction. Amount of medical treatment, training and rehabilitation of a dependent disabled person. Here the flat deduction is given. Even if you spend 10,000 rupees, 20,000 rupees, does not matter. Flat 75,000 if it is a normal disability for that person. If it is a severe disability, in that case 1,25,000 will be eligible for deduction. Sir, who is that dependent? You can just have a look at this table, you will understand. Next, see if any amount is received from that life insurance, from the insurance company at the time of death of that disabled person. In that case, whatever amount received by this person who was taking care of this disabled person will be taxable. If the amount is received while the person who is disabled is alive, then it is not taxable. TDB 80 Section 80 DDB, deduction in respect of medical treatment of a specified disease. Specified disease. If there is a specified disease for the eligible persons here, we will discuss that. In that case, if you are spending some money, flat deduction is given here. Resident individual and HUF, this is applicable. Payment qualifying medical expenses incurred for self or dependent person for treating specified disease or ailment. What is the deduction, sir? If you are spending a medical expenditure for normal person, in that case 40,000 or actual expense, whichever is lower, is eligible. If you are spending money for senior citizen, in that case maximum amount you can claim as deduction is 1 lakh rupees. Now who is a dependent, sir? You can again have a look at this table. Next one is 80U, means the assessee itself is a disabled person. In 80D, he was taking care of some other dependent disabled person. 80DDB, for specified diseases of a dependent person he is taking care of. But in 80U, the assessee himself is a handicapped person. In that case, flat deduction of 75,000 or 1,25,000 is given. If it is a normal disability, 75,000. Severe disability is more than 80% of disability. In that case, 1,25,000 is given as deduction. Next comes 80 Section 80E. 80E for education loan. If you have taken education loan for higher education means after class 12th, if you want to pursue some higher education, be it in India or outside India also, if you want to go and pursue some education, for that if you would have taken any loan, in that case whatever interest payments you make, that is eligible for deduction under Section 80E. There is no limit for amount of deduction which you can claim of interest. Mind you, only interest deduction is given. Principal deduction is not given under this section. It is available in the case of individual. How much is the qualifying? What is the payments qualifying, sir? Even pursued in India or abroad. Education which is pursued in India or abroad is eligible. Interest on loan, there is no limit. Interest, the loan should be taken from financial institution or approved charitable institution. Sir, I took loan from my friend, sir, that is not eligible. Now, who is a relative is given here. Higher education means after class 12th, as I told you. Period of deduction is very, very important. For how many years I will get this deduction, sir? First, in the first year in which you took loan plus 7 years succeeding. So first year of interest payment plus succeeding previous years. First year of interest payment, it says. Let's say for example, I took loan this year, but I started paying the interest in the next year. In that case, that interest deduction I can claim from the next year plus 7 further years. The next section is 80EE. See, in order to boost the real estate sector in the country, income tax department or the Indian government comes up with these kind of deductions. If this kind of deductions are given to public, they will take more loan and buy more property, so real estate sector can keep moving on. Under 80EE, interest on loan borrowed for acquisition of residential house property by an individual. Means very simple, boss. You have to buy a house by taking loan. Only if you take loan, then only it is eligible. That whatever interest you will pay on that loan, that interest amount is eligible for deduction here. If you are buying home from your own money, then there is no deduction. No, yes or no? Now who is eligible? Individual who has taken loan for acquisition of residential house property. Residential house property, it is not available if you have taken a land. Getting it? From any financial institution, you have to take the loan from financial institution only. You cannot take it from your friends. There are some conditions attached to it. The stamp duty value of the property which you are purchasing, the stamp duty value should be less than or equal to 50 lakhs. Means the house should be worth less than 50 lakhs. You cannot go and buy a bungalow. Okay, 50 lakhs worth. The maximum loan of sanctioned for this purpose is maximum 35 lakh rupees. So purchasing home worth of 50 lakhs and the maximum loan I should take is 35 lakh rupees. And there is one more condition: you should not own any residential house property at the time of buying this property. If you already own a house at the time of purchasing this property, then you cannot claim deduction on this interest. The loan should be sanctioned during 2016-17. So actually this section was introduced in 2016-17 so that they can boost the real estate sector in the country. So the period of benefit till the repayment of loan continues, you can claim the interest deduction. How much interest deduction I can claim, sir? Maximum 50,000 you can claim. Mind you, interest deduction for a house property, again we have under income from house property separately under section 24. Apart from that, this 50,000 is in addition to that. Next, 80EE. See, 80EE, the scheme was only during 16-17. Again, in order to boost the real estate sector, they came up again with a new scheme in 2019 to 2022. So, if you are purchasing a house between 1 April 2019 and 31st of March 2022, then also you can claim deduction under this if you are making payment of interest. But mind you, the same condition of not owning a house at the time of purchasing this property will apply here. Means at the time of purchasing the whole house under this section, you should not own any house. For whom this is applicable, sir? Individual who has taken loan for acquisition of residential house property. Same dialogue. SDV here is given is 45 lakhs. Their SDV given was what? 50 lakhs. Loan maximum of 35 lakhs. But here there is no limit of a loan maximum. Only SDV of the property should be up to 45 lakhs. The loan should be sanctioned between 1/4/2019 and 31st of March 2022. Should not own any residential house at the time and should not be eligible for a claiming deduction under 80AA. Automatically you will not be eligible under 80EEA, because if you are already taking a deduction under 80EE, then it means that you already have a house property now. Then automatically you are not satisfying this condition. Yes or no? Next. Till you make a repayment of loan, you can claim the interest deduction. The maximum interest deduction given here is 1,50,000. In the 80EE, the deduction given was only 50,000 rupees. This is again in addition to section 24 deduction. Next, double EB, 80EEB. You can remember like this. EB means electric bike. You can just remember like this. Interest payable on loan taken for purchase of electric vehicle. So if you are purchasing any electric vehicle and if you make payment of interest and if you take electric vehicle on a loan, if you have purchased the electric vehicle on loan and on that loan if you are making any interest payment, that interest payment is eligible for deduction, maximum 1,50,000. When should you purchase? Between 1/4/2019 and 31st March 2023. In order to boost the go greener in the country, means all the petrol vehicles should be vanished and only the electric vehicles should run. That is why this kind of schemes are run by the government. You should take loan from the financial institutions. For an electric vehicle you should take loan. Now comes 80G. So if you make any donation to these specified institutions, in that case you get deduction. Lot of times you see, generally it is seen that you go to some temple or charitable institution, you make donation, then you ask them, so is it eligible for 80G deduction, sir? Then we'll tell yes, we are registered under 12AA. So you will get that registered, you will get the deduction under section 80G. That 80G deduction we are talking about. So whenever you go temple, whenever you give donation, you ask them, sir, is it eligible for 80G deduction or not? Are you getting it? Now, so under 80G deduction, there are 4 categories, boss. Firstly, 2 major categories, then 2 minor categories. What are two major categories? Unlimited deductions and limited deductions. Unlimited category and limited category. Under unlimited category also there are two minors. 50% unlimited, 100% unlimited. Limited also there is 100% limited and 50% limited category. What is this, sir? Simple, boss. Unlimited category, no. How much ever you donate, out of that, if it is a 100% category, 100% of unlimited amount you can claim deduction. Let's say for example, I am donating 50 crore rupees. to a 100% category, in that case, full 50 crores, I can claim it as a deduction under Chapter 6A. Let's say, for example, I'm contributing, I'm donating, but I'm donating to a 50% category, unlimited category donation. In that case, let's say, for example, I donated 50 crores. In that, 50% only will be claimed as deduction, which is 25 crores. Unlimited means 100 crores also. If I deposit, if I donate under 50% category, then 100 crores, 50% is how much? 50 crores. So there is no limit. 1000 crores I can donate. But in limited category, there is a limit on how much amount you can donate. Are you getting this? Let's look at these things in a detailed manner. So this is applicable, very, very important. This is applicable for all SSCs, boss, even companies, individual, HUF, anyone. It is applicable for everyone. So as I told you already, there is an unlimited category, unlimited and limited category. Under unlimited category, again, you have 100% and 50%. Under unlimited category, you again have 100% and 50% of unlimited category. What are these eligible donations? Let's have a look. Under 100% unlimited category, national fund. So wherever you will see national, prime minister, chief minister, see here national, prime minister, Africa contribution, PM cares fund, again prime minister fund, national children's fund, under army central fund, chief minister fund. You have to just remember these things so that it is easy for you to recall in examination and apply. So Swachh Bharat Kosh, Clean Ganga Fund, PM Cares Fund, all these funds are eligible for 100% unlimited deduction. There is only one deduction which is available under 50% unlimited category, which is PM Drought Relief Fund. PM Drought Relief Fund. If you are donating to PM Drought Relief Fund, in that case, unlimited amount you can donate, but 50% of whatever donation you made will only be eligible for deduction. Then we have a limited category. Boss, limited category means you have they will cap or they will fix a amount up to which only you can make a donation. Out of that, they will take 100% and 50%. Let's have a look at this. In this, there are two categories again, as I told you, 50% and 100%. Under 100%, only two things are covered. If you are donating for a promotion of a family planning to some government or approved local authority or any other institutions, or donation by a company, if you are donating, that is not eligible. Only donation made by a company for the development of an Indian Olympic Association, for a development of sports or games, or sponsorship of sports or games, only these two are eligible for 100% limited category deduction. Whereas if you are making donation to public charitable trust, housing development authority, for renovation or repair of any temple, gurdwara or mosque, or a donation for promoting minority community, in these four cases, 50% limited category will be applicable. Let's look at what is this limited category, sir. How to compute unlimited category? Very easy. Whatever donation I will make, if it is 100% limited, 100% category, unlimited total amount I can claim deduction. But in the case of limited category, I should know what is the limit prescribed. Now, method of computation of eligible donation under limited category. We are looking at the eligible donation, which is eligible under limited category. So you have to compare two things. Whichever is lower will become your eligible deduction or a donation. 10% of adjusted total income and total actual donation under limited category which you made. When they say total actual donation, you will add both the 100% eligible deduction and 50% of a limited category donation. I repeat, when they say actual donation under limited category, you will add both 100% donation you made and 50% donation under limited category, whatever you made, you will take these two and compare it with 10% of adjusted total income. Now your question is, sir, what is adjusted total income? Very simple. Take the gross total income, but don't include 112A and 111A. Reduce all chapter 6A deductions except ATG. What you arrive at is adjusted total income. Take 10% of adjusted total income here. Take the total limited category donations you made, means total of only these two donations. What you made actually. Don't take these two again. Okay, only you have to consider what? Only you have to consider these two in these two categories. Whatever actual donations you made, you will consider and compare it with 10% of adjusted total income. Then you will arrive at that eligible donation under limited category. Are you getting this? Next, these donations should not be made in cash. Only maximum 2000 you can make in cash. Beyond 2000 you should definitely make in the prescribed modes or other than cash modes. Donation in kind is not eligible for deduction. Next one is 80GG. See, if you are an employed person, means you are an employee in an organization, you generally receive what? House rent allowance you receive. If you are residing in a rented house property, yes or no, you receive what? House rent allowance. But for a non-employee, let's say for example, I'm a self-employed. I'm not an employee in any organization. In those cases, this section will be applicable. 80GG, rent paid for residential house property. This is not applicable. This section deduction you cannot claim if you are receiving house rent allowance. You being an employee, you are an employee, but you did not receive any HRA from your employer. Then also you can claim here. Okay. This is he who has not received HRA and pays rent of a house. He can claim deduction. How much deduction, sir? Condition for availing deduction, the same dialogue. You should not own any house property. Quantum of deduction is very simple. You will compare three things. Whichever is lower will be your deduction. 5000 per month, actual rent paid minus 10% of adjusted total income and 25% of adjusted total income. What is adjusted total income, sir? Gross total income minus all deductions under chapter 6A except 80GG. See, wherever adjusted total income comes, no, generally you will see the same dialogue. Adjusted total income means first you take a GTI minus all deductions except the deduction for which you are computing the deduction for. It is like that only. Next, 80GGA, donation for scientific research and rural development. If you remember in PGBP, there is one section, section 35. There also you make donations to scientific research. That is why here it says if you are if you are a PGBP person, then this deduction is not eligible. Means if you are doing business, then you cannot claim deduction under this section. All assessee except assessee having income under PGBP head. How much the deduction, sir? 100% is allowed. Maximum 2000 you can make in cash. Other payment you have to make in other than cash modes. Then 80GGB, donation to political parties. 80GGC, donation to political parties. See, GGB is applicable in the case of companies. GGC is applicable for person other than company. If you make donation to any political party, full 100% is allowed, boss. But the only condition is you should not make a donation in other than you should not make donation in the form of cash. Maximum 2000 is allowed in cash. Now comes very important section, which is 80JJAA. See, in order to increase employment in the country, to promote employment in country, to remove the unemployment, to remove the unemployment in the country, this kind of schemes the income tax department gets. What is this scheme? You know, this scheme 80JJAA deduction is applicable only in case of a new entity which is creating employment or generating employment. If any entity generates employment, in that case, whatever payment or remuneration paid to the employees, on that amount 30% is eligible for deduction for this person who is creating this employment. Are you getting this? Let's have a look. SSC should be engaged in business. Of course, if you are in business, then only you will employ people, no? Mandatory to get books of accounts audited, boss. Business should not be formed by splitting up. I told you it should be a brand new business. How many years you will get deduction? You will get deduction for 3 years. So for 3 years, whatever new employment you generated in your business, for all these new employment, whatever money you pay to them no as a salaries, of that salary expenditure, another 30% extra you will get as deduction. Business is not acquired. Return of income is filed within due date. These are the conditions. Then how much of amount of deduction, sir? 30% of additional employee cost. Now, what is additional employee cost, sir? Let's say, for example, this is the first year you started your business. You employed 100 people. In the first year, you employed 100 people. So all 100 is new employees only, no, because you started business in this year only. So all 100 are new employed. Yes or no? So all these are additional employees. Yes or no? Because at the year start, it was zero. So you employed or you hired 100 people or 100 are new. So all 100 are eligible for generally eligible. Let's say, for example, they satisfy all the other conditions given. Then all 100 are eligible. Yes or no? In the next year, let's say, for example, out of 100, 40 left the organization. They left your organization and you joined another 40 people. Then you cannot say, sir, in the second year I generated 40 more employees. No, because overall the number is same only. No, out of 100, 40 went off, 40 came. Then where is the new employment generated? Nothing. So let's say, for example, in this example, out of 40, 40 left, but let's say, for example, 40 left, but came 60. 40 left the organization, new employees joined were 60. In that case, in the second year, how many employment you newly generated? 20 employees you generated. For them, whatever you pay emoluments, on that 30% will be eligible. Like this, you need to do for 3 years from the date you commence your business. Are you getting this? Now, 30% of additional employee cost deduction available for 3 consecutive years from the year of commencement. I hope that's clear. Now, what is additional employee cost, sir? Additional employee cost, because 30% of additional employee cost is eligible. No, what is additional employee cost? Total emoluments paid or payable to additional employees only, which I just now took example. In case of existing business, that is in second or third year, additional employee cost shall be nil if there is no increase in total number of employees. Whatever example I just now discussed. Emolument should be paid by account pay check, I means in the prescribed modes only. And I have given a beautiful example. Whatever example we have discussed just now, the similar example is given. You can read. In case of new business, emoluments paid to employees employed during the year shall be eligible. Of course, in case of a new business, in the first year, whatever employment you generate, fully it is eligible. No, because all employees are new only. Next, additional employees shall not include. You employed 100 people in the first year, but there may be a scenario out of these 100, there may be few employees who are ineligible. Why? Because they are not satisfying these conditions. If any new employee falls under this category, then he is not eligible, or whatever amount paid to him is not eligible for additional employee cost 30% deduction. Are you getting this? Who are these employees, or whoever is employee is falling under this category, that employee will not be treated as a new employee, though he is hired newly. But if he falls under this category, in that case, he is not treated as a new employee. What are these categories, sir? Employees whose emoluments is more than 25,000 per month. If the employee's salary is more than 25,000 per month, or whatever amount which is paid by the employer to this employee, new employee, if it is more than 25,000 per month, that employee cannot be treated as new employee. If the new employee stayed for less than 242 days only during the previous year, means within 240 days, 240 days, he left the employment, even in that case, that person is not treated as is not considered as new employee. If the employer is in the manufacture of apparel or footwear, in that case, if the employee leaves the employment within 150 days, less than 150 days, in that case, that employee is not a new employee. If the employee do not participate in the recognized provident fund, even that employee is not a new employee. If employee for whom the entire contribution is paid by government in the national pension scheme, in that case also, that employee will not be treated as new employee. So four things I told you. Number one, if the emoluments paid to the employee is more than 25,000, he is not considered as a new employee. If the employee left the organization within 240 days in the previous year, in that case, he is not treated as a new employee. If the employer is in the manufacturing business, in that manufacturing of apparel or footwear business in that case, or leather products in that case, if the employee left organization within 150 days, that employee is also not treated as new employee. If the employee does not participate in the recognized provident fund, he is not treated as a new employee. And if entire contribution for the employee is for the pension scheme, if the contribution is made by the government, he is also not treated as new employee. Rest employees, if they do not fall under this category, and if he is a newly employed person, additionally employed person, in that case, whatever amounts paid to them, 30% of that can be claimed by your employer. Next, 80QQB. This is an income based deduction. Whatever we have seen from 80C to 80JJAA, all are expenses. Expenses you have to deposit here, you have to spend that money. It was relating to that. Now what we are looking at is deduction in respect of certain incomes. 80QQB is the first income. Income of royalty on books. Let's say for example, you wrote a beautiful novel. Now you have to sell it off. Now there are royalty payments which you receive generally in the case of books and novels. And if you receive any kind of a royalty, in that case it is eligible only in the case of a resident individual. How much of deduction I can get, sir? So you wrote a novel, you got royalty amount. In that case, out of that royalty income, how much you can claim deduction is given here. See, in royalty on books, there are two categories, boss. One, you can get lump sum consideration. Lump sum royalty means one bulk amount they will give you. How much ever they sell outside, it is their profit. There is a second category. Depending on the number of books sold, you will keep on getting the royalty. So if you receive lump sum royalty, then actual amount received will become your eligible royalty. But if you receive other than a lump sum amount, in that case, maximum 15% of value of books sold will be eligible royalty received. Why are we looking at the eligible royalty? Because to order to get the deduction, you have to compare two things. One, eligible royalty received, and the maximum 3 lakhs, whichever is lower. So in order to compute this eligible royalty, if it is a lump sum, you will take actual amount received. If it is other than lump sum, maximum 15% of the books sold will be taken. Now, you have to keep in mind one point. If you have sold books outside India, or if you are receiving royalty from outside India, then you will be eligible to claim deduction only if you have got that money from outside India to within India within 6 months from the end of the financial year or the previous year. For claiming deduction of royalty earned outside India, such income must be brought into India into convertible foreign exchange within 6 months from the end of a previous year, in which within 6 months from the end of previous year, or within time allowed by RBI. Otherwise, the deduction is not allowed. Exactly the concept of 80QQB, there is a concept of 80RRB, deduction in respect of royalty on patent. Patent means what? You created some beautiful formula to create a product, that is called a patent. Okay. Resident individual, it is available for lower of royalty received and maximum 3 lakhs. The same dialogue of within 6 months, it is available here also. Next comes 80TTA. Let's say for example, you have a savings bank account with a bank. Then whatever amount balance is there in your savings bank account, on that the bank will pay you interest. No, that interest, to the extent of 10,000, it is eligible for deduction. 80TTB is applicable only in the case of senior citizens. If they deposit any kind of amount with the bank, and if the bank gives interest to the senior citizen up to income of 50,000 as interest, is eligible for deduction, maximum 50,000. Now, there is a concept called SEZ, deduction under section 10AA. Deduction under section 10AA. First of all, what is a SEZ? See, special economic zone is a zone where lot of manufacturing entities or lot of service providing entities are established. They only do exports. Very limited they do domestic sale, boss. Maximum it is for export purpose only. Why export so much of boosting? Because more exports means more foreign exchange for the country. Are you getting this? Now, in order to boost this kind of entities, this deduction of a 10AA is given by the Indian government. What is it, sir? Very simple, boss. If you establish an entity in a SEZ either for manufacturing a product or for provision of any kind of services, in that case, for first 5 years, profit, export profit, whatever export profit you have, full 100% of the export profit is given as deduction. For next 5 years, means sixth year to 10th year, 50% of the export profit is given as a full deduction. 50% of the full export profit is given as deduction. For the next for the next 5 years, means from the 11th year to 15th year, you have to compare two things. How much amount you have allocated to SEZ reinvestment allowance reserve, and 50% of export profits, whichever is lower is eligible for deduction. Are you getting this? Are you getting this? Let's look at this. Eligible assessee engaged in the manufacturing of a product or provision of a service in SEZ only. SEZ unit received approval up to 31st of March 2020 and started its operation before 31st of March 2021. So this timeline you have to keep in mind. So you have got approval by 31st of March 2020 maximum, but you are given one more year extra to start the operations, that is up to 31st March 2021. Plant and machinery in the SEZ business shall be brand new, boss. Maximum 20 can be, 20% can be second hand. Plant and machinery imported will be treated as new. Are you getting this? 44AB tax audit is very mandatory and return should be filed within the due date prescribed. How much of deduction, sir? Just now I explained you 100% in the first 5 years, 100% of export profit. In the next 5 years, 50% of export profits. In the next 5 years, lower of these two things will be given. What is export profit, sir? Export profit means total profit into export turnover by total turnover. Very logical, noda. Total profit of SEZ you take, multiply by export turnover divided by total turnover. Sir, my total turnover, export turnover, sir, then your total profit, export profit. Come on. Next, export profit means that proceeds of exports brought into India and convertible foreign exchange within 6 months. So in royalty also you have to bring back that amount which you are receivable amounts, whatever are there in the from the foreign country, you have to receive within 6 months from the end of the previous years. There are a few important points. Let's have a look at them relating to 10AA only. SEZ reinvestment reserve, whatever you are creating, no, here SEZ reinvestment allowance reserve, this should be utilized within 3 years for purchase of a new plant and machinery. Shall be utilized for acquiring new plant and machinery and shall be put to use within 3 years from the end of a previous year. Now, let's say for example, this dialogue, what is there? No, within 6 months you have to bring back the money from foreign. If money is not brought back to India, but there is one separate account created in outside India and amount is deposited there with the approval of RBI, then it will be deemed that you have got that money and you will get this deduction. If the amount of realized export turnover has been credited to a separate account maintained by assessee outside India with the approval of RBI, the sale proceeds are deemed to have been received in India. Now, what does this total turnover and export turnover include, sir? Total turnover shall not include freight, telecommunication charges, insurance, expense for providing services outside India. Are you getting this? So total turnover, whenever you will take for this formula, you will not include these items given here. And the total turnover shall also not include any cash compensatory support, duty drawbacks, profit on sale of import entitlement license, or any ancillary profits of business. Total turnover includes export turnover, domestic turnover, further includes even that portion of export turnover which has not been received in a convertible exchange. Are you getting it? Next. Deduction shall be claimed after claiming deductions. All chapter 6 deductions and gross total income. From gross total income, after claiming all chapter 6 deduction, you will claim 10AA deduction. Is it clear? Next, the last concept is alternate minimum tax. See, alternate minimum tax is applicable in case of all assessees except companies, boss. It is applicable in case of all companies. Number one. Okay, except company, all assessees it is applicable. Number one condition. Number two, alternate minimum tax is not applicable under default tax regime. It is only applicable under optional tax regime. Getting it? So all associates except company and under the default tax regime, it is not applicable. Are you getting this? I'm sorry, here only it is written. Only under optional tax regime, this is applicable. The third condition, this alternate minimum tax is applicable only if you are claiming deduction under 10AA, 35AD, 80JJAA, QQB, and 80RRB. I repeat, this 8 alternate minimum tax concept is applicable only if you are claiming deductions under 80JJAA, 35AD, 10AA, 80QQB, and 80RRB. Only if you claim these deductions, then only you will apply AMT concept. Now, what is AMT, sir? You have to compare two kind of taxes. Number one, income tax payable as per normal provisions of Act and 18% of adjusted total income. This 18.5% is the AMT tax rate. Alternate minimum tax rate is 18.5%. On what you will apply is adjusted total income. Again, here also adjusted total income we have to compute separately. Are you getting this? So what you compare is two things. Number one, tax as per the normal tax rates and 18.5% of the adjusted total income. Why are we doing this thing? Why are we doing this? Because see boss, whenever you claim these deductions, 80JJAA, 35AD and all, almost because of this you will be paying very less taxes. In order to ensure that you have to pay minimum this much of tax, this alternate minimum tax is paid. Only if you are claiming, see, 35AD and all huge capital expenditure you will spend, and if you claim that as expenditure, your profit will drastically come down. You will hardly pay any tax to the government. So, in order to ensure that at least this much this much tax has to be paid by the assessee, in order to ensure that the government says, boss, I will apply a concept of alternate minimum tax and I will check at least you are paying this much of tax. So you will compare these two. Of course, whichever is higher will be paid as a will be called as a alternate minimum tax. Now, what is adjusted total income, sir? Total income as per the normal provisions of the Act you will take after claiming all the deductions and all. Total income means what? GTI minus chapter 60 deductions. That is what is called as total income. That you will take. Then you will add back whatever deductions you took already under chapter 6A. 10AA, 35AD, 80JJAA, 80QQB, 80RRB. All these deductions again you will add back. Now logically think, 35AD, if you remember that section, in 35AD it is clearly mentioned. If you are claiming 100% deduction under 35AD, then depreciation on the capital asset will not be allowed, it was written. Now, if 35AD, if you disallowed, then I am now eligible for deduction for depreciation or not. That is why here, less depreciation under section 32, assuming deduction under section 35AD is not allowed. Are you getting the logic why we are reducing depreciation here? So if you reduce that, you will arrive at something called as adjusted total income. That adjusted total income, on that you will compute 18.5%. You will compare it with the tax as per the normal provisions of Act. Whichever is higher will become alternate minimum tax. Now let's say for example, whatever adjusted total income you computed is less than or equal to 20 lakh rupees, then you need not compute adjusted total income or alternate minimum tax. I repeat, if the adjusted total income whatever you computed here, if it is up to 20 lakh rupees, then in that case you need not compute the alternate minimum tax, where it is given, sir, AMT not applicable if adjusted total income is up to 20 lakhs in the case of individual HUF, AOP, BOI, AJP, etc. Are you getting this point? Are you getting this point? Yes or no? Next, how AMT works? Let's say for example, this year, as per the normal provisions of the Act, I am liable to pay tax of normal provisions of the Act. I am liable to pay tax of 10,000 for example. When I computed the alternate minimum tax by following all the procedure which we just now discussed, let's say for example, I am arriving at 13,000 tax payable. Now, normally I am required to pay 10,000, but my alternate minimum tax is you have to pay 13,000. Then what tax I will pay? Of course, higher of these two, no, I will pay, which is 13,000 I have to pay. So if I pay 13,000, how much excess I am paying? 3,000 I am paying. No, 10,000 minus 13,000. 3,000 will be called as AMT credit, alternate minimum tax credit. This credit I can carry forward to the next years, and I can set off in such year when I am paying a tax of normal tax more than the alternate minimum tax. Are you getting this? I repeat, whatever excess I paid this 3000, I can carry forward to the future years, and I can set off this 3000 in the year in which my normal tax will be more than my alternate minimum tax. That's what is given here. If alternate minimum tax is more than the normal tax, then excess shall be treated as AMT credit. AMT credit can be carried forward and set off for 15 years. I can carry forward, boss. Credit can be set off in the year in which regular tax is more than alternate minimum. Is it absolutely clear? Okay, guys, let's wrap the session of deductions from gross total income.